out any more volatility going forward in the market. But, there's a lot lined up on the show. Let's get started.
Absolutely. Let's get started, and we'll get started with the top headlines for today, and starting with Wall Street, because that ended sharply lower, with Dow ending over 800 points in the red. S&P 500 and the Nasdaq also saw a sharp cut as Treasury yields jumped. President Trump's tax bill and earnings from retailers weigh on the sentiments.
Stocks in the Asia-Pacific region also opened lower, mirroring Wall Street's moves. The GIFT Nifty is indicating a weak start for the Indian market.
Oil prices ease after Oman's foreign minister said a fresh round of nuclear talks between Iran and the United States would take place later this week. Meanwhile, a weaker dollar and geopolitical uncertainties push gold to a one-week high.
IndusInd Bank reports a net loss of over 2,300 crore rupees, a first in FY26 on a clean slate without carrying forward any of the past issues.
And in key earnings today to watch out for, numbers from ITC where 4 to 5% growth is expected in cigarette volumes. In other important earnings, Sun Pharma's Q4 revenue is expected to grow at 9%. Also keep an eye on the numbers from Grasim. On that note, let's look at how the Asian markets have opened up this morning. Doesn't seem like the handover is good. So Asian markets also seem like they've opened up in the red as well. Taiwan index is down 0.6%. We're seeing that the Hang Seng, that's down 0.5% as well. So Asian markets have opened up muted. Shanghai is trading quite flat. Just a slight bit of a positive bias, 0.03% is what I checked the last time. Let's look at the Nifty implied open. Yesterday, we did close 0.5% higher in terms of the Nifty. Today, as of now, is indicating a 54-point decline. So that will be interesting to watch out for where the market is headed. Do not forget there is Nifty expiry as well. A lot of earnings that we're seeing, the last leg of earnings that we'll be seeing coming in as well, Vamakshi. But as of now, negative bias is what is indicated for the Nifty, and a red start is what we're watching.
Well, absolutely. When the handover that came in from Wall Street was also not quite promising. We saw a rise in the Treasury yields on the deficit concerns. And, in the US market, Wall Street ended largely lower. The Dow Jones slid more than 800 points, while the S&P 500 finished the day 1.6% low, and the Nasdaq lost almost 270 points. CNBC's Peepa Stevens gets us a wrap of all the action on Wall Street.
U.S. markets saw a steep decline on Wednesday amid pressure from a spike in Treasury yields as traders grew worried the new U.S. budget bill could put even more stress on the country's already large deficit. The Dow falling 817 points, the S&P slipping 96 points, and the tech-heavy Nasdaq shedding 270 points. OpenAI said on Wednesday it is buying artificial intelligence devices from Johnny Ive's startup I.O. for $6.4 billion. In the statement, OpenAI said the legendary former Apple designer will take on creative and design responsibilities across the company, while his creative collective, called Loveform, will stay independent. I've had a hand in Apple's most iconic products, including the iPod, iPhone, iPad, and MacBook Air. The purchase is OpenAI's largest by far, and it comes a week after the company agreed to buy AI-assisted coding tool Windsurf for $3 billion. And demand for mortgages in the U.S. dropped in the past week as interest rates jumped to their highest level since February. The average rate on a 30-year fixed loan increased to 6.92%. The Mortgage Bankers Association says investors are concerned about rising inflation and the impact of higher deficits and debt. Applications to refinance a home loan also fell, as rates are now nearly the same as they were a year ago. That's what's happening here in the U.S. Back to you in Mumbai.
Thank you so much for that. But let's also listen to Kate Moore, CIO at Citi Wealth, talking about the U.S. market and how the tariffs affect the economy.
When you look at the aggregate earnings revision ratios, they're pretty low, many more cuts than there were upgrades. At the same time, the only places you were seeing upgrades were in tech and comms. And that's what I'm really talking about, is that most of the earnings are coming from these really concentrated places, and yet the entire market was rallying as if we're going into an expansion. We've been past this point of maximum tariff shock, but not anywhere close past the point of tariff pain. In fact, we haven't even really felt it yet. So, yeah, we've had this incredible round trip in terms of risk assets. People have been more sanctioned. sanguine, they put risk back on. But that wasn't broad-based, right? We saw some segments of the investment community stay more on the sidelines or hold their allocations. And frankly, at City Wealth, we've been on that camp too, where we've been more neutral equities, rotating into the higher quality parts of the equity market.
So that's all the global market action that we have for you this morning. But how is all this going to be impacting our Indian markets? We have a team of research here to set you up for trade, tell you which are the important stocks to watch out for, as well as the cues in the world of F&O. First up, we'll go across to Vivek, who's waiting by to tell us what are we watching out for today, given that it's expiry day today. What are the cues coming in, Vivek? Good morning.
Well, good morning. This Thursday, it's expiry day as well. Like you rightly mentioned, kind of cues that we are working with are slightly muted, given the kind of sell-off that you've been highlighting since the start of the show as far as the US markets are concerned. The spike in treasury yields and the low demand over there is something that equity markets got quite spooked by. Now, coming to the oil markets, oil markets too fell. In fact, Brent yesterday was down a little over 0.5%, now hovering around the $65 a barrel mark. Now, coming to Indian markets, remember day before yesterday, especially in the last hour and a half of the trading session, saw significant selling pressure. But yesterday, the markets managed to recoup most of the losses that they saw in yesterday's, day before yesterday's trading session. And in fact, all of the indices managed to trade with strong gains and managed to end the day with strong gains, which was also quite important. Now, when you're looking at the advanced decline ratio, the advanced decline ratio was firmly in favor of the bulls or in favor of the gainers, and that is something that the market as well as the bulls will take quite a lot of heart from. What recovered and what did well? Well, the entire pharma pack, defense stocks, railway stocks, and also capital goods, especially some of the capital goods named like Siemens, Cummins, were among the top gainers in yesterday's trading session. Whole host of results reactions coming by: ONGC, Colgate, Tech Wabag, some of the names that will react to results today. If Nifty, Asian markets all indicating a muted start for our markets today.
Well, thank you so much for that, Vivek. Now over to Upasna, who will list out the stocks to watch out for in today's trading session. Good morning, Upasna.
Good morning, Vamakshi. First up, let me start with IndusInd Bank. The company has reported a weak quarter this time around. The net losses stand as high as 2,328 crore versus a profit of 2,349 crore. When we talk about NII, it is down about 43%, and asset quality has also worsened from 2.25% to 3.3% in terms of the GNPA ratio of the bank. Now, coming to Mankind Pharma, the revenue growth was largely in line, led by domestic and export market. Revenue up 27%, margins stood at 22% versus 24% on a YoY basis. Interglobe Aviation is the another stock on our counter. The profits were mainly aided by the operational performance of the company. Net profit up 62% and revenue up 24% on a YoY basis. Colgate will also be in focus as the profit is down 6.5%, revenue down about 2%. Weak set of numbers, certainly. Margin at 34% versus 35.7% on a YoY basis. Now, Nalco will also be in focus as companies perform solid performance from both the segments, that is alumina and aluminium. The revenue saw a sharp growth of 47% on a YoY basis. Even PAT saw a growth of 47% at 1,470 crore. ONGC will also be in focus. The company has reported higher revenue as compared to the poll, and the higher exploratory cost boosted the earnings of the company. Now, profit was down 22% sequentially and revenue was up 4% sequentially. RVNL will also be in focus. The net profit was down 4%, but revenue was also down about 4.3%. Margins stand stable at 6.7% with a downtick of just about 10 basis points on a YoY basis. NBCC will also be in focus on the back of the order win. The company bags order worth 162 crore from Power Finance Corp. And lastly, Hindustan Zinc will also be in focus as the company gets an LOI for a block in Andhra Pradesh. So all in all, these are the stocks that we'll be watching out for today.
Okay, thank you so much for that, Upasna. Keep an eye out on all the stocks. But what is going to be happening in the world of F&O, I beg your pardon. Mangalam is here to give us those details. Good morning, Mangalam.
Good morning. So, yesterday was a move towards equilibrium for the market. Why do I say that? Because previous Thursday, the big up move that we saw, and, 2 days ago, the big down move that we saw in the last hour of trade were both on the extreme side. The range for the Nifty is 24,600 to 25,000 itself. And that exactly what played out yesterday as well. We came back to moderate zones for our market. The high and the low on the Nifty yesterday tells you the broad range that the street should be working with. The good part, the FIs came back to buying after 10,000 crores of selling the previous trading session. 2,200 crore worth cash purchase. The DIIs topped it up with another 700 crores as well. In index futures, there was a mild purchase by the FIs, 201 crores. They added about 500 long contracts, covered 600 short contracts. and as a result of which their long exposure over the last couple of trading sessions stays steady at 37%, though the net contracts have come down on the short side by about 1,000 contracts at 37,500. The put-call ratio, which was again at an extreme of 0.69, has now moderated back again to 0.81, and that brings us to the important levels that we are watching out for today. 24,900 call shed some open interest, and we saw 24,800 put shed some open interest as well, or add some contracts. So the broad range that the option writers are positioned for today in terms of expiry would be 24,700 to 2550 on the Nifty. For the Nifty bank, it is the 20-day moving average which moves as an important fulcrum as a support. The stocks that I'm watching out for, Titagar, we had spoken about, it entering F&O ban at midday yesterday, and that has happened. It's re-entered F&O ban after exiting it yesterday itself. And then a bunch of stocks which will be excluded from F&O trading come August series include the likes of Aarti Industries, Hindustan Copper, which has been in the ban for a very long time, Birlasoft, MGL and Piramal Enterprises. These are stocks that come out of F&O trading from August series 2025.
Well, thank you so much for that, Mangalam. Let's slip into a short break now. Up next, we get you a review of IndusInd Bank's Q4 numbers. Don't go anywhere. Stay tuned. Welcome back. You're watching Power Breakfast on CNBC TV18. IndusInd Bank is the one that is in focus. The company reported its Q4 earnings. We now have Abhishek joining us with the fine print. Not a great set this time around, Abhishek.
It's the worst result in the banking sector that you have seen in Q4 FY25 across various parameters. Now, what's exactly gone wrong? Not only is the P&L under stress, but take a look at the corporate book that's declined more than 15% on a sequential basis, and that's not an easy factor to build in back again. So it will be a tough road ahead for them with respect to if they intend to build the corporate portfolio. The NII decline of more than 43% YOY and about 42% sequentially is the highest decline that you are seeing in the banking sector. The net interest margin is the lowest ever for them, coming in at 2.25% versus 3.93% in the previous quarter. Now, other income is one of the lowest on a quarterly basis in last 39 quarters. Other income was down 71.7% YOY and about close to 70% sequentially, the highest decline that they have ever seen. This is the only bank to report an operating loss in Q4 FY25. So highest net loss in the banking sector as well, coming in at more than 2,300 crores for Q4 FY25 in the banking sector. Slippages were really elevated at more than 5,000 crore versus 2,200 crores. So the annualized slippage ratio is one of the highest that you are seeing in last 16 quarters, coming in at 5.8% versus 2.4% in the previous quarter, largely led by the MFI or the microfinance portfolio. Gross NPA ratio is the highest in last 10 years or even more, coming in at 3.13% versus 2.25%. Net NPA ratio is the highest in 21 quarters, coming in at 0.95% versus 0.68% in the previous quarter. The risk weight to advances ratio, that's increased massively, and it's at the highest in last 11 quarters, coming in at close to 121.6% when compared to 114.6% in the previous quarter. And the bank has used entire contingent provision of 1,325 crore in this quarter. So the P&L, massive miss on our poll, both on the NII front as well as the loss front. Back to you.
Okay, thank you so much for that, Abhishek. But following the earnings call, the bank's chairman, Sunil Mehta, addressed the media about the bank's recent discrepancies seen in its books and what steps the bank plans to take to rectify them. Listen in.
Based on review of all these matters and reports received by the board suspects the occurrence of fraud against the bank and the involvement therein of certain employees, having a significant role in the accounting and financial reporting of the bank. Accordingly, the bank has directed necessary steps to be taken under applicable law, including reporting to regulatory authorities and investigative agencies, and to also fix accountability of all persons responsible for these lapses. The financial impact of all the above has been fully taken in the audited financial statements of the bank for the financial year 2024-25. The bank's approach towards financials has been to start FY 25-26 on a clean slate without carrying forward any of the past issues. The bank has thoroughly reviewed all the lines of accounting and has taken a conservative view in some of the accounting treatments. Following the findings of external review announced on 27th of April 2025, the bank's CEO and Deputy CEO had resigned from their respective roles thereafter. The RBI has advised the bank to submit proposals for appointment of the new CEO for RBI's approval by 30th June 2025. The board is at an advanced stage in the selection process and is confident that the recommendations will be submitted to the RBI in advance of the timeline prescribed.
Well, on that note, let's slip into a very short break. Up next, we get you cues from the commodities market. Stay tuned.
Welcome back. You're watching Power Breakfast on CNBC-TV18. Now let's move on and now getting you the latest on Trump-related developments. We have Dia joining in with us in our special segment, Trump Watch.
Starting off with a striking statement from US President Donald Trump that is making headlines this morning. President Trump once again repeated his claim that he settled the recent conflict between India and Pakistan through trade. This was during his White House meeting with South African President. Let's listen to what he said.
If you take a look at what we just did with Pakistan and India, we settled that whole thing, and I think I settled it through trade. We're doing a big deal with India, we're doing a big deal with Pakistan, and I said, what are you guys doing? You know, somebody had to be the last one to shoot. But the shooting was getting worse and worse, bigger and bigger, deeper and deeper into the countries. Pakistan has got some excellent people and some really good, a great leader. And India is my friend, Modi. And he's a
mutual friend.
Yeah, he's a great guy. And I called them both, and we just did something good.
President Trump on Tuesday said his massive tax package is close to being finalized, having notched a deal over the state and local tax deduction. But the White House is yet to win over a faction of conservatives who want more austere spending cuts. House Republican leaders are also reportedly planning to accelerate new Medicaid work requirements to December 2026 in a deal with ultra-conservatives on the tax bill. Turning to tech policy, the Trump administration will maintain efforts to keep advanced artificial intelligence technology out of China's hands, a top White House official said, brushing off calls from NVIDIA Chief Executive Officer Jensen Huang to ease restrictions on chip exports to the world's second-largest economy. Meanwhile, the Trump administration has asked the U.S. Supreme Court to halt a judge's order that would force it to answer questions from a watchdog group and turn over documents about Elon Musk's Department of Government Efficiency in a fight over public access to the office's records. Now, lastly, the Defense Department formally accepted a luxury Boeing 747-8 jumbo jet from Qatar to temporarily serve as the new Air Force One for President Donald Trump, one of the biggest foreign gifts ever given to the U.S. government. Now that's all for today. Back to you.
Well, thank you so much for that, Dia. But moving on then, Manisha Gupta is now joining us with all the updates from the world of commodities. Good morning, Manisha.
Morning, and thank you for that. Well, when it comes to commodities, we've seen stronger gains overnight, especially when it comes to the precious metal as a space. You have gold prices now trading at around 1 week highs. The soft U.S. dollar, safe haven demand, economic and geopolitical uncertainty, all of that seems to be supporting prices. Not just gold, silver is trading at a 3-week high. There's a strong buying from China and European Union for silver for the solar industry that has been supportive. And then we're also looking at copper prices holding rebound. HRC steel prices are trading at a 4-week high. The best of the gains, though, have continued for platinum. That one is trading at a 51-week high, and we've seen prices gain up by 13% in the past month. The only area that I see a bit of a decline working in is the crude oil prices. The U.S. crude inventories have increased. We've also seen a sell-off in the U.S. equity markets, and that weighs onto the markets. But the headline today clearly comes in from Bitcoin. It's up 15% in May until now and trading at an all-time highs above $110,000.
Okay, Manisha, thank you so much for that. All-time high levels coming in for Bitcoin. We'll keep an eye out on that. But let's move on. And Delhi has witnessed intense thunderstorm last evening that impacted flight operations, metro services, caused traffic snarls, as well as uprooted trees and damaged vehicles. Power outages were also reported as electricity lines were also impacted. The metro services were affected too, as the heavy wind and debris damaged the overhead wires and tracks. While airlines also faced major stumbling block with 12 flights being diverted to Jaipur and 1 to Mumbai.
Well, in another news flow, an Indigo flight going from Delhi to Srinagar with more than 250 passengers on board experienced strong turbulence as it navigated through an unexpected hailstorm that damaged a small portion of the aircraft yesterday. In a press statement issued, the flight and cabin crew followed established protocol and landed safely in Srinagar. The aircraft would also be released post necessary inspection and maintenance.
And with that, we'll wind down this edition of Power Breakfast on CNBC TV18. Thank you so much from Mamakshi, myself, as well as the team who put this show together. But don't go anywhere. Up next, your Bazaar Morning Call to take you through all the market action.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. It's a rainy morning here in Mumbai. It's a Thursday morning and it's leaking a little bit as far as markets are concerned. So US markets taking a bit of a dive last night. So I think that's got to be the number one talking point. And it's not driven by equities. It's driven by what's happened in bond markets. I'm Prashant. With me, my colleagues Nigel and Rima is with us today. Guys, morning.
Hi, morning. That's the big theme, right? Bond vigilantes have woken up and they've pushed the yields much higher, 5% plus on the 30-year.
Well, we got plenty of market action to talk about, but just for a minute, wanted to focus on the IPL yesterday. Mumbai Indians qualifying for the playoffs. I was very, very happy. I was at the stadium with my kids and my wife, and
no wonder your voice is gone.
That unbeaten record continues. Whenever I've gone to the stadium, Mumbai Indians has won. So I would like to think that I'm the good luck charm. So, but what a win. What a win. The boys are on top of it. Played a little slow at the start of batting, finished it with a flourish, and then came in and knocked off all the 10 wickets. So good and pumped up, but we've got the markets to talk about.
Absolutely, and let's hope that the market also is able to turn the corner at some point, because the start is, of course, going to be slightly lower. So let's take it from the top, right, in terms of what you need to know as we begin this session. I'll start with, of course, just the price changes on the equity side. The S&P down about 1.6%, the Nasdaq down about 1.5%, and the Russell 2000 down 3%. So that's the overnight cuts across Wall Street that we saw. Now, straight away across the US yield curve, the 5, 10, 30, the 5-year was up about 8 basis points, the 10-year 11 basis points, and the 30-year hit 5.08. Actually, I think at one point it hit about 5.09. It was up 12 basis points on the 30-year. And this is essentially what led to equities coming under pressure. So there was a 20-year auction, which was weak. I think it was the total quantum was about $16 billion or so, but it was a 20-year bond, and it was in a way underfunded, undersubscribed. I mean, it was quite weak, and that essentially raised risks of, once again, the fact that the bond market, what has been described by many, maybe a little extreme, as a buyer's strike. That the U.S. fiscal situation is bad, and people essentially want to be careful about not committing too much, and they want to diversify away from U.S. assets, bonds, of course, in this particular case. And I already kind of outlined the reaction. Yields shot up, people demanding much more to come in into U.S. bonds. That's the point. The 10-year, by the way, if you just look at what's happened since the beginning of May, it's up 47 basis points. It was on the 1st of May, it was 4.12. And now it's 4.59. That's 47 basis points in May so far. The question, as we always ask, is at what level do bond yields start to hurt equities? The simple answer, of course, is the psychological 5% number. If the 10-year goes to 5, I mean, I think expect a bit of a sell-off, etc. But I think it's now also widely acknowledged that it's not just the level on the yield, I mean, on the 30 or the 10 or the 5 or the 2 for that matter. It's the pace of the move and, how fast bond yields move. And in that sense, we're already up in short order, 47 basis points. And if you do more, I mean, just the pace itself, and you don't necessarily need to get to 5%, I mean, can start to hurt and start to do real damage as far as equities are concerned. So keep this in mind. By the way, it's interesting. What did we start this week, Monday, with? We started with that S&P downgrade. We started with news that on Sunday that Trump's that one big beautiful spending bill has passed. So in a way, you can, I mean, if you want, you can read this as a bond market warning to not overspending. I mean, Trump and team have been promising to contract the fisc, not expand the fisc. But as the latest bill shows, I mean, there is no contraction, there is expansion. This latest bill, by some estimates, will add over $3 trillion to deficit by 2034. So there is no contraction. And, all of this, of course, needs to be seen in that particular context. Now, just to look at some of the other things, dollar index was down about 0.5. Oil prices were down about 1%. There was also some inventory data, apart from, of course, what happened. Otherwise, precious metals were strong. Gold, it had, it had swung down to about 3,100. It's back at about 3,300. Bitcoin briefly hit a fresh all-time high. That's broadly the picture that you want to pay attention to. Now, just to circle back and look at the levels here, important to look at levels on the downside. I mean, yesterday the market did a little bit, 0.5% or so, but not on a very strong and sure footing. It kept sort of waxing and waning through the course of the day. The 20-day moving average at 24,150 will be the important downside level on the Nifty from here. We are at about 24,800. So there is some distance to go. On the upside, 25,116 is the level to take out for the Nifty, for the market to pick up some momentum. Nifty Bank is close slightly above the 20-day moving average yesterday, but it's just a little confusing. I mean, how much should you read into it? It's only marginally higher above it. So the swing low on the downside at 54,690 is the important level to watch. And then the other downside levels, if this swing low goes, is 54,031, which is the lower Bollinger Band, and the 40-day exponential moving average, which is 53,505. So these are some levels and some indicators, etc. GIFT Nifty will come up on your screen, and I think it will give you a sense of how we start. It's about 65 odd points lower at this point in time. Rima.
Hi. So Asia is also paying attention to the rise in the U.S. bond yield. So across the board, whether it's the Nikkei market, Kospi, they're paying attention, they've taken note, and they're tracking the losses on Wall Street. So 1% gone on Taiwan. Nikkei is also down 1%. Hang Seng is lower by nearly 0.5%. So that ripple effect is seen across all markets. In terms of flows yesterday, while we did clock in just a 0.5% gain, the FIs bought pretty okay. So 2,200 crore bought by the FIs in the cash market yesterday, while the DIIs net bought nearly 700 crores. So it's good to see both institutions buying in our market. So what's on the deck? Two big earnings. So one is IndusInd Bank, and they've reported worse than feared net loss of nearly 2,400 crore rupees. But Interglobe Aviation is flying in bright skies. So very strong domestic demand has driven a big profit of 3,000 crore rupees. So mixed bag. IndusInd Bank on the way down and Interglobe Aviation on the way up is what you need to watch. Earnings today: ITC, Sun Pharma and Grasim. You also have the Nifty weekly contracts expiry, so volatility could spike towards the close of trade. And today is also the record date for the demerger of the lifestyle business of Aditya Birla Fashion and Retail, ABFRL. So that's what I'm watching. Nigel, what about you?
Well, that's right. Let's take the top three cues that I'm looking at from the global perspective. It was a bit of risk-off that played out overnight. That's why you did see that gold prices did spike up overnight. And after seeing a bit of a dip, it's pulled back very, very swiftly. The problem for global equities is that the US bond yields, the 10-year in particular, that's moved up in a matter of a month when it moves from around 4% to around 4.6%. That's a reason to be a little bit cautious with regard to the global market scenario. However, the dollar index cooling off, it's good for emerging markets, India included as well, particularly with regard to the flows picture. And after selling, it's good to see that the FIs return back to the buying list. Now, the Nifty is going through a brief phase of consolidation. And in this phase of consolidation, the clients that were net short, they gradually turned net long. And now, in fact, they're building on those long positions. The last count we have, clients are net long with close to around 44,000 contracts on the long side. FIs, they're on the opposite end of the spectrum, not moved too much overnight. So I'm giving you the absolute number. They're net short by close to around 38,000 contracts. This is not such a bad combination as I've been saying for the last many days. What about the options data? That becomes extremely important because today is the weekly expiry. You had some put writing that we saw yesterday, and the close actually was quite strong. We'll give back some part of that, what we put on yesterday, but you had the 24,800 put, 24,700 put as well, both of them seeing a fair bit of open interest build up. And the PCR is at the lower end of the band at around 0.8 or thereabouts, which brings us to the level. Since you saw writing at around the 24,700 put, premium roughly around 70, 80 rupees or thereabouts. So you're looking at the 24,620 level, holding out at least for today's trading session. A little lower than that is where the 20 DMA comes in. That's around 24,500 or thereabouts. But for today, you don't want this level to get breached. If you want to get some confidence with regard to the up move, you like to see a higher high. And that's the level that I'm looking at. That's the high that the Nifty made yesterday, around 24,950 or thereabouts. Remember, we're facing resistance at around 25,100. But for today's trading session, that's the level I'm looking at. The Nifty Bank, that's going to be the swing factor. IndusInd Bank reported a weak set of numbers. It'll be interesting to see whether some of those flows start moving to the larger, better banks as well, which may not be such a bad case for the Nifty Bank on the whole. So the resistance that we have, ran into the last many trading sessions, on the upside, 56,000 odd. On the downside, you don't want this 54,500 odd mark. So we're going to start off in the red. Volatility picks up in the second half of the trade. But I think if we can get through a couple of hours of trade, maybe in fact the bulls will fancy their chances if in fact the 24,620 level does hold out.
All right, Nigel, thanks very much for that. So that's the levels and the futures and options data, which is important to track as well. Fu Kian Yap is senior investment strategist at Standard Chartered Bank. He's with us. Fu, good to have you here. This bond market scare, is this going to pass once again? Or it'll be with us for some time? And that question, right, at what level does it start to hurt? What's your sense?
Yeah, no, thanks for that. I think the bond levels, yeah, it has been going up. The yields have been climbing. I think, wind back a month ago, I think the market was looking at 3 or more than 3 rate cuts by the end of the year. And now I think a lot of things have changed. Obviously, market concerns have eased a bit. So we're looking at less Fed rate cuts. That's on the short end. And then on the long end, I think we've seen it climbing as well. Also affected a little bit by the view on how there's less Fed rate cuts affected. But obviously now the discussion about the fiscal spending and the tax package there affecting the longer end yield. I mean, our expectation actually is that the 10-year, it will move to 4 to 4.25% in the 12-month, 1-year time frame. That is our own view, because we do expect Fed rate cuts to come in later on to support growth as it slows down. But look, I mean, yields are going up at the moment. We see a lot of discussions going on in Congress, concerns obviously about the fiscal spending and how the fiscal deficit could unravel it in the US. But we look, I think a lot of this, I think, is within the control of the politicians and the Trump administration. We do believe he is sensitive to what the bond market tells him, so that they will be able to come into some kind of agreement. But I think, much longer term, we're looking at 20, 30 years, there are inflationary forces, if you like. But if we look at the 10-year and how the Fed is going to be reacting, I mean, we're looking at it coming down to 4 to 4.25%. I mean, to your question on when it starts to hurt, I think, yeah, I mean, it's hard to say, but we are still constructive on the equity market. Like I said, looking at a 12-month view at least, I think looking at the Fed coming in to support growth, we do expect yields to be coming down. And more importantly, we shifted the narrative very much from a trade war now into something else. But we think the trade war and how it affects recession is still going to be the key for equity markets.
But on the whole, yields inch lower to 4.2%, aided by a Fed rate cut, and U.S. equities is still very resilient and headed higher. So there's a new acronym, right? FOOC ABUSA. Anything but USA, challenging the entire exceptionalism. You're not in that camp to ditch America.
No, we're not. I think post-Liberation Day or 2nd April, when, the tariffs was shocking to the world, we saw a little bit of that when, the dollar weakened and yields going up, and we saw some rotation coming out of U.S. assets. And I think a lot of that was due to the tariff shock. And we did see the U.S. exceptionalism that's been going on for the last 10 years, perhaps, pause. We think that is a pause, actually. I think what happened in Geneva in terms of the agreement between U.S. and China, look, it came about very quickly. And it was better than expected. So we think actually that was a very significant moment in terms of the negotiations. We do see a bit of the Trump put in action there, that he's willing to support growth and support the market. So US exceptionalism, I think, took a pause, but we don't see that going away at the moment. But the US market is still a very big chunk of it. We think attractive growth is still there. AI is still there. It's still early days into AI spending and earnings growth. So as the trade war fades, we believe the investors can still refocus again on the AI trend. And it's still going on there. I mean, the spending is there. Companies are willing to invest. And that's going to be supportive for earnings growth in the US.
Okay, all right. Hi, Fook. Good morning. Good to see you. And, Fook, I think another way of tackling with Trump's tariffs is talking about a jet. Qatar did that with, gifting them the jet. And I think last night, the South African president as well was joking, I don't have a jet plane to give you. And he said it would be nice if you did have one. So interesting times. But talking about the global equities, I recall you saying that India was a market that you liked a couple of months ago. We've had a very, very good run. Post this run, where does India feature in your scheme of things from the global equity markets? And also, I think you said that you'll be a buyer at gold closer to around $3,000 an ounce. So you're positive on that. Where is it headed?
Yeah, thanks very much for that. I think, we do have a core holding view for India at the moment. Within Asia, our preferred market is still China. And India, I think the recovery has been very, very good. But the earnings revisions is still a bit negative for the month of May. I think it's less bad compared to April. I think April we saw much more negative earnings revision. May, it is still negative. So I think that is actually what keeps us cautious. India, as you know, very strong growth, but the valuations are quite high. So we think we really need earnings revision to turn positive to support the high valuations in the market. But look, I think structurally in the medium term, India continues to be a very attractive market for us. As I said, as a core holding, as what we tell our investors. Our preferred market is China, which I think the reasons are not new, but in terms of the valuation in there, it's attractive. Stimulus will be there to be supportive. And they have their own AI and technology developments as well. And the more recent news about the agreement in Geneva, I think is supportive of China. So I think to your question on gold, I think we do like gold. I think we have an overweight view on gold at the moment. Our 12-month target, 3,005. So yeah, we do see it as attractive to have in the portfolio to hedge against your recession and inflationary risk.
All right, Fook, thanks very much. Good speaking with you. Appreciate your time here on CNBC-TV18. Well, Rima, you want to just tell us, what is that?
ABUSA, anywhere but USA.
So
AB, USA.
USA is USA.
USA, and AB is
anything but.
Anything but USA. It's Newland. Well, we've had so many acronyms, right?
Yeah.
FANG, there was...
I heard, so US exceptionalism, US unexceptionalism. That's Abusa sounds better. We'll take a quick commercial break here. We're going to come back and tell you the interactions which are lined up. Actually, let's just do that quickly. Deepan Mehta at 8:30 will be talking stocks. 8:35. You have the IndusInd Bank performance in focus. Digant Haria will be with us to tell us how to read those numbers. We'll also have Hetal Dalal coming up on that. Tech Wabag management will join us at 9 o'clock to talk about numbers. 9:20, you'll have Gautam Shah on technicals. He's a market master today. 9:30, Uno Minda will be speaking with us about their numbers. Protean eGov speaking with us at 9:40 to talk about, of course, the entire ban issue that's been a setback for the company. 9:50, Gokaldas exports management runs us through the fourth quarter performance. 10 a.m. you'll hear from the Indigo management. Numbers have been super strong, and DLF management will be with us towards the end of the program. Stay tuned.
Time to slip into a break. We've got a lot of stock-specific action to track for you. Get to that in just a bit in our special Top 10 segment. For the time being, give you a sneak peek. Interglobe Aviation, ONGC, Nalco, Tech Wabag, all of them will be reacting to positive news flow, and you have more number of stocks actually reacting to negative news flow. The list goes on as IndusInd Bank, Oil India, Mankind Pharma, Colgate, RVNL, and Aircon. Slip into that break, come back, we'll get into further detail on all of these names.
Welcome back. Yesterday, markets eked out a gain of about 0.5%. The Nifty closed at 24,100. This morning, Asia's under pressure. GIFT Nifty is lower by 60 points, but lots and lots of individual stocks to track, whether it's IndusInd, Interglobe Aviation, ONGC. So let's straight away get to our top 10 segment of the day. And these are the stocks to watch with our entire research team. But top of the list is IndusInd Bank. Abhishek?
Well, worst result in the banking sector that I have seen in the last 10 years or even more from top to bottom across various parameters. So what's not worked for them? The corporate book decline is massive, more than 5.5% YOY and more than 15.5% sequentially. Now that's a tough one to swallow because it's tough to, grow the corporate portfolio again. NII decline of 43.3% YOY and 41.7% sequentially is the highest decline in the banking sector in Q4 FY25. Net interest margin is the lowest ever for them, coming in at 2.25% versus 3.9% in the previous quarter. Now, the other income is down more than 71% YOY and about 70% sequentially, the highest decline that you are seeing in the banking sector at a time when other income for others have grown robustly. This is the only bank which has reported an operating loss in Q4 FY25 and the highest net loss in the banking sector in Q4 FY25. Slippages are elevated in absolute value. They have grown by 115% quarter on quarter, and the annualized slippage ratio is the highest that you are seeing in last 16 quarters, coming in at 5.8% versus 2.4% in the previous quarter. Asset quality, the gross NPA ratio is one of the worst in 10 years or even more. It has inched up to 3.13% versus 2.25% in the previous quarter. The bank has used entire contingent provisions of 1,325 crore, so they have no more buffer with respect to making provisions henceforward. PNL, it's a huge miss on our poll, both on the NII front and the losses being way ahead of our poll. Back to you.
Thank you very much for that. We have a discussion lined up on the Q4 performance of IndusInd Bank. Digant Haria of Green Edge Wealth Services and Hetal Dalal of Institutional Investor Advisory Services will be with us.
Okay, all right. Well, let's talk about a good set of numbers then. Vinny joins us to tell us about Interglobe Aviation. Vinny?
Hi, good morning. So in terms of numbers from Interglobe Aviation, a very, very strong set of numbers coming in, beat on all fronts. So factors that are leading to this beat: one, the revenue per available seat kilometer, that's seen a sharp improvement. Foreign exchange gains is also there. So that is something supporting the profitability of the company. Now, profits, overall operational performance was also quite good. When you're talking about the revenue available per seat kilometer, that is also at 5.3 rupees. Yields at 5.32 rupees versus 5.2. Poll was around 5.3, so in line with expectations there. Q4 overall forex gain came in at 136 crores, which is aiding the profitability growth of around 60% as well. And there was a loss in the last year and last quarter as well in terms of forex loss. So there is a support coming in on that front as well. What is interesting now, overall Mahakumbh festivities supported the growth in terms of increase in number of flights, but the outlook for FY26, the management is saying in Q1 FY26 they expect a capacity growth guidance in mid-teens and maintain the early double-digit growth guidance for FY26. This is the highlight that we have coming in from the con call. So that will be key to watch out for, because maybe some bit of a subduedness we could see coming in terms of revenue, but overall Q4 strong performance.
The management also said that I think in April was fine in terms of demand, but May got impacted due to geopolitical tensions. So there were slower bookings in the month of May, which according to the management is behind them. So June should be okay. But May was a slower month for them.
All right, absolutely. And, you'll hear from Peter Elbers of Indigo at 10 o'clock this morning. ONGC and Oil India are the next in focus. Sud is here with details. Good morning.
Morning, Prashant. So factoring certain adjustment earnings for ONGC were largely in line with estimates. Exploratory costs have seen an increase of almost 3 times on a sequential basis because company has recognized travel well-off and it has recognized for the entire year in the Q4. That's the reason exploratory well costs were at rupees 4,173 crore versus 1,467 crore last quarter. Talking about the headline numbers, EBITDA was flat at rupees 19,000 crore. Margin was at 54.3% versus 56.5%, but it was higher against our estimate of around 52.8%. Talking about the operational details, crude realization was up 2%, crude sales have increased 1%, and gas sales were down 2%. I'm going with green for today, but considering the continued fall in crude, there might be a further decline in crude realization, so I won't be surprised if ONGC sees profit booking as well. For Oil India, I'm going with red. Other income has boosted profit, and profit was up 30%. Other income has increased by more than 250%. It has come at rupees 664 crore versus rupees 190 crore. Revenue has increased by 5%. EBITDA was down 7%, and margin has come at 35.9% versus 40.7%. And talking about the production, both crude and gas production have seen a fall of almost 3%. That's the reason I'm going with red.
Okay, all right, Sid. Thanks for that. Well, let's go back to Ekta. Ekta, tell us about Mankind Pharma. Numbers not too good?
Well, disappointing you'd have to say on the operational front. So revenue was up around 27%. Margins came in at 22% versus estimates of around 26% and a profit of around 400 plus crores, which was fine. But the domestic growth was strong, up 18%. Consumer healthcare up 14%. Exports did well as well. But the FY26 guidance was a bit disappointing as compared to consensus. So they have guided for domestic formulation growth of around 1.26 times. BSV revenue, which is one of the Bharat Serums and Vaccines acquisition, up 18 to 20%. Margins 25 to 26%. Macquarie said that FY26 guidance was below consensus estimates because they were working with estimates of 27% margins. They've guided for 25 to 26%. Expect the stock to probably be in the red today.
Thank you, Ekta, for that. It's over to Mangalam now for Colgate-Palmolive.
Well, it's a weak set that is coming from Colgate-Palmolive. No two ways about that. It was a tough environment. The companies reported a weak set where the revenues missed expectations. The EBITDA and net profit were largely in line with very muted expectations. So sub 500 crores for the EBITDA. The revenue was a miss at 1462 crores versus a street expectation of 1527 crores as well. Even if you don't look at what the estimates were and look at the numbers as they were reported, 1.8% decline in the revenue, 6.5% decline in the EBITDA. Margins were lower by 170 basis points and the net profit lower by 6.5% as well. The company said it was soft urban demand, but at the same time intensified competition that impacted their fourth quarter performance. So I saw a product being launched, a competitive product being launched by Unilever, and also a lot of these D2C players like Perfora, etc., are doing a lot better. So maybe they're losing some market share there. They anticipate continued near-term macro headwinds, and recovery, they say, is likely to be only gradual, and that too in the latter part of the year, which is the second half. So the next couple of quarters, the visibility remains low. The stock has been an underperformer, expected to continue to underperform.
All right, Mangalam, but what an outperformance last night from Mumbai Indians. Pumped up, isn't it?
All about Surya Kumar Yadav, the team. It was incredible, the way the team is steamrolling right now after a sputtering start. And on the other side, it was Delhi, which had a great start and then sputtered out of the competition. So all Mumbai Indians. Hail Mumbai Indians for now.
Well, that's right, Mangalam. And at the stadium, I met someone who was talking about chartbusters, and they said life is FMCG. I think you got it. You turned it around. It's FMCG is life. Thanks a lot for that, Mangalam. But from the FMCG basket, let's talk about metals. Nalco. The numbers are expected to be good, and boy, oh boy, those numbers were very, very good. So solid set of numbers out there. Top line growth of close to around 47%. The EBITDA number going up by 150%. And margins, on a year-on-year basis, it looks beautiful. But even on a quarter-to-quarter basis, from around 50%, it's expanded to around 54%. The important point was they got the benefit of higher prices, but also lower cost of power. And that's clearly depicted on the screen because the cost of power is a percentage of sales. That came down to around 16% or thereabouts. The profit number, well, that as well ballooned up by close to 47% because depreciation had a bit of a one-off in that. So that explains why the profit number as well was up 47%. Segmentally, things look very, very good, both on alumina, which is the chemicals business, and aluminium. So the stock opens up in the green. The problem is, are these the peak numbers? The key determinant will be what's going on in Guinea with regard to bauxite availability, because that's what's pushed up alumina prices. So stock opens up in the green, but we'll have to see how it does from there on. These numbers, though, blockbuster. Going back to Vinny, RVNL as well as IRCON, you're tracking both those two?
Absolutely. Keeping an eye out on both these names after the numbers. Not a great set of numbers coming in from both the companies. Firstly, RVNL, they're seeing a decline of around 4.3% in terms of revenue. The slow growth has continued through the year of FY25, so it's nothing different, but so muted performance overall for FY25 as well. Margins have remained largely flat, 6.73% versus 6.8% last year. So muted operating performance, slow growth, that is something in terms of the impact that we could see coming in on the stock as well. Execution is going to be key for the company going forward. As of now, expecting red for this one. IRCON International also expected to open up in the red. They're seeing a decline of around 10% in terms of revenues. Margins have seen a 100 basis point contraction. Overall weak operating performance. Other income is down by 11% as well. So that is something to keep an eye out on. Weak set of numbers from both the companies.
All right, Vinny, thank you very much for that. Tech Wabag is the next one. So interesting company, always lots of interest around this theme. Vivek is here, though, with the quarter numbers. Vivek, morning.
Well, good morning, and the management will be joining us later today. So quite a lot to ask about, but key among them will be what is the kind of order prospect pipeline that you're seeing, especially as far as the Middle East is concerned. But let's have a look at the Q4 numbers themselves. Revenues higher by 24%, so it's been a good execution as far as the end of the year is concerned. EBITDA higher by close to 22% on a year-on-year basis. EBITDA margins, that'll be the only blip as far as the performance is concerned, 12.2% versus 12.4, 20 basis point decline. And as far as the profitability is concerned, higher by 37.5%. At the end of FY25, the order book remains quite strong at 13,700 crore. FY25 order inflow of close to 5,700 crore. Remember, in FY25, the company did see a cancellation of a large order as far as Saudi is concerned. So replenishment of the order book is something that will be key to watch out for. The company also says they are the preferred bidder as far as projects are concerned of over 3,000 crore. So L1 status for projects over 3,000 crore. Amongst the key things to watch out for, remember FY25, the company has managed to grow top line towards the lower end of the guided range. So that will also be something that the street is looking out for. Strong Q4, that should keep the stock in the green today.
Thank you very much for that. And at 9 a.m., we will be joined by the management of Tech Wabag to discuss their Q4 performance. And here is a quick recap then of the top stocks. Stocks with positive news flow are Interglobe Aviation, ONGC, Nalco, Tech Wabag. Stocks with negative news flow are IndusInd Bank, Oil India, Mankind Pharma, Colgate Palmolive, RBNL and Ircon. Moving on then, equities are sinking, but Bitcoin is surging. Manisha is now joining in for a roundup of all the action from the world of commodities. Manisha.
Well, thank you for that. Since you mentioned about Bitcoin, well, yes, we have seen a very, very strong surge, 17% up for Bitcoin now for the month of May and 62% up in this year already. So we're looking at very strong gains. Well, support coming in from, risk on, the kind of liquidity that the street has right now. And of course, the kind of legislations and conversations that we hear from US has led to a lot of Bitcoin accumulation, not just from techies and enthusiasts, but also from companies and public companies and ETFs as well. Well, that's about Bitcoin, but we are also looking at good going when it comes to the precious metal space. Gold is trading at a 2-week high, silver at a 3-week high, platinum trading at a 51-week high, and it's a similar strength that has continued for base metals also. Aluminum is trading positive, copper is trading a percentage point higher, HRC steel is trading at a 4-week highs as well. So metals also doing good. The only area that hasn't done well in the Asian markets right now has been energy. The crude oil prices have gone in for some profit taking as the U.S. crude inventories have risen. And the markets will now watch out for the U.S.-Iran fifth round of nuclear talks. Well, that is scheduled on 23rd of May in Rome. That would give you further directions in this space.
All right, Manisha, thank you very much for that. What we're going to do is we're going to take a quick commercial break and we're going to come back with a discussion on IndusInd Bank. That's coming up. Digant Haria and Hetal Dalal will help us with that. Deepan Mehta, of course, will also be with us on IndusInd and more stuff. Stay tuned.
Welcome back. Hope you're having a good morning. Well, there'll be a lot of stocks in focus, and top of mind is going to be IndusInd Bank. In fact, IndusInd Bank's chairman Sunil Mehta addressed the media about the bank's recent discrepancies seen in the books and what steps the bank is plans to take to rectify this. Let's listen in to that soundbite.
Based on review of all these matters and reports received by the board suspects the occurrence of fraud against the bank and the involvement therein of certain employees having a significant role in the accounting and financial reporting of the bank. Accordingly, the bank has directed necessary steps to be taken under applicable law, including reporting to regulatory authorities and investigative agencies, and to also fix accountability of all persons responsible for these lapses. The financial impact of all the above has been fully taken in the audited financial statements of the bank for the financial year 2024-25. The bank's approach towards financials has been to start FY 25-26 on a clean slate without carrying forward any of the past issues. The bank has thoroughly reviewed all the lines of accounting and has taken a conservative view in some of the accounting treatments. Following the findings of external review announced on 27th of April 2025, the bank's CEO and Deputy CEO had resigned from their respective roles thereafter. The RBI has advised the bank to submit proposals for appointment of the new CEO for RBI's approval by 30th June 2025. The board is at an advanced stage in the selection process and is confident that the recommendations will be submitted to the RBI in advance of the timeline prescribed.
Okay, that's IndusInd Bank. And if you see the brokerage verdict, despite the stock being apparently okay in terms of valuation, 0.7 times price to book, we've had multiple downgrades. HSBC has downgraded the stock today. IFL Capital has downgraded IndusInd Bank. UBS is putting a target price of 600, so much lower than where the stock currently closed at 770. Let's, talk about the way forward. Digant Tharia, founder at Green Edge Wealth Services, and Hetal Dalal, president and COO at Institutional Investor Advisory Services, IIAS, are now with us on the show. And we also have Dipan Mehta joining in. Digant, the first question is, do you think this is a kitchen sinking kind of a quarter? And your thoughts on the Q4 performance. And it's going to be very hard, the recovery, the repair from here on. It's an uphill task to kind of get the investor and customer confidence back. Both, one, is this kitchen sinking? Is this it? The worst is now in terms of the numbers and the recovery from here.
Yeah, morning, Rima. See, whenever such things happen, we've seen like almost instances of 10 accounting lapses / frauds or whatever you want to call it. So it's not a one-off event that, the top management or the board would not be knowing and, it just happened somewhere, in the side cabin of some employees. It's not like that. I think the rot runs really deep. And see, this is not something that the management came out on its own. These were the findings when the RBI audit happened. So let's be very clear that, this is a tussle between, say, RBI and the bank management. We have seen such tussles in the past with, say, a Bandhan Bank or a RBL Bank. And RBI in India is extremely strict. They are very, very careful about the depositors' money. So they will clean up. They will clean up the bank. But it's a long-run process, as you said. More than a year or two will go. Difficult to trust them at this stage. But, because all these things have come out of an RBI audit, we know that, a lot of it is already been taken. From an investor's standpoint, I think it's a wait and watch. It's not an easy journey. So those are my opening comments, Rima.
Yeah, no, absolutely. Makes sense. Hetal is also with us. Hetal, good morning. First thoughts on this entire issue?
So look, it's not unexpected, right? The minute they announced the entire derivative accounting piece, and then there was this whole story around the microfinance book, and the fact that there is now a leadership vacuum and essentially a leadership change, would expect that the bank would take the big bath, so to speak, and clean up the books to the extent possible. I think there are significant failures around the chain, right, in terms of just the oversight, the internal audit, the statutory audit, and several layers of audits that banks go through. I think what is likely to now happen is you're likely to see a CEO coming in from the outside. That's more than likely because RBI is unlikely, given the fraud that the board has talked about. RBI is unlikely to sort of agree to an internal candidate. You're also going to see a significant review of internal processes and systems internally. It's going to slow down the bank. The bank is likely to be far more inward focused, at least for the next 1 year, till they are able to build the confidence back from depositors and investors and other stakeholders.
Digant, do the coming straight away to what happens next for our audience, a lot of whom would have IndusInd Bank or was sold or would be thinking what to do. You just look at what the stock has done. It's not fallen, even as many of these newer things have come out, right? If anything, I think over the last 1 month, it's up a little bit. So there is this expectation that, this, as Hetal said, the big bath and then the cleanup, and then some new person will come in and, he'll be able to really push this bank in a new, different, better direction. That's essentially equity investors for you. Of course, always hopeful. You've got to be hopeful. What is your sense, Digant, in that sense? What would you tell them?
Yeah, so Prashant, I think the news floating around was that along with a very, very disastrous set of results, maybe IndusInd would announce a very good private banker or, a team of private bankers as the new management. And I think that is what was building in this optimism that, like Hetal said, everybody knew that there is a fraud and there could be more frauds. But even then, stock price was not reflecting a lot of that because there was this optimism of private bankers coming and leading the bank out of this trouble and back to glory. I think that hope, they've not announced the candidate yet, which means that, probably RBI may want to put a candidate who will first be very tight and on the cleaning up side and then think about growth. So I think this whole expectation gets delayed by at least 6 to 12 months. So I think for shareholders, it's going to be a painful journey. Like stock will oscillate between 600 to 800. I don't think there is an existential issue or anything of that sort. So there is not a very big reason to panic because this is RBI intervention which is getting all these things done. But yeah, the quick buck, absolutely no, probably 10% lower, and then you will oscillate between hope and agony over the next 1 year. It's not an easy task. You look at Bandhan Bank, you look at RBL. It took at least a year to get to some strategy and some stability.
So basically the stock becomes a touch me not for the time being till we get clarity.
For long term, for investors, yes. For traders, probably it will be a delight, Nigel, that you can short, you can long, based on the news flow and the levels. But I think valuations are quite okay. And see, whenever problems with RBL, Bandhan, they don't go below 0.6, 0.7 times book because we know that RBI does not let the banks fail in India. And, if banks don't fail, they eventually, revive. That's the whole premise of this investing.
Okay, all right. Let's get in Deepan Mehta as well. Deepan, what's your view on IndusInd Bank? It's been a disappointment. I think in the past you have said you have been very disappointed. And I think there was some exposure as well out there. What do you do from here on? Hang on, sell out, look to average? What is it?
Yeah, good morning, Nigel, and thank you for having me on your show. I think the time to sell is gone, and we, like all other investors, are stuck in the stock. And we need to take a long-term view as usual because eventually these things will get sorted out. But what I like is the fact that as compared to a lot of other situations in the past, be it Bandhan, RBL, and we've had even Axis, ICICI, actually every single bank with the exception of HDFC has had some issue with spike in NPAs or a default or a fraud or something like that. And IndusInd Bank is no different. But they all come out of it, and I'm sure IndusInd Bank also will come out of it. But they are in a far more stronger position than any of the other stories in the past, be it RBL or Bandhan Bank or Axis or ICICI for that matter. Their NPA still remains there about 3% or so. They have a good tech platform, I would say pretty strong brand and distribution network. It's just that the top leadership needs to be changed, and someone who's more dynamic, at the same time understands the business better. If he takes over, then certainly the business can get turned around. And who knows, 3-4 years from now, the stock price can give very good returns from these points, from these levels, sorry.
On a lighter note, Deepan, maybe somebody not so dynamic.
Maybe somebody who's more conservative, but eventually I think, the business is such that it's a growing industry, and, IndusInd Bank can certainly recapture the lost ground and lost market share of the past year and a half or so.
Hetal, is this the first time the management has acknowledged of a fraud, of a suspected fraud? What was the prior communication from the management on the word fraud? And secondly, if the RBI appoints a nominee director on the board, what kind of signaling will it send to the investors?
Look, I think the management in the past has talked about the fact that there have been lapses and there are concerns around accounting, but this is the first time they really talked about it as a fraud, and fraud has very severe sort of implications in the banking system. And therefore, the kind of oversight and the kind of intervention that you'll now see given a fraud of this nature and this size is likely to be different from simply saying that there are accounting lapses. I think having a nominee of RBI on the board is par for course for a lot of banks, but this will therefore, if you actually have an RBI nominee on the board, it's going to show a lot more sort of signal a lot more severity of the problem, and RBI stronger oversight in ensuring that the cleanup actually happens. So if you have an RBI nominee on the board, it's actually good from a stakeholder perspective. And it will ensure to a very large degree that the RBI nominee is also there in terms of providing better oversight and control.
Digant, as you said, right, investors were hoping that a marquee private banker name gets announced as a CEO. If that comes through, because the deadline is 30th of June, if that comes through, would that be a buying opportunity?
I think, Rima, this will be, as I said, it will be a trader's delight, because see, we have seen this movie with Bandhan Bank and with RBL. So, just let me rephrase what this movie can look like. Maybe in the next 2 months, you get an announcement. If it's a private banker, the stock will go up. If it's a PSU banker, then we all know that, okay, it's a long journey towards the cleanup. And then, once a new MD, CEO and a new team is announced, they will fire the old ones. Then, some more process issues or accounting issues may come up, because, the new guy would want to come and say, hey, this is not something which I have done. So he'll probably clean up even more. So, the first announcement will give some hope. The stock may go up. Then the cleanup will say, oh, the problems are not over. Then the stock will come down. And then eventually things start stabilizing, and then we can see a secular journey. So I think 6 months, it's going to be a trader's delight, you buy, sell, whatever, based on the news flow. But I think within the next 1 year, for a long-term investor, probably zero returns is what we can expect for the next 1 year.
Net. After all the ups and downs, which, as Digant is saying, is likely. Thanks very much, Hetal and Digant, for that perspective and that quick take this morning. Appreciate it. Deepan, of course, stays with us because we'll address more names with him. We'll take a quick commercial break here. There's 12 minutes to go for market pre-open. Okay, welcome back. 10 minutes to go for the pre-open session. There's 70-point cut coming through on the gift Nifty sale. Sudarshan Sukhani is with us, and so is Shilpa Raut. Sudarshan and Shilpa, thanks very much for being with us here. Good morning. Sudarshan, you go first. Once again, it's a bit of a scare from US markets, but, we've had one dip earlier for 2 days this week, got bought into, as we saw yesterday. What is your sense, Sudarshan?
Yeah, good morning. See, my sense it changed. The view changed on Tuesday when an unexpected deep correction came about. That was the third day of that small consolidation, and the markets fell rather than go up. So yesterday, my sense was do not trade the Nifty. There is no clarity. Unfortunately, that view continues to remain. The Nifty, yes, we saw how volatile the market was, the index was yesterday, going down, going up, again coming down. That's not a tradable index today. My view continues to be the same. Uptrend that we saw has at least seen a significant pause. I don't think we should be looking to trade the Nifty. There is a single trade in the Nifty. If we see a sharp correction towards 24,600, that we can buy with a tight 24,500 stop. That's a 100-point stop approximately, or 120 point. Apart from that, if you don't see a correction, if you don't see anything else, don't trade the Nifty. Focus on stocks.
Okay, don't trade the Nifty. Only if you see a sharp pullback, then maybe in fact you want to take a buy call out there and keep a 100-point stop loss. Got that, Sudarshan. Shilpa, how are you feeling about the Nifty today? What are the levels you're looking at on the downside? And I think the gift Nifty is suggesting a 80-point downtick. Buy the dip or stay away?
Good morning, Nigel and everyone, and thank you for having me on the show. Talking about indices, we have been speaking on daily basis that 24,700 is going to act as a support. If we hold that, then we'll always see that sharp upside move of 100 to 150 points. Not 25,000, but 24,700 to 25,000 plays the range as long as we are not reaching either on the one side. But as of today's setup, I feel that, we might see a slip and we might see 24,500 levels coming as well. The data is somewhat little more on the bearish tone than, on a consolidation or any sort of bullish tone.
Okay, all right. Let's get to stocks then. Data towards the bearish tone. That's what Shilpa is saying. Shilpa, you go first. Stocks that we should be looking to trade today?
I have a sell on ABFRL. We saw, quite a meltdown yesterday, and the stock has closed below 270. So from here, I believe 245 to 250 levels, anywhere in between these levels can be the next targets. Keep a stop loss at 275, and this should be a sell. The other one would be a sell in JSW Steel. If it breaches 1,000 levels, then it is a breakdown where you will see levels of 970 to 960 coming. So in that case, keep a stop loss of 1,025 and stay on the sell side. The other one, I have one buy. The buy would be in Policy Bazaar. Policy Bazaar yesterday saw remarkable outperformance, and it is heading towards 1,800, I believe. So keep a stop loss of 1,695 and stay long in Policy Bazaar.
Yeah, no, absolutely. Sudarshan, what about you? What would you want to trade?
Well, it's a mix. Siemens is a buy. It's a stop under 3230. Tata Consumers is a buying opportunity. Stop under 1115. FMCG stocks are all giving buy signals. I'll just find, we don't know why, but maybe you know better. But M&M is an intraday short with a stop above 3150. And IDFC First Bank is another intraday short with a stop above 68. So it's a mixed bag.
Okay, no, it is a mixed bag, but I think kind of reflects the broader market view, which is a bit of lack of clarity at this point in time. Thanks very much, Shilpa and Sudarshan, for joining us. We'll speak again soon. We'll take a break. We are back. But there's the pre-open, of course, to look at. But we also have the management of Tech Wabag to talk about their fourth quarter performance and road ahead. Stay tuned.
Welcome back. In conversation with Dipan Mehta, awaiting the market opening. Dipan, a stock which was under severe pressure yesterday was Dixon. The numbers were underwhelming. What would the advice be?
Yeah, Rima, I think that it came below expectations, but if you didn't have much expectations, then the numbers were pretty decent. And it's a high growth company, and any misses are going to be punished like this. Valuations are also on the extremely rich side, but look, there are very few pockets of growth within the entire listed space. So we're going to see this kind of concentration of high valuation in a few counters. As investors of Dixon Technologies, we remain invested because the long-term story is pretty decent, and just because valuations are high doesn't merit a sell. But from a fresh investment perspective, I would just wait and watch and look for values to when the valuations compress. That's a good time to get into the stock. But I think next 3 to 6 months may be a bit challenging for Dixon Technologies. So I would just avoid for the time being, but certainly not a sell.
Do you or anyone in your team look at Protean eGov? What have you made of the numbers, the conference call?
No, I haven't seen the transcripts of the conference call, but of course, I think client concentrations are coming to the fore over here. And look, if the valuations were cheaper, it's one thing, but these are so richly valued stocks that any negative news flow is certainly going to have a very damaging effect on the stock price. And I think that that's something to consider at this point of time.
So from the numbers that came yesterday, and there are lots of them, you had Nalco, Tech Wabag, etc. Which one stood out for you?
Tech Wabag, and I'm looking forward to the interview with the management. And I think great set of numbers. What I like best is the fact that they have a nice diversified order book position. I think apart from L&T, this is the only EPC or engineering construction company which has got such a geographically diversified order book, which certainly improves the business model and also gives more predictability to the earnings. So looking forward, and stock is pretty reasonably valued. For disclosure, we and our clients are invested in it.
No, absolutely. It's although the high it was made at about almost $2,000 and stocks at about 1,410, and that's essentially what the valuation. And we'll of course have the management joining us in just a bit to run us through the numbers. So there you can see it. Mr. Sitaraman is ready to sort of join us. I think we'll just address the pre-open session and just look at what's happening in the pre-open as things kick off. I think it should be in the range of being 65, 70 points, and then we'll kind of move from there. So there you go. The first change, it is higher, but I think it expected to settle down as it always does. And I think we'll get a better sense of things. I mean, this week, like last few weeks, so big moves, large moves in terms of single stocks. I think, of course, this week the big casualty was Protean. The other, of course, pack, which continues to be in focus, in and out of favor on a day-on-day basis, depending on when you look at it, of course, is the defense pack. So lots happening in that sense with these names. Dipan, thank you very much for joining us. Good speaking with you. And I think we'll actually, do stay tuned because I think we have the Tech Wabag management joining us. Rima.
Indeed. So straight away, let's invite the management of Tech Wabag. The company for the full year reported a top-line growth of 15.4%. EBITDA margins came in at the lower end of the guided band of 13 to 15%. Skanda Prasad Sitaraman, CFO at the company, is now with us on the show. Thank you very much for joining in. So FY25 top-line growth of 15.4% is at the lower end of your guided band of 15 to 20%. On revenues and margins, what can you guide for FY26?
Hi, good morning. Good morning to your viewers, and thank you for having us on your show. I think let's start off with what we have done for this quarter and year. It's a historic high for us, whether it comes to top line, whether it comes to EBITDA, PAT, cash. We have from whatever we have guided the market, we have met almost all the targets well. Especially if you focus on the quarter 4, it's a very, very strong quarter that we are starting with. The projects have started to move forward very well, large projects. And of course, we are very well diversified, whether by product or by geography or by our offering. And that gives us a very good foundation as we move forward. From a top line and margin guidance, we are in an EPC business. So a multi-annual guidance is what will be more relevant, considering that projects run over years. And this, we have already given the guidance in the last year that we would aim for a 15 to 20% CAGR of top line growth, be in the 13 to 15% EBITDA range, continue to remain net cash positive, and deliver a return on equity of 15% and over. And this, we think, right from the first year of guidance, we have met all of those. Our order book is also extremely strong. Our cash flows are extremely strong. We're sitting on almost 1,000 crores of gross cash, 700 crores of net cash if you exclude the HAM SPV, which is transitory. And you can see the board has also expressed confidence in the performance, right from the cash reserves that we have, the growth in margins, and the outlook for the next years, and has recommended a dividend of 4 rupees after.
Mr. Sitharaman, good morning. Prashant here. So yeah, that's a long-range guidance which you've kind of talked about earlier as well. Could you just, since we are at the start of the new financial year, just run us through the order booking and how does it split? As you said, products, geography, just that split will be helpful. The overall number and how does it split?
So, Prashant, we are already sitting on a close to 14,000 crore order book. And we are a preferred bidder in orders of about 3,000 crores. So in a couple of weeks or a couple of months, our order book will sit at this 17,000 crore range, which we initially guided at. It's only a matter of time. If not for the order in Saudi, which got delayed, where we have rebid and we are preferred bidder already, we would have hit that target by now. But nevertheless, it's only a few weeks, months away from getting there. When it comes to product mix, geography mix, you know very well, we focus only on emerging economies. India, Middle East, Africa, CIS countries, Southeast Asia. This has been our focus. We have defocused from Europe. We have divested 3 European subsidiaries to ensure that we can invest our time and effort on the emerging markets. From an emerging markets perspective, again, Middle East and Africa will remain a very key growth engine. You've already seen we have secured one order, which is 370 plus million order from Saudi, from Al Hayar. And we are, as I said, already preferred bidder in another order in Saudi Arabia, which is also a large order. So Middle East Africa will be a very key growth engine, while we will focus on the growth market. Middle East and Africa will be a very key growth engine. From a product perspective, desalination, wastewater, reuse, and industrial water. That's been our focus areas, which is manufactured water in all. And that is where we will put our maximum effort, and that is where we see the maximum amount of orders coming back to us.
All right. Hi, Mr. Sitharaman. Good morning. Good to see you in. Nigel on this side. You mentioned that Saudi order a couple of times. That's the big trigger, right? Give us a timeline. Weeks, months and years. You said all of them. How long before we hear about that the rebidding of that Saudi project?
So, Nigel, I never said years. I said couple of weeks, maybe a couple
weeks, and then I think months as well. Yeah. So how long before the next quarter we should hear about this? If you could give us a timeline.
We are very hopeful that before we come back for the next quarter results, we should be able to give you the good news.
And what would be the size of the Saudi order that you're expecting?
It will be large. You know, we have already we won this order a few quarters back. It'll be a similar size. While I can't give you exact numbers since it is under evaluation, but you can expect the broad sizes are the same.
Mr. Sitharaman, I remember in our earlier conversations, you know, a lot of the orders, this is water, right? And a lot of the orders come from multilateral organizations, right? Could you tell us what proportion of it is from these organizations? I mean, you know, UN affiliated, etc.
See, the way we see payment security is that the order should fall, and that's our first C for order intake. Either it is multilaterally funded or federal government funded or sovereign backed. So this is where 95% of our EPC order intake falls, whether it is ADB, World Bank, AIIB, JICA. If you see top few orders, I'll mention. Our Senegal order is JICA funded.
Got it. So would you? I get that. What would multilateral is significant within this mix?
Multilateral, yes. I'll split it into three. In India, we focus on a lot of multilateral. In the Middle East, of course, it is more sovereign backed. Again, in Africa, there's a lot of multilateral. And wherever it is more industrial, it's LC backed. So India and Africa are largely multilateral orders. Indian cluster
and there is no risk here, Mr. Sitaraman, because US has been a big part in terms of providing funding across multilateral organizations, and now the US is pulling back across the board. At least that's it's not just in your industry, but so many other projects. Healthcare, for example, we hear from companies which work in the vaccine segment. So US is pulling back, and that's the source of big money across these organizations. Is that a risk at all?
I think we can afford to cut down on many things, but not water. And that we have seen. We have not seen any impact. We have not seen multilaterals come down on this. At least we are confident that water will not face that. Water will in fact have a lot of tailwinds, because there is also urbanization, industrialization. All the new industries require high-tech water, high-quality water, ultra-pure. You take anything, you just see the economics, right? You see EVs, you see hydrogen, you see semiconductor.
No. It's not, Mr. Sitaraman, it's not about the importance of water. It's just that the US, why should we spend elsewhere around the world supporting these projects? I mean, better to spend in the US. So the logic seems to be that. Of course, I mean, you do what you do. Desalination is absolutely critical and is very much required. But it's just that the source of funding, I mean, at least, especially the US, seems to be a little more tenuous. But you don't see any impact right now. That's what you're saying.
Not at all.
Just some quick questions. 15,000 crore, what portion of it will be executable in the next, say, 12 to 18 months?
See, we have, if I'm not wrong, about 4,000-5,000 crores of O&M, and the remaining is EPC, which would be executed over the next 2.5 years.
Got that. And India witnessed a slowdown in orders and execution. What's the outlook here?
I don't think we experienced a slowdown anywhere. In fact, if you see our Q4, we've only gone strong. We have a top line growth of close to 30%. So we are only seeing tailwinds. This execution will only go faster. All our mega projects are in full swing today.
Got that. Thank you very much for joining in. We've settled in pre-opening. IndusInd Bank is down nearly about 2.5%. But let's go across to Sudarshan now for his 9:10 call.
Well, Tata Consumers, consider buying Tata Consumers with a stop under 1115.
Thank you. And let's talk about IndusInd Bank. Big opening gash. Abhishek joins in with the brokerage view.
Well, brokerages have written on IndusInd Bank. They have cut the earning estimate anywhere between 35 to 40% on an average and 45% on the higher side by Motilal Oswal over the next 2 years. So loan growth to be in single digit by most of them in FY26 is their estimate, and around 10% for FY27. They say that the bank will now face difficulty with respect to touching the 1% ROA mark. The path is long drawn for them. ROE to be below 10%, around 6 to 8% over FY26 and 27. The next event to monitor will be the recommendation of CEO by the board to RBI by 30th June 2025. So brokerages have downgraded a stock like IIFL Capital and HSBC have downgraded to reduce. The target price has been cut massively by most of them. IIFL Capital, Investec, Nuvama, as well as HSBC, CLSA and Jefferies have cut the target price, while Macquarie remains the bullish call on IndusInd Bank. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Vineet. She's here to tell us about Indigo. There's a bull and there's a bear as well in the offing. Vineet, take us through both the pieces.
There are many bulls. but one bear that is coming in for Interglobe Aviation. So let's talk about the first one that's coming in from Citi. They're maintaining their buy rating, target price of 6,500 rupees per share. Obviously, the numbers were quite good, so they beat the expectation of Citi as well. Mahakumbh festivities, passenger load factor was good. So this is all what Citi is highlighting, and as well as in terms of the management commentary. So they're optimistic on that front, and that is why they're maintaining their buy rating. Morgan Stanley also is positive on the stock. They're maintaining their overweight rating. Target price has been raised to 6,502 rupees per share. Also, they expect the YOY yield weakness in Q1, but they have still raised their FY26 EPS estimate to 9% and FY27 is at 4%. So they too are positive on the stock. Now, Jefferies, positive note coming in here as well. Buy rating, target price 6,300 rupees per share. They've raised EPS by 6% on the back of lower crude estimates that they're expecting, which will offset the weakness that one is expecting to see in Q1 FY26. Now, on the flip side, and the bear that is there in this on the street is Investec. They're maintaining their sell rating. Target price is 4,050 rupees per share. They're saying that, obviously this benefit that one is seeing of Mahakumbh is not going to be there. So that's going to go off in FY26. But even in terms of engines, Pratt & Whitney compensation that is going on right now, they expect that to fade off in FY26. Indigo has been reducing its dependency on Pratt & Whitney engines over the last few years. So that is something in terms of compensation will also start going off. And they expect further decline in FY26 before they are expecting in FY27 a recovery. So FY26, they're expecting weak, and that is why the sell rating.
Mini, thank you very much for that. The stock's actually flat in the pre-open session, and we'll pick it up from there. It's, of course, done extremely well last couple of years on the share price. Let's just focus on Colgate for a quick bit as well. Mangalam is here to shine the spotlight in this one. Mangalam.
There's a weak side that has come in from Colgate, no two ways about it. If you look at the revenue, the street was working with a number upwards of 1,500 crores. The company's gone ahead and reported numbers a little over 1,450 crores. The EBITDA, not much was expected. The street met that. The company's reported numbers met street's expectations. The net profit as well, muted expectations, muted performance is what has come by. Even if you strip off what the street's expectations were and look at the numbers by themselves, a 2% decline in the revenue, 6.5% decline in both EBITDA and net profit, with the margins contracting by 170 basis points, not particularly, enthusing. And the management's commentary wasn't great either. They said that there has been softening urban demand, but at the same time, competition has intensified. They expect the near term to be muted. More than that, they expect only a gradual recovery, that too in the second half of this year. So all these factors may impact the stock, which has already been an underperformer, but trading at 40 times FY27 earnings.
All right, no, absolutely. Thank you very much, Mangalam, for that. What do we have? It's a 1/3% lower start on the Nifty, 24,714. Nifty Bank is down about 0.4. 54,825 on the Bank Nifty. The Sensex is down. The small cap index is down about 1/3%. And I think you've got the mid cap index, which is down about 0.5 odd percent as well. 56,400 on the mid cap index coming through as well. So unexpected lines, 24,700 now on the Nifty. So ticking down a little bit. Heat map coming up on the Nifty. And it's largely on the downside with few gainers, about 8 or 9 gainers, but everything else is starting in the red. Rima.
The Nifty at open has lost more than 100 points. So it's currently at 24,700. IndusInd Bank is your top loser, straight away 4% lower, 740 on IndusInd Bank. IT is on the back foot. Cuts of more than 1% on HCL Tech, on Tech Mahindra, on Infosys, on TCS. This is following the 1.5% knock that we had on Nasdaq overnight. ITC is weak ahead of its numbers later today. ITC share price is opened with a cut of nearly 1%, and Reliance Industries is also exerting pressure with a downtake today. Other notable drags include a Power Grid, a Shriram Finance, a Nestle, Trend. So a couple of these consumption names, FMCG names, also weak in trade. There is only one Nifty stock with a gain of 1%, and that's Adani Ports. So that's the top gainer right now. But other than that, Adani Enterprises, Coal India, BPCL have a green tick. ONGC should also come up for you on your screen, reacting to numbers. ONGC share price is up nearly about 0.5%.
Well, that's right. This company we just spoke to, Tech Wabag, just take a look at that stock. Bursting away, the stock is up closer to 9%. Big up move is what we're seeing out there. In the final minutes of trade, in fact, we did have NTPC Green that came out with a set of numbers. Bazooka move out there. Remember, the stock had danced away. I think it had given a 40-50% return post its listing. But post that, it did pull back to the IPO price. And now, in fact, it's getting back into form. So that stock is up and about in today's trading session. A couple of other big movers in trade today. Nalco, the numbers are good. The stock pops up close to around 3%. Sustaining this gain is going to be important. And a couple of other notable movers on large volumes. You have Dishman Pharma. I think that one, in fact, is up close to around 8% now. VRL Logistics. On the top line, it was a bit of a disappointment, but it seems the management is now focusing on the operational performance. And the margins actually were a pleasant surprise out there. So that's why that stock is up close to around 7.5%. Big move is what we're seeing out there. And Cosmos First. That's the other one that's trading with good gains as we speak. So a couple of these stocks actually doing very, very well from the broader markets. On the flip side, a few stocks that are getting clobbered. You have AG Infra, that's down close to around 8%. So big downtick is what we're seeing out there. JMM Pfaudler as well, it lost its form and now in fact in a post that it's never been able to get back into form. So JMM Pfaudler as well, down close to around 5% as we speak. The market's now at the low point of the day. IndusInd Bank, that's the top loser, but in fact it's pulled back some losses from the lows of the day, now down only approximately 3%.
Okay, well, I think so. It's a downtick just under 24,700 on the indices as we begin this session on Thursday. Gautam Shah is with us, founder Goldilocks Global Research. He's joining us to take some questions on markets. Gautam, great to have you here. Thanks for joining us. It just seems the market's done quite a bit, coming back sharply, and everyone is now, of course, a little confused about is there more upside here broadly, or do we go into a bit of a tailspin of consolidation? Overall, the mood is not helping. I mean, you look at what's happened, worries around the Japanese bond market, US bond market. So there are these small, localized tremors, earthquakes, whatever you want to call it. Keeps popping up once, every now and then, keeping everyone on their toes. So it's not all clear in that sense. And of course, there is this big thing of tariffs. What's your sense, Gautam? Do you see a clean run, or do you see a much more fractured kind of path from here?
Good morning, Prashant. Mood not helping is actually good news because it keeps the bull market in check. I think we've handled a lot of local and global stress in the last few months, and the markets have come out with flying colors. The fact that you are at such elevated levels of 25,000 itself, I think, is a big win. I don't think many people in the market would have thought that we can come to such levels so quickly. And I do see bull market characteristics. I mean, if you look at the momentum, the participation, the way India has handled the news flow, local and global, I do believe that we are headed significantly higher. And, these issues that keep propping up from time to time, I think is quite normal because I think we live in a world where something has to happen on a daily basis. But the price action has been super solid. There are no concerns on the charts. The market is not even significantly overbought. In fact, in the last 1 week, we've just gone a little sideways after such a big rally. And you have immediate support at 24,500 and possibly 23,800, which is more of an investor support. So keeping all of these factors in mind, I do believe that this dip is a buying opportunity. And I do see the Nifty moving towards a level of 25,600 and eventually lifetime highs. And I do see a wave of outperformance for the mid caps and small caps. So I think one should be invested. Even the US market setup is quite solid, and we see those markets hitting lifetime highs as well. So I don't see, as a technician, I don't see any concerns on the charts, and I think the markets are in fine form.
Okay, so 2,500 is the immediate stop, then all-time high levels, mid and small caps outperform. You spoke about US markets, Gautam, and I see Goldilocks has done a lot of research on the US markets. Your first big picture report for the US pack is out. So tell us a little bit more about the US markets, because overnight they went into a tizzy following the surge in bond yields. So that is emanating as a bit of a concern. So considering there are linkages between what happens in the US and back home in India, what's the call on the US market?
Yes, Reema, so we closely track all the US market indices, the ETFs and the top stocks. And I think since we have a product there, I think we now have a better understanding of what's happening in the US. And, after the Trump talk and the fall that we saw, again, not many people globally would have thought that US markets will come back so strongly, and they have. So I think the men have been separated from the boys, not just India, but world over, including the US. And I do see the S&P 500 moving towards a level of 6150. In fact, even the Russell 2000, which tracks the mid caps and the small caps, is coming back really well. So I think globally, I don't see a problem. I mean, even if you look at Europe, markets like London, Germany, France, all very strong. Asia has been relatively strong. Look at Taiwan, look at Singapore. So I think globally we remain in a bull market. That's what I want to call. I know it's very early to call for a lot of people, but the characteristics globally suggest that we are in a bull market, and this is only going to help India, which anyway has a lot of standalone positives.
Okay, all right. Ooh, the Nifty actually, as we speak, it's actually drifting lower. We're at around that 24,600 mark, which incidentally is one of the important support zones. So this 24,500, 24,600 is the important zone. Hi, Gautam. Good to hear your comments. You're sounding quite bullish on global equities and India included. What about the Nifty Bank? That's been the leader, right? I mean, it saw a lot of selling, the FI selling, it underperformed for a period. And then when it found its form, well, it took the Nifty higher. What's your take?
Yeah, I think in the difficult period of October to March 25, the Bank Nifty actually did not go down as much as the overall market. I think that was the key takeaway, that the banks have inherent strength. And thereafter, Bank Nifty single-handedly, took the Nifty higher from levels of 50,000 to about 56,500. It's consolidated beautifully in the last 10 to 15 days. It just passed on the baton to some of the other sectors, and you might have noticed how technology, metals, capital goods, real estates, FMCG started to do well. But I think this breather phase for Bank Nifty is likely to end. And once the level of 56,000 is cleared, I think Bank Nifty is headed towards a level of 60,000. And when I see all the top stocks, I remain quite encouraged that they will do well. But one thing is very clear, that the movement or the outperformance is now shifted to some other sectors. And I continue to believe that metals will be one of the star performers of the next 6 to 12 months.
Metals will be one of the, I think it's a view that you've had in the last time we spoke as well. And out of the pack, you'd recommend buying a bunch here on the metal side, or anything in particular, Gautam?
See, a couple of days back, the metals index hit the first resistance of 93.50. And I think once that number is taken out, you are heading towards a level of 10,500. That's about 12% upside from where we are. And typically the iron and steel producers are the ones that we like the most. But I think everything will be a beneficiary. We've seen in the last 4 years that when a theme works, everything does well. And that's what is likely to happen with metals. So the top 6 or 7 names across the board, ferrous and non-ferrous metals, I think will be an outperformer. See, the Nifty is not going to give you supernormal returns from here. You have to be in the right themes. And I think real estate, PSU and metals are 3 pockets which I think will see serious outperformance.
3 pockets. You said real estate, metals, and the other one is?
PSU. I think PSU, after a mega run for about 2.5 years, went through a consolidation for about 8 to 9 months. And I see the entire basket coming out beautifully in the last few weeks. And I think there is clearly a lot more money to be made there because valuations are comfortable. These are companies that don't have anything to do with foreign soil. And I think the structure is beautiful after that, initial run up. So I think PSU, given all of these factors, stands out for me for the next 6 to 12 months.
So PSUs in banks, are you talking about defense? Are you talking about power, oil and gas, and any stocks or any trades?
See, I think it's going to be across the board, even though we love the top 3 PSU banking names. So I think that's one focus area, the PSU power names, the PSU infrastructure names, and the PSU oil and gas names. These are the pockets that we like. Defense and railway, I know they've done very well in the last 15 days, but I don't think the risk reward is justified to go long here. But apart from these 2 pockets, the entire basket of PSUs, including the PSU metal names, I think will stand out.
Okay, all right. What about Reliance Industries, Gautam? That's like an index by itself. And that went through a big period of underperformance and bounced off that 1100 odd mark. And it's done quite well from there. Any view on this one?
Yeah, I think it's good to see that the underperformance has at least ended. It tested a level of about 1110. From there, we've seen a 300 rupee rally. Structure is looking a lot more comfortable. But will Reliance see major outperformance here? The answer is no. At the same time, it's not going to fall much. So I do see a gradual move up on Reliance. And, if you have 3 big pockets of the market, which is banks, IT and Reliance, all having good setups on the charts, you can't have the markets go down too much. And that's the reason I feel at today's level of 24,600, the market remains a buy risk reward.
Sorry.
I was mentioning that IndusInd is
moved in the green.
The green. And this is what I was saying in the morning. I mean, if you look at the last 1 month, there's been so much bad news where the stock is not selling off. Everything has been, and there's been a lot of supply. All of it has been absorbed without breaking the price. People still hopeful that, it's just a valuation game that you're buying something which is now beaten down, depressed, and maybe there is some money to be made from here. So we'll see. You, of course, heard, Digant, who thinks it's largely going to be a trading game. 600 to 800 was his range broadly, but doesn't really, do very much point to point a year down the line. Of course, Hetal was also with us in the morning on IndusInd. 210 lower on the Nifty is what you have. On real estate, Gautam, what are your picks?
Again, I'm sticking to the top names. I think real estate is a structural trend for the next 3 to 5 years. That's the way I want to look at it. Went through a nice 1 year of consolidation. If you look at DLF, Godrej Properties, Oberoi Realty, Brigade, Prestige, Shobha, all went through a large consolidation in the last 1 year, and they all seem to be creating a foundation for the next leg up. You can't play India and not play real estate. I think it's a direct proxy to the India story, which banks were for a long period of time. So I think given the valuations, given what I'm hearing on the ground, what I'm hearing from many of my clients, I think real estate from a risk reward perspective stands out, and the index could actually see a 20% appreciation from these levels.
Gautam, great conversation. Thank you very much for joining in. The Nifty, though, is still down close to about 200 odd points, even as IndusInd Bank has recovered back in the green. Some of the drags include IT. In fact, IT is under severe pressure. Tech Mahindra, HCL Tech, both down over 2%. And then you've got ITC too. Week. But let's talk about Uno Minda's Q4 performance. The company reported largely an inline set of Q4 earnings. Switches lighting segment continued to see growth of more than 20%. Management expects business to grow more than 1.5 times the industry growth rate. To talk about the performance, Sunil Bora, Group CFO of Uno Minda, is now with us on the show. Thank you very much for joining in. While margins are still on the whole within your guided band of 11% plus or minus 50 basis points, in Q4 there was a drop of 100 basis points in your margins. What led to that? And do you think you can increase what's the guidance on margins going ahead? Do you think there is scope to, for margins to cross 12% in FY26?
Yeah, so first, you mentioned that from year-to-year perspective, there is a margin softening of almost 80 basis points. And that is primarily because in the last Q4, we had some good price settlement with some of our customers which were delayed. But as we have guided, our overall profits have been within the range of 11% plus minus 50 basis points. And that's the guidance we are maintaining for FY26 as well. The key reason being, even though we are expecting growth and we are not able to see the benefit of operating leverage in our bottom line, is primarily because we are in a very high growth phase. We have multiple plants, businesses which are under startup phase or under phase where they are in the construction and will come into operation phase in the next fiscal year. So as you know, any new business or any new plant we start, normally you will have a lot of startup costs, and initially you are into ramp-up phase. So first year or two are actually in the investment phase where you don't get any returns. In fact, first year you might be actually in negative zone, but gradually you ride the growth phase, and once the plant stabilize, our target always has been in the third full year of production, we should achieve our guided profitability or targeted profitability. So that 11% plus minus 50 basis points actually factors in all those startup costs and initial ramp-up costs, and despite that, we are able to hold on to our margins. So if you exclude that, actually we might be improving our profitability if you see on apple-to-apple basis.
Hi, Mr. Bora. Good morning and good to see you in. Nigel on this side. Well, India and UK, they have recently signed those FTAs. And even India as well as the US are likely to announce at least the first part of the bilateral trade deal. You have talked about additional opportunities, right? Do you see signs of that? And could that be a potential benefit for your company from the UK-India FTA?
Absolutely, Nigel. From UK-India FTA, as of now, we have not been having any significant exposure to UK. But we do hope as things stabilize, as the taxes comes down, we should gradually become more competitive. But coming to India-US, we have good exports, even though it's overall pie, it's not very high. Our revenue from US markets is less than 2% of our total revenues. but we do remain optimistic. We are seeing positive traction discussion with our customers, and we are cautiously optimistic in terms of the discussions going on between the two nations. And hopefully, whatever we are hearing from the government in US or the officials from the US, there seems like the auto component sector or the tier one sector might get good relief for imports into US. So from that perspective, we are seeing very good traction, and the discussion with our customers are in a positive zone in terms of maybe increasing our businesses as we move forward.
Sunil, hi, morning, Prashant here, and good to speak with you. You can't put numbers. It's too early, right? You can't put any numbers to it in terms of what it could mean. Volume of business going up. It's too early.
It's little early, but Prashant, I can tell that even in the current phase, before this 90-day pause, obviously we have been in discussion with our customers, and the feedback we have been getting from customers was positive in terms of the business continuity and expansion of that business also. We are in the process of evaluating few more RFQs which customers have issued to us. So hopefully, as we move forward, in absolute terms, the revenue from that region, we do expect to go up. Yes, it is tough to put numbers on the table today, but we don't see any significant degrowth from that perspective. In fact, if at all, we are looking at upside only as we move into the near future.
What about Europe? That is UK, but what about Europe? I think here there are still headwinds, right? Cheaper imports, higher production costs, and of course, generally, it's just been a sluggish demand environment, region-wise.
No, you are right, Prashant. Region-wise, the volumes are significantly lower. So we have like both sides of the coin. We have a couple of key businesses there, one in Spain and one in Germany. So the Spanish business obviously is a horn business which is facing challenge because that is directly linked to the vehicle volumes. Even though we have not lost any share of business, the volumes are significantly down, and that is what is showing up in our numbers as well. So like last quarter, our revenue from those operations is down by almost 25 crores in the quarter. But in Germany, things are looking better. Even though the volumes are down, we are looking at some new businesses which we feel will be able to more than offset the volume drop or the impact of the volume drop. So as of now, it's industry-wide. If you see, yes, volumes are lower, but we are looking at optimistically in terms of new business additions.
Sorry, what's the contribution of Europe and what's the extent of pressure?
Yeah, so in terms of revenues from Europe, from our Clarton Horn subsidiary, is something around 400 odd crores of revenue, and same broadly number is from the German business. And in terms of volumes, the volumes are down almost like 10 to 15%, which is what is mirroring in our Clarton Horn revenues.
Okay. Can you give Sunil some more color on your various divisions like switches, lighting, castings? What is the growth that you anticipate? What are the trends that you're seeing for FY26?
No, you are right. So if you see, a lot of our businesses do continue to ride on the premiumization theme. If you start with switches, we continue to hold on to our lion's share in both the businesses, be it the four-wheeler switches or two-wheeler switches, both in more than 50% market share. We are seeing a lot of upgradation in the switches, be it the haptic-based switches, touch-based switches, a lot of premiumization happening in that. We are also gradually increasing our share of exports into those businesses. If you see alloy wheel, yes, alloy wheel last year has been, in terms of application ratio, has been almost stable. So application ratio, when we say it is like alloy wheel versus steel wheel. So it has been almost in between 40 to 45% range for last couple of years. But globally, if we see, it is more than 80-85%. So India obviously will ride that journey, but it might not be in a short time frame. It might take a few years. But maybe last year was our consolidation phase. And in terms of tool alloy wheel, we have consistently been expanding our capacities in line with what we have done in four-wheeler wheel. Two-wheeler wheel, we have grown from 6 million wheel now to 8 million wheels, which is fully operational and fully booked. We have announced another 1.5 million wheel capacity in Bawal. So we are consistently expanding our capacities, and there is a good demand we are seeing in the alloy wheel segment. Moving to some of the other segments like lighting, you said lighting has been one of our very strong growth area, which we have been able to successfully increase our market share in last couple of years, specifically in four-wheel lighting. Even in two-wheeler lighting, we are almost like 30% market share. So things are looking much better, and there is a lot of focus on innovation, technology, R&D, etc. In fact, recently we have also opened a new tech center in Czech Republic to support our four-wheel lighting business. So there is a lot of action happening on all that. And if you see from growth perspective, and our target has always been to do at least 1.5x of the industry growth. And if you see last year, we have done industry grew over by 9%, we grew by 20%. So that clearly demonstrates our commitment. And we do hope that as we move forward, we should be able to deliver at least 1.5x of the industry growth based on all these factors which I just spoke about.
Okay, all right, Mr. Bora, very quickly, before we let you go, could you tell us what's the current content per vehicle? What's the difference between, say, an ICE as well as an EV? And where do you see the content per vehicle number headed?
So content per vehicle, if I see broadly in the two-wheeler segment, currently stands roughly around 12,000 rupees for ICE and roughly around 35 to 40,000 rupees for an EV two-wheeler. And in terms of PV, it ranges very, very widely. So if you see, it is for the top end almost like 2.25 lakh for a D segment car for ICE engine, and for EV, you can add another roughly 1 to 1.5 lakh rupees of kit value on top of that.
All right. We have Sunil, thank you very much. I think that's a fair bit of detail, and look forward to our next conversation. Thank you indeed for joining us. Let's focus on the next company, which of course has been in news, with the news flow actually taking a bite out of the stock price over the last 3 days. Protean eGov Tech is the company in focus. Of course, the news was that they've not been shortlisted for PAN 2.0 by the IT department. The market did not take the news flow too kindly. But they've reported numbers now as well. Suresh Sethi is MD and CEO at Protean eGov. Mr. Sethi, good morning. Great to have you with us here. Prashant this side. So let's just start with that setback in that sense. How do you, so let me ask you, and I think you, in that conference call to analysts, you did explain that you don't see that as a bit of a setback. Why is that? What is the difference between what the PAN work that you are doing and the scope of work for PAN 2.0 why would this not really sort of take a bite out of the growth for future years, which many were building in? Go on.
Sure, Prashant. I think it's critical to understand the PAN application process. So there is basically when an applicant is applying for the PAN card, there is the complete collation of data, and securely transmitting to the ITD. So today as Protean, we run multiple online and offline channels. We have a well-regulated network of almost 400,000 agents at which a citizen can go and submit their information or submit information for updation of a PAN card. And this is transmitted securely to the IT department. The IT department today runs the system through which the allotment of the PAN number is provided. And once they allot the PAN number, then the same is given back to us and we issue the PAN card and we send it to the citizen. Now the entire tech stack which is used for allotment is a system which is run completely by ITD. And that is something we don't even do today. We run largely the processing and the issuance of the PAN card. So we don't see the two being sort of, on the same track. And while it was critical and a excellent opportunity to further deepen our relationship with the IT department, our current business continues as is. And equally important is the fact that the PAN 2.0 from deployment or allotment is going to be another 18 months journey. And it will be looking at online channels at that stage.
So in a way, it's like what TCS does for the passport service, right? That's what you do with regards to PAN.
You can make a similar analogy.
I mean, I'm just trying to simply, that's much better understood.
And Prashant, just to add over here, it's also critical because it's a citizen-centric service. Today, a lot of citizens, actually 70% of them still go through an assisted mode. These are digital non-natives who absolutely want some support to be able to apply for a PAN card. And therefore, the network becomes very, very critical and important to support them.
Mr. Sethi, what was the reason that you were not shortlisted?
We have sought a clarification from the IT department as of now, and we await to hear from them.
Do you think it's technical in nature, or would it be something else? I mean,
no, there are basically 3 rounds of, if you may, a qualification. There's a pre-qual, there's a qualification, and there's the price discovery at which multiple bidders go in and there's a fair and transparent way of discovering the price of the project. This was at the qualification stage. where along with us, the other competitors have also been in a way indicated that they didn't make it to the last round, and one final competitor has made it to the last round. All this information is available on the GEM CPP portal.
So which is the company which will now be doing PAN 2.0?
It is available on the portal yet because as of now, they still have to do the price discovery round.
What's the scope of work, Mr. Sethi? What's the size of work here?
The scope of work is basically revamping, deploying, designing and integrating and maintaining the core IT systems, which, as I mentioned, are being run by the IT department themselves as we speak.
Can you put a number value to it?
There was a budget shared by the government, which is there in public domain. It can always be referred to.
Can you, since we have you, it's easier to ask you, is it possible for you to share that?
It was indicated as a 1400 CR budget.
Over what period of time? This is like
So as I mentioned, the design and the deployment of the stack is supposed to be done in the period of 18 months, post which there'll be a maintenance period for the same stack.
Okay. So today, PAN is 50% of your revenues, right?
Yes, almost.
Okay. And for the next 18 months, it's business as usual.
See, I would say that the service...
Or will there be a drop-off in revenues?
Exactly. So service models, as we see how they evolve down the line, because as I mentioned, we today also have online and offline channels for people to apply for the PAN card. But 70% of the people go to our assisted points of service, where we run a regulated network of almost 400,000 agents covering the country. We don't know what the service models will evolve in a couple of years, but largely will be driven by the citizen's choice of how they want to apply for a foundational ID like PAN.
Okay, but just, simplistically, for the shareholders, revenue will continue to drop off and come to zero, say after 18 months. And after 18 months, what is your own expectation?
No, so again, I'm reiterating, 18 months, the new stack does not come into play. Down the line also, as I'm saying, we don't know the service models, how they will pan out. Today, citizens do take assisted services. 70% go through that mode, and we expect it will be driven by the consumer choice. So the distribution and the issuance business is separated out from PAN 2.0 and what it will bring at that stage.
All right. Hi, Mr. Sethi. So clearly this 50% of your business has gone into a bit of a tailspin, and there is some uncertainty out here. Now, you'll have to try to fill in the gap, right? What are the avenues you are looking at, both domestically as well as internationally, to fill in this gap? If you could tell us that. And
no, but first of all, let me say there is no gap. As I mentioned already, the PAN 2.0 talks about the revamp of the core IT systems of ITD, which we don't do today. What we are running is the distribution for collating the PAN data or PAN updates and transmitting it securely to the IT department. We today also have both online and offline channels to do it. So our business continues as is the mandate given to us by ITD in 2003.
So you'll continue to grow then? Because the street is clearly not buying this. As you have said in the last con call as well, you said that business will not be impacted, but the street is very, very nervous. You're looking at a couple of sales notes out here. I'll tell you what's the problem. The problem is on 50% of your revenues, that was the cash cow. So if you were to get into new verticals, the street was positive on that. They were expecting you to get more business out there. Suddenly that goes out of the way. So if you're saying it's not going to impact business, do you expect to grow from here on?
No, so absolutely. As we see, PAN is not a saturation ID. We are seeing new PANs getting issued up till 6 to 7 CR every year. And we have almost a 57% market share. We gained 5% market share during the course of this year. So we expect this business to be aligned with the issuance of PAN. And citizens today, if you may, only 35% penetration of PAN is there in the country. It's not a foundational ID, the lines of Aadhaar, which is 99% penetrated. Yeah. So there is a huge headroom over there for new PAN cards to be issued.
All right. If you could help us out with the growth guidance then?
So definitely, as we've been saying earlier, we expect 6 to 7 CR PAN cards to be issued. We currently have...
Revenue growth guidance, sir. As a company, what kind of revenue growth can we look at?
Yeah, so as you were saying, we are looking at other areas, goes without saying. So we have clearly gone into multiple open digital ecosystems. We are working in the space of agri, health, digital commerce, ONDC. Likewise, we are introducing products on top of our identity services business, East Pro and Rise we've spoken about. So we clearly see a good trajectory for the company in new businesses, and the core businesses remain strong, including the pension business, where we have a 97% market share as of now.
Okay, just a couple of more questions. In the last quarter, there's a big jump in other expenditure. Any one-off was there?
No, there's no one-offs.
No one-offs. Okay, all right. Because there's quite a sizable jump, even if I look at it on a sequential basis. Also on ONDC revenues, could you tell us what is the outlook out there? It seems that, it is plateauing at around 7 million per month. But you were optimistic on that, right? So what was the revenue in the last year, and how do you see that panning out?
Yeah, sure. So there are two parts to the revenue that we accrue from the ONDC business. So one, we are running the foundational gateway and registry, which today, as we mentioned, is directly compensating by the ONDC as an entity. And that is where the network play comes into play. And this is foundational. The other area where we were looking at was a SaaS sort of a business model where you are creating the demand and supply applications. Now, the demand and supply applications clearly get linked to the fact that as the network grows and there is more consumption, you will get paid for every transaction. So we hope, as we've seen, that ONDC is gaining traction. There has been growth, but clearly we have to hit an inflection point, and the SaaS revenues are what will pick up from here onwards.
What is the revenue, though, for the past year?
So the past year, we had around 8 CR of revenue coming from the core stack, and the revenue coming from the SaaS business was pretty limited at this stage.
Mr. Sethi, you've approved a scheme of demerger, right? Protean Infosec Services. Could you tell us what does the subsidiary do and what is the logic behind this?
So initially, we had established a subsidiary to look at our Infosec vertical. We are clearly also looking at aligning and coordinating that business with our cloud services business. We find a lot of alignment in that business because, end of the day, any cloud deployment involves a lot of cybersecurity and security-related considerations. So we are bringing the two businesses together to take it as a common business to market.
Which two businesses? Cloud
services and Infosec.
And what is Infosec exactly?
Infosec is information security, to running any SOC centers, doing the VAPTs, doing various sort of services for the consumers in the space of containing any security threats on the Infosec perspective.
Okay, just one last question. You said there's only for PAN issuance, penetration is still quite, you said 35%, right?
That's right.
And 6 to 7 crore PAN cards to be issued over what period? This is
an annual figure we generally see because that is what we've been seeing as the run rate for the last few years.
And you're able to do this without, you'll do this in FY26 as well. I mean, it should be in this ballpark.
Absolutely.
Okay, all right. We'll leave it there. Thank you very much, Mr. Sethi, for joining us and answering all those questions. And, look forward to when you get to know, as you said, you've asked for a clarification. Do let us know as well in terms of what led to you not qualifying for that PAN 2.0. So we'll look forward to that. Thank you very much. We'll take a quick commercial break here. Gokaldas Exports is going to be with us on the other side to talk about their fourth quarter performance and, of course, the outlook forward. Stay tuned.
Welcome back. More earnings interactions. Gokaldas Exports reported a good performance in Q4 and FY25. Top line growth was about 25%. Siva Ramakrishnan Ganapati, Vice Chairman and MD of the company, is now with us on the show. Thank you very much for joining in. 25% revenue growth year on year, 3% on a quarter-on-quarter basis. On a year-on-year basis, what was the impact of the acquired entity? And going ahead in FY26, what's the outlook?
So the acquired entities have started performing well, and between Atraco and Matrix, we had about 850 crores plus another 450 crores. So about 1,300 crores come from there out of the total 3,900 crores. So that's the kind of split of revenue coming from the acquired entities. All of the entities have grown. The base business itself has grown substantially, where the erstwhile Gokaldas itself has grown pretty strongly, both in Q4 as well as for the whole year. And we have been growing at a much faster pace than the rest of the industry.
Okay, all right. Hi, sir. Good to see you, Ben. Just to clarify, one acquisition that you made was BRFL, right? That hasn't yet contributed in the past year.
No, we have just made an investment. We have not acquired them as yet.
Not acquired.
Them. That's right.
All right. So got that. Now, if you could tell us what is the current order book, if you could give us a brief idea, because that gives us some kind of visibility going ahead.
So the order book is strong, and we have booked all the way till the second quarter. So we have a fairly good amount of order flow happening. There are certain concerns from the customer side with tariff and uncertainties, etc. But we seem to have been overcoming that and generally having a reasonable state of booking. So we don't have as much concern, though. I feel that in the longer run, I think given the macroeconomics and the geopolitics that is going on, India should be in a stronger position, especially with UK FTA happening. Hopefully, an FTA with EU and US also, tariff agreement being reached. Then we will see better traction. In the interim, in the short term, tariff may play havoc with short-term business. We will have to just deal with it. We will have to, contend with those uncertainties and manage the business through that period.
Okay, all right. So, the last time we spoke, you said that India is better off if you compare it with other countries, China, Vietnam, Bangladesh as well. Is that still the case? Given the sudden talks between China as well as the United States, has some of our edge got taken away?
So China, it was impossible for China to export anything to US when the tariff was at 145%. Now that it has come down to 130%, there is some trade resumption between China and US. Having said that, a 30% tariff is still high, and we will definitely have an advantage over China. But what's important to see is how does the tariff eventually play out for other competing countries like Vietnam, Bangladesh, Indonesia, etc., because that's where bulk of the larger customers have pivoted already to. So the relative tariff post this 90-day pause window is what will determine, in the longer run, who will have what advantage. At the moment, there's a level playing field for everyone in this Asian region, barring China.
You had guided for improving EBITDA margins to 12%, and I think you've achieved that. Now, going ahead, what is the outlook on EBITDA? Can you further increase it? And considering you get about 70-80% of the, your revenues from the US, and there are going to be tariffs to some extent, what are your conversations with customers like Gap, for instance? Are they asking you to bear a part of the impact?
See, all customers are asking us to bear an impact of the tariff. So in the short term, which is say the first half of this year, when the tariff will be in play. For example, the revised tariff or reciprocal tariff started from April 9th. So it's impacting Q1. So we do have to share some amount of our margin with our customers. The supply chain contributes to bearing the tariff as well. So in the interim, to keep up our relationships and to make sure that we continue to grow, we will have to forego some margin. So Q1 and Q2, we will have some, setback on margin. So This year will have some tariff related challenges. If I exclude that, I don't see any problem for us. We will continue our growth journey both on top line and on the margins. But tariff will certainly impact our margins. Tariff will also bring in volatility of business volumes. At the moment, we don't know what the tariff is after July 9th, after the 90-day pause window. So will it go back up to the 26% announced earlier? Will it stay at 10%? Most of the customers who are placing orders today will receive their goods after the tariff pause window.
Yes.
So how do you place an order now without knowing clearly what is the tariff at which you are going to clear the goods when it comes into the United States? So this is a big concern, and that brings in a short-term volatility. But we are building the business for the long term, and when you look at the long term, we don't seem to have those kind of concerns. In the short term, we definitely will have this problem.
So say for H1 of FY26, what's your own expectation of EBITDA margins?
It's very difficult to predict. I'm sorry to say that, because I don't even know what's the tariff going to be in Q2. So how can I predict that margin? How do I know what kind of burden share that we are talking about in the second quarter? Our endeavor will be to protect our margins as much as possible, but we are living in an uncertain times where we don't even know what are going to be some of the tariffs. So it's hard to predict margins in such an environment.
Fair enough. Okay, but you are sharing some of the burden with your customers, and that could keep your margin subdued. That's the key takeaway from that. Okay, you'd also spoken about a 15% kind of a revenue growth driven by a strong order book, sourcing trends, etc. Is that on track?
So again, long term, 100% it's on track. Short term, there will be some aberrations. When I say Q1 and Q2, there could be some order flow hiccups, primarily because customers themselves are unaware as to how the tariff is going to impact them, and hence how do they go and build up their inventory. So if I buy now for holiday season, which is the winter season, most of the production will happen in Q2 of our financial year. What is the tariff?
So orders have been paused, sir?
Orders have not been paused. Orders are coming through, but the brands are just concerned about the order flow. So they may trickle it down. I don't see an order flow problem, but I see some volatility again because of unknown tariff.
And ROCE, you had plans to, I think, scale it up to 20% plus.
Yes.
When does that happen?
I think it'll take 2 years, and it will happen. One of the reasons why ROC is showing a slight dip now is because we have made investments in several capexes, capacity increases. So we are also trying, filling up those capacities. So planning to do that, and those have yet to come on stream. So these are all capital work in progresses, as well as our investments in the textile unit BTPL. Has contributed to capital outlay, but we are not counting any benefit coming out of it. It's just an investment. So ROC will improve as we progress. I think in FY27 we should start seeing a fairly strong ROC again coming back to us.
Pleasure talking to you, sir, as always. Thanks a lot for joining in. Hopefully next time around we'll have further clarity with regard to what's going on in the globe, and you can give us some more concrete guidance on the path ahead. But thanks a lot for joining in. For the time being, let's focus on Indigo. The company reported a rather strong performance in Q4, backed by festivals, your weddings and the Mahakumbh as well. That's what took the profit number beyond the 3,000 crores mark. But to discuss what went on in the past quarter, how they see things moving ahead, we're joined by Mr. Peter Elbers, the CEO of Indigo, who joins us on the show. Hi, Mr. Elbers. Thanks a lot for joining in. Well, it's a sharp jump in revenue is what we're seeing. Could you give us some kind of a breakup? How much of it was led by the Mahakumbh? What was the increase in flights? And do you expect this now to fizzle out?
No, I think we have to look at what's the underlying assumptions we use for India. And with the growth of the economy and the growth of the GDP, we have set a long-term objective by doubling in size between 2023 and 2030. And that means we expect to have a significant growth year over year. Then in the year itself, we always see stronger quarters and weaker quarters. So if we look back to FY25, we saw, for example, that Q2 wasn't great. There was the elections, there was the heat wave. There were a couple of factors which were kind of dampening the growth. What we see then the quarters after that, and Q3 and especially Q4, were kind of picking up a lot. in that traffic. And then, of course, indeed, specific events like the Mahakumbh create some extra traffic and extra demand. And Indigo has operated quite a few additional flights to Prayagraj and other cities in UP. But that in itself is, in fact, a reflection of the overall demand and positive setting. And yesterday, I think the DGCA released their numbers for April, and even April came in at a solid 9% growth of the market.
Okay, all right. Let's talk about FY26 then. Could we expect double-digit growth coming in FY26?
You know, for FY25, we've given a capacity guidance in the early double-digit growth. That's the capacity guidance we have. Obviously, with an 87% load factor as we had in last year, that capacity guidance should not be too far off from the traffic guidance we're giving to the market. So again, early double-digit is the capacity guidance we've given for FY26 going forward.
Peter, hi. So Q4 has been good, very good, but the street is concerned about Q1, right? We had Operation Sindoor, a lot of people cancelled their flights. What was the financial impact on the flight cancellations, on your network schedules, and how do you generally look at how have the months of April and May been for you?
Well, if we look to Q1 and the 3 months in Q1, let me just look at these in kind of separation. So April, we just mentioned, actually the quarter started very good and pretty much in line what we had seen in the months prior. So April was a good, as I said, 9% for the overall market. Then obviously May, and that includes, by the way, clearly the attack at the end of April, which was already there. Then clearly May had a dampener. The impact in May was for us 8 days, a closure of 11 stations and a total of 170 flights per day. That's a significant number. But then if I look to the overall operation of Indigo, we fly 2,200 flights a day. So if we take out 170 flights, it's still a relatively limited percentage of that. The same goes for the overflying limitations for Pakistan. We had to close or suspend rather 2 stations in Central Asia, Tashkent and Almaty. And we have another 34 flights which have somewhat extended flying times in the network. So the overall impact of that is relatively limited. And clearly what we have done is we reallocated some of our flights to the southern part of India and basically are growing from there. Post the ceasefire, the flights have been reinstated and all the 170 cancellations have been reinstated by the end of last week. And we're sort of back to a regular operation. That clearly has an impact on May, but again, it's more in the single-digit range when it comes to capacity impact. We have seen a drop in bookings, as we just shared also in the call. But that seems to have bottomed out. And actually, we see now the first signs of people picking up bookings again. And the resilience of the market is actually quite strong. And we expect, therefore, June to see again a performance which is more in line with the situation prior to May rather than the situation in May.
All right. What is the current outlook, though, for forward bookings as well as the fare trends for the upcoming quarters?
We have not adjusted our capacity guidance for the year. We've actually just reiterated the early double-digit capacity guidance for the entire year. We have reiterated our capacity guidance for the first quarter. Again, slightly lower because of the cancellations in May. But we have reinstated all these cancellations after these 8 days of cancelling. And basically, we see the traffic coming back. So for us, no change in planning and no change in expectation or outlook other than the month of May, which, of course, will have some impact on the overall profitability.
Got that. So April will be a bit of a subdued month. Can you take us through how was the air traffic and the yields and the outlook on the same?
If we look at the year which has gone by, the 4 quarters had a very distinct operation in terms of demand and even with that performance. And of course, the price of the fuel also had its impact on the overall profitability. The last quarter had a very strong demand also in terms of yield. Quarter 1 and quarter 2 are traditionally weaker quarters when it comes to demand. And clearly quarter 3 is also always very strong with Diwali and the festive season in it. So I don't see any reason why this year would be very different as compared to previous years in terms of demand. What is adding actually to it is that Indigo is continuing its path on further internationalization. So we have stepped up significantly our number of international destinations. We're now into 41, and actually as recent as today, we announced the open for sale flights into Manchester and Amsterdam, operating out of Mumbai and starting in the first week of July.
Give us some more details on a couple of other aspects. Could you provide us with an update on the codeshare and the partnership with the Turkish Airlines? The lease is up for renewal on the 31st of May. So I ask you this.
I think it's important to recognize that flights between countries are governed and by what is called air service agreements, and that's agreements between the respective governments, and the same is in place obviously between Turkey and India. There's an air service agreement, and Indigo is operating within the guardrails, if you wish, of that air service agreement. That's one. Two, Indigo is operating in full compliance with the operation mandates and guidelines and opportunities and restrictions which are there by the government. And thirdly, importantly, we've had thousands of Indigo customers booked on those flights. The majority, by the way, connecting over Istanbul and connecting to other places. And we just wanted to make sure that we continue the operation, serving our customers, making sure that they can either go to their destinations or come back from their destinations in the light that we had so many bookings. When it comes to a review of the permit, we await the outcome of the government and we will operate accordingly.
Okay, but in the event the lease doesn't get renewed, then what is the impact on your earnings?
Let me put it in perspective. Indigo operates a little short of 2,300 flights a day. That's the Indigo operation. We fly 2 times per day back and forth, so that's a total of 4 sectors to Istanbul. So 4 out of the 2,300. Then obviously these are larger planes, so you can move it a bit up in terms of percentage, but the overall scope is 4 out of the 2,300 daily flights we're having.
All right, final question before we let you go. Crude oil prices have been trending lower. How would this impact Indigo's margins, considering fuel accounts for roughly around, I think, 40% of the operating cost?
Well, thank you. Well, cost is, of course, an incredibly important part of the basis and foundation of Indigo, and maintaining our cost leadership in the Indian market, being such a highly competitive market, is incredibly important for Indigo. And I guess we have demonstrated over the many years that Indigo has been able to maintain that cost leadership. And that, by the way, will also help us now in the international arena where competition is different. And clearly we should also have and maintain our cost leadership. The price of fuel obviously is an important part of our cost, but in the long run, the correlation between ticket prices and fuel prices is always there. And it may not be immediately in the quarter, or maybe even not 2 quarters, but over time that correlation is there. Because if fuel prices will go up substantially, it will have its reflection on ticket prices for companies just not to go out of business. If you look to the outlook for 26, I cannot do much more than repeat what some of these sort of international agencies are expecting in terms of a environment which is likely not to change. But I guess we all know that this can change pretty much overnight if something unexpected happens. And if I were to be in a position to make an accurate fuel projection, I guess I'll be doing something else than running an airline. So against that backdrop, we keep the agility. We have the youngest fleet, and with that, a very fuel efficient fleet. So I think Indigo is very well placed to, in case fuel would rise, to have the adequate planes for that. And if fuel remains at this level, to continue to operate with very attractive prices for our customers.
Peter, great conversation. Thank you very much for joining in. The Nifty still down about 1%, in line with the cuts that we're seeing across the Asian markets. IndusInd Bank, the expectation was that perhaps it's going to be, it's going to be under severe pressure in the morning. But look at the way IndusInd Bank is now back in the green. Top Nifty gainer, 3% up, 3.25% up on IndusInd Bank, and very close to that 800 rupee mark. So swift recovery from the opening lows on IndusInd Bank. Outside of that, in the frontline pack, you've got Colgate, weak, 5.5% down on the back of numbers. Oil India is reacting to the decline in margins. Oil India has a cut of nearly about 4%. Dixon sees pressure for the second day in a row. It was the earnings miss of yesterday, down 5-6%. Another 3% gone on Dixon Tech. On the way up, it's IndusInd Bank. We spoke about Nalco, Prince Pipes. That's been one of the mid-cap stocks of the morning. Soni Patnaik is now with us on the show from JM Financial Services. Soni, on expected lines, we've had a big gap down. Now, what would you advise for trade?
Good morning, Rima. Thank you so much for having me on the show. See, I think Nifty may slide down towards its 20-day EMA support, which is around at 24,350 odd levels. And maybe, that's the level from where a bounce back or a buy on dip sort of a structure can get formed. But as of today, 24,650 to 24,700 is seeing multiple resistances, and the expiry could just be below these levels. So only the resistance is taken out. It may retest 25,000 again, but as of how the call writers are placing themselves at higher strike prices, possible that Nifty slides down and the profit booking continues for the day before seeing any, sort of a good buying back from those levels. So it's advisable to stick to stock-specific strategy, and a balance of both short and long side can be seen for the day. The first buy recommendation comes in Indian Hotels, which is approaching its 20-day EMA hurdle. It has seen a very strong bounce back above its 200-day EMA. So I think the stock does not sustain historically below the 200 EMA. Bounce back is quite strong from those levels. One can buy Indian Hotels at current levels for targets of 790 to 800, keeping a stop loss of 758. That can be seen. The second idea is a sell recommendation, which is an official recommendation that we've shared today with the clients. It's a sell in Grasim. Also, Grasim has seen a stock, a breakdown below 2,700 levels as per the option chain breakdown, and also below its 10-day EMA support. So one can sell Grasim futures with a stop loss of 2,720 and targets of 2,630 can be seen.
Thank you very much for that. Get into a break. On the other side, Manisha Gupta will join in to focus on commodities. Stay tuned. As promised, Manisha is now with us in the studio. Manisha, what's the one commodity that we should look at this morning?
Well, I'm looking at a couple of them actually, and sharp gains overnight is what we are witnessing in both of these. One is an asset class, which is cryptos. Bitcoin is trading at an all-time high of 110,000, and we've seen prices gain up quite strongly in the last month or so. Actually, since the time 2025 has started, we've seen very strong gains continue into this one. But for the month of May alone, we are up by 15% for this. Well, it is the usual suspects which have led to a lot of buying in cryptocurrencies as well. It is the softer US inflation numbers that led strong buying, de-escalation of the US and China trade war, and then Moody's downgrading the US credit rating. All of that led to money flowing into cryptocurrencies. And then Coinbase joining S&P 500 was quite a watershed movement. And on that day itself, we saw prices gain up quite strongly. But apart from that as well, when you look at the cumulative inflows within cryptocurrencies, and especially Bitcoin ETF, well, those have surged to almost $40 billion now. And then there is record liquidity that we also saw for Tether stablecoin. The US Senate has voted now to advance legislation to create regulatory framework in US for stablecoins. That has been supportive for that space as well. And then the US president also has said that before the Congress goes for recess in August, he wants to see the crypto regulations ready to sign by August. So markets are really hoping for a lot to happen before the time that we see August ending there. This is what we've done in sense of month-on-month buying, in sense of many of those US public companies. For 2025, they have seen 31% increase in crypto holdings, so far standing at around $340 billion. Now, when you see that number, that is 15% of all Bitcoin available in the markets. So very strong buying coming in from the coordinated markets there. This is what we've done in the last 1 month in sense of cryptocurrencies. The best of the gains clearly coming in from Ether at 46% up, but the other cryptocurrencies, including Bitcoin, is 19% up, and 10 to 15% of gains is what we've seen in the last 1 month itself, with very high gains now being talked about in this year and the next as well. But the other thing that I want to watch and bring to the table is the silver prices. Very sharp gains into this one. For this week now, we are up by 6% for the silver prices. With that, we're trading at a 3-week highs as well. And the silver prices have been inching towards that 1 lakh rupees per kg market in the Indian space as well. The all-time high that silver has done on MCX has been 1,03,000, not too far away from those kind of levels. And the kind of breakup that we've seen come in for silver, the expectations are that you could be reaching that level pretty soon. Well, we have seen decline in US dollar index. There also is safe haven buying that we have seen in silver. Also, when you look at the China and the EU market, the photovoltaic or the solar demand for silver has been quite on the stronger side. Well, 2025 is the 5th straight year that you're looking at global deficit continuing in silver. Last year was industrial production at record highs. The markets are anticipating that we're looking at record industrial consumption for silver in this year as well, and that perhaps could be supportive. The targets that people are putting out for silver is a support of 30 or 32, but the upsides could be 38, 40, 42 as well for this year. So that's the kind of bullishness that silver seems to be carrying.
Thank you very much for that. Get into a break. On the other side, we'll have the management of DLF joining in.
Welcome back. Well, the markets are under pressure, but good times for the broader markets because the number of stocks advancing now has taken over the number of stocks declining. So more green on at least in terms of the broader markets. But let's focus on DLF. That's a stock on our radar. For Q4, they saw strong growth in bookings, collections, while launches in FY25 exceeded the guidance, but that was on expected lines. We have with us Mr. Ashok Kumar Tyagi, the MD of DLF, who joins us on the show. Hi, Mr. Tyagi. Good morning. Thanks a lot for speaking to us here on CNBC-TV18. Well, just to blend earnings, stock markets and the IPL, well, the IPL gives us a chance, right, to watch super cricket, but it makes the cricketers wealthier. I say this because Shikhar Dhawan, in this week itself, he's gone ahead and bought a flat in Dahlias for around 69 crores. Woohoo! How many units of Dahlias do you plan on selling, once it's ready? For this year, FY26, if you could give us a number. And I'm just going by these numbers and I'm Googling as well, 60 to, I think, 120 crores. The profit margin will be huge, right, on these flats?
Okay. So you asked a lot of questions in your one question. So yes, I also read the news about Mr. Dhawan buying the Dahlia, which is obviously very good. So, Dahlias has a total of, I think, about 430 odd units. We have sold about 190 odd of them so far. For the next couple of quarters, the sales would be relatively more muted on Dahlias. But I think we expect that by the year end, we should have our experience center ready, which should be the sort of, the launch pad for the next phase of focused sale on Dahlias. I mean, we have put out a 4 to 5 year timeline for selling out all of Dahlias because at that ticket size, obviously, you sell at a certain pace. I mean, we'll be happy if we do 4 years. Hopefully, we should do it that. Worst case, it could be 5 odd years. But that is broadly what it is. For the current year, I can't give you a specific guidance on Dahlias. But I can tell you that our total launch guidance, our total sales guidance for the current year is 20 to 22,000 crores of pre-sales.
But Mr. Tyagi, on this sales guidance for this year, 20 to 22,000, it's the same as what you did last year, which was about 21,200. Are you just being conservative? This number is going to be upped? Or do you think last year was an exceptional year?
So honestly, maybe it's a combination of both. Clearly, the Dahlia sales last year was an extremely positive surprise, even for us. That it will have such an enormous traction right at the launch stage. So in that sense, maybe those numbers were slightly higher than what we had originally anticipated them to be. If you recall, our sales guidance for last year was 17,000 crores, and we did about 21 odd. Frankly, Rima, while I know the market goes gaga about this pre-sales piece, I mean, we do believe that the two metrics that everybody, including the media, should really begin tracking now is the free cash flow and the embedded margins being generated. Because, if you sell 30,000 crores of stuff at a price point of 10,000 rupees a square foot at a margin of 2,000 rupees a square foot, is it really worth it? So we don't get too swayed by the pre-sales number. The pre-sales number for us is a derivative of the high margin launches that we make. And so we believe that as long as we stay in the 5-figure category for our free cash flow generation next year, for our embedded margin generation next year, and free cash flow by and large on track to what we did this year with a slight improvement, we should be good.
Okay, all right. When is the Mumbai project going to be launched? Every time I speak to someone who's developing in the northern part of the country, they say, y'all are jealous, the prices are going up too much. But when are you coming back to Mumbai?
Really? So I think this is our first project in Mumbai. I mean, really the first time that we are getting something on the ground. I think we should be hopefully closing out very soon. We are in the final throes of the approval process. I mean, in a slum rehab scheme with multiple slum societies, it is a more complicated, approval process than what, frankly, we were used to in Gurgaon. I'll be very transparent. But I think we are now almost at the business end of it. And I think we should be hopefully, filing for RERA approval, very, very shortly. And then depending on the time RERA takes, we should be ready to launch.
Any softness, though, in demand that what you have observed? Numbers, I think we've got most of them out. If you could give us two numbers now before we let you go. One is a qualitative aspect. Any slowdown are you seeing? And what is the rental income likely to look at for this year?
Okay, so the second point first. The rental run rate that we exited this year was about 6,000 plus crores. And we expect that the rental run rate by March 26 should be close to 7,500 crores across Cybercity and DLF, both parties put together. We should be at a 7,500 crores rental run rate by March 26. On the qualitative side of the demand, frankly, I think the demand continues to be robust. But what we have always maintained is that this is also possibly the time when most responsible players also need to just ensure that they are not entering the speculative zone, either in terms of launches or in terms of price points. I mean, clearly, I think the demand is strong, but I think we do need to keep an eye on the future, frankly.
Mr. Tyagi, it's a short conversation today, but thank you very much for joining in. DLF has had a good run. Stock is up 8.5% this week, reacting to its numbers. With that, we close down on Bazaar from the entire team. Thank you for watching. Don't go anywhere. On the other side is Chartbusters.
IndusInd Bank recovers 9% from lows. In fact, is the top Nifty gainer, even as the bank reported a loss of over 2,300 crore rupees in the fourth quarter on account of accounting issues and MFI stress. The management says they hope to start FY26 on a clean slate without carrying forward any of the past issues.
Colgate slips close to 5% following a weak showing in a tough environment and intensified competition. The revenue business estimates EBITDA and profit as well meet muted expectations.
Mankind trades under pressure on the back of an operationally weak quarter. Margin contracts 8.3% year-on-year. Profit also declines nearly 10%.
Tech Wabag rallies close to around 6% in trade after it reports a solid set of numbers. Revenues rise by 24% from a year ago. The management tells CNBC-TV18 that the order book will increase to the range of around 16 to around 17,000 crores.
NTPC Green trades higher post its fourth quarter results. Revenue increases 22.5% from a year ago. Margins expand while profit after tax also sees a significant rise.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. Hey Mangalam, the screen actually, we should get a couple of indices that come up in just a bit. I think they should come up. Yeah, more red than green is what we are seeing. However, the broader markets, you have a high number of stocks that are advancing in comparison to the number of stocks declining. So glimmer of hope there.
There is a glimmer of hope there, Nigel, but it is all volatile. At one point it was high. Right now it's actually, split right down the middle. We have just 20 stocks higher as against the number of stocks which are lower. In fact, as we speak, the crisscross lines come up for you on the screen. They have, intersected. But alongside that, we also have Yash on the screen because he's got us an exclusive. As the news flash at the bottom of your screen tells you that the SEBI may release its circular soon on weekly index expiry days. Yash joins in with more. Yash, what are these days and what does it mean for both BSE and NSE?
Well, of course, the important piece of news is that the circular, when it comes to weekly index expiry, is expected shortly. This is from the doors of market regulator SEBI. Of course, SEBI had put out a consultation paper very recently after the flip-flop in expiry days between the two exchanges, NSE and BSE. What SEBI had said in the consultation paper is that there would only be two expiries. One would be on Tuesday and one would be on Thursday. So there's this enough gap between the two expiries. And of course, once the final regulations are out, then it will be decided which exchange gets what day as its expiry. What we've been given to understand is that the National Stock Exchange, NSE, has already applied with market regulator SEBI when it comes to having Tuesday as its expiry day. What that means is that if NSE is given Tuesday as its expiry day, then BSE naturally would be given Thursday as its expiry day, as SEBI has said that both expiries from both exchanges cannot be on the same day. What we've been given to understand from our sources is that SEBI's appointed SMAC, which is the Secondary Markets Advisory Committee, met recently to discuss and suggest the final regulations around the expiry days to market regulator SEBI. As I said, NSE has already applied for Tuesday when it comes to that expiry day. Also, what we've been given to understand is that market regulator SEBI is actively considering NSE's request to grant Tuesday to the exchange as far as its expiry day is concerned. This could be negative, as analysts suggest, for BSE, because the numbers that we've been getting from analysts is that this could lead to a migration of about 20% volumes away from BSE. 15% could migrate to NSE. This could also lead to an increase of nearly about 5% market share in index options for NSE. These are the numbers largely that we've been collecting from analysts, but certainly could be negative for BSE.
All right, negative for BSE. If NSE gets a Tuesday, BSE gets a Thursday. Wonder how that goes on. We'll await the circular, as Yash said, should be out anytime soon. But let's get in some technical perspective on the market as well. 24,600 is where the Nifty is right now. The mid-cap index shade better in terms of falling not as much as the frontline indices. And the Nifty Bank actually is also outperforming, currently just below its 20-day moving average. We do have Sachidhanand Uttekar joining in for a quick check on the market. Sachi, what are your thoughts on the index right now? Do you think this is a dip worth buying, or maybe just stay away until the expiry is out of the way?
Good morning, Mangalam. Good morning, Nigel. Clearly, I think the market is under pressure. And if you look at the broader structure, it looks like a major consolidation phase. The base for this particular range is placed somewhere close to around 24,450, 500. I think that will be an ideal level wherein some control longs should be deployed. On the higher side, at least for the day, it looks very difficult for the Nifty to, recoup about that 24,790, 800 kind of a zone. But as of now, I think it looks like a sideways to negative day with the resistance clearly placed at 24,800. But I think the support, if we get a dip towards 24,450, 500, I think that will be an ideal level wherein some contra long positions can be deployed. When we look at Nifty Bank, clearly, 54,956 is the immediate level. And we see this particular level as a very strong resistance. The index has been, trending below its 5-day exponential moving average. And if you look at the data, it looks very certain that we may see a further swing towards 54,400, 450, within that particular range. So I think it's better to take contra bet on the Nifty on the long side in case if we see lower levels close to 24,450. But if you are trading Bank Nifty, then I think the bias for the day is negative.
All right, bias for the day is negative. And individual stocks, are you more on the short side, or you may fancy a couple of longs as well?
Mangalam, in fact, both the trading ideas are on the long side. The first one is Bharti Airtel. Now, the stock was witnessing a correction. The correction was very gradual. What we have observed is that the 1800 put writers have been very confident. It's a bearish, a trend structure, but within that, we have seen a breakout from a falling wedge formation on the 60-minute scale, which is indicating that there could be a trend reversal soon. What we have recommended is that the stock may scale towards 1865. The stop loss for the trade can be placed at 1818 on closing basis. Disclosure would be that we have recommended this trading setup to our clients as well. The other stock which has been a very confident outperformer is HAL. Even here, if you look at the last 4 trading sessions, what we have observed is that there is a rising 3 candlestick formation, which is a rare continuation pattern formation on the candlestick charts, which is indicating that the trend which is on the bullish side should continue. We are expecting that the floor is now well set at around 5,000. So the stop loss can be placed at around 49.90 on a closing basis. And even at this juncture, fresh long positions can be added. A trading swing can be expected towards 52.90 followed by 54.30.
Okay, all right. Thanks a lot for that, Sachi. Well, let's shift focus then to our special segment. We get a few ideas for profit from Money Control Pro. Anand Chaudhary of moneycontrol.com joins us to talk about a stock that is tracking closely. Anand?
So today, let's talk about Emmer Enterprises, a leading contract manufacturer of room air conditioners and their components, holding a strong market share of 26% in room AC. However, with the rollout of the PLI schemes, Emmer has strategically shifted focus from RAC to RAC components and into non-RAC components. As a result, RAC share in overall revenue has declined from 72% in FY18 to 43% today. Emmer has entered into a joint venture with Resojet to manufacture fully automatic washing machines, both top-end and front-load. In the electronics segment, Emmer is expanding its product portfolio beyond consumer durables to applications like smart meters, defense, and industrials. This will improve operating margins in this segment to 10 to 12% over the next 2 years. To strengthen its printed circuit board PCB capabilities, Emmer has acquired Ascent Circuit, simultaneously partnered with Korea Circuit for HDI and flexible PCBs. Emmer is putting 650 crore in a Hosur facility that will double its PCB capacity by FY26. Under the government's electronics component PLI scheme, Emmer is entering HDI and substrate PCBs. The combined capex for next 5 years will be 3,000 crore. Lastly, its railway segment, that is rebounding, will resuming Vande Bharat train and metro construction. Though stock isn't cheap, it is trading at premium valuation of 50 times on FY27 earnings.
All right, with that, we'll slip into a short break. On the other side, Rajendra Gandhi, who's the managing director at Stovekraft, joins in to discuss the company's 4th quarter numbers. Well, it's a little wobbly out there. We were talking about the advanced decline ratio. Now it has moved into the favor of declines. We have about 1,261 stocks which are in the red for about 1,200 stocks which are in the green. So those lines were crissing and crossing and now intersecting with the red marginally above the green. Among the stocks which is losing today is Stovekraft, reported its fourth quarter numbers, a 45% dip in their profitability. Saw a significant improvement in their EBITDA as well. But we have Rajendra Gandhi, who's the MD of Stovekraft, joining in to discuss the quarter that went by. Thanks a lot, Mr. Gandhi, for joining in. The EBITDA, the net profit, all of that aside, let's talk about the revenue. I remember us having a conversation here on CNBC-TV18, and you had earlier targeted double-digit growth for this year. And not just that, you also said it would be in mid-teens, etc. You haven't met that. For 2 years in a row, the revenue growth has been 6-7%. What's causing this slowdown in revenue, and what's your outlook for this year?
Good morning. On the quarter gone by, we had missed on the planned revenue for the quarter. It is there was a little slowdown in the general trade. There is a change in the technology for our coated cookware for exports, so we have geared up for that now. So we could not execute all the orders that were there in the last quarter for our exports. There was also a decline in the institutional and that last mile delivery business. So all this put together, from our planned revenue, we were short by almost 10% of our revenue, which is also reflecting on our, though there was increased gross margin and EBITDA, is reflecting on our PBT and PAT. Overall, but for the year, we continue to grow. And going forward, we believe these things, particularly on the export business, there is a very strong outlook. And with the domestic business also getting up, we believe that we'll be back with the growth. And as planned, we will definitely be able to.
What is that growth? What is that growth? You said you'll be back with the growth. What is that growth?
So it will be definitely above the double digit. And also we are working on improving our gross margins from the current level. We both the EBITDA and gross margin, we'll be able to improve on margin by at least a percentage on both.
Okay. All right. Hi, Mr. Gandhi. Mr. Gandhi, the street must be flummoxed, right? A second year in the row, you're saying that you'll grow at XYZ and then you don't grow at that. Yeah. How confident are you that this time you'll do a double-digit growth? And exports, you're saying that there is strong demand out there. Last year, how much did it contribute? And this year, how much you expect it to contribute?
So we closed the year at about 160 crores on export revenue, which we believe will have substantial growth here. We have a very strong order book, but there is a change in the kind of coating that we do, which we are going through the learning curve. As soon as we stabilize this, on the order book, we have a very strong order book. If we are able to deliver, we can also see a growth of about 55-60% on the current number on export.
All right, 55-60% if you're able to deliver. You know, Mr. Gandhi, not only is the street flummoxed by you not having met your revenue guidance, they are also flummoxed by the fact that the presentation hasn't been uploaded on the exchanges yet. It's not something that you do regularly. You often do it immediately after the results. So just wanted to understand what has caused this delay. And for those who are used to seeing the presentation, are also used to seeing what products, geographical regions, what categories, what did they do in the quarter? So if you could give us a sense on how cookware, appliances and stovetops did in the fourth quarter, if you could break that revenue down for us categorically.
On the presentation, there could be a glitch. I'm not very sure why it was not. I'll get back to the team. On the growth, I can tell you that we continue to grow on the small appliances. By value, we grew by 25%, by volume about 6%. Our pressure cooker, we could grow by volume by 1.4% and on value about 0.5%. And cooktop, we could grow on volume by about 6.7%. Induction cooktop, we grew in volume by 2.3%. The mix for us, of course, the small appliances continue to dominate. So we are growing faster than the other categories. So 43% of the revenue is contributed by our small appliances. For the cookware category, that is including the cookware and the pressure cooker category, is about 39%. And the cooktop, that is induction cooktop and the LPG stove categories at 18% on contribution to revenue.
All right, Mr. Gandhi, you had that tie-up with IKEA, right? Partnership with IKEA. And you were saying that at peak in the next few years, it can do what, 200-300 crores, right?
So we have set up the facility, and we are doing up. We are getting up to the delivery date, and there's a process of development. We are likely to start business in the third quarter. More of that business will start seeing in the fourth quarter. We are likely to start delivering from November. The plant is getting ready. Yeah, it's a great. We see a huge potential there. Apart from IKEA, we have multiple retailers globally, particularly from America, who are more keener to work with us. We have a very strong demand side and also a strong order book on exports. Of course, the execution will be what we'll be able to deliver. And if we are able to deliver, the next few years seem to be very strong on exports.
That's the golden question, sir. If you can deliver, that's going to be very, very important, because you have told us you have the capacity. You need to ramp up the revenues. Execution doesn't seem to be catching up. And if I got that correctly, last year you did 160 crores of exports. And this year you're saying there's a possibility that it could even grow by 50%. Is that correct?
Yeah, right, sir.
Got it. And what about on the margin aspect? Realistically, what kind of a margin guidance do you want to give us for this year?
We are able to get to the 38% as envisaged and planned. The margin side on gross margin, we are able to correct. At EBITDA, because there was a little short of the revenue in the last quarter, we could not achieve the 11%. We are at around 10.5% on the EBITDA margin. We believe both at the gross margin and EBITDA margin for the current year as a whole, we'll be able to improve it by 1%.
Right. Mr. Gandhi, I'm looking at your numbers, compounded sales growth, your profit growth over the last 5 years and 10 years. Over the last 5 years, your sales compounded at 17%. Last 10 years as well, they compounded at 16%. Last 3 years, the sales have not come by. They've compounded at just 9%. And similar is the case with your return on equity as well. 5 years compounded number is 14%. Right now, the average is 9%. Profitability as well over the last 3 years has actually declined by 13%. What is this issue structural? Yeah. And what can you do to improve it? I mean, that's what the street would want to know.
This is a planned investment that we have done, and which is resulting in lower ROCE. We have been investing in the last 3-4 years. We are almost at the fag end of the capital investment, or I can say that is almost done. We are ready for the larger growth now. We have the capacities in place. We also see an opportunity that is ahead of us. Even on the demand side, we don't see a challenge. More particularly, larger demand driven by exports. And when demand in the country also comes back. So this both, we are very confident on that. Okay. So we are at that inflection point where from here on, we'll see improvement on all these ratios.
All right, Mr. Gandhi, is it an industry problem? If yes, are you outgrowing what the market is growing, or are you degrowing less than what the market is doing? And according to your assessment, have you gained market share?
In each of the categories that we operate, we have definitely gained market share. In majority of the categories that we operate on volume, we have larger market share than any of our peers. Definitely, the demand side was not very strong in the last 7-8 quarters in the overall domestic market. But we are poised with all those changes in the government policies with increased custom duties, with deterrence on imports. We are now, being a manufacturing company, upwards of 95% of the products that we sell are manufactured within our facilities. We are highly backward integrated. This gives us a huge headroom over competition. So we are actually ready for that larger opportunity that lies ahead of us. And even on the margins, we are very confident now with where we are. We can improve on this. So it is that we have a higher depreciation because of this, and that's why you see a lower PBT, PAT, which will get corrected.
So you're gaining market share, you're guiding for double-digit revenue growth this year, and some margin improvement. Are we getting that correct?
Perfect.
Thanks a lot for joining, Mr. Gandhi, but we're going to hold you to these numbers, and your investors will be hoping that this time around, at least, you deliver what you have guided for. Appreciate you joining in and speaking to us here on CNBC TV 18. Stock down close to around 4.5%. In the last few trading sessions, it's been seeing intense selling pressure on rather large volumes as well. Slip into a break, come back, we'll continue our focus on markets. Well, let's cut across to SEBI Chairman Tuhin Kanta Pandey, who's addressing the press. Let's hear him out.
Thank them with a round of applause. Unless we are secure, our economy cannot grow. It's an honor to be here today and share my thoughts on the key growth enablers that can propel India towards the ambitious yet achievable vision of becoming a Viksit Bharat, a developed nation by 2047. As we stand at this pivotal juncture in our economic journey, it's clear that India's transformation will be powered by a convergence of long-term investments, infrastructure expansion, technological innovation, and deep institutional reforms. The government's commitment to building world-class infrastructure, improving ease of doing business, and unleashing entrepreneurial energy has already begun to redefine the contours of our economy. Digital transformation, the emergence of AI, and the strengthening of digital public infrastructure are unlocking efficiencies and inclusion on an unprecedented scale. These developments, combined with strong macroeconomic fundamentals, policy stability, resilient financial market ecosystem, are creating an enabling environment for sustained capital formation and productivity-led growth.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia, and still down close to about 200 points in the Nifty. The Nifty's at that 24,600. Expected to be a muted start. Caution prevailing across the Asian markets too, and so far there hasn't been a recovery.
Yeah, repercussions felt on
ripple effect.
Ripple effect, and it's showing up on a lot of these sectors as well, right? You see it on IT, you see it on a lot of these export-oriented names as well. But again, 24,600 is the level that the Nifty is fighting to hold on to currently, even as IT has recovered a bit from the lows of the day. Some very choppy moves seen in the metal names, but still a 200-point cut on the index. Currently seeing a bit of a status quo as of now, not falling, but we're not trying to recover from the lows as well. Of course, there are plenty of stock-specific movers in the broader markets, and they are the ones that are either reacting to earnings or there have been news flows related to them. NTPC Green Energy at one point was up 10%. It's slightly off the highs of the day. Now it's still up 5% and among the top gainers on the Nifty 500. But the one that has sprung up to the highs of the day is Shipping Corporation of India, and that is now up 10% in today's trading session as we speak. So the top gainer there, Shipping Corporation, at the highs of the day. Speaking of shipping corporations, Garden Reach 2 had seen a bit of a surge after it emerged as the lowest bidder for that 25,000 crore project for the Indian Navy. So 4% higher on Garden Reach as well, and it's doing well for itself. A lot of these names, including the likes of Astral, which is an earnings reaction, Solar Industries, that is continuing to build on to those gains that have been seen post the positive management commentary. So that's another gainer. Among the losers though today, we have BSE. Of course, we just heard from Yash a few minutes ago on the exclusive that he had done on the expiry days, and the decision from SEBI could be out soon. So 5% lower on BSE. Colgate Palmolive is an earnings reaction, so 4% lower on that stock as well. And JK Tyre giving up some of those gains in today's trading session as well. But of course, the big earnings reaction that we were watching out today has been IndusInd Bank, and after opening 5% lower, there has been a significant recovery in the stock, seeing some choppy moves today. At one point was up almost 3%, and this is despite a quarter that was weighed down by accounting issues, the MFI stress, and a lot of other issues as well. Abhishek is now joining in to tell us what brokerages are making of these numbers. Abhishek.
It's the highest percentage earnings cut that I've seen in the banking sector post the numbers of a lender in Q4 FY25. So brokerages have cut earning estimates ranging from 35% to 40%. Motilal Oswal has cut by 45% over the next 2 years for IndusInd Bank. Loan growth to be in single digit in FY26, largely brokerages say that, and about 10% in FY27. Now, it's difficult for the bank to reach an ROA of 1% is what the brokerages do say. The path is long drawn. ROE to be below the 10% level, around 6 to 8% over the next 2 fiscals. This event to monitor will be the new CEO at the helm, whose name the bank will submit to RBI by the end of June, that is 30th June 2025. Now, largely brokerages have cut down the target price. Some of them are downgraded, like IIFL Capital to reduce from add. HSBC has also downgraded to reduce. Target price has been cut to as low as 600 per share, while Macquarie has a target price which is the highest on street at 1,210 per share. Back to you.
Thank you. And it's over to Ritu now, who joins in with the key conference call highlights from IndusInd Bank. Ritu.
Well, after posting its biggest ever quarterly loss driven by multiple accounting lapses that are now being labelled as fraud, IndusInd Bank is promising a full clean-up. In an unusual move, we had Sunil Mehta, who is the bank's part-time non-executive chairman, personally addressing analysts on the earnings call, calling the developments since March unfortunate and painful. Now, he acknowledged that the board was not informed of these discrepancies at the time of approving results earlier, but assured stakeholders that now the bank is taking comprehensive corrective action. He sought to allay concerns, saying auditors have now conducted deep dive reviews with expanded sample sizes to adequately and fairly account for any past lapses in the fourth quarter earnings, and that the board now suspects a fraud against the bank that involves certain employees and is pursuing legal action, including reporting to investigative agencies and regulatory authorities. He also reiterated that the board's approach is to start FY26 on a clean slate, with all known financial impacts already absorbed in the FY25 numbers. The chairman also disclosed that RBI has advised the bank to submit proposals for the appointment of a new CEO for its approval by the end of June, and that the board is in advanced stages of the selection process and is hopeful of submitting these recommendations ahead of the deadline. So now, while there may be questions on the auditors and the board's own accountability and how quickly a new CEO is appointed and is able to steady the ship, the biggest question for now is whether the worst is behind. And to that, all that the management has to say is that the full financial impact of all the known irregularities has been accounted for, and to the best of their understanding, no further issues remain.
Indeed, Ritu, thanks a lot for that. And that's IndusInd Bank for you. Earnings cuts, target cuts. The stock currently trading around 0.4% lower, having given up most of those gains that it saw in early trading. But the other mover in today's session is VRL Logistics, and that is of course on the back of its earnings, 10.5% higher on that stock. Mangalam is here to tell us what exactly happened during the quarter. Mangalam.
Two things happened in the quarter. The company got rid of low margin businesses, and as a result of which it improved its realizations. And secondly, they increased their cost saving initiative. So if you look at it, the revenues were up just 5.6%. No big great shakes out there, but the EBITDA jumped 77% year on year. Margins improved by 1,000 basis points. 13.7% turned into 23.1%. And we have the net profit, which surged from 21 crores all the way up to 74 crores. So near 250% jump out there too. This continuation of low margin businesses impacted volume growth. So that's reflected in an 11% volume growth that we've seen, volume degrowth that we've seen. But realizations improved by 18% because they've discontinued those businesses that didn't make them money. And at the same time, they've also increased their cost saving initiatives by buying in bulk fuel. So earlier that accounted for 31% of their total purchase, and now it's accounting for 41%, as a result of which their diesel procurement prices came down from 87 rupees per litre to about 84 rupees per litre. Going forward, they are looking at prioritizing volume growth. So maybe the volume dip that happened right now will recover going forward too, along with cost initiatives. The street likes that. The stock up 10%.
Thank you very much for that. I think there is a dividend as well that the company has announced of 10 rupees. Margins are 23%, highest that we've seen in the last many quarters. And also VRL Logistics, as the stock hasn't done too much. In the last 3 years, the stock price is only up 7%, which basically is today's up move. Strip that out, 3 years, the stock has pretty much given no return. We will get into a break. Thank you, Mangalam, for that. On the other side, we'll discuss commodities. Manisha Gupta joins in.
Welcome back. Still near the 24,600 mark on the index, but we're shifting focus now to the commodity space. Manisha Gupta is joining in, and today we put the spotlight on silver. Manisha.
Well, yes, that is because we are not too far away from that lakh rupees a kg mark yet again for the Indian markets here. In the global markets as well, this week has been quite positive. We are up by more than 3.5%. Silver is trading at a 3-week highs as well. And for the Indian markets, as I said, we are going back towards that all-time highs that the silver prices did touch in the month of Feb there. Well, a few factors which clearly are supportive for silver buying currently. One is the decline in the US dollar index. Well, that has been supportive for most tangible commodities. The second is the safe haven buying. We've seen that come back in case of gold, and silver seems to be going higher because of that. And then because silver is part industrial metal, most of these industrial metals have been doing quite well in this week, and that in turn has been supportive as well. Well, just to tell you that nearly 55 to 60% of all silver usage in the global markets comes in from industrial fabrication, industrial demand, that is. And the additional supportive factor is that 2025 is going to be a 5th straight year that you're looking at global silver markets in a supply deficit. Last year, it was a supply deficit of around nearly 2 billion ounces, and this year as well we are looking at a very strong deficit. Those are the numbers that tell you that after a record silver industrial demand in last year, this year as well, a 700 million ounces of an industrial demand is what the street is anticipating. So everywhere that you look, there's very strong support coming in for the silver prices, and the kind of numbers that we've seen come in from EU and China also suggest that the solar industry seems to be needing more and more silver as we go forward from here.
Thank you very much for that. Now moving on to Bansal Wire. Reported a decent set of numbers in Q4. The top line and the bottom line went up by nearly 30-35%. Pranav Bansal, Managing Director and CEO of the company, is now with us on the show. Pranav, hi, morning. This is Rima here. Good quarter. Now as we look ahead, what can you guide for FY26 in terms of volume, since there is incremental capacity which comes on stream? And what was the volume number and the growth in FY25?
Sure. Hi. So 25 has been a good year for us. We closed at about 3.5 lakh tons in volume, which we started off the year with 2.5. So that was a good jump that we were able to see. Of course, part of it was due to consolidation. Looking ahead, even in FY26, we see some good volumes coming in. Now that we have about 5.6 lakh tons of installed capacity with us, we are looking to ramp that up very soon and very quickly. So we are looking at about 20-30% jump in volume.
Looking at 20 to 30% jump in your volumes. Pranav, good morning. Thank you for joining in. I'd like to ask you about the Dadri facility. You had earlier mentioned that you had mentioned in the previous quarter that you see around 20 to 25% utilizations there. What are the current utilization levels, and do you expect them to ramp up in the new financial year?
So in fact, we closed at about 40% utilization for the last month of the year. So with that, we would try to utilize that to the maximum level possible this year. That's how we are looking at a 20 to 30% volume jump. And now with that capacity, we had 5.6 lakh tons in total, which will also jump by about 1.2 lakh tons in the next 2 quarters as well.
So your installed capacity will now, say by the end of next fiscal year, would stand at 6.8 lakh tons. Is that correct?
Absolutely. Okay. This is in lieu of the demand that we are looking at, or we are seeing from our customers in all our entities.
Okay, but your volumes, you're saying, will only go up, say, by 30% on a base of 3.5 lakhs. So 4.5 lakh tons would be the volumes in terms of the sales?
That's the least that we're looking at. Although this year will be a year where we would want to ramp up our volumes even higher.
So what would be the realistic volume growth? Because you're giving a guidance of 20 to 30%, but you're saying it should be even more than 30%.
I mean, that's the target, but I think a safe estimate should be about 20-30%, in which we should be able to very easy.
Pranav, are you witnessing a slowdown in any of your segments? As far as your business mix is concerned, most of your business is towards the auto segment, then you go into infrastructure, engineering, durables and miscellaneous as well. Do you expect this mix to remain how it is in this financial year as well? And in the sectors mentioned, are you seeing any slowdown so far? What is the kind of on-ground scenario you're witnessing currently?
So our main strategy has been to diversify as much as we can in different end users, and that has worked for us throughout the years. This year should also not be very different. We are looking at a similar product mix even this year. This in turn with a lot of new products that we have added, I think automotive will be the largest end user as was last year. And on the demand side, also, we see good demand coming from our customers. We are also increasing our market share in those customers while adding new products, new offerings for those customers.
But Pranav, now that your Dadri facility has now ramped up, as you mentioned, you ended the year at around 40 to 45%. Do you see an improvement in your EBITDA per ton levels from the current levels? If you could mention what are the current levels and what are you anticipating the growth to in the new year?
So we are now implementing a 2-year strategy in which FY26 will be a year where we want to grab a higher market share, even if we have to sacrifice our EBITDA a little bit, so that by FY27 we can come back to the same level of EBITDA with a higher base. And plus, with that, we will also be established in our backward integration project by FY27. So that will also give a push in our EBITDA going forward. But for FY26, because of the product mix and because of a higher volume base that we are targeting, we feel that the EBITDA might go down by 10% in per ton basis. But of course, in absolute numbers, it will definitely go up because of the 20-30% increase in volumes.
So EBITDA per ton will go down by 10% in FY26 is what you're trying to say as you try to gain market share.
Absolutely.
So what is the current?
This is also a mix of product mix. It also differs in the product mix.
What is your current market share, Pranav? What are you targeting to get to?
So currently, I think we would be at about 8%, 9% kind of a market share, and the industry grows at about 7% every year. Whereas we've been growing at 20-25%. So, every year we gain some market share.
What about exports? What's the contribution of exports to your overall revenue? Say FY25, what did it grow at?
So last year we closed at about 10% of our revenues in export. And I think that is our target even for this year. We are a company that is focused on the domestic market. And that is where we see a lot of good demand coming from. Of course, export should also grow at a reasonable pace. But the percentage of export in our total revenue should be similar.
What about your capex plans, Pranav? You've highlighted that there is a 600 crore investment in Sanand that you're making for a 1.8 lakh ton steel plant and a stainless steel wire facility as well. You are currently debt free. So how are you funding these? Is all of the 600 crore being funded via internal accruals?
So majority of it will be absolutely funded through internal accruals. We've done an EBITDA of about 270 to 80 crores last year, and that should only increase this year and the year going ahead. So in the next 2 years, we should have enough internal accruals to fund this with some mix of debt.
What will be the asset turn?
Asset turn, I do not have those numbers right now.
All right, Pranav, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management of Bansal Wire there on the road ahead for the company. Take a short break. A quick chart check on the other side as the Nifty is now slumped to the lowest point of the day. Sudeep Shah of SBI Securities joins in with some trading ideas as well. Stay tuned.
That's very soon, sir. It's only 22nd. So it's already 22nd, so that'll be very soon, I think.
It should be soon then.
Thank you, sir. Thank you.
Sir, update on the panel. IndusInd Bank, sir, the board yesterday said that the it has submitted its report to the government. So any step that SEBI is taking on that and regulatory agencies?
No, I think the RBI is looking into that. Whatever the SEBI has to do in relation to whatever SEBI's remit is, SEBI is doing.
Sir, can I also ask you on the NSE IPO? It's been stuck with SEBI for a very long time.
Yeah.
What is the update on that?
Is there any progress in the process?
Which?
NSE IPO.
NSE IPO, I think all I can say is that if all the outstanding issues will be resolved and we will move forward.
So by when? Is there any timeline on it?
Can't give you the timeline, but I think we should soon be doing it.
So have you received any assurances from the NSE side on some of the outstanding
NSE and
issues?
SEBI, they are talking, and I think they are resolving the issues, and I'm very hopeful that it will be cleared and we'll move forward.
So this one issue is about the crypto regulation. Now the crypto is at 110, and if there is a demand that there should be a proper regulation in India. But as of now, as a regulator, what is your view on this?
No, that is a policy call is to be taken by the government. Crypto as such is not a security at the moment under the SEBI's remit.
So also on the NSCL matter, sir, is there any settlement scheme that's likely for the commodity brokers on the NSCL scam that happened earlier?
NSCL is?
NSCL.
Yes, I think we are working on it. That will be through soon.
And so also are we looking into the corporate governance issues of IndusInd Bank after GenSol, that initiative that you've taken?
I replied, whatever.
Okay, that RBI is looking into.
It's RBI's remit, so far as a bank is concerned. But to an extent, whatever there could be, if there are any egregious violations by anyone in its capacity, that SEBI is looking into it.
Okay, so just coming back on that expiry date, sir. So just queries coming in that. So as of now, there is no change. Tuesday and Thursday is what it is at the moment. But going forward, waiting for your further directions, that may change. Great, sir.
Thank you, sir.
Thank you, sir.
Thank you.
Important comments there from the SEBI chairperson Tuhin Kanta Pandey on the NSE IPO, on IndusInd Bank, the expiries as well, the story that Yash just broke a few minutes ago. So important commentary coming in there, and he mentioned that they'll be issuing directions on the expiry dates this month after comments received on the consultation paper. So the decision is likely to be soon. And on the NSE IPO, of course, he did mention that all the outstanding issues will be resolved. Of course, he did not share a timeline as to when does that happen, but he said that he is optimistic that this will move forward soon enough. So important commentary coming in there from the SEBI chairperson. But time to talk more on the markets. Then Varun Locha from HDFC Securities is now joining in. Varun, good morning. Thank you for joining in. IndusInd Bank, of course, can't not talk about it. After the loss that it was reported, the commentary that you heard from the management yesterday, do you believe that the worst is now done, or there are more questions than answers here?
Yeah, hi, good morning. So IndusInd, it's actually there are still a lot of moving parts. We are not able to get an exact handle on the underlying numbers. But our view on the stock, we have a reduced rating. And we believe even if this is, probably all the skeletons are out, and if this is the worst number, even then we believe the road to recovery will be a prolonged one because a lot of things have to fall in place. In terms of, even the liability franchise is weakening a little, the investor confidence is really shaken up. So I think the path of ROA improvement will not be a very smooth one. And therefore, we believe it's better to avoid it at the time being. And, we have other stocks in the sector which are looking more attractive from a 12 to 18 month point of view. So that's our view on IndusInd.
Varun, do you have a view on BSE? Because sources, I don't know if you've caught the story that Yash has been putting out, but sources have said that SEBI's circular on index expiry days for exchanges may come soon, and NSE has likely applied for Tuesday as its expiry, which is basically BSE's date. So for NSE, it shifts from Thursday to Tuesday, if approved. So if that happens, what could be the potential impact on BSE and how would this play out?
See, again, if it were to happen, there will definitely be an impact on BSE volumes because the pace at which they have been gaining market share in the derivatives market was really strong. We currently have an ad rating, but our target price is not materially higher from the current price given how sharp the run-up has been on the stock. Our thesis has been on medium-term market share gain story in derivatives, which has played out to a large extent, but we believe it is still, there are some more, there's some more room for market share gains over the next 12 months. But if this were to come, this will definitely impact, in terms of earnings because the pace of market share gain, accelerated after the change to 2 expiries per week.
Right.
And Tuesday would always get a better volume market share. So. But we won't be able to comment on specifics till it comes out, and gets it.
Varun, while we are on this subject, let's just go across to my colleague Shivani, who is in conversation with Ashish Kumar Chauhan of the NSE.
Have their own strategies. Other independent blocks like China or India will have their own strategies. And so it remains to be seen finally how it settles down with the US, but also across ASEAN and many other blocks. And so it is just what I call a beginning of a change where India has not been a very large part over the last 30-40 years of the trade portion of it, that is the manufactured goods trade, because we have been more in services. But we are getting an opportunity to realign our manufacturing to ensure that when the world is trying to move away from China, India has a legitimate claim, and of course with its skilled workforce and low labor cost, we should be able to make a good dent in the manufactured exports also.
Okay. So FII outflows was also some of the concerns, was one of the concerns in the past few months for the Indian market. Has that stabilized, and what do you think in terms of after Operation Sindoor, a lot of talk about that was happening. How do you feel about that?
In a way, the FPIs were moving away because of the strengthening of interest rate in US for last almost a year. This month onwards, I think April onwards, the FPIs have started investing in India in a big way. There is also a talk about moving away from dollar. And so there are emerging markets like India, which is not so emerging because we are now the 4th largest in the world. But effectively, lots and lots of foreign capital is going to pour into different markets which are trustworthy. Currently, a lot of inflows are being seen in Japanese assets for the time being, which is moving away from US. But some benefits are coming into India too. So that's how you see a positive sort of inflows by FPIs into India over the last 1.5 months.
So from a sector perspective, defense has been doing very well post Operation Sindoor and obviously the budget allocation that we saw in this year's budget. How do you see sectors panning out? Do you think there is some bubble, or do you think some sectors are going to come up?
In a way, whenever such what I call path-breaking situations happen, a lot of companies get involved, and naturally India has actually changed the paradigms of war which had come about over the last 10 years, which was largely drone-driven. And the first time over last 10 years, a country has proven that over a border of 5,000 kilometers plus from Ladakh to Kutch, India has been able to protect itself from the low-cost drones, which is itself a unique achievement. And I think the new phase of the way the battles are fought are going to be basically fought on the way India has now defined, or India has redefined. And that's where many of the Indian companies which have provided this equipments to Indian armed forces would also have their equipments in demand across the world. Of course, within Indian armed forces also, but across the world. And that's where I think you might see some movements. But overall, we don't look at individual companies. What we see is some of these things happen because of the way the technologies change, the way the frameworks change, and clearly India has redefined the concept of battles and wars over which was coming up over the last 10 years in some ways.
The last question from you is that there is a lot of talk today about the expiry day circular from SEBI. What is NSE's take on it? Is there a day that you have decided?
No, we have not been aware I mean, we are getting it from you, but whatever the decisions of SEBI, we will have to go by.
And sir, what about the IPO? Where has that point reached?
Again, we are awaiting our no objection certificate. We have applied to the regulator, and as and when that comes, we can do the further process of preparing the DRHP and later on filing it with the regulator again and things like that. So it's a still work in progress.
Thank you so much, sir, for joining us here on CNBC TV. Thanks a lot. Thank you.
Welcome back. Varun Rochab is still with us. Varun, thank you for staying on. I can't not talk to you about defense, right? Because there is so much that has happened. Stocks are up 50-55% in the last month. And the broad gamut of the sector that it is, where do you position yourself in? Would you go in with the traditional names like the BELs and the HLs? Do you go with the shipbuilders? Or do you go with the equipment suppliers like Zen? Or even for the technology names like Data Patterns?
Fortunately, won't be able to comment much on that because we don't cover the defense stocks, So, but as a space, obviously in our capex report, we have been consistently highlighting in the last couple of years that the defense spending by the central government seems quite structural, the runway of growth is fairly large for these companies. And in addition, now even the export story should pick up for the sector. But beyond that, we don't cover individual stocks, so won't be able to comment.
But do you cover individual stocks within the pharma basket then? Because that is another sector that has been under a lot of uncertainty with regards to the tariffs that have coming in, the pricing pressures in the US markets. Again, the generic players, the CDMO players, where in pharma?
So pharma and healthcare both we cover, and in fact we like both of those spaces. We have been quite positive on names like Sun Pharma has been our top pick for the last 12 to 18 months. We also like Torrent Pharma, Eris Life Sciences among the smaller names, Alchem Labs. So these are some of the top picks from the pharma space. Even CDMO space looks quite attractive from medium to long term. The growth rates are looking attractive. Inquiries have increased, though I think FY26 numbers are not looking that great for some of the CDMO companies vis-a-vis the expectations, which were very elevated. But from a medium term, 2 to 3 year view, we are quite, we see good opportunities in the CDMO space as well. So pharma and healthcare, I think overall is a good space to be in from a next couple of years perspective.
What about banks, Varun? I did ask you about IndusInd, but you mentioned that there are other names that where you could find value in. So would you like to go with the larger private banks, which have still been there and thereabouts in terms of giving returns, but it's not the 15, 20, 25% returns that you would find elsewhere? So private banks, PSU banks.
See, I think 20-25% return expectations would be a bit too much from a large sector like banking. What we are anticipating is that next year would be better for banking sector from two perspectives. From a smaller bank's perspective, the credit cost will normalize upward. Credit cost will be better for some of the smaller banks, which saw a lot of pain in FY25. And at the same time, the large banks and overall banking sector will have some NIM pressures, which will lead to overall PAT growth of around 10 to 12% for our coverage universe of the bank. So, but valuations are supportive, so there is some room for PE re-rating. So to expect 12 to 15% return from banking stocks would be a more reasonable expectations. And we believe the larger banks are better positioned to capitalize on the growth as well as to be able to navigate the volatility and the pockets of stress in terms of the credit on the credit side. And the liability franchise, the cost of deposits, that has already some of the pain has already gone through in terms of the NIM compression. So incrementally, I think beyond FY26, that pain should also subside. So large banks, ICICI, SBI, have been our top picks for quite some time. And even Axis Bank we like. So I think these three would be the top picks in the banking sector. We are still sticking with the large banks.
All right, Varun, thank you so much for sparing time and joining us. Looking forward to having you more often on the platform. Take a short break. The management of Team Lease joins in on the other side. Stay tuned.
Welcome back. The next corporate conversation is with Team Lee Services. The stock right now is up by close to about 4% and perhaps reacting to the improving margin trend. In Q1 of FY25, margins were 0.9%. Q2, they expanded to 1.2%, stayed the same in Q3, and in Q4, they further expanded to 1.7%. And for the full year, revenue growth has stayed at 20%. Ramani Datti, CFO of the company, is now with us on the show. Ramani, hi, morning. This is Reema Tendulkar here. Before we get to the outlook, just explain the headcount decline. On a sequential basis, your overall headcount is down by 7,500. Is it purely on account of attrition in BFSI? Or are there any other pockets of weakness in hiring? And what is the outlook on headcount addition going forward?
Good morning, Reema. So specific to this quarter, as we have already called out in Q3, this is a planned absorption with one specific large NBFC. And other than this, we are not seeing any kind of challenge with other industries. In fact, all the consumer verticals for us are doing very well, both in terms of new headcount hiring and expansion to new geographies. So other industries, as of now, we are not seeing any challenge. BFSI is the only one that has impacted as far as general staffing is concerned. We'll come to IT later, but within general staffing for this quarter, the entire dip that we have seen is on account of the NBFC insourcing or absorption.
So is there a headcount addition guidance that you can share for next year?
So we would be comfortable to add at least 10,000 per quarter, so which is about 45,000 for the full year. That's the outlook that we have right now for next year. In case if BFSI and NBFC hiring gets picked up, it can be incremental to that number.
Got that. And how would this 45,000 crore of a headcount addition compare with what you did last year?
See, 2024, FY24, we did about 37,000 headcount. This year, because of the BFSI hit, it was down to 27,000. But going back to 45,000 looks achievable because we have already delivered similar numbers in FY24.
Sorry, you're saying FY25 headcount addition will be 45,000 versus 27,000 last year?
FY25 is 27,000.
Yeah, so you're expecting a big jump going forward.
Yes, that's correct. Because we are not foreseeing any further insourcings or absorptions in BFSI or any other vertical.
Sure.
And we are currently working on about 30,000 plus open positions. The demands are going up in other sectors and industries as well. So 40,000 volume addition for next year is something that we are targeting.
Got that. What about margins? Can you continue with the improving margin trend? And what would be the foremost reason which explains the improvement in margins?
Yeah. So one is, first of all, in all the businesses, we have already hit the bottom last year, especially in Q1. That's what we called out earlier as well. So we have been consistently improving on new client acquisition, more operational efficiency using technology enablement, and more focus towards cost optimization. That has definitely helped. In addition to that, we also have diversified our product portfolio, be it within our HR services or within specialized staffing, and also new geographies have helped us to expand the margins. And for next year as well, except for Q1, we will be able to demonstrate consistent margin expansion quarter on quarter. Q1, because of the annual appraisal impact, there'll be a dip in the margins. But barring that, we are confident of maintaining the margin expansion trajectory for next year as well.
Well, Ramani, you spoke about the BFSI segment, right? But what about others, like, say, the quick commerce segment or even the FMCG segment? What is the kind of growth that you have witnessed here? And what are the trends that you are currently witnessing on ground almost, 45 days into the first quarter?
Yes. So as I called out earlier, FMCG for us right now is giving the maximum open positions. In fact, out of the total open demands that we have right now, almost 35% are into consumer related verticals, be it FMCG, e-commerce, quick commerce, retail. These sectors are giving us the maximum open positions. In addition to that, pharma, telecom, and a few other emerging sectors are also giving us good open positions. BFSI at this stage is still lull. We are expecting some recovery around the festive season, before the festive season picks in. But at this stage, we are not having any major hiring demand as far as BFSI is concerned.
Now, we can't not ask you about IT, and I don't want time to run out before we get to IT hiring. I believe GCC, that's Global Captive Center, now contribute 60% to specialized hiring. Is that correct?
That's correct, Rima. So 60% of our revenue in specialized staffing comes from GCC. This number used to be 40% about a year back, and we have been consistently adding a good amount of clients on GCC front. So that's the good news. But unfortunately, on the IT services, the domestic demand is actually very low, and in fact, it has been slightly coming down quarter on quarter. And the uncertainty continues. Even at this stage, we are not seeing any green shoots as far as IT services is concerned, while we are confident on the GCC side.
% compares with 45% a year back?
Yes, that's correct.
Got it.
All right, Ramani, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management of Team Lease, the street likes what Ramani was highlighting on the road ahead. Headcount addition seen at up to 45,000 compared to 27,000 in last year. The stock has now surged to the highest point of the day as the conversation went by. Take a short break. Up next, we put the spotlight on ITC. Numbers expected later in the day. Stay tuned. Welcome back. Nearing the lowest point of the day now for the index, 227 points lower so far, struggling to hold on to that 24,600 mark for the Nifty. So not very good going for the market so far, at least for the benchmark index. Of course, that does not take away from the fact that there are a lot of movers on the upside, and you pull up Fortis Healthcare. That is now the top gainer on the Nifty 500. That is also, of course, after the management commentary, which is on the bullish side in their earnings call, and you can see the move that you've seen in Fortis Healthcare, 9.5% higher on the stock. But the one that we're focusing on today is ITC. Numbers out later in the day. Mangalam is here with what the street is expecting. Mangalam.
Well, two things before we talk about what the street is expecting. For ITC, don't look at the versus numbers, because the current numbers will be X the hotel business, and the versus numbers, we'll watch it when it comes in, the income statement itself. So, which is why I've not given a percentage change in the numbers. So what you're supposed to look at is the numbers that the street is expecting, and this is adjusted for the hotel business. You're looking at revenues of 16,820 crores. The same number last year was 16,579 crores, but there is no percentage change we'll have to make because the base will get restated once the company reports its numbers, its hotel business as well. So 16,820 is the important number to watch out for. EBITDA would be 6,100 crores and margins of 36.5% as well. And the net profit that you're looking at is 4,960 crores. The other part is that the most important number for ITC is the one that it does not give, which is the cigarette volume growth. The street is expecting 4 to 5% cigarette volume growth. This could be inferred with a 6 to 8% sort of gross revenue growth in the cigarette business, with a 3 to 5% EBIT growth. Any more than that would mean that there is a beat on the volumes. And then you'll keep an eye out on the FMCG business as well. 6 to 8% revenue growth is what the street is working with out there. But more than the revenue growth, I'll be curious to know how the margins perform, because last quarter there was a big dip in the margins. This time around, the street expects a 200 to 300 basis points dip there as well. And finally, the revenue growth on a low base will be led by the agri business because of favorable environment right now in terms of prices for tobacco leaf and the liberalized export policy. So agri business likely to show revenue growth of upwards of 20-25%. Paper business, 3 to 5% growth is expected, but that's because the cyclical nature of paper business, which is currently undergoing some sort of issues. So weak performance from paper business, good cigarette volume growth. The overall numbers come in ex-hotel demerger. Watch out for better performance in agri and margin dip in the FMCG vertical.
All right, Mangalam, thanks a lot for that. We'll keep an eye out on ITC, and just as Mangalam was mentioning, numbers not to be compared on a year-on-year basis, of course, because they'll be adjusted for the demerger of the hotels business. But with that, we call time on this edition of Trading Hour. From Rima, me and the team that put this show together, thank you so much for watching. Halftime report on the other side.
Concerns over rising US deficit and the per show at Treasury auctions spooked the market. Auto, FMCG and IT stocks are the big drags.
IndusInd Bank stock gains on hope that the worst may be behind the lender, but analysts remain wary of more skeletons spilling out of the cupboard even as bank suspects internal fraud and continues its hunt for a new CEO.
Indigo Airlines owner Interglobe Aviation sees its profits soar as higher traffic aided by the Mahakumbh rush. Festivals and weddings drive up income and realizations with forex gains too kicking in. The company also declares a 10 rupee dividend for the first time since 2019.
Softening urban demand and intensifying competition led to Colgate-Palmolive missing revenue expectations even as profits come in line. The oral care major hopes for a revival in the second half of the year.
SEBI will give its final word on the weekly expiry soon, says Chair Tuhin Kanta Pandey. This is even as CNBC-TV18 learns that NSE has applied to shift its expiry date to Tuesday from Thursday. Pandey adds that SEBI may look into any violations by IndusInd Bank that merit attention.
You're watching us here on Halftime Report on CNBC-TV18. I'm Manglam Malu. With me, Ekta Batra. Not looking like a good screen for the frontline indices. The Nifty is down by almost 1%. The mid-cap index is falling a little less. We have the Nifty Bank down 0.75% as well. 40% more stocks declining than the number of stocks which are advancing. So portfolios are not looking particularly happy. Day before yesterday, we saw a sharp gash in the last hour. Yesterday, there was some recovery. Today, on account of global fears, perhaps there is some weakness.
Hi, Manglam. Yes, I think it's absolutely in line with what the global markets are doing. We saw the markets, the Asian markets correct in line with what we saw in terms of global cues. And, Asia did fall after the US decline, which was on account of deficit concerns. Just to put it into perspective, the US 30-year yield has broken above 5% for the second time this week and has reached levels that we've not seen since October of 2023. So that's really what the street is looking at in terms of a cue going forward. Separately, in terms of earnings back home, I think stocks will be in focus on account of earnings. So we have ITC as well as Grasim coming out with numbers, and separately Sun Pharma, Honasa, a couple of stocks to watch out for, MCure from the pharmaceutical space. So these will be a lot of, stocks in focus, and that's probably where the action will head in the second half as well. But let's start with the big stock in focus today and has been making news since the past couple of weeks and especially post its Q4 numbers last evening. IndusInd Bank is in the green after what was a weak fourth quarter and disappointing fourth quarter that was weighed down by accounting issues and MFI stress. Abhishek's been looking at this story. He joins in with what the brokerages are making of the numbers now.
Well, as you mentioned, it's one of the weak counter that we saw with respect to the results coming in, and largely it was factored in. The stock is flat right now, and if you take a look at the earnings, it's been one of the worst earnings in the banking sector from top to bottom across various parameters. Corporate book declining by as much as 15.7% sequentially. It's not seen ever before. It's also, the highest decline that you are seeing amongst all the other large private banks. The net interest income decline of 43% YOY and 42% sequentially, highest decline in the banking sector. The net interest margin for them is the lowest ever that they have seen historically, coming in at 2.25%. Other income was down sharply by more than 71% YOY and about 70% sequentially. The only bank to report an operational loss in Q4 FY25 and the bank to report highest net loss in Q4 FY25. Slippages were elevated, 5,014 crore. The annualized slippage ratio is the highest in last 16 quarters, coming in at 5.8%. Asset quality gross NPA ratio is perhaps the highest that you are seeing in last 10 years or even more, and they have used their entire contingent provision of 1,325 crores. With reference to the P&L, both the NI and PAT is below our poll. Coming on to brokerages, they have cut earning estimate anywhere between 35 to 40% on an average, and as high as 45% by Motilal Oswal. Loan growth to be in single digits, and they say that return ratios will remain tepid over the next couple of years for IndusInd Bank. Back to you.
Okay, all right. Abhishek, thanks very much for that. So that's on IndusInd Bank. Some flashes about Colgate on your screen from the conference call talking about demand. So just keep your eye out on that. But RVNL reported an operationally weak performance in Q4 with a decline in revenue and EBITDA. Vinny, our colleague, caught up with MP Singh, who's the director, to discuss the quarter gone by and their growth outlook.
Financial year 24-25 was a challenge for us as we're transiting from our core sector of railway projects to projects secured through bidding. And the predominantly cause of the muted revenue growth in 2024-25 is substandard performance in Q1 and Q2, predominantly due to region of the election in first quarter, which has affected the execution by affecting the movement of the labor. And the Q2 was affected by unusually high monsoon in the country. But from Q3 and Q4, the execution has accelerated. And you can see from Q3 as compared to Q4 performance is substantial improvement. And in Q4, the revenue growth is of order of 40%. And when compared to the Q4 of the financial year 23-24, the decline is only to the extent of 5% only. But we hope to improve this execution performance in this financial year. And I'm very sure that with our innovative execution methods and resiliency and growth potential of our organization, we'll be able to not only improve our revenue target significantly.
Sir, what will the improvement in revenue targets be for FY26? What could we expect? Right, full year right now is around a 8%, 9% decline. Q4 was a 4% decline. Surely an improvement, what you're seeing on a quarter-on-quarter basis. But FY26, could we expect this to turn positive, mid-single-digit growth at least?
Yeah, certainly we want to improve. The silver lining is in form of our revenue growth from projects secured through bidding, where you can see in the year 25, the revenue growth is around 68%. And if this growth continues, and we are securing more projects in various sectors, so we hope to see a significant improvement in revenue guidance for FY26, and it will be of the order of 22,000 crores.
Okay, 22,000 crores is what you're talking about in terms of revenue guidance. So that was your guidance in FY25 as well, right? 22,000 crores, but that was a miss coming in. So now you're reiterating that guidance for FY26 that you will achieve 22,000, right?
Yeah, we are expecting that because we are some of the projects which we won through bidding, the large projects, they are now under execution, and we hope to get a large revenue share from those projects, be it a BharatNet projects or our projects in various metro sectors and RDSS projects. Last year, it was basically starting year. As in the project execution cycle, the normally first year is revenues are not that significant, but in the mid phase of the project, the revenue growth is substantial.
Okay, so those projects will now start giving you the benefits that will come in, and that's when we'll see the growth also coming in. The first phase is over in FY25. FY26 is where you're going to see that better growth coming in. And sir, overall order book, what is that at right now? And what do you see it going forward also?
Yeah, the order book is a dynamic figure because it keep on moving by adding up the new order flows and reductions in form of the executions done. So the current order book stands around 97,000 crores, out of which around 47,000 crores is from our legacy projects. The rest are from our projects secured through bidding. So this gives us a revenue visibility of around 4 years time. And we hope to see significant revenue in order inflows in FY26 also.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, definitely a weak day for the markets. We have the Bank Nifty, which is now down over 400 odd points. We have the mid-cap index, which is down over 300 odd points, and an almost 800 point cut that we can see on the Sensex as we speak. Just watch out for a couple of stocks which are managing to buck the trend. So Dishman is up around 12.5% after what was a turnaround on the operational front, and Fortis Healthcare after it held its conference call midday yesterday during market hours. That stock is up around 9.5% today. So definitely some amount of positive outcome there. But let's talk about a couple of companies then. Gulf Oil Lubricants is the next management on the show. It reported what was a steady set. Margins, however, came in flat. We have with us Ravi Chawla, who's the MD and CEO of Gulf Oil Lubricants, joining in to talk about the numbers. Mr. Chawla, welcome to the show. Well, you know, before we start talking about the margin picture, just wanted to understand the entire volume picture. If you can just break up what the core lubricant volumes were this quarter, as well as, say, for example, what you did in the B2B segment when it came to infra and industrial. Was it probably as good as the previous quarters where you did record, the highest ever volumes?
Well, on the volumes, this quarter we've closed at the highest volume ever in a quarter, 39,500 for lubricants, which is about a 7% growth. Even the year has similar, we've closed at 152,000 KL, which is again a 7% growth. So if we have about 10% of business in factory fill, that didn't go very well. If we take out that, we've been at 9%, but 7% is the record. And as you spoke about the industrial IMF, that has continued to grow. And overall, also, we have seen, a good steady quarter. And we managed the margins well because you did have in that quarter, in the quarter four, you did have some exchange rate issues. But we managed that well. And I think this is also the highest margin. And as predicted in the 12 to 14% band, this is 13.6. So I think the quarter has been a steady, good growth quarter and a record year in terms of our profits also have gone up 17%. So I think a good year and a good end to the year in quarter four.
Where does your market share stand at the end of this year? And if you could also break up your revenue in terms of industrial and non-industrial businesses, how much is that contributed? What's your outlook for the next year?
So our B2C business is about 53-54%. The rest is the B2B, which, as you said, of course, the products differ because some automotive products go into industrial. So that we have kept that, and all segments have grown. And I think in terms of overall, I would say that the growth that we have been gaining over the last many years has been to grow 2x the market. So even this year, I think we've been growing in across segments, our key segments. So we have gained close to about 0.4 or 0.5% market share.
And where does it stand at right now?
So in different segments, in diesel engine oils, we are close to double digit, and motorcycle oils. The others, we are around 6 to 7%.
Okay. Now, just coming to the margins, you've seen a fantastic growth in terms of volumes, but your margins have remained flat on a year-on-year basis at 13.5%, and you've closed FY25 with a lower margin of around 12%. Take us through what the key drivers are, how is crude impacting this at current prices, and what are you targeting in FY26?
Yeah, so typically crude will, the base oils that are derived from crude, they follow crude. But we have also seen that base oils, because of the different availabilities, doesn't necessarily follow it all the time. But yes, there is a lag which comes. So I think this year has been challenging in the sense that the exchange rate also plays a role. And we have been able to look at all our segments growing. And we continue to invest in the brand and our, marketing activities. So I think for us, we are looking at this 12 to 14% band, because we believe that is where we are, and also trying to focus on premium products, improving the mix. So we hope we can move to a 14 to 16%, but definitely we would require stable prices of, base oil. But I think that is where we hope that now with the current, cool off in terms of crude, we are able to see that so that we can move to the next band.
All right, we will await the next band. If you could give us some color on what proportion of your revenue currently comes in from premium, and what are you targeting out here since you are looking at increasing your premium contribution?
So we have typically synthetics and semi-synthetics. For us is still less than 5%. So great opportunity for us. And we do have other products which are, I would say products which give us a better margin. So a combination of these, we've been trying to in the last 1 year, try to improve that. So if we've been growing 7% overall in volume, we try to at least grow at double the rate here. So we're able to then bring in margin. But yes, since we are growing in all the segments, whether it's agri or car or motorcycle and B2B. We want to really focus on both volume growth and also keep the margin band and continue investing in our brand and other initiatives.
Okay. Just want to, narrow in on the biking segment. That is something that you've spoken about in terms of, a key focus for the company going forward. Tell us, how did that particular segment do for you this time?
So it has done very well in Q4. Actually, our motorcycle segment, we have the standard range, which is the mid range of the. And we're also looking at going to the premium range, which is the adventure bikers. So we are investing in our brand there through the India Bike Week. So motorcycle has been one of our key strengths. In fact, we've just launched a campaign for Gulf Pride with a new pack and with the highest specification in the industry with a long drain interval of 10,000 kilometers. So this is really where we've been delivering the best products. We've also gone to the right at the top end with the adventure bikers. And we also have a range for, the value segment, which is called Zip. So we've kind of segmented the market and are focusing on this because this is one of our strengths. Even our brand consideration and brand awareness is in the top 2-3 in the industry. And motorcycle is a key driver for us. We have Mahendra Singh Dhoni, who's our brand ambassador, who's also a very big biker, as we know. So we are promoting our brand, our distribution. We have bike stops, which are branded garages. And we continue to grow with the bazaar segment and with OEMs like Bajaj.
Right. What about, Tyrex and EV batteries? I remember Tyrex, you were targeting 500 to 700 crores with that EBITDA break-even coming by soon as well. Where are you on that path? And EVs as well. You had a target of battery business to do about 300 crores of revenue. Where do those numbers stand?
So happy to share that our business, DC charging business, which is Tyrex, has actually tripled in their revenue and crossed 75 crores this year, 78 crores. So that's a start, I would say. And we are projecting 400 to 500 crores in 5 years' time. Tyrex has about 8 to 10% market share in DC chargers. So that's going well. We're going to expand the factory, expand our service. So that's doing well. Obviously, it's a start in terms of our business. And we've got a lot of chargers installed across in terms of DC charging. They are also manufacturing AC chargers, and that will also help us. And overall, in terms of batteries, I'd just like to tell you that we are into two-wheeler batteries since a number of years. This is mainly for the traditional two-wheeler batteries, but we've also started supplying some batteries for the EVs, for the auxiliary start. So these are VRLA batteries. And that again, we are happy to share in both these businesses. We are now positive in terms of our EBITDA.
How much are they contributing to the business as a whole, and how much do you want it to contribute? What is the target?
Currently, we are happy we crossed 3,500 crores as a revenue as a company in this year. And batteries, two-wheeler batteries, about 75, 80 crores. And Tyrex is a similar turnover this year of 75 to 80 crores. But ambition is that in the EV charging, DC charging, we can go to 400 to 500 crores in 4 to 5 years' time.
I have to ask you this. What is the difference in the market share between you and the leader? And we understand that Castrol is on the block, right? Would you be interested if there was something which was on offer?
Well, let me just tell you in terms of market share, we are definitely the second highest market share in the private sector. And we do have a lot of opportunity to grow somewhere in some of the cases where we are less than 5% market share. So I think overall that is there. And yeah, we'll have to watch the developments on what's going on, as you rightly mentioned. So I think a lot of interest is there for many, global players and other players. So we'll have to wait and watch this space, I think.
Why do you think that would have happened? Is it because the industry is, it does not look very feasible for players in this space, for an industry leader to actually go ahead and, offload its asset? What do you think has driven this? Is it just an individual case, or is it a sectoral call that BP would have taken?
Well, I think that is for them, but I can tell you the lubricant market is a very good market in India, and also it is growing here. So it is a very good market here and other countries also. Definitely in the Western world and developed countries is flattened out, but lubricants as a market is growing very well in India. We've also been leading that to explain to people. And we are seeing the impact that a lot of companies are coming and making investment in fresh production facilities. Indian companies who deal with lubricants have expanded their base oil. So I think India and a lot of the other markets, you are seeing growth, obviously due to reasons of economic development, industrial development, penetration of vehicles. And even if EV is coming, we still see lubricants growing 3 to 4% in the next decade. and maybe it will just go a percentage down after that. But India is an attractive market, so I can speak for that, yes, there is an interest in this industry. I think companies would take their calls based on their priorities. For us, it's a focus, and India being such an important market, I think many players are coming into India. We have seen that over the last 2 years.
You have 450 odd crores of cash, and update the figure if you can for FY25 ending. What's the plan for utilization then?
Yeah, so we are happy to share that our board has agreed on a final dividend, which is a record 48 rupees, 1400%. And we have got 1,000 crores cash. We crossed that milestone. So I think keeping that in mind, obviously we are returning to shareholders, but we also will look at some investments in the EV mobility space. And maybe that is what we have done with Tyrex and a few others. So we'll continue looking at spaces where we can invest. But currently, obviously, the dividend has been announced. So it's been a record dividend also.
All right. And you are not interested in buying Castrol, if at all it comes to that?
So no comment on that. I think, as I told you, the market is attractive. It's for everybody to look at what there is. Consolidation keeps happening. So we'll have to wait and watch.
Take that point. Thank you so much for joining in and fielding all our questions. Ravi, always a pleasure speaking with you. With that, we'll leave you. Wish you good luck for the remainder of this year. Take a short break. Come back on the other side. Pearl Global Industries. The management joins in to discuss their fourth quarter numbers. Welcome back. The other company on our radar right now is Pearl Global. It's reported a strong set of fourth quarter earnings. More importantly, for the year as well, the revenues jumped between 30 to 40%. The question is, where do they go from here? Pallab Banerjee, who's the managing director and group president of the company, joins in now. Thanks a lot, Pallab, for joining in. Two-part question. One, will you sustain this revenue run rate going forward? What's your expectation? And secondly, with all that's happening in the US and the free trade agreement with the UK, what are the opportunities for the next couple of years?
Thank you, first of all, for having me on this show. Yes, as a company, Pearl Global, we have a growth plan, and we have been growing at a quite a reasonable rate, and we'll continue to do so. And see, most probably all these garment industry, if we talk about, the largest global players, mostly from Taiwan or Korea, there are multi-billion-dollar organizations or sales top revenue that they generate. So our goal would be to compete with them and be a big global player. So that way we are looking forward to a good future, like in which we will be continuing to grow quite aggressively, I would say.
So 30% sustainable, 25% sustainable, because the base also increases, right?
Our CAGR that we have been planning is about 15%, 12 to 14% is something that we have been talking about. And yes, when the opportunities are there, like, the market is disrupted at this point of time due to various reasons. And this is the time that, if you are a strong company, then that's the time to gain your market share. So this year we got a good share, almost about 30% we grew. It looks like in the next few quarters, it's looking like that this kind of similar kind of, not maybe 30, but a little less, but that kind of, it is still showing. But yeah, on an annual scale, we would say that definitely we are confident that 12 to 14% we should be able to achieve.
Okay. Well, Pallab, the conversations with, peer companies have indicated that US clients are asking them to bear the cost if it comes to tariffs and the burden of the tariffs if it comes to that. Is that the case? Have you had any such conversations that you can highlight?
Yes. You see, like most of these US companies, the US retailers and brands, they have reached out to all their suppliers to partner. And there are various ways partnership can be done. Most of these companies at this point of time is having a 10% duty, or extra tariff that is being done. So as you know that too, we have a WTO tariff, for example, for a cotton shirt or a cotton product, it's averaging around 17%. And now there's a additional baseline tariff of 10%. This is something which has been implemented on April 2nd. And that's why most of these retailers have come back to their supply base and say how that can be mitigated. So that's why some burden share discussion has happened. And now how do you circumvent it? One, you give some kind of discounts and help the retailer to absorb part of the cost that they absorb, something we absorb, and then something maybe passed on to the end consumer. Or the other way, how do we do it? There are two, three other things also can be done. So it's a combination of these three that most of these US retailers have asked for and been negotiating with their vendors.
So if they meet midway, what could the margin impact be? Because you're targeting 12 to 14% revenue CAGR. What is your margin expansion plan going forward?
So margin expansion plan is more than 12 to 14%. We have said that we should be expanding our margin by almost about 17, 18%. But then our exposure to US market is about less than 50%, I would say. So, and on top of it, we are implementing all these three models that I was talking about. So for example, they are badly stuck in China. How can I help on those products rather than giving a discount? Then the second thing is if I can land the product, because most of these retailers have a higher cost of landing the product compared to us, we can maneuver faster and at lower cost. So, and the third is that simple, you don't do these two things and just give us some kind of discount. So that we have been negotiating. So it's part of a simple negotiation that we do every quarter, every season. So I'm not overly, I would say, worried about it. Maybe for one quarter, it might come in the books because normally our costs are frozen with the retailers for about on a quarterly basis. So
sorry, you said EBITDA compounding should be 17 to 18%, right?
For us.
Yes, so that implies margin expansion. If you could, for the benefit of our viewers, currently your 9% EBITDA margin, what is an aspirational target and by when do you get there?
So we have said that we are looking forward to a double digit between 10 to 12%. And we have given a plan, most of our investors, that within the next 3 years we should be doing it. But we are almost there now. We have almost crossed 9. We are touching almost double digit in this quarter. Also, we almost touched 10 because there are some new projects that we have started, which is still in losses. Otherwise, we should have been more than
okay.
double digit.
The UK FTA, the India-UK FTA, how does that affect you all? And how much do you get in terms of revenue from the UK?
The UK currently is about overall approximately 5% of our revenue. And we have been servicing that market majorly from Bangladesh. As you know, the Pearl operates factories in Bangladesh, Indonesia, Vietnam, India, and Guatemala. So UK, most of our shipment has been going from Bangladesh already. And these customers, with the expectation of the FTA, have been talking to us for the last few quarters and have started doing some business in India as well. So we look forward to definitely the India component will be going almost about 3x or maybe 4x over the next 1 to 2 years. And it should benefit us. Rather than servicing from one country, now we should be servicing them from 3 countries. As you know, that even Vietnam also got into that comprehensive trade Trans-Pacific Pact, because of which they also have the same kind of benefit. So it's a very dynamic movement in the world at this point of time, and the opportunities are coming.
And where would your incremental capex be, considering that it is completely dynamic, in terms of opportunity? So any kind of incremental capex that you have on the cards, and where would it be?
So we are, in fact, our major production is happening in Bangladesh, India, and then followed by Vietnam. So in all these 3 locations, we do have capex plans. For Bangladesh and India, definitely we are going ahead with it.
Okay.
Right. And what about capex? How well utilized are you? What's your capacity expansion plan from here on? How do you fund it?
So we have been funding our capex. We had a QIP also done some time back. So we had that fund which have been allocated this year, and then apart from that, the kind of cash that we are generating, that's going back into the capex. So that planning we have shared with our investors, and that's something that we will be implementing. So the next year, I think we are talking about almost about 230 crores. We already have a plan, plus some more opportunities that we are looking at.
And the asset turnover that you're looking at?
Asset turnover, if you've seen, ROCE has touched almost 30.1, and ROE also is about 20.1 at this point of time. We would be maintaining or having a similar kind of run.
Okay. Just quickly, you have operations in Bangladesh. Just wanted a sense, there are these new import rules which have come through as well. Any kind of impact on business that you can share?
So what our business is that we are supplying to the global retailers and the brands across all the markets. Like I told you, markets like USA, UK, Europe, Japan, Australia. We are not so far very focused on Indian market or China market as of yet. So the import restriction that you're talking about is the goods that is imported from Bangladesh into India. So that doesn't affect us at this point of time.
Okay, all right. We're going to let it go on that note. Thanks very much for joining in and speaking with us. So that's Pearl Global. They're targeting a revenue CAGR of 12 to 14% over the medium term, and a bit cautious about the trade tariffs and the negotiations at this point in time. We'll take a short break, but more on the markets, and we'll focus on F&O once we're back. Stay tuned.
Well, it's a weak day of trade so far. No, two ways about it. Down 250 points for the Nifty. The Nifty Bank is down about 0.75%. The mid-cap is now increasing its losses, though not as much as the Nifty, but still down about 0.2%. A good time to get in, the advanced decline lines as well. They started with the red line above the green one. Then there was an intersection. There was some recovery from the lows that was quickly sold into. Now the lines far and wide apart. It's weekly options expiry today. So what are the levels we're looking at? Not too different from where we are right now. The 24,600 call is seeing some writing, 20 rupees premium, telling you upwards of 24,620 will be some supply, but at the lower level, 24,500 put is equally active for a premium of 15 rupees. So those are selling this strangle, which is a 24,500 put and a 24,600 call. They are hoping for a range between 24,500 at the lower level, 24,470 to be precise at the lower level, and 24,630 at the higher level as an expiry range. Important level to watch out for in the Nifty, 50 points from here at the lower level is the 20-day moving average. The Nifty Bank, which has been meandering around the 20-day moving average yesterday as well, recovered, is now firmly below that level. So the next leg to watch on the way up for the Nifty Bank will be this 20-day moving average itself. Colgate is seeing a lot of shorts. Management commentary in the conference call notwithstanding. ITC too ahead of numbers is down about 2%, seeing some short addition. And we had pointed out the possibility of Dixon Tech entering F&O ban yesterday. Well, it hasn't happened, but today it may, given the rise that we've seen in open interest. And in case you miss all of this, what you can do is you can get all of that on your fingertips, because that's the good news. India's business news leader, and now just a click away. This is the CNBC-TV18 app, which gives you instant access to breaking news, in-depth articles, and all financial world updates, all of them at your fingertips. What you can do is download this app from your Apple Store or the Google Play Store, or if not, just scan that QR code, which will give you the link that redirects you to download link for this app. Stay with us.
Welcome back. Well, for the markets, like we've been pointing out, has been weak, but a couple of stocks have been managing to buck the trend, and one of them is Fortis, which is actually doing quite well at this point in time. Remember, I did mention that the numbers did come out day before yesterday, and the conference call was held yesterday during the market hours. Now, in terms of a couple of key takeaways, the company is interestingly looking to add around 1,976 beds over FY26 to 29. Majority of the expansion is expected to be brownfield. They expect the brownfield beds to achieve a break-even within 6 months. FY26, they're estimating 14 to 15% growth in the hospital business and 150 to 200 basis points margin expansion in the hospital business. The growth is expected to be driven by 5 to 6% growth in the RPOPs. Now, diagnostic guidance, FY26 double-digit revenue growth, margins mid-20s is what they're guiding. FY26 EBITDA margin on a net revenue basis could probably reach 23%, and in a couple of years, 25%. Nomura has written on Fortis. They maintain a buy and a target price of 700 rupees. According to them, the revenue growth guidance of 14 to 15% is ahead of the current estimates of 12%, and the company guidance implies FY26 hospital segment EBITDA margins at 22 to 25%, better than estimates of around 21.9%. Nuvama retained its buy, target price 770. It's amongst the select few players, according to them, on a margin ascent trajectory over the next few years. This is backed by 60% brownfield expansion and high occupancy. So good going, Mangalam, for this particular counter, doing well in today's trading session. I think the street is quite bullish on the fact that the margins in the diagnostic business did well this time.
That's about the company that reported its numbers, but what about that is likely to report their numbers? Ekta, Sun Pharma, what is the street expecting?
Well, yes, Sun Pharma revenue growth of around 9%, EBITDA growth of 19%, margins 27% is what the street is anticipating, and a profit growth of around 10%. Expectations is that revenue growth will be led by domestic growth by around 9 to 11%. Street is estimating US revenue of around $500 million, which is up around 4 to 5% Q on Q. Drugs like Revlimid generic are likely to be flattish to marginally higher at around $20 million Q on Q. The global specialty business range is wide. It could be $315 to $330 million and is possibly expected to decline Q on Q, X of milestones due to seasonality. R&D, watch out for it. It's expected to be 6.5 to 7% of sales, so that could impact margins. Commentary, guidance of the global specialty business, and launch of a couple of key drugs in the US markets.
All right, with that, we'll take a short break. On the other side, all things commodities. Manisha Gupta joins in with Sumit Gupta of CoinDCX, perhaps discussing the big move that we've seen in crypto. Bitcoin, remember, this morning hit a fresh record high.
Welcome back, and joining us on the show is Sumit Gupta. He's co-founder at CoinDCX. Sumit, what a day. It's pizza day, and it is also an all-time high day when it comes to Bitcoin there. I mean, I remember the folklore says that there was a time that you could buy 2 pizzas, just about 2 pizzas from a Bitcoin. It's trading at 111,000 right now. For the Indian markets, that is 94 lakh rupees for 1 Bitcoin.
Yeah. And you know, Manisha, how much those 2 pizzas are worth today? It's over $1 billion. Over $1 billion. Let that sink in. Yes. Phenomenal.
So how are you reading into the price move to begin with? Because, you know, the year didn't start so strong. Of course, there have been those underweight currents coming in from the US markets. But this rally clearly comes in on behind of legislative moves. And not just that, the public companies, the kind of holdings that they have increased in Bitcoin.
Oh, yeah, absolutely. I think this one is a bit different. Normally, we have seen the previous rallies coming in because of retail investor participation. This time, we clearly see that there are institutional investors and whales which are driving the market sentiment than retail investors. In fact, yesterday, I was looking at the Google search trends, and I've not seen a lot of activity in terms of Google searches on Bitcoin. What that means is that a lot of people are still on the sidelines. But this rally, this price move is largely because of US institutional investors who are wanting to get into this asset class before anyone else, and now it's at the 5th largest asset class in the world, even bigger than Amazon and Google. So yeah, we have come a long way.
Well, we have. Also, Sumit, when you look at the Bitcoin ETFs, and that clearly was a changing factor as well in 2024 itself in Jan, that is in the last 1 year with $40 billion of, you know, the inflows that we've seen happen in the matter of last week itself. How are you reading these trends?
Honestly, Manisha, I think these trends are going to continue because when I speak to people in the US, I think it's just the beginning of the rally. It's just the beginning of institutional investors. It's the beginning of ETFs. I don't see any reason why this should slow down. Not just that, if you look at the data, as of May 25, only 7% of Bitcoins are held on exchanges up for sale. What that means is 93% of the Bitcoins are on private wallets, cold wallets. And when you see a scenario like this where people are not selling, people are hodling, right? That means that the buying pressure is so high and there's a supply squeeze, which is going to drive the price higher and which is going to force these institutional investors to get in even more earlier. So the time that we are sitting in, I think this rally is going to continue and institutional investors are not stopping.
There also is a statement from the US president saying that he wants to see crypto regulations ready to sign by the month of August before Congress goes in for recess. What are you anticipating from this bill?
I think I would take that seriously, those timelines also seriously. I mean, from my discussion with a lot of my friends there, I think this government is very serious about, passing bills. I think we have seen stablecoin legislation coming out already. We are also expecting one more legislation in terms of market structure. I think those are some massive moves. And yeah, I think there's a lot more momentum that we will see in the coming few months.
And where does that leave India, Sumit? Because, yes, it was this week itself that we heard the Indian Supreme Court yet again tell the centre to come out with some kind of a bill, some policy when it comes to cryptos.
Yeah, I mean, that's a tricky one. We've been calling it out from several years now. I think, see, look, Bitcoin is the 5th largest asset class by market cap. If people and if governments are still not serious about Bitcoin being a serious asset class, I don't know what will. I think it's high time. India needs to open up and give more openness and legitimacy to Bitcoin investing because retail want to get in, people want to get in, and Bitcoin is a lot safer. It's a $2.2 trillion dollar asset class, and if not today, then eventually, if we do it 2-3 years down the line, then Indians would end up paying lot more in the years to come. So I think the earlier we recognize it, the earlier we regulate it and bring it under the purview of regulated scenario, I think that is going to be beneficial to everyone, to the industry, to customers. And it will build a healthier and a safer ecosystem because the world is moving.
It sure is. Sumit, even as we wait for that policy paper, how are you looking at the Indian participation? I understand the taxes are really high, but there are people who continue to invest even at these numbers. Also, the derivative market, that seems to be really picking up and developing faster.
Yes, all the markets are picking up fine. And we are seeing a lot of new investors coming in, Manisha, a lot of new participants. Obviously, it's not as much as we had seen 3-4 years back because of the high taxation. But let me also highlight that if someone is buying Bitcoin and holding it for 2, 3, 4, 5 years time period, I think the tax does not impact them. So it doesn't stop anyone to investing and looking at it like a real estate or a very long-term investment. I think because there is no TDS, TDS is only applicable when you sell Bitcoin. Capital gains when you realize the profit. But I think the way current tax structure is for spot buying, I think people can still take an exposure and either do SIP. We have SIP product. So there are a number of ways in which people can start taking some exposure before it gets even more expensive. And I was looking at doing some analysis yesterday. I think all the macros and tells me that we are nowhere the end of the rally. I think is just starting, and I do believe the rest of the year is we are going to see a lot more momentum in Bitcoin prices.
Oh, well, absolutely. There have been various reports from global banks and brokerages as well suggesting that. But, it's not just about Bitcoin again, because we've seen Ethereum gain by 45% in the matter of last month. A lot of meme coins in US seem to be doing quite well. The Trump coin itself, I mean, the US president is going to have dinner with the people who own his meme coin. I mean, there's just so much happening, which is serious and then not so serious as well. What is the serious stuff that you will watch out for this year?
Yeah, I mean, a lot of those things continue to happen. I think Bitcoin is largely dominated by retail plus institutionals. I think a lot of these Trump coin and meme coins are largely retail frenzy, which is driving the prices up. Ethereum, of course, is a very serious, asset, which is promising. Ethereum, Solana. So, these are all, I'll consider them into the blue chips category. But I think for a new investor, I would not focus too much attention on the meme coins and some of these riskier low cap altcoins. Of course, people understand it. Some people get it, and some people have higher risk appetite. For them, of course, they can play around with that. But these things continue to happen. It's not new. We have seen those things happening in the previous rally as well. I think what matters is that do you really understand what you're getting into in terms of these altcoins? And if you do, and if you understand the risk associated, then why not experiment with a small amount? But yeah, I mean, those things continue to happen. People have different projects. New projects are coming up, and those are all like I've seen in the last 8-9 years. A lot of these are interrelated. The way it works is that Bitcoin goes up, and then that money then flows into altcoins, Ethereum, Solana, and in the rest of the coins. So it's a journey, it's a cycle, and people who understand this essentially tend to take advantage of that and make higher gains. But if you are new, I think I would request you to first limit it to some of the blue chip ones, and then essentially as you get more understanding, expand to other assets.
Right. Sumit, he can't control his smile.
He can't.
It's $110,000 asset that he is. And, this, even as the market is at the low point of trade, we're talking about the equity markets. And a couple of things stood out for me. One, he said all those who are in this space right now, they're hodling it. That's a very crypto term, as it is, holding it. And then he started speaking about blue chips in cryptocurrency as well.
It's a different asset class, Mangalam, and I think it's time, the way it has stayed, and with various countries coming out with various policy papers on that, I'm assuming that India would follow suit soon.
Yeah, and just to complete the loop on the pizza day that you spoke about, for those who are uninitiated, way back on 2010, May 22nd, 2010, a gentleman from Florida, I guess, bought 2 Papa John's pizzas using 10,000 Bitcoins. Back in the day, 15 years ago, 10,000 Bitcoins.
That's exactly what Sumit converted into. Those 10,000 Bitcoins now stand at billions of dollars.
So you might be smiling right now. I know one person who's not smiling is the one who actually paid those $10,000 for those 2 Papa John's pizzas. We'll wrap up on this edition of Halftime Report on that note. Papa John's pizzas makes you feel a little hungry. What you do is, while Manisha and I eat the pizza, you watch Business Lunch.
Concerns over rising US deficit and the poor show at the Treasury auction spooked the markets. Auto, FMCG and IT stocks are the big drags. The IndusInd Bank stock gains on the hopes that the worst may be behind for the lender, but analysts remain wary of more skeletons spilling out of the cupboard, even as the bank suspects internal fraud and continues its hunt for a new CEO. Indigo Airlines owner Interglobe Aviation sees its profits soar as high traffic aided by the Mahakumbh rush, festivals and weddings drive up income and realizations, with forex gains also kick in. The company also declares a 10 rupee dividend, the first since 2019. Softening urban demand and intensifying competition lead to Colgate-Palmolive missing revenue expectations even as profit comes in line with expectations. The oral care major hopes for a revival in the second half of the year. And SEBI will give its final word on the weekly expiry soon, says Chairman Tuhin Kanta Pandey, even as CNBC-TV18 learns that the NSE has applied to shift its expiry date to Tuesday from Thursday. Pandey adds that SEBI may look into any violations by IndusInd Bank that merit attention. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormus Patakia. Well, it's not a very good day for the market so far. Of course, it is the weekly options expiry. We are coming in on the back of some very weak global cues as well, considering the bond market tensions that are flaring up in the United States. And that has had a sentiment way down on Wall Street. And that has spilled over onto our own markets as well. Not to forget, today being the weekly options expiry of the Nifty contracts, that's weighing down on sentiment as well. 960, almost 1,000 point cut now on the Sensex, and almost 300 point cut on the Nifty, near at the lowest point of the day as well. So a forgettable day so far for the bulls, but of course it is expiry, so it'll be interesting to see what happens in the final couple of hours of the trading session, whether we see a recovery from that all important 24,500 mark which the bulls are trying to defend, or whether we see further downside from these levels. Of course, the losses being led by the index heavyweights, Reliance and HDFC Bank among the top contributors to the downside. Mahindra and Mahindra is the other major contributor along with ICICI Bank. Of course, we are tracking earnings from three Nifty companies today, be it Sun Pharma, ITC and Grasim. And Sun Pharma might be reporting results during market hours, but generally we'd expect results from ITC and Grasim after market hours. So we'll be keeping an eye out on those names. And there are earnings reactions as well that we need to track. Colgate-Palmolive is one of them. We just mentioned in the headlines as well, 5.5% lower on the stock, the top loser on the Nifty 500 in today's trading session. But on the gaining side, Fortis Healthcare 8.5% higher after some very strong management commentary coming in on the earnings call. That is among the leading gainers. Garden Reach Shipbuilders is now at the highest point of the day, 6% higher on the stock after it emerged as the lowest bidder for that 25,000 crore Indian Navy project for the next generation Corvette vehicle. So Garden Reach, a good day in the office. But of course, all eyes today were on IndusInd Bank as to how the stock reacts after being a weak fourth quarter that was weighed down by accounting issues, the MFI stress as well. The stock opened lower, then recovered and is now again below the flat line. Abhishek is here to tell us what brokerages are making of the numbers. Abhishek.
Well, as you mentioned, it's one of the weak counter that we saw with respect to the results coming in, and largely it was factored in. The stock is flat right now, and if you take a look at the earnings, it's been one of the worst earnings in the banking sector from top to bottom across various parameters. Corporate book declining by as much as 15.7% sequentially. It's not seen ever before. It's also, the highest decline that you are seeing amongst all the other larger private banks. The net interest income decline of 43% YOY and 42% sequentially, highest decline in the banking sector. The net interest margin for them is the lowest ever that they have seen historically, coming in at 2.25%. Other income was down sharply by more than 71% YOY and about 70% sequentially. The only bank to report an operational loss in Q4 FY25 and the bank to report highest net loss in Q4 FY25. Slippages were elevated, 5,014 crore. The annualized slippage ratio is the highest in last 16 quarters, coming in at 5.8%. Asset quality gross NPA ratio is perhaps the highest that you are seeing in last 10 years or even more, and they have used their entire contingent provision of 1,325 crores. With reference to the P&L, both the NI and PAT is below our poll. Coming on to brokerages, they have cut earning estimate anywhere between 35 to 40% on an average, and as high as 45% by Motilal Oswal. Loan growth to be in single digits, and they say that return ratios will remain tepid over the next couple of years for the IndusInd Bank. Back to you.
Abhishek, thanks a lot for that. And staying with IndusInd, Ritu is now joining in with the key takeaways from the earnings call that IndusInd Bank held last evening.
Well, after posting its biggest ever quarterly loss driven by multiple accounting lapses that are now being labelled as fraud, IndusInd Bank is promising a full clean-up. In an unusual move, we had Sunil Mehta, who is the bank's part-time non-executive chairman, personally addressing analysts on the earnings call, calling the developments since March unfortunate and painful. Now, he acknowledged that the board was not informed of these discrepancies at the time of approving results earlier, but assured stakeholders that now the bank is taking comprehensive corrective action. He sought to allay concerns, saying auditors have now conducted deep dive reviews with expanded sample sizes to adequately and fairly account for any past lapses in the fourth quarter earnings, and that the board now suspects a fraud against the bank that involves certain employees and is pursuing legal action, including reporting to investigative agencies and regulatory authorities. He also reiterated that the board's approach is to start FY26 on a clean slate, with all known financial impacts already absorbed in the FY25 numbers. The chairman also disclosed that RBI has advised the bank to submit proposals for the appointment of a new CEO for its approval by the end of June, and that the board is in advanced stages of the selection process and is hopeful of submitting these recommendations ahead of the deadline. So now, while there may be questions on the auditors and the board's own accountability and how quickly a new CEO is appointed and is able to steady the ship, the biggest question for now is whether the worst is behind. And to that, all that the management has to say is that the full financial impact of all the known irregularities has been accounted for, and to the best of their understanding, no further issues remain.
Ritu, thanks a lot for that. That's the sum and substance of IndusInd Bank. Choppy move seen in today's trading session, but has to be the stock that we've been tracking since the morning. More earnings then. Indigo reported a good fourth quarter with festivals, weddings, the Mahakumbh taking their profit beyond 3,000 crore rupees. Earlier, we spoke to the CEO, Peter Elvers, and he discussed the company's FY26 capacity and revenue growth outlook and how Operation Sindoor affected flight operations for the airline. Listen in.
You know, for FY25, we've given a capacity guidance in the early double-digit growth. That's the capacity guidance we have. Obviously, with an 87% load factor as we had in last year, that capacity guidance should not be too far off from the traffic guidance we're giving to the market. So again, early double-digit is the capacity guidance we've given for FY26 going forward. So the overall impact of that is relatively limited, and clearly what we have done is we reallocated some of our flights to the southern part of India and basically are growing from there. Post the ceasefire, the flights have been reinstated and all the 170 cancellations have been reinstated by the end of last week, and we're sort of back to a regular operation. That clearly has an impact on May, but again, it's more in the single-digit range when it comes to capacity impact. We have seen a drop in bookings, as we just shared also in the call, but that seems to have bottomed out. And actually, we see now the first signs of people picking up bookings again, and the resilience of the market is actually quite strong. If I see where we are now, we ended up the last quarter with the AOG number in the 50s. The quarter prior to that, we've ended up in the 60s, and today we're somewhere in the 40s. So, you know, we've moved down from 60s to 50s to 40s today. So clearly, we see a steady improvement of that situation. And when we said we have turned the corner, it clearly is, and I guess that trend we expect to continue going forward. So that means by the time we turn the corner 1 year back, we probably should be around half of that by the time 1 year is passed.
Indigo, one of the other earnings reactions today, and at least 8 analysts who have coverage on the stock expect that to cross levels of 6,000 and beyond, 1.25% higher for Indigo. But our role is limited to the issuance of just PAN cards, and that is the word coming in from Suresh Sethi of Protean eGov Technologies after the Income Tax Department did not shortlist the company for the PAN 2.0 project. Now, he told CNBC-TV18 earlier in the day that they are looking to expand into sectors like agri, healthcare, ONDC and identity services. Listen in.
Current business continues as is, and equally important is the fact that the PAN 2.0 from deployment or allotment is going to be another 18 months journey, and it will be looking at online channels at that stage. There are basically 3 rounds of, if you may, a qualification. There's a pre-qual, there's a qualification, and there's the price discovery at which multiple bidders go in and there's a fair and transparent way of discovering the price of the project. This was at the qualification stage where along with us, the other competitors have also been in a way indicated that they didn't make it to the last round, and one final competitor has made it to the last round. The other area where we were looking at was a SaaS sort of a business model where you are creating the demand and supply applications. Now, the demand and supply applications clearly get linked to the fact that as the network grows and there is more consumption, you will get paid for every transaction. So we hope, as we've seen, that ONDC is gaining traction. There has been growth, but clearly we have to hit an inflection point, and the SaaS revenues are what will pick up from here onwards. So the past year, we had around 8 CR of revenue coming from the core stack, and the revenue coming from the SaaS business was pretty limited at this stage.
The management there of Protean eGov Technologies. Take a short break. On the other side, Donald Trump re-emphasizes his role in brokering a ceasefire between India and Pakistan. External Affairs Minister S. Jaishankar also gives his take on the events that unfolded leading up to that move. Welcome back. Now, sources are telling CNBC-TV18 that SEBI may soon release its circular on the weekly index expiry days. Yash, who broke the news earlier in the day, is joining in for that. Yash, tell us more.
So that's correct, Hormaz. The big update as far as fixing the days for weekly expiry for exchanges is concerned, that the final set of regulations from market regulator SEBI could come as soon as tomorrow, that is Friday, or by next week. That is the outer limit that we've been given to understand from our sources. Now, under that, the big thing is that the largest stock exchange, the National Stock Exchange or NSE, has applied with market regulator SEBI seeking Tuesday to be the day of expiry for NSE. Now, what that does, if in a situation where Tuesday is given to the National Stock Exchange, then it leaves BSE with Thursday as the day of expiry. Both exchanges cannot have their expiry on the same day. This is what SEBI has already, mentioned as a part of its consultation paper. Tuesday and Thursday are going to be the 2 days, and if NSE gets Tuesday, then BSE would be left with Thursday. What also we've been given to understand from our sources is that market regulator SEBI is actively considering NSE's request when it comes to getting Tuesday as the day for its expiry. The Secondary Markets Advisory Committee that very recently had its meeting where the regulations around expiry dates were finalized. They will be suggested to market regulator SEBI, and the final regulations would be out, as I said, latest by next week. But this is a very important development and rather a negative for BSE, because in a situation where NSE gets Tuesday as its expiry day, sources suggest that this could lead to a migration of as much as 20% of volumes away, options volumes away from BSE, and large part of it could come to NSE because the expiry there would be just at the start of the week. Also, it could possibly, according to sources, lead to an increase of market share of about 5% when it comes to the options market, options contracts for the National Stock Exchange.
Indeed, it's showing up on the stock price of BSE as well. Yash, thanks a lot for that. At one point, the stock was down almost 5.5–6%. There's a slight recovery from the lows, almost 3/4% lower currently for BSE. But on that subject, here's also a reaction from the SEBI chairman Tuhin Kanta Pandey on the possible SEBI circular from the sidelines of the ASSOCHAM event.
We will just be, right now, whatever is a framework, it's there, and we will be issuing post the consultation paper. The comments we have analyzed, that committees have met, and soon we will be issuing further clarification on that.
So that will take a month to have applied for?
No, I think within this month.
So will it be a circular?
They'll shift to Tuesday.
No, those days are fixed now, those 2 days.
In fact, my colleague Shivani also asked the NSE MD and CEO Ashish Kumar Chauhan on that SEBI circular. Listen to what he had to say.
Question from you is that there is a lot of talk today about the expiry day circular from SEBI. What is NSE's take on it? Is there a day that you have decided?
No, we have not been aware. We are getting it from you, but whatever the decisions of SEBI, we will have to go by.
Shifting focus now to global stories, US President Donald Trump has once again repeated his claim that he settled the recent conflict between India and Pakistan through trade. Now, this was during his White House meeting with the South African president. Listen to what he said.
If you take a look at what we just did with Pakistan and India, we settled that whole thing, and I think I settled it through trade. We're doing a big deal with India, we're doing a big deal with Pakistan, and I said, what are you guys doing? Somebody had to be the last one to shoot, but the shooting was getting worse and worse, bigger and bigger, deeper and deeper into the countries. Pakistan has got some excellent people and some really good, a great leader. And India is my friend, Modi. And he's a mutual friend. Yeah, he's a great guy. And I called them both, and we just did something good.
However, External Affairs Minister S. Jaishankar holds a different opinion with regards to how India and Pakistan brokered a ceasefire between each other.
Yes, we have a mechanism to talk to each other as a hotline. Yeah. So on the 10th of May, it was the Pakistani army which sent a message that they were ready to stop firing, and we responded accordingly.
And where was the US in this process?
Well, the US was in the United States. I mean, obviously there were US Secretary of State Rubio and Vice President Vance had called up. Rubio had spoken to me. Vance had spoken to our Prime Minister. They had their view, and they were talking to us, and they were talking to Pakistanis, as indeed were some other countries.
Yep.
I mean, the United States was not alone in this. I think there were some countries in the Gulf. There were some others as well.
Mm-hmm.
That happens naturally. When two countries are engaged in a conflict, it is natural that countries in the world call up and ask and try to sort of indicate their concern and what they can do in such a situation. But the ceasefire, the cessation of firing and military action was something which was negotiated directly between India and Pakistan. We made one thing very clear to everybody who spoke to us, not just United States, but to everybody, saying, look, if the Pakistanis want to stop firing, they need to tell us. We need to hear it from them. Their general has to call up our general and say this. And that is what happened.
Well, take a short break here. The Nifty is still down around about 270 points. More on the markets on the other side. Stay tuned.
Investing.
Welcome back. On to some national updates then. Supreme Court has called out the Enforcement Directorate on their probe into Tamil Nadu's liquor corporation, saying that it has, quote-unquote, crossed all limits. Ashmit is joining in now with more on this. Ashmit.
Well, what we understand is that the Tamil Nadu government made a move towards the apex court, basically to challenge some of the ED raids that were conducted in the state back in the month of March. And now all of this pertains to the alleged liquor scam in the state. Of course, just for context, it's TASMAC. It's a state-owned body which is responsible for marketing and retailing of liquor in the state. That's what the ED investigation is all about. The concern, however, that the Supreme Court today expressed is that how is it that the ED went about conducting raids, conducting surveys, when there are already FIRs that have been registered by the state police. This, the Supreme Court said, is tantamount to breaching of all limits, especially as how the state police has already filed the FIRs, there is action already underway, and therefore this is something that constitutes a breach of the federal structure of our constitution, breaches the state-center relationship, and that is something that led to the Supreme Court, headed by a bench no less than the CJI, fuming at the Enforcement Directorate. So what the fallout of that essentially is, the Supreme Court for now has stayed all ED investigations into the TASMAC matter. ED was claiming it's a 1,000 crore rupee scam, we need to investigate it. The Supreme Court hitting the pause button, saying that, look, no further investigations till we hear this case again. Not only that, the Supreme Court has directed the Enforcement Directorate to come back with a response justifying its actions going ahead with this investigation, with the raids, even though there were already FIRs registered in this case. With respect to the FIRs, TN government clarifying, Tamil Nadu government clarifying, they're not defending any of the accused. All they're saying is that there are already 41 FIRs registered between 2014 and 2021. There's absolutely no grounds for the ED to investigate, and certainly not to pick up, round up devices of the accused and clone them and keep a copy of it with them. These are actions extremely egregious, unconstitutional, and something that the Apex Court has something to say about. This case, we understand, is likely to be taken up in the month of July.
Ashmit, thanks a lot for that important update. But with that, we call time on this edition of Business Lunch. We are seeing a slight recovery from the lows of the day, only marginal, but the bulls are fighting tooth and nail to protect that 24,500 level on the Nifty. From me and the team that put this show together, thank you so much for watching. Midcap Radar on the other side.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Doria and with me is Vivek Iyer. Vivek, a very good afternoon to you. But the markets, they're not doing too well. Of course, we had a very weak handover coming in from the global markets on account of the deficit concerns in the US. But the Indian markets too reacting much like Asia as well in today's trading session.
Absolutely. Good afternoon, Vamakshi. Like you mentioned, in line with the global handover, in line with the kind of handover that we've seen from our Asian peers, India too seeing quite a bit of a dip today. The Nifty down over 1%. In the last 15 minutes, however, there has been select buying seen across mid-cap. So the mid-cap and small-cap end of the markets doing slightly better. We have a lot lined up on the show. We have managements too, post Q4 results, who will be joining us a little later on. But let's start off with the top headlines. Concerns over rising US deficit and the poor show at a Treasury auction spooked the market. Auto, pharma, FMCG and IT stocks are the big drags. Mid-caps under pressure.
SEBI will give its final word on the weekly expiry soon, says Chair Tuhin Kanta Pandey. This even as CNBC-TV18 learns that NSE has applied to shift its expiry day to Tuesday from Thursday.
Softening urban demand and intensifying competition lead to Colgate-Palmolive missing revenue expectations even as profit comes in line. The oral care major hopes for a revival in the second half of the year.
Tech Wabag rallies more than 7% after its Q4 results. Revenue rises nearly 24% from a year ago. The management tells CNBC-TV18 their order book will increase in the range of 16 to 17,000 crore rupees.
Astral and Prince Pipes trading higher today despite weak results as PVC resin prices see a reversal after 5 months.
Well, 24,550, that is where the Nifty is hovering around. The Sensex too is seeing a cut of almost 1%. But when we look at the mid-cap end of the market, that is doing slightly better as compared to what the benchmark indices are doing. The Nifty mid-cap index is down nearly 0.6%. When we look at the small-cap index as well, the performance out there is relatively better than the benchmark indices as well. When we look at the sectoral indices, most of them are in the red. The fall is being led by the Nifty FMCG pack, and within the FMCG space, it is actually Colgate that is driving the FMCG index lower. ITC also is one more counter that is expected to report its numbers today, but ITC as of now is declining in trade today. But in the mid-cap space, there are a lot of stocks that are moving around, and we have a special segment, Mid-Cap Movers. Hormas is across the wall, and he will take us through the mid-caps that are moving around in trade. Good afternoon, Hormas.
Good afternoon, Vamakshi. The broader markets are outperforming today only by virtue of not falling as much as the benchmark index has declined. So we'll start off with the losers then in the broader markets in today's session, be it Redington. Redington as a stock was up after its results, but then has seen a bit of a cool off now. Is at the lowest point of the day, 5% lower on the stock. What is also at the lowest point of the day is Piramal Enterprise is now 4% down there. Ashok Leyland, ahead of its results tomorrow, is also trading at the lows of the day. Earnings reactions continuing plenty, some on the positive side, some on the negative side as well. And Fortis Healthcare, after some strong management commentary, at one point was up 10%, still holding on to gains of around 8%. And Colgate, after highlighting some challenges, is down 5.5%. And Astral, among the outperformers of the day after its results, up almost 4.75%. Some of the newsmakers in today's session, Garden Reach is one of them after it emerged as the lowest bidder for that Indian Navy project, now 9% higher on the stock and continues to grow from strength to strength. By the way, it's nearing record highs now. Is Garden Reach 28.33 is that level that you need to watch out for. BSE, of course, after the news break from Yash is down 3.5%, and Mankind Pharma 2, an earnings reaction down 3.5%. And some of the stocks that are doing well on the back of volumes in today's trading session, and they'll come up on your screen, include the likes of Tata Tele. It was up yesterday, continuing to build on those gains. Shipping Corporation of India is now up 8%, and Craftsman Automation seeing strong gains on very strong volumes as well. And lastly, some stocks that are bucking the trend in today's session, other than the ones we just spoke of. PTC Industries is up, NTPC Green, an earnings reaction. Earnings, of course, came during market hours yesterday, but is up 6.5%, and Hitachi Energy too having a good day at the office. So there are declines, but there are gainers too in today's session. Back to you guys.
Thank you so much, Hormas, for joining us, giving us a sense of what exactly is transpiring in the broad end of the markets, earnings, volumes, whole host of other stocks that you've just highlighted. Well, a couple of more stocks to keep on the radar. Look at the entire NBFC pack. Names like M&M Financial, Cholafin, as well as Shriram Finance, all of these three NBFCs today under pressure. In fact, all of these stocks near the day's lowest points. But it's also a very good time to welcome Vinay Rajani of HDFC Securities for a quick technical check on the market. Good afternoon, Vinay. Thank you so much for joining us. How are you looking at the markets at the current levels? It's been a very choppy trading session so far.
Yeah, good afternoon. Yes, it has been choppy and we have already seen a 600-point fall from the recent high of 25,100. So in the last expiry, when we saw a surprising rally in the Nifty, when we saw a recovery of more than 600 points in one day, exactly reverse has happened, and the entire rally which we saw on the last Nifty weekly expiry, it has been fizzled out. So 24,500 odd level was the low on that day. So that is a strong support. So no doubt today could be the effect of expiry, and we have not got any positive cues from the global markets as well. So 24,400 to 500 is a very strong support zone. According to us, Nifty should find support in this range and bounce back because primary trend has been positive. So, and breadth of the market is also not that bad. So overall, primary trend is positive. We are passing through the short-term correction, and according to us, Nifty should find support in the range of 24,400 to 24,500. And ultimately, we are headed higher, and we are expecting Nifty to go beyond 25,200 in the coming days.
Well, thank you so much for that, Vinay. This is Vamakshi joining in. So this is only a blip in the larger bull market is what you're saying. But can you help us understand what are some of your top picks as far as stocks are concerned?
Yeah, so defense is the space which has been continuously performing very well. So according to us, Bharat Dynamics, so BDL is looking very strong on the charts. We have already seen a rally in the GRSE today. BDL is one of the stock which continues to be very strong on the charts. So around 1900 one can initiate trading long positions. 1850 should be the stop loss for the traders. And we are expecting a target of 2,000 in the Bharat Dynamics. The second pick, we would take it from the metals and mining space, which is MOIL India, manganese ore. So MOIL India has broken out from the long-term consolidation and looks very strong on the charts. So MOIL can be bought around 374. Stop loss can be kept at 367. And for the traders, target should be kept at 387.
Thank you so much, Vinay, for joining us, giving us your sense of how exactly you expect markets to pan out and your individual trading picks as well. Well, it's now time for a short break. The management of Interarch Building Solution joins us next to discuss their Q4 numbers and FY26 way beyond. Welcome back to Midcap Radar. Well, like we promised, Arvind Nanda, who's the Managing Director at Interaj Building Solutions, joins us now to discuss the Q4 results and the way forward. Thank you so much, Mr. Nanda, for joining us. First up, when you're looking at Q4 FY25, significant improvement seen, especially as far as the operating margins are concerned. FY25 top-line growth at a little over 12%. You had earlier told us that you're expecting to end the year with a 10% top-line growth. So you managed to beat that. FY26, what is the top-line growth that you are targeting, especially with the enhanced capacity, and can operating margins expand?
Thank you for having me on the show. Yes, I think Interact managed to perform beyond expectations. For the next year, I think if you look at our order book, the order book is showing more or less 1,700 crore, 1,640 crores of orders already booked in this year, including a very large order, which is the largest single order in pre-unit buildings, which we booked a month ago. So I think our expectation is that we should grow by at least 17.5% to 18% on the top line growth in the coming year. Steel pricing remaining similar. The turnover does get affected a little bit by the steel prices. And I think we are aiming that our profit before tax should be in the region of, currently it was about 10, I think 9, our EBITDA is actually lower than our PBT because we have actually no interest and very low depreciation. Interest is a positive for us. So we are expecting that our EBITDA should go up to about 9.7, 9.8, and consequently the profit before tax to cross 10%. Things get better, yeah. I think our operational leverage will help us this year. I think we should improve our percentages all around in the coming year.
Sure, and I'd just like to ask you, so 17.5 to 18%, very good growth, much higher as compared to the 12% or so that you've posted this time around, so bodes well for the company. But apart from the confirmed order book that you have on on your books, what does the bid pipeline look like, and how much of this would be converted into order inflows in FY26?
The pipeline is looking very good. In fact, I think in spite of our trying to add capacity much faster than what we've been doing in the past 12 months, our new plans are also there. We have recently bought more land besides the Gujarat land which we had in Andhra Pradesh, right next to our present Andhra Pradesh facility. We feel that we can probably put the plant there faster. So speed has become of great essence. Tying up with other companies like JSPL, we tied up. We have tied up with one or two smaller companies also to help us in giving us more production and engineering capacities like with Moltech. So I think going forward, the pipeline is excellent, but I think we will be a little constrained because of our capacity, considering that we already have 1,640 crores of orders in hand. So literally we have 12 months of expected orders. So we are going to try and boost up the capacity as fast as possible in the next few months. Pipeline or orders is not an issue currently. We don't see any problem except the problem of too much. I think it's a problem of plenty right now rather than... So we are adding capacity, and I think pipeline on both ends, we have two different pipelines. One is a more serious pipeline where we have already engineered the building and bid for it and negotiations going on. That is currently about 2,500 crores. And the ones which we are bidding, but on a very broad category, still 6 months to 1.5 years away, is about 3,500 crores. I think together 5,000 to 6,000 crores of pipeline is a very, very good pipeline in the market. It's more up to us. I think we need to build up our capacity faster and faster.
Mr. Nanda, I get that completely, and you mentioned this last time as well, that it's more of a constraint of capacity rather than one of demand. Well, a couple of numbers. At the end of the March quarter, we understand that the total order book was around 1,646 crore. You mentioned that you had booked one large order in April of this year, which was the largest ever order you booked of close to 1540 crore. Is this from a tire company that you had mentioned last time around? Is it the same order that you're referring to? And also, can you give us a sense, as once capacity does expand, what kind of top-line growth can you achieve as far as FY27 is concerned?
See, our order book we have been taking, because when we started our first quarterly results, so we've been taking not the same quarter, but let's say 1st February we gave an order book. So this one is actually 1st of May, 30th April. These 3 months. So 30th April, our order book is 1,646 crores, as you are showing. And I think if we can, it is for a very large company. We are not under confidentiality. I cannot disclose the name or the field. But yes, I think it will come out more or less soon. We have worked in that field for many, many years for many other companies also. We got the advantage of doing the whole project, which is why the size is larger. That Interact was trusted with the full order of by this company. And I think if we add capacity, we can grow faster. But today I would not like to commit. I think 6 months down the line, once the more capacities are in place, I would be in a better position to say what kind of growth we can expect in 25-26. And we are planning, as we had said earlier, that 27-28 we should have a turnover of about 24 to 2,500 crores, which we are sticking by. We are hoping that it might improve even further. Things have been going, but that is definitely what we are sticking to, 24 to 2,500 crores by 27-28, FY 27-28.
Sure, Mr. Nanda, and you've alluded that you want to increase your capacity. I believe that you've also already ramped up production in Andhra Pradesh. You're looking to increase capacity in Gujarat. You're coming up with a 5th facility as well. So what is the kind of capex investments that you will be making, and how would you fund it?
See, each plant of ours, approximately capex is between 70 to 80 crores. Land is already bought. Andhra Pradesh and the other plants are over. So it's all from internal sources. We raised some money in the IPO for the Andhra plant and for the North India plant. That is a part of the IPO. We already have a lot of our own internal resources, internal profitability, which we have got. We have, for the first time in many decades, we are distributing a dividend this year also. So we have a 12.5 rupees per share dividend also, because we are making good margins and good cash acquisition. So it is all going to be from our own resources. Till next 3 plants, we have sufficient money currently to set up 3 new plants without any problem. And I'm sure by the time they end up, we would have more internal resources to set up. So we are not looking for any capital raise, any debt. We have been a debt-free company, as many people are aware, for many decades.
Right.
And we intend to remain that.
Okay, thank you so much, Mr. Nanda. The street clearly likes what you've been saying. Stock high by almost 10% in today's trading session, ending FY25 on a very strong note. We'll now slip into a short break, but as we do that, here is some good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Date.
Welcome back. You're watching Midcap Radar on CNBC-TV18. Now let's focus in on Colgate Palmolive. The stock is under pressure after reporting a weak set of Q4 numbers. In fact, the company expects to gradually recover in the latter part of the year. We have Mangalam joining in to help us understand how the Q4 numbers look like and what did the company say in the conference call.
Well, it was a weak set of numbers from Colgate, no two ways about it. It's not that the street was expecting too much either, because the stock was down about 30% from its highs ahead of numbers, and the expectations were just about a low single-digit revenue growth. That itself did not happen. Year on year, the company's revenues declined by about 2%. The EBITDA declined by 6.5%, met muted expectations, as did the net profit. But the important part is that the management commentary as well did not inspire much confidence. They said that the business was impacted this time around by weak urban consumer sentiment and higher competitive intensity as well. Add to that, they did say that they expect gradual recovery, and that in the latter half of this year. So that puts at bay any sort of growth expectations over the next couple of quarters too. The stock, which was trading at a premium of almost 42 to 44 times FY27 earnings, after this decline, the street believes that there could be a case for derating, and the management in the conference call as well that took place today didn't sound very confident. Yes, they did say that in the premium end of things, in urban premium, there is still resilience, but that's something that everyone knows about. Their objective is to drive top line and sales volume going forward. How are they going to do that? What is the quantitative path for improved performance out there at a time when competition is intense, is something that the street was hoping for some strategy towards. Well, the management has said there is a plan. I think the street will just give it a pass until those numbers do come by, and that explains why even after a mild recovery that it saw post-conference call comments, the stock is now currently at the low point of trade.
Thank you so much, Mangalam, for joining us and giving us a sense of what exactly is happening as far as the oral care market is concerned. Well, two stocks that are doing quite well in the session, despite a muted showing as far as Q4 is concerned, are pipe makers. Both Astral as well as Prince Pipes are trading higher today, as PVC resin prices have seen a reversal after 5 straight months of decline. Ria joins in with more details.
Well, yes, both Astral and Prince Pipes have been trading higher in today's session, defying their weak FY25 results. And the key reason for this is that PVC resin prices, which had been falling for the last 5 months, are now seeing a recovery. Now, this reversal is being seen as a positive for plastic pipe players like Astral, Supreme Industries, Phenolics Industries, and Prince Pipes as well. Now, during the price correction phase, channel inventory had dropped significantly. But now, with prices turning, restocking is expected to begin, setting the stage for recovery for all of these companies. Now, as per PL, industry volumes are projected to grow at a rate of 8 to 8.5% in FY26, and larger players are likely to outperform and potentially exceed their near-term guidance as well. Now, looking at Astral's numbers, its plumbing business saw a volume growth of just about 3.4% in FY25, well below the guided range of 10 to 15%. However, margins came in strong at 18.9% in FY25, beating the company's guidance despite facing inventory losses from falling PVC prices. As for Prince Pipes, the Q4 volumes declined by around 2% on a year-on-year basis, missing expectations. The full-year volume growth was also modest at 3%, while EBITDA margins halved to just 6% versus 12% that we saw in FY24. So largely, while the recent performance has been weak for these companies, the reversal in raw material prices is bringing back optimism, and the stocks are resultantly trading higher in today's session.
Well, thank you so much for that, Ria, keeping an eye out on both of these counters. But, with that, viewers, that's all we have on Midcap Radar. MF Corner when we return.
Hello, good afternoon. You've tuned into MF Corner on CNBC-TV18. I'm Vinny Motiwala. Thank you so much for tuning in, as always. Now, this episode, what are we going to be focusing on? We're going to be putting the spotlight on common factors that investors tend to overlook while investing in mutual funds. Too many schemes of a particular category is one such example. You have over-diversification. That is another thing that could maybe eat into your returns as well. So, how are you going to declutter your portfolio? What is important? You can't just keep adding, right? So how are you going to get some things off the plate as well? That's important in your portfolio. To talk to us about all of that, we have Kalpesh Ashar, CFP, RIA of a Full Circle Financial Planners and Advisors joining in with us. Kalpesh, good afternoon and thank you so much for joining in with us on the show. You know, Kalpesh, we've always spoken about what I should buy, what I should look at, how many SIPs. Now tell me, when is my time that I look at it, oh my God, I have over-diversified, I have too much in my portfolio. What are the signs that one should watch out for this situation?
Thanks, Vinny, for having me here. And this topic, you know, is not always spoken about. Because like what you rightly said, we always talk about returns, we always talk about the ups and downs in the mutual fund portfolio or markets per se. But nobody talks about how much is enough. And in mutual funds per se, like many other things in life, what people think is that larger the better. Whereas, like after a lot of evolving stages of life, people understand that less is more. So that also needs to be somewhere brought down to your mutual fund portfolios, and that's what we are going to talk about. That how do you declutter a portfolio? Because in our daily practice, we see so many, portfolios having numerous schemes, and ultimately it's nothing but just overlapping of the same schemes with different AMCs, or the categories which are there, they just keep repeating. Because, what has happened is that it's a great boon that the mutual fund, I would say the revolution has taken off in India. But now it's a stage where it needs a little bit of introspection, and people need to understand that what is actually required to make a healthy mutual fund portfolio. So if you see mutual fund portfolios, you will find people having one AMC ka many schemes. Because probably that's a bias. They have a certain confidence with a certain AMC.
With some AMC. Sometimes they're like, I might as well buy one more of this one from the same.
But they stick to the same AMC. That also is a bit of a risk, because you want, again, a diversification in the people who are handling your money as well. Then you have too much of a particular category. So you will find portfolios having so many, mid caps, so many small caps, so many large caps. Now, again, that is a bias because they have not been advised properly. And more so, it's been the flavor of the season. But let me tell you here that mutual funds is not your, ice creams or flavor of the season that it comes and goes. And like the typical question people ask, what is good nowadays? Mutual fund is not what is good nowadays, what is good over
a period of time.
So people need to understand that. Now, all these points put together, plus I think we'll discuss during the course of this, make a portfolio very, very lethargic and flabby, if you would put it in health terms.
So I have to make it fit right now as well.
Absolutely.
So, Kalpesh, before we dive into how to get fitter in terms of your portfolio, what are the major issues, other than some of them you have highlighted, right? Going into just one form of an AMC, or maybe just going into large caps and just looking at that particular side. Major issues that are there in terms of a portfolio that is overcluttered, as well as in terms of common risks that an investor makes when they're trying to declutter.
So first and foremost, let's find out the reasons why people do this in the first place. And most of it now we're exposed to the digital world, and on the phone you get everything, and print media is there, digital media is there. People look at the star ratings and they go, which is the latest one, which has performed in the last 3 months, 6 months, and the number of more the stars, the better the fund. Now, that's a myth, because over the years, if people have studied mutual funds, that there is no particular performing fund which repeats itself more than 1 or 2 years. And then when that star falls off, it goes down the barrel of that mutual fund portfolio, and the people even don't look at that. So they're looking at that star rating. Obviously, performance, returns are paramount. But that's not the only way you choose a fund. And people are susceptible to it. They keep making that same mistake. Second aspect which is there is, that without blaming any AMCs, because that's their business, NFOs keep coming.
Yeah.
Okay. And more the NFOs, people are more attracted to it, probably saying that Naya kya hai?
Yeah.
And what's new. And more of it, if they think they're technically sound, they are probably, I would say, not aware of the fact that they are just adding the same thing, that's like the old wine in new bottle, into their portfolio. Because there's nothing novel coming out very frequently. Obviously, there are very good themes which AMCs come out, they manufacture, they see what is required, but not everything is novel. The other thing is they are under the myth that when they buy a mutual fund, it's bought at 10 rupees. So that 10 rupee, bait of the NFO, draws a lot of people into this, and they just keep accumulating NFOs over NFOs, and then really they don't track also.
Okay.
Okay, so that's another problem. Now the thing is that this NFO frenzy is one part. The second thing is, which we just discussed in the previous point, is that they see what is the momentum going on right now. And they do not look at what is right for them. They look at what is going on right in the performance.
Everyone wants to enter in as that FOMO fan. Yeah, I don't want to miss out on anything.
FOMO is the word. FOMO is the word. But what you need here is a focus on your portfolio which is aligned to meet your long-term and short-term goals. Now, in the frenzy of trimming your portfolio, like what you say, that they say, oh, I've got too many things and it's overwhelming and I need to come out of it. They do it in a hurry. Okay. Many a times, if they feel that they can't even look at the type of returns which are generated, or they're not given enough time to it, they exit. Now, obviously, there's a capital gain tax element to it. So even if they have not completed 1 year, they come out of it, they entail a short-term capital gain on that. Second, they invite exit loads on each and every fund.
So that again is a cost that you're just adding
That again is a
to
cost,
yourself.
and you've taken that decision in a hurry without really putting your mind to it. And all because of one important thing, that their portfolio was not structured to meet their financial goals.
Is there a difference that it makes in terms of, there are so many options now, right, for me adding into mutual funds. So while decluttering a portfolio also, how important is it? Like sometimes you can directly go on the sites and get into mutual funds. There is demat accounts now as an option as well. How important are such different methods? And does it make a difference when I'm decluttering my portfolio?
So the idea should be, or the focus should be, that what you do, keep following it. Don't go like, there is an option available that you can do your mutual funds through demat. Now, nothing wrong in it, but there are certain shortfalls that in the demat format, what you're doing is actually you are only buying or selling through the units part and not the amount. So certain things like the excellent features which are there in a mutual fund, which is you can do an STP or an SWP, becomes very cumbersome if it's done through the demat account. And the physical mode of the mutual funds, which is we all do the offline mode, is more easy and I think more manageable. But the point what I'm trying to make here is that if you follow a certain pattern, now don't say that I've got mutual funds in my demat account. I've got mutual funds in a normal physical mode. I also do direct plans. I also do regular plans. So
that's going to be difficult for me to handle.
Because that is what they're hearing. That's now you should do this, now you should do that. And if you don't have the assistance of a proper advisor or a distributor, I think you're going to go haywire. And that's what we have seen many portfolios. Now they listen to certain people. Now they start and stop SIPs at their own will. Now SIP is not to be done or managed that way. We've spoken enough. This is not the forum to speak about SIPs. But everybody knows what SIPs are. So they start and stop SIPs at their own whims and fancies, and that portfolio again is left hanging. So the point what I'm trying to make is, whatever a person is doing, get a proper advice and follow that. Because that becomes of paramount importance, that he develops a healthy and a trim portfolio.
Absolutely. Healthy and a trim portfolio is what is required. But how will I get to it? What are the steps that one has to take to get to that trim portfolio? What are the practical steps one should follow, not what people here say and do?
So, one more thing before we go into that, I'd like to point out is the problem of, making sporadic decisions and getting into new things. People also make this decision from their various bank accounts which they have. So if they have assigned, for example, certain mutual funds in a certain platform through a certain bank account which they're going to make and redeem and get the money there. They also do it simultaneously from their another 2-3 bank accounts. But the problem is, in some frame of mind, if they have shut that bank account in which they've invested, and again it's a basket of schemes they've invested, they do not really know that that bank account has been assigned to a particular mutual fund.
And now
when they want
stuck.
a redemption, they are stuck. They have to undergo the whole process of a change of bank, and the redemption time then lapses. So this is the practical thing. Now, how do you focus on making a trim and a healthy portfolio? I think first and foremost, let's get back to the basics, which is identifying the purpose of your investment.
Okay.
Once the purpose is identified, the risk tolerance is decided, and your cash flow, which is the starting point of from where are you going to make the investments. Those three things are streamlined. I think you will be more focused on creating a healthy portfolio. Second is, do not get swayed by all the noise of new things happening around you. Because if you are stuck to a particular path by a particular advisor, it's better to tread that, because there's a lot of thought and a lot of technical advice which is associated with that, why you're in this particular schemes or particular funds. So it's similar to, you might go to a mall every Sunday, but not necessarily you will be buying every Sunday.
Yeah.
You can just go for enjoyment, have a look around, and then come back.
Just window shopping.
Just window shopping. So same is with mutual funds, that once you've got what you have in your portfolio, unless and until, basically if you're doing really well and you want to add on to certain things,
then it's
add amounts.
Yeah.
So that is more important. And only if there is a scheme which requires that type of I would say, direction for your goal, then go to that new scheme. So we can highlight it, what types of schemes are required, to each his own.
Absolutely. On that note, actually, we're going to sip into a very short break. We'll continue this conversation with Kalpesh after the break as well, so don't go anywhere. Welcome back to Mutual Fund Corner on CNBC-TV18. Today we are discussing how you should declutter your portfolio. You have added too many mutual funds in your portfolio? Kalpesh is here to help us with that. We've gone through a whole host of details. But Kalpesh, while we've spoken about, how they should be looking at getting out of it, having a larger portfolio is a myth. We've spoken about all of that. But tell me, what is the ideal way of a portfolio? What is the ideal allocation in terms of a portfolio? What is the maximum amount of number of portfolios I should have? Large cap, mid cap, small cap, how much should that be in my portfolio?
So, there's no thumb rule for this, Vinny, but through experience, what we found that what would be the ideal mix. Now, obviously 10-15% up and down is fine, but the ideal mix, because, now post 2018, when SEBI has categorized mutual funds into so many things, there's a host of people lined up to say, "Mere ko ye bhi chahiye, I want that, and I have to be a part of this." It boils down to simply that, you could have a max of 6 to 8 or max 9 funds, schemes, I would say, in your portfolio. And I'll just highlight that, how we are looking at, okay? So if from a personal financial planning perspective, because that's what I do day in, day out, I would say you can have 2 debt funds. Let's start with debt funds, okay? The simple reason is that you could have 1 debt fund, which is a liquid fund, assigned for your emergency needs, a contingency fund, okay, which is easily in and out, and there's no qualms on that. The second one in the debt fund category could be either a corporate bond fund or a banking PSU fund or a short-term fund, because that is a little bit less volatile than the than the government securities which are there. And that could serve as your, medium-term goal, or it could serve as a hedge to your portfolio, and it does that job. So 2 funds in the debt space are good enough. Now coming to the cream, the equity part of it, okay? In the equity part, I think now there's a lot of passive investments which are picking up and, all those things. You could have 2 large cap funds, because that is where people would want a little bit of more presence. Most of them, I'm not saying that each one of them. So you could have 1 index fund and you could have 1 active blue chip fund. So a large cap fund, which we call. So that's 2 more there. You could then have a couple of flexi cap, because flexi cap, I believe, is a category where you are completely depending on the fund manager to have his say. He's not bound by anything, and he can swing across according to his discretion. So you could have a flexi cap fund, which probably is a little bit more dynamic by nature, and also has the liberty to invest, say, for geographical diversification, say in international stocks, and one which is a conventional flexi cap. So you have another 2 there. And finally, for the alpha, which everyone wants, that's
what everyone's waiting for.
Okay, so that sweetness, that mithai, which people want, is 1 mid cap and 1 small cap.
Okay.
So that could there, because excess of mithai also is dangerous. So
that's true. Diabetes is not what we want.
Not what we want. Okay, so we want controlled. Yeah, we want controlled growth. So mid and small does the job for that. So 1 or 2 or maximum, because there's a little bit of a volatile area, you could have 2 mid caps and 1 small cap, or vice versa of that. That does it. I think you should not really be more than that into anything. Now, unless your advisor suggests something or you have the bandwidth, maximum, I would say, you could take the liberty of 5 to 10% in a sectoral fund.
Okay.
So that is what could be permitted, but again, don't overdo it, because that is where we have seen the last 2 years, people have been completely...
And then now
and now they've seen what the color of that is, Sure. So that is what could be an ideal mix of a decent trim portfolio.
Okay, 2 debt funds, 6 equity funds, and in that also Kalpesh has mentioned where you can look at in terms of large cap, flexi cap, index funds. What's the breakup there? He's spoken about that. So that's interesting, and thanks so much for that, because it makes it easier for all of us. But how often do I need to, maybe review or rebalance my portfolio in terms to get the right asset allocation? Should I do it yearly, 2 times a year? What is the right way, so that I know that I'm not over-added, I've not done anything wrong?
So 2 ways to do it. One is surely looking at the time duration of your financial goals. So because each and every investment is tagged towards a financial goal. So as and when the financial goals are, approaching, you make the necessary changes. And apart from that, on a technical basis, I would suggest that it's not a fill it, shut it, forget it product, as people still think, but you need to review it, I think, once a quarter. So that would be ideal.
Okay. Kalpesh, sometimes I've heard people say that, okay, maybe I'm adding multiple funds that will give me better value. Does that make sense, or is that just a myth?
No, I think that's a myth because, it dilutes the returns. If you see on an overall portfolio, because let's understand, Vinny, what are mutual funds? Mutual funds by nature offer you diversification, right?
Yeah.
Now, even if one scheme, if you take in a large cap or anything, you're automatically exposed to 30 to 50 stocks. Now, in that you keep multiplying, you say you have 8 portfolios, and if they're different by nature, you will still have 70 to 80% of overlap in that, and the remaining will be novel. But beyond that, I think it's just a simple case of dilution.
And Kalpesh, is there a way that, how long should an investor actually wait before exiting? So I'm looking to declutter, but there are times that your mutual fund, one of your mutual funds or something in your portfolio is underperforming. How long should I wait before judging whether I should actually get that one out of my portfolio, or what is the strategy there that I should follow?
One of the parameters of evaluating it is at least give it, I would say, 2 years. 1 or 2 years, because here we are not going by the mutual fund thing, we are going by an economic cycle rotation. That anything would probably, have that much 8 quarters type of a time frame for it to perform or underperform. And then I think you could look at it for either keeping it or redeeming it. Other thing is that what we said, on the face of it, to the naked eye, if there's too much of one, I think you don't need any time to say that I need to trim.
Absolutely, too much of fun, then you know what you should be
have to get
trimming
out
as
of it.
well, removing your carbs or removing excess sugar.
Absolutely.
That's what you should be looking at. Kalpesh, to round this whole conversation up, I know you are a movie buff. You give us interesting analogies over there. So something to round it up and making it fun for our viewers in that terms.
Oh, great. So, what I would suggest is that when you have a mutual fund portfolio, you add amounts to it and not schemes. And that brings me to a very famous dialogue from the evergreen movie Anand, which Rajesh Khanna was saying, that zindagi badi honi chahiye, lambi nahi. Similarly, आपका portfolio बड़ा होना चाहिए, लंबा नहीं.
Absolutely. So bigger in terms of amount, not the amount of longer, but not the amount of portfolios that you have. So keep it simple, keep it small. I think you were saying that also before in the conversation. That is what we're going to be doing. And to round it up, one liquid scheme is what we should have as a contingent fund in terms of debt. We should have a short-term bond fund as well, is what one should watch out for. 2 large cap funds, could be between index fund and large cap funds. Then you can look at 2 more flexi cap funds, something in a mid and small cap is something, and sector thematic.
Only if required.
Only if required is what one should be maintaining. So thank you so much, Kalpesh, for joining in with us, helping us understand also in terms of how one should follow in terms of decluttering the portfolio, the steps that we should follow as well. So thank you so much for joining in with us, coming to the studios as well, and helping our viewers understand all of that. And viewers, thank you so much for tuning in as always. Hope this helped you all declutter your portfolio, making it fit from the flap situation if you're going through that. So thank you so much for that. But don't go anywhere. Up next, we have Closing Bell to take you through the last hour of trade.
lines to understand the reasons for the day's movers and shakers and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Doesn't seem like the handover is good. So Asian markets also seem like they've opened up in the red as well.
The bank has directed necessary steps to be taken under applicable law, including reporting to regulatory authorities and investigative agencies.
The S&P down about 1.6%, the Nasdaq down about 1.5%, and the Russell 2000 down 3%. So that's the overnight cuts across Wall Street that we saw. It's a 1/3% lower start on the Nifty, 24,714. Nifty Bank is down about 0.4.
Markets have come out with flying colors. The fact that you are at such elevated levels of 25,000 itself, I think, is a big win.
With the growth of the economy and the growth of the GDP, we have set a long-term objective by doubling in size between 2023 and 2030.
What SEBI had said in the consultation paper is that there would only be 2 expiries. One would be on Tuesday and one would be on Thursday.
All I can say is that if all the outstanding issues will be resolved and we will move forward.
India has a legitimate claim, and of course with its skilled workforce and low labor cost, we should be able to make a good dent in the manufactured exports also.
The Nifty mid-cap index is down nearly 0.6%.
Well, that is the day so far, and the markets has been under pressure from the word go. No real reprieve. Last hour coming up. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Rima and Nigel with me. Guys, hi, afternoon.
Hi, afternoon, and it's gotten worse, right? Yeah. We're at the day's low. Sensex has crashed nearly 1,000 points, and it's a global risk-off today.
Well, that's right, and I think the institutional numbers today become very, very important because I don't know whether it's the weak hands that are selling, they don't want to take a risk, because otherwise risk-off seems to be playing out. We have the 10-year that spikes up to 4.6%. The Indian rupee actually is making that big move. So, if you look at
86.1.
Yeah, if you look at it in the last half hour, you pull up a chart of the Indian rupee, it'll tell you the kind of weakness that we're seeing. So I think today's FI number becomes very, very important to track. I don't know whether they have turned sellers or not, but the intraday chart actually will give you a better picture of that one. Just take a look at that. Currently, and it's also at the lowest point of the day.
At the lowest point. It's also the Nifty weekly contract expiry today. So last hour will be important.
So, I mean, actually, that I don't think any other currency is moving. I saw before coming in, I don't think there's any move in the dollar. There was a big move in US yields last night, but across Asia, if anything, there's a little bit of cool off, 1, 2, 3 basis points as far as Treasury futures are concerned. So this move in that sense is interesting. Otherwise, it is, the view out there is still, it's going to be short-lived and maybe 24,200 on the downside, but below it, tough to see the market trade down below it. I mean, 24,200 is about 1% away from here. That's it. So we'll see how this one goes. What Rima said, I think the expiry factor, and sometimes on Thursday, the market gets yanked up, sometimes it gets yanked down. So we'll have to see whether from tomorrow it'll look a little better overall or not. But in any case, I mean, the levels will come up on your screen. The last I checked, and I think that is now, of course, been broken, but we were trading exactly at the 20-day moving average, which is 24,513. And now we are slightly under it. The other one was 24,494. And now the market is trading just under 24,494 as well. That was the swing low. So we'll see what the close is in the next hour or so. Nifty Bank is below the swing low of 54,960. Again, I think the closing will be important here. And of course, the big talking point globally is bond markets. And not just in the US, but in Japan, etc. as well. I mean, for example, look at the very long end of the Japanese yield curve. There has been a bit of a move there as well. So that's the global story, and who knows how that will play out, that will pan out. But generally, the view in the market for now is 24,200 on the downside, and then maybe the market starts to look a little better. That's not very far from where we are right now. Prima.
Okay, let's just quickly take stock of the action on individual stocks. The Nifty is below the 2,500 mark. It's staring at a cut of more than 300 points, 1.3% gone on the benchmark indices. Sensex fall is in excess of 1,000 points. The top loser on the Nifty right now is ONGC. Post-earnings stock down 3.5%, and it's breached the 100-day moving average on the way down. Outside of that, but lots of commodities weak. So it's not just ONGC, it's Hindalco, Coal India under pressure, BPCL down more than 2%. M&M has lost ground. M&M is down nearly about 3%. IT names have been weak. Reliance down 2%. ITC before its earnings also weak in trade. On the way up, only 3 stocks, at least in the frontline pack. TVS Motors, IndusInd Bank and Bharti Airtel. 3 of them have modest gains.
Okay, all right. Well, let's get in then a call on the markets. Nagraj Sethi of HDFC Securities joins us on the show. Hi, Nagraj. Well, it seems that in today's trading session, at least, that 24,500 getting taken out is showing some signs of weakness. What do you think? Are we starting a fresh leg down, or do you think this dip is going to be shallow as we have seen in the past, and you would use this as a buying opportunity?
Yes, rightly said, Nigel. Good afternoon. Nifty has been showing some sharp profit booking from the higher levels. I'm not expecting any bigger turnaround on the downside from here onwards, just a healthy downward correction and profit booking from the higher levels. And if the Nifty sustains slips below the 24,450 odd levels, then I'm expecting 24,200 to 24,000 is going to act as a strong support base for the market, where the 12th May downside gap is offering support, and I'm expecting the upside bounces to take place from the lower onwards. The most of the damage has already been done for the market from 25,100 to almost 24,450, 500 levels. I think some more weakness is likely, and I'm expecting upside bounces from the lower levels.
Okay, all right. What about individual stocks, Nagraj? What do you have on your radar?
Yeah, I have 2 stocks from the long side itself. First one is from a defense side. Majgaon Dock chartically has been in a fantastic up run. Higher tops and bottoms on the chart indicates that this stock has been in a strong upside momentum over the last few months. And currently, after a small downward correction, bounce back again from the last session, currently trading around 3473, 3475 levels. I'm expecting more upside in this stock. One can look to buy at this point of time. 3,700 is going to be the upside target, and 3,380 one can place a stop loss. Second one is Astral Limited. Astral was moving in a downtrend over the last few months, currently shifted into an accumulation pattern at the lower levels and gradually gaining momentum from the higher levels. Currently around the 1437, the overall chart pattern is indicating a rounding bottom kind of a pattern. One can look to buy at this point of time around the 1438, 1440 levels, and the upside target would be around 1550, and one can place a stop loss at 1380 levels.
Okay, those were some technical trading ideas, but the big story that CNBC-TV18 has learned from sources is that SEBI may soon release its circular on weekly index expiry dates. It's been watched very, very carefully. Everyone's awaiting that. Yash joins in with what he's learned from his sources. Yash.
That's correct, Rima. So it's important as far as both stock exchanges are concerned, BSE and NSE. What we've been given to understand is that market regulators, SEBI, may very soon look to release the final regulations when it comes to deciding on the 2 expiry days, the weekly expiry days for both exchanges, and of course the ancillary regulations around the headline regulation of deciding the 2 days. What we've been given to understand from our sources is that this final set of regulations could come as soon as tomorrow, that is Friday, or next week. And as far as the exchanges are concerned, what we've been given to understand is that the largest stock exchange, NSE, has already submitted an application, a request with market regulator SEBI that they would want Tuesday as an expiry day for themselves, that is NSE. In a situation where Tuesday is allotted to the National Stock Exchange, then BSE would be left with Thursday as its expiry day, because these are the 2 days which SEBI had in its consultation paper mentioned would remain as the 2 days for expiry of the 2 exchanges. Also, what we've been given to understand is that market regulator SEBI is actively considering NSE's request to be allotted Tuesday as its expiry day. But of course, a final call will only come out as far as that particular release of the regulation comes from market regulator SEBI. But also in terms of sources, what they tell us in terms of movement of volumes is that if Tuesday is allotted to NSE, as much as 20% of options volumes could migrate out of BSE. Majority of it could come to NSE. Also, it could lead to an increase of a market share of as much as 5% as far as options contracts are concerned for the National Stock Exchange.
Yash, thank you very much. I mean, that's, of course, the story. I just want to make it very clear that, of course, BSE is already on Tuesday. NSE wants Tuesday. And at the end of the day, the regulator will decide. And we're just saying that they will consider, NSE's proposal here. So we'll just see what happens. By the way, I mean, of course, the BSE has a 25% share now as far as the options volume go. Stocks, of course, reflected it. It's the #1 performing stock on the NSE 500. If you look at the last 1 year, that is the BSE stock. So it's obviously going to be consequential for stock price from here in terms of what really happens. Here's a quick reaction from the SEBI chairman, Tuhin Kanta Pandey, and he was speaking earlier this morning. Listen in.
We will just be, right now, whatever is a framework, it's there, and we will be issuing post the consultation paper, the comments we have analyzed, that committees have met, and soon we will be issuing further clarification on that.
So that will take a month to move?
No, I think within this month.
So will it be a
They'll shift to Tuesday.
No, those days are fixed now, those 2 days.
Question from you is that there is a lot of talk today about the expiry day circular from SEBI. What is NSE's take on it? Is there a day that you have decided?
No, we have not been aware. We are getting it from you, but whatever the decisions of SEBI, we will have to go by.
Okay, that's the big story. Deven Choksi, Managing Director, DR Choksi FinServ, is now with us on the show. Deven, weigh in with your comments. Do you think it's likely BSE already has, dibs on Tuesday? They will change and NSE will get, Tuesday. How does this all play out from an investor point of view? Also, it's been a bit of a merry-go-round.
Yeah, good afternoon. I don't know whether we should be talking this subject from the investor's point of view. Frankly speaking, I think by changing the narratives or changing the dates of expiry, etc., that doesn't solve any kind of problem. On the contrary, I think we must understand one thing, that today one and the other exchange, is basically thriving on arbitrages. I think the volume which is getting created between the two expiry is more, created by the arbitrageurs who are basically using their positions to switch over from one to another exchange and for the economics. I think that we are not denying that part of it. But frankly, I think that is only creating more amount of volatility, and frankly, it is creating more amount of confusion to investors. So if for investors, we are talking about the derivative market and at the same time for the purpose, which is for creating the liquidity as well as for hedging mechanism, then in such case, I think it's time now that we start talking about creating the product differentiation in a systematic way, so that neither exchange keeps on toggling between one another, and probably clear on with this particular subject. So maybe we look forward to what regulators take a call on this subject. But certainly for investors, this market is becoming more confusing and more volatile because of this kind of movement which is happening in the derivative markets.
Okay, all right. Talking about expiry, actually, just take a look at what's happened. It's the Nifty weekly expiry day, and pull up the intraday chart of the Nifty. We hit a low of around 24,462. And in a matter of 10 minutes, we are 100 points higher. Just pull up, just take a look at that. Big spike is what we're seeing. This could be on account of, the weekly expiry that's played out. And a couple of heavyweights actually would be pulling up the Nifty. I think you pull up HDFC Bank, that was down 1%. I think that's cut its losses to half. So they're seeing a big uptake on that particular name. Yeah, just take a look. HDFC Bank, normally that's the batsman that comes out to bat for the Bulls. What else? I think Axis Bank is another one. That was down 1.5%. That's down 1%. So I think the Nifty Bank on the whole has seen a bit of recovery. Could be expiry related because it's a quick fire 100 points. Now hanging on to this, pullback is going to be important. That said, IndusInd Bank, that's a surprise of the day. The numbers were weak, but the stock is holding more or less flat. It's seeing a bit of a bounce from the lows of the day. Abhishek joins us to tell us what are brokerages making of the numbers. Abhishek?
Well, as you mentioned, the numbers or the earnings in the banking sector, perhaps the worst quarter was by IndusInd Bank in terms of the losses and across various parameters as well. The corporate book that declined massively by more than 15% quarter on quarter, which is the highest that you are seeing amongst many other banks or peer set as well. The NII decline was 43% YOY and 42% quarter on quarter, the highest decline that you are seeing for the banking sector as well. Net interest margin for them was the lowest ever, coming in at 2.25%. Other income was also down massively by more than 71% YOY and about 70% sequentially. The only bank to report operational loss was IndusInd Bank in Q4 FY25, and they have given the highest net loss in Q4 FY25 by any lender. Slippages were elevated at 5,014 crore versus 2,200 crore. Annualized slippage ratio, the highest in last 16 quarters. Asset quality, one of the worst in 10 years or even more. The bank has used its entire contingent provision as well. The numbers way below our poll, both on the NII as well as on the poll of loss front. Brokerages say that they have cut earning estimate anywhere between 35 to 40% over the next 2 years. Some of them have cut as high as 45% by Motilal Oswal over the next 2 years. Loan growth to be in single digit in FY26 and it can touch 10% in FY27. Difficult for the bank to touch the mark of 1% ROA given the fact that the path is long drawn and ROE will remain between the range of 6 to 8% over the next 2 fiscals. The next event to monitor in this bank would be the CEO transition, whose names are submitted by the bank at the end of June 2025. Largely, brokerages have a reduced rating. IFL Capital as well as HSBC have downgraded to reduce. Target price ranges from as low as 600 to as high as 1,210. That is by Macquarie. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Deven, what do you make of this one? IndusInd Bank, there could be value, but there are too many loose ends, one would think. Would you buy into valuations, or do you say, no, it's very, very unclear, too many grey areas, you rather sit away?
So, Nigel, I think a couple of points. I agree that I think the valuation-wise price-to-book value ratio probably is at the lowest level. And that is also getting reflected because of the confidence of the players in the market into the stock. One after another unfolding of situation which is happening in this particular case is definitely, I think, posing some of the very serious questions about the ability of the management to run this particular business. And that's where I think the serious investors wouldn't like to take immediate bet. Till the time, I think we see a couple of things. A, I think the full disclosures, which I believe that I think with the results have come out. But still, if any more surprises are left, I think one would like to know them. Second, the corrective course of action in form of A, the internal management and the control, and B, who the new leadership would be in this kind of a situation for the bank. Till this point of time, I think everything gets clear. I doubt whether I think on the ground, the business would be as usual for this bank. And that's where probably I think one is not very sure about whether one should go into the investment. Maybe I think the market will react because of its own reasons, technical reasons included. But I don't know whether fundamentally I think one would get enough conviction to buy into the stock till the time the clarity comes.
Quite a few losers today. So one of them is Gokaldas Exports, where the management says that they will have to share some of the tariff hit with the retailers. All the US retailers they're in conversation with, they're asking them to share part of the burden. As of now, it's too soon to say, but it's quite likely that margins will be muted, and even ordering has been a bit volatile because you don't know what the extent of tariffs will be. So that's Gokaldas Export. Stock is down nearly about 6.5%. Colgate, Mangalam has been telling us from the start that it's been a very, very weak set of numbers. Expectations were muted, but it's a miss on that. Mankind too is down close to about 3.5%. Deven, any of these buying opportunities to your mind?
Not really. I think too many, weak points out there in the respective businesses. Colgate, of course, I think I'm not completely surprised. I think it's more of a steady performer. And I think in a given quarter, if the performance is down, I think it has the ability to, bring it back in subsequent quarters. But yes, one thing is for sure that I think the competitive pressures are increasing from respect to the brands. And one of the reasons for which I think this kind of companies are probably now started facing the challenge Also due to the fact that I think the valuation wise, they have always been quoted historically at the highest level. So there is no further headroom left. And that's where probably I think you're seeing the pressure after the result on the stock. But immediately, if any recovery is in sight, I'm not very clear about that aspect because the valuations are at the higher levels.
Okay, any view, Deven, on Stovekraft? We had the management that joined us earlier today, and they told us the same thing they told us last year, that they'll grow in double digits, which didn't happen. Now, they're saying they're going to grow in double digits and margins will improve. It's always been that company that has valuation comfort and it has capacity. But where are the numbers? The street wants to look at it. At around 570 rupees, what's your view?
No particular view on the company since we don't have coverage, but I think on the face of it, maybe I think one want to test whether the validation is happening on the commitment that the management has been giving. And I would prefer to wait for a couple of quarters before which taking any particular view on the stock. At this point of time, since we don't have coverage, we don't put across our views officially at this point of time.
All right, Devin, we'll leave it there. Thank you very much for joining us. Appreciate you taking out the time and being here as always. Guys, there was I don't have it now, but I'll just paraphrase a funny Twitter user just the BSE discussion which was happening, right? Posted saying that I don't know if this is a real quote attributed to Aswad Damodaran, the NYU finance professor, but obviously this person has attributed the quote to him saying, the first rule of being a successful F&O trader in India is to remember which day the weekly expiry is. I think that sums up the state of affairs, which of course now the regulator is trying to correct with Tuesdays and Thursdays, and we'll see.
I mean, sorry to come in, but I think that got very confusing when I used to cover F&O in the morning. Yeah. Today there is a weekly expiry for Nifty Bank, for Nifty.
BSE Bank X.
Because every day there was something, right? So, so I don't know. Let's see which way this goes. But
so now Tuesdays and Thursdays, just remember which will be much simpler. We'll take a quick commercial break here. Sanjay Parekh, founder and CIO of Soham Asset Managers, on the other side. Okay, welcome back. 250 points lower, 24,560 is where we are at. Sanjay Parekh is founder and CIO of Soham Asset Managers. He's with us to take some questions. Sanjay, great to have you with us here. Thank you for your time. You know, some of the, we always kind of, once in a while, once every 2 or 3 interactions, get a stock idea from you, something new you've done. So why don't we, I mean, is there one today, Sanjay?
So essentially a recent addition, we used to own cinema at one point of time. And then it moved up quite fast. And then we did sell off. But recently again, we found it quite attractive at reasonable valuation. And so last month, we added that because we clearly realized that the EMS space, certainly will do well. And this had a good amount of consolidation and earnings had moved up. And their valuation was now getting a little reasonable. It's still not that cheap, but for the growth, we were comfortable to enter. That was one entry that we did. Of course, it's a very small weight because these stocks are volatile, so we do keep an eye to average if it goes down. Another one we added was Polycab earlier last month. Again, that space has done well. All of them in that segment has done well. The opportunity is pretty large, and it's a sizable player with a pretty good market share. And there is a clear story of unorganized to organized. And there were some worries about new competition, but I think that's still 3-4 years away. By then, this company would really gain size. And while again, it was not that cheap, but for the growth, we were comfortable. So these were 2 additions that we did.
Sirma SGS and Polycab. You're overweight, Sanjay, telecom. So I presume Bharti in that, that's the only play? Or are you looking at Industars or...
So we had both, and I'll disclose to this, we had both Bharti and Indus Tower, but Indus Tower we recently just reduced because we thought it was really getting a little murky in the sense of, Vodafone talking about that if government support doesn't come through, they would want to file a liquidation. So it is getting a little tough. I really still hope that it will not go that way, but we were wanting to be cautious and luckily we were in the money, way in the money. And so we thought that let's take money off the table and then we will reassess if things get clear on that side. Bharti we still own, we have a neutral weight, we have a partly paid up. So effectively we are neutral weight in Bharti. It's not cheap now, but we like it structurally because it's a very clear play on gaining market share and it's done exceptionally well. So it's a good core holding for us.
I was just going to ask you because Bharti has run up so much in the last 5 years. It's gone up from 500 rupees to about 1800, 1900. And considering that you focus so much on value, your PE of your fund is much lower than the PE, the average PE of the Nifty 50. So how does it align, Bharti's valuations versus, even though it's offering growth on the valuation front, how do you think about it?
Yeah, so, our strategy is we love growth, but we don't want to overpay for it. So growth at reasonable price is what we are. Today also, I think our valuation in our markets moved up. So it's more like 14.5 times on 27 for growth rate, much higher than Nifty, and ROE is much higher than Nifty. So Bharti, yes, it's worked very, very well for us. We participate through the main and the partly paid up. In fact, partly paid up, I remember, has almost become 3x because underlying has gone up 2x, and they're not called out for the 402 rupees, which is yet to be paid. So it's worked well. So one is, you're right, in the near term when you see, they don't look cheap. But now Bharti is into a free cash flow territory. Also, there is a clear case of revenue market share gain. And when you look at this company in terms of EV, EBIT to EV or FCF field on the core business, then it is not so overwhelming. It is still going, I think, a bit faster. So when you think from a next 3-year angle, you may not get returns for the next 6 months, 9 months, but it's okay. That's the way we are thinking about Bharti, that if we think from the next 2-3 years, the clear runway for growth and appreciation.
All right. Sanjay, just stay with us. I want to ask you about IndusInd Bank. We're getting some statements that are coming in there from Mr. Ashok Hinduja. He's expressing confidence that, in fact, the bank is on the recovery path. And importantly, the last part of that particular press release that he's put out is that though the capital adequacy of the bank is quite healthy, for business growth, should any further equity be required, the promoter entity remains committed to supporting the bank as it's been doing over the last many, many years. So there is, some kind of confidence in case it's required. Promoter entity saying, we are there. He said it before, but I think, reiterating that, I guess the street is taking heart from a couple of those statements that are flashing for you at the bottom of your screen. Sanjay, what is your view on IndusInd Bank? Diversified financials is what you like. Will it make the list?
Yeah, no, so we got hurt. We own a little bit. We did sell on the rise. So let's me admit that it's certainly that we own. So I think there is clearly a mess by the executive management. There is not one mistake. There are a series of mistakes. And of course, whether it's fraud or it's connivance is yet to be proved. But certainly for the fifth largest bank with 4 lakh crore of capital, it's certainly, and as I said, it's not one area. It started with investment book, then it went into microfinance. Then even the classification issues, while it does not have a profit impact. So these are, for the fifth largest bank, it certainly doesn't go well. So to admit first, certainly it's not good. Now, whether it is in the, we are all, we've gone through earlier in a lot of banks, whether is it in the price or is it not in the price. I think yesterday's call from the board was quite satisfying in terms of the controls that they have taken from the executive management. While there's a committee which is managing it, and RBI has been very supportive. And we have a 4 lakh crore deposit franchise still not impacted so much. So if you have the right management which will come through, then this franchisee has done a lot of good things as well. The impact on the book value, mind you, after all this is not more than 40-50 rupees. So the book value, this year they made profits, the book value will be around 820 rupees. And next year, conservatively, it could be 880 and then 950. So now, if the ROE trajectory, which is not going to happen to 12% for the next 2 years, but if things on the delta gets better, I think cleanup has happened. Now, if the right management comes through, if they get the right top management, executive management, and if that gives confidence, then I think things can get better. So that's where that's where we are right now, and I think we'll also watch it as it progresses.
So Sanjay, what are you saying? You got hurt, as you're admitting, but what's the call right now? The time to sell, you believe, is over. Is the time to come in there and chip in again coming, or would you wait buy only at, say, lower levels?
No, so we on the rise, and we transparent, we did sell, but we are owning 1.3%, and we will hold on. I've seen that at times, it's better to pause a bit, wait at times. There could be, it's a very large bank with a market cap, in fact, less than Yes Bank, I suppose. So it's certainly very, very attractive for, if today this were to have an M&A or a merger, it could be lapped up at a significantly higher price. But that's not the way we should think about it. In the near term, it's important that we get a good executive management and they run it efficiently in a better way with better processes. And I think that will instill confidence, but it can be a time-consuming process.
Absolutely. Sanjay, just one last brief question. You have some allocation to very, very small to commodity chemicals. What name is that?
So we have Pondi Chemicals, which is
I see.
It's not chemicals, it's into recycling like Gravita.
Correct. We've spoken about this and it's done very well from the time that you've I think bought the name. Thank you very much, Sanjay. Appreciate you joining us and good luck as always as you run the fund. We'll take a quick commercial break here. We come back in just a bit. And as always, we get you a quick check on what dealing rooms are saying in our segment D Street Chatter. We'll get you some technical trading calls as well. Stay tuned.
investing.
Welcome back. Well, keep an eye on a few stocks actually from the broader markets. Genus Power should come up for you on the screen. Big uptick is what we're seeing on that name. Remember the promoter entity that sold some shares at higher prices. And from there, we saw a sharp correction on the stock price. But today, it's moved up on rather large volumes. A big move out there. Hind Rectifier as well. That had come out with a decent set of numbers. I don't think they have any institutional holding. But this one, in fact, I think in the last 10 days or so, the stock is up close to around 15%, 10% of that coming in today's trading session. So actually, in the last 14 days, it's up more than 20%. Big move on this stock as well. But it's that time of the day when Nimesh joins in to help us out with what he's picking up on D-Street Chatter. Nimesh, what do you expect today in terms of flows? The Nifty is still down, but some recovery.
Well, Nigel, from a flow perspective, you're going to see a down day. I understand there is a large basket selling at a leading FI day. So the FI number could be relatively large in today's market. But we've seen a bit of a recovery as well in the last 30 minutes of trade. But largely, it's a day of risk off. You've seen globally as well, a lot of equities are under pressure on the back of rising bond yields. So that's going to be a bit of a concern in the very short term. Sector where there is a bit of buying interest continues to be the PSU basket. And within PSUs, I understand for the last couple of days, there is buying interest in the PSU bank stocks from larger institutions. So that from a flow perspective. Even the broader markets, the breadth is still slightly negative in the last couple of hours of trade. A small recovery there. But again, at least in the broader market, there are equal gainers as well. So a mixed day from a mid-cap, the broader market point of view. But there is pressure in the Nifty names, largely on the back of FI selling.
Right. Nimesh, thanks for that. In terms of specific stocks, what's coming up on your list?
Well, Prashant, I'll start with blocks. That's something which I track very closely. So the first stock is TD Power. There's a large block in the opening trade today. The stock has recovered from the intraday lows, but from a block perspective, the promoter entity was a likely seller. And I understand some domestic mutual funds were buying into this block. So the disclosures at the end would be quite interesting. So that's the first name. Second, a couple of stocks where there is a small MOC buying in the last 30 minutes at an FI days, which is Cipla and Shriram Finance. In both the stocks, there is MOC buying at a leading FI days, so that stands out for me. Third, a bit of buying back in metal names. So both SAIL and Tata Steel stands out in terms of buying interest from larger institutions. So there is delivery-based buying in metal stocks today, especially the steel names. And the last one is Zydus Life. Post earnings, we've seen a bit of a recovery in that name as well, largely on the back of commentary. The stock was falling. But while the stock is recovered in the last 2 days, today in the last 30 minutes, you're going to see a small MOC selling. So I might see a bit of a reaction there, but at least for today, there is last 30 minutes selling in Zydus Life.
Okay, all right, Nimesh, thanks a lot for that. By the way, keep an eye on IndusInd Bank. The stock has now moved to the high point of the day. I think that vote of constant coming in from the Hindujas and the commentary that came up, that's what's helped the stock move closer to the high point of the day. It's perked up a little bit post those lines that were flashing for you on the screen. But Nagaraj Sethi from HDFC Securities is back with us. Nagaraj, we want some trading ideas. What do you have on your radar?
Yeah, apart from that, two stocks discussed a while ago, and I have a couple of stocks which are showing some promising trend. First one is from a shipping side. Shipping Corporation of India, what we can observe is a sharp upside momentum in today's session after a reasonable downward correction. Currently placed at the hurdle of 100-day EMA. I'm expecting this hurdle to be taken out in the near term. So that is looking attractive. The overhead resistance to be watched is around 210 to 215 in the near term. Second one is the NMDC. If you look at chartically, NMDC was moving in a consolidation. Chartically looks like a flat breakout on the upper side, placed at the hurdle around 70, 50, 71, making an attempt of upside breakout. Once it breaks out from the 71, 50 level, the next resistance, overhead resistance would be around 75.50 to 76 levels in the near term.
Okay, got it. All right. Thanks a lot for that, Nagraj. Well, let's focus on a couple of other big moving stocks. Ekta joins us to tell us first up about Fortis, and then I think we get a quick analysis on Strides. Ekta?
Thanks for that. Well, yes, Fortis was in focus, on the back of its numbers a couple of days ago. It had its call yesterday. So in terms of the call, they have indicated that they're looking to add around 1,976 beds over FY 26 to 29. They are estimating around a 14 to 15% growth in the hospital business revenue and 150 to 200 basis points margin expansion, with the growth driven primarily by ARPOPs by around 5 to 6 odd %. That's average revenue per occupied bed. Diagnostics, the guidance is FY26 double-digit revenue growth, margins of mid-20s. EBITDA margin on a net revenue basis in FY26 for diagnostics could reach 23% and maybe 25% in a couple of years. Nomura maintains its buy target price 700 rupees. According to them, the company guidance implies FY26 hospital segment EBITDA margins at 22 to 22.5%, better than consensus of around 21.9%. Nuvama retains a buy and a target price of 770 rupees. According to them, they are among the select few players on margin ascent trajectory in the next few years.
Okay, Ekta, we can't let you go at that though. Tell us about Strides. The numbers came out, the stock has taken off, striding away.
Well, yes, absolutely, taking big strides, this one. Now, the main thing about Strides is that they've met their FY25 guidance and the overall numbers look good. So, revenue was up 14%, EBITDA was up 17% year-on-year, margins 18.3%, profit also was around 82 odd crores. Now, FY25 guidance, they indicated 12 to 15% growth. They've come in at around 12.7% growth. EBITDA has come in at 800 crores. The guidance was 750 to 800 crores. Debt to EBITDA is less than 2 times. It's at 1.9 times. US revenue has recorded $291 million, higher end of the guidance of $275 to $290 million. Overall, they have also indicated that going forward, they are reiterating the US business revenue outlook of $400 million for FY27 to 28, and they plan to launch around 60 products, which are these dormant ANDAs that they have. They will be relaunching it over a period of time. They've already launched 3 in FY25. So overall, guidance seems to be, they've met their guidance for FY25 and they seem to be quite bullish on the US business going forward as well.
All right. Thanks very much, Ekta, for that. So those are Strides coming off a little bit from the high point. Fortis is the other one, which we highlighted. Now, let's also shine the spotlight on a bunch of other names which are making moves, large moves. Vinny's got that list. She's standing by. Vinny, afternoon.
Hi, afternoon. So keeping an eye out on a few other companies. Interarch is the other one, which reported a very strong set of numbers in Q4 FY25. And management commentary, that seems to be good as well. When they spoke to CNBC-TV18 today earlier in the day, they spoke about expecting a top-line growth of around 17.5 to 18% growth in FY26. Margins expected at around 9.8%. Order pipeline for FY26 also seems healthy. They met the track record of what they have in terms of order books, and that is what is keeping the stock abuzz today. Let's talk about Garden Reach. That's run up in trade today as well. They have emerged as an L1 bidder for construction of NGCs for Indian Navy. Now, this L1 bid they'll be making around 5 out of the 8 NGCs that are supposed to be made. So the value of that is expected to be somewhere around 25,000 crores. Now, why is it interesting? Because 22,680 crores is their current order book as on March 2025. So this order value is already much more than what we're seeing in terms of the order book of the company. Emcure is another stock. They reported their numbers a short while ago. Good set of numbers that's come in from the company. Overall revenue growth of around 19.5%, profits up around 65%. Growth this time is led by the domestic business, which saw 25% growth approximately, led by cardio, dermatology, OTC segment of the business. And on the flip side, we have Indigo Remedies, weak performance coming from the company. They've reported a net loss versus a profit last year, as well as revenues are also down by 13%, so keeping the stock under pressure.
Okay, all right, Vinny, thanks a lot for joining in and giving us that entire list of stocks that are buzzing around. Mayuresh Joshi of William O'Neill joins us on the show. Hi, Mayuresh. You heard of quite a few stocks that are moving around. You know, you have Strides, Emcure, Pharma, both of them reacting to a good set of numbers. In fact, you know, the list of stocks that have moved up in the last few minutes is quite a large one. I can see Garden Reach as well building on gains. You have Carousel that has moved up. Anything that comes to mind from the broader markets? Because that's clearly the one that's outperforming today.
Afternoon, Nigel. First of all, I simply love your tie.
Sending it across to you, Mayuresh, whenever you require it.
Secondly, I think out of all the group, all the numbers which we just discussed, I think within the healthcare space, I think Fortis and Strides Pharma both come to our notice. And Strides is something that we have continued holding in our global portfolios. I think the guidance that they've probably given, specifically in the case of Strides, $400 million from approximately $290 million that they achieved in FY25, is a significant jump as we see it. Obviously, I think the expectations in terms of their margin delivery expected to be between 17.5%, 18.5%. And therefore, if you probably look at both the US market and the regulated markets, the expectation of very strong growth and tailwinds might probably continue. Growth in the access markets, the numbers might be a little lumpy, is what the management suggests. Even in last call, I've not heard the call so far. I think the call will happen in some time. And therefore, I think that part of the business might still be a little lumpy. However, I think the overall numbers might still be very, very constructive. They've got almost 15-20 ANDs which are awaiting approval. And therefore, I think it should be a very, very strong balance sheet show for Strides. Again, I think with the hospital space, hospitals as a space, Nigel, is something that we've continued liking at O'Neill. We continue holding hospitals like Apollo Hospitals, Krishna Institute of Medical Sciences in our global portfolios. But Fortis also had a very, very strong numbers delivery. If you probably look at the core hospital business, the margin in excess of 20%, 20.4, 20.5% for FY25. The diagnostic business for one-offs, their margins are at 24, 25 odd percent. The RPOPs that they have probably reported for FY25 on an annualized basis, close to the 2.5 crore mark. And obviously the debt numbers have gone up because they've done the HLS acquisition, which is apparently doing well. So in our own sense, I think hospitals as a space should continue doing well. Fortis, fabulous set of numbers, but something like an Apollo and KIMS is something we continue holding at global portfolios.
I absolutely, completely agree that with that view, Fortis, I mean, what a run it's had overall. Even as everyone kept waiting for that IHH open offer for years, right? But the stock has not waited. It's just continued to reflect the improvement in financial operational performance. So it's done phenomenally well. More stock talk in a bit, but ITC will report numbers as well. Fourth quarter in focus, numbers should be today, later. Mangalam is here with a quick preview in terms of what the street is expecting. Mangalam, over to you.
And a couple of things, when you look at the numbers, just look at the estimates of the street and not look at the base numbers, because the base numbers would be restated on account of the demerger of the hotel business. So the estimates that the analysts have made have taken off the hotel business, and as a result of which they are expecting a little over 16,800 crores in terms of a top line for ITC this time around. The EBITDA would be close to 3,600 crores. And the net profit as well will be in focus for ITC. Again, the EBITDA would be 6,100 crores and the net profit would be closer to 3,600 crores. The important part to watch out for ITC this time around would be the cigarette volume growth, a number that the company does not disclose. The street is working with a number anywhere between 4 to 5% on cigarette volumes. And what we're expecting is that the cigarette revenue would grow anywhere between 6 to 8%. The important thing to watch out for in the FMCG vertical is how much is the margin compressing by, because we've seen a sharp inflation in palm oil prices. So on a 6 to 8% revenue growth, there could be about 200 to 300 basis points margin contraction. The third part of the business, the agri part, because of increase in tobacco prices and also liberalization of some of the export opportunities, that business is likely to grow at a higher clip, around 20 to 25%, whereas cyclical weakness in the paper business would imply paper revenues which will grow just about 3 to 5%. All in all, ITC numbers likely to be steady. The stock is reflecting that.
Mangalam, thank you very much for that. ITC Hotels, by the way, the demerged hotel company, that is doing very well right now while we wait for the ITC numbers themselves. I think last I checked was up about 7%. Okay, 5 now, so 215 on ITC hotels at this point in time. We, of course, have been speaking with a whole host of companies which have reported numbers. Gokaldas was one. So we had the management with us. Let's just quickly play out a couple of sound bites here.
Long term, 100% it's on track. Short term, there will be some aberrations. When I say Q1 and Q2, there could be some order flow hiccups, primarily because customers themselves are unaware as to how the tariff is going to impact them, and hence how do they go and build up their inventory. Orders have not been paused. Orders are coming through, but the brands are just concerned about the order flow. So they may trickle it down. I don't see an order flow problem, but I see some volatility again because of unknown tariff.
Okay, some volatility in in their space. That's for Gokaldas. But Indigo reported a good performance in Q4 with festivals, weddings, Mark Home taking their profit to around 3,000 crores. Earlier, we spoke to the CEO, Mr. Elbers, as he discussed the company's FY26 capacity and how he sees things pan out for the next year. Let's hear him out.
For FY25, we've given a capacity guidance in the early double-digit growth. That's the capacity guidance we have. Obviously, with an 87% load factor as we had in last year, that capacity guidance should not be too far off from the traffic guidance we're giving to the market. So again, early double-digit is the capacity guidance we've given for FY26 going forward. So the overall impact of that is relatively limited. And clearly what we have done is we reallocated some of our flights to the southern part of India and basically are growing from there. Post the ceasefire, the flights have been reinstated and all the 170 cancellations have been reinstated by the end of last week. And we're sort of back to a regular operation. That clearly has an impact on May, but again, it's more in the single-digit range when it comes to capacity impact. We have seen a drop in bookings, as we just shared also in the call, but that seems to have bottomed out. And actually, we see now the first signs of people picking up bookings again, and the resilience of the market is actually quite strong. If I see where we are now, we ended up the last quarter with the AOG number in the 50s. The quarter prior to that, we've ended up in the 60s, and today we're somewhere in the 40s. So, we've moved down from 60s to 50s to 40s today. So clearly, we see a steady improvement of that situation. And when we said we have turned the corner, it clearly is, and I guess that trend we expect to continue going forward. So that means by the time we turn the corner 1 year back, we probably should be around half of that by the time 1 year is passed.
Well, time to slip into a snappy break. As we do that, here's some good news for our viewers. India's business news leaders now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates. All of this at your fingertips. Download the CNBC-TV18 app from the Apple Store or the Google Play Store, or you can just scan the QR code that's up for you on the screen. Welcome back. Keep an eye out on a few stocks. Garden Reach continues to build on to gain. So good up move is what we are seeing out there. And Reliance Infra, I think it comes out with its set of numbers. The street's quite optimistic on prospects because, they've turned it around. They've got credit upgrades out there. And the debt number has come down substantially as well. So I think it'll be an interesting set of numbers. Explains why the stock is up close to around 2.5% or nearly around 3% as we speak. Mayuresh, you have been quite positive, I think, on some of these alcohol beverage companies. As of now, which ones on your radar? You had Tilak Nagar, you had Allied Blenders, both of them came out with good set of numbers. I think Radico as well, came out with set of numbers on the day of the India-UK FTA. Right. But what do you like?
So we continue liking Radico, Nigel. I think the numbers, as you said, were fabulous in our opinion. Again, I think the entire premiumization story for these alcohol beverages are actually continuing on a very, very strong footing. And therefore, in terms of the contribution of premium products is going to increase substantially in the next few quarters from a volume perspective. Obviously, from a value perspective, as volume increases, the value growth will also be very, very obvious. And even within the premium segment, the super premium segment, the management is of the belief that they should cross 500 crores in terms of turnover as we speak. The margin performance has been relatively better as well, and therefore expectations of margins remaining between that 13, 14, 14.5% band is quite a possibility because input costs, both ENA, molasses, glass prices are subdued as we speak and are expected to continue remaining on the lower side, which gives that added impetus in terms of both price hikes from respective states, the premiumization as well as lower input costs, creating huge operating leverage onto the balance sheet. So as far as ratings, rankings, distribution, holding is concerned, as we see it in Cancelim, I think this fulfills most of the criteria. And therefore, this is one stock that we continue liking from the alcohol beverage space.
Radico is the pick as far as the alcohol bev space is concerned. And again, I mean, something which is done very, very well. We've spoken about this in the past, BSE, and Mayuresh, any thoughts on it's correcting a little bit, but it's the best performing stock in the NSE 500 last 1 year. So can give back a little bit, no problem. But what's your sense here?
Absolutely. I think I remember, Prashant, you guys did a very good piece on BSE and NSE, both from a business perspective, valuation perspective as well. And therefore, I think the things that are working in favor of BSE in terms of the expiry, which is now restricted to one exchange per week, respectively, as well as expectations in terms of the core big picture argument, which stays with the exchange platforms. With the assumptions of more demat accounts being added on, expectations of more clients probably coming and trading through various intermediaries as far as stock exchange platforms are concerned, as well as its annuity business as well. And therefore, I think it is sweetly placed. However, I think the moves that have probably now happened in BSE in terms of price action, it's actually doubled, as your chart is indicating, in a matter of a year itself. And therefore, I think my own sense is investors should probably be a little bit cautious if you're entering aggressively into this stock. I think pullbacks onto this stock will be a better strategy or an optionality if that exists.
Okay, all right, Mayuresh, request you to stay with us, but let's wind down the market for today's trading session. We end with the cut of around 170 points. Well, I'll tell you what, we recovered more than 150 points in the last 60 minutes. Remember, today is the Nifty weekly expiry, so that could have been an element at play. What did well in today's trading session? Well, from the Nifty pack itself, the outlier was IndusInd Bank. It appeared it was a kitchen sinking quarter, and the street is appearing to look ahead. The management commentary as well has been positive, with the Hinduja saying they're ready to back up the bank. So that gave some confidence. Stock ended up close to 2%. Bajaj Auto as well was up close to around 1%. ONGC, you have some pressure on crude oil prices, so that one corrected in line. Mahindra & Mahindra has been the rank outperformer. That came in for some profit taking. And Hindalco as well, a bit of a risk off is what we're seeing. So that's why that stock was lower in trade. Add to the list trend. But from the broader markets, plenty of winners. And let's talk about only 20% gainers in today's trading session. Cosmo first, 20% up. You had Jai Bharat, that one was up another 20%. Ramco Systems up another 20% in trade today. And a few other notable winners on very, very large volumes. Interact, stock up more than 10%. Elecon Castroy, that one was up more than 10%. You had Carousel India as well, up close to 10%. And Garden Reach, the street likes the big order that they have won. So that goes home with a gain of close to around 10%. Hind Rectify is another name that went home with solid gains of close to around 10% or thereabouts. So It was a day that the Nifty goes home with some cuts. The Nifty Bank took support at around that 54,500 odd mark, which is a crucial mark we had highlighted earlier today. And it bounced back close to 400 points from the low point of the day. So not such a bad trading session, though the Nifty goes home in the red.
Absolutely. And, much of the lows of the day, briefly, the market had broken the 20-day as well. But we end well over 100 points above the 20-day moving average for the Nifty. So that's the overall picture. That's the bell which goes off. And it's a broadly down day. Market breadth is in the negative, but I mean, it's not spectacular one way or the other. 1,500 stocks are down, some 1,200 stocks are higher. And that's the broader sense, the overall sense of what really happened. I think what we're going to do is wrap up on this edition of Closing Bell. From all of us here, it's goodbye, but don't go anywhere because markets forward is coming right up, and Vinny and I will take you through that over the next 30 minutes. Stay tuned. Global cues spooked Dalal Street. Nifty and Sensex fall nearly 1%. Broader markets fare slightly better.
IndusInd Bank stock gains on the hope that the worst may be behind for the lender, but analysts remain wary of more skeletons spilling out of the cupboard even as bank suspects internal fraud and continues its hunt for a new CEO.
SEBI will give its final word on the weekly expiry soon, says SEBI Chairman Tuhin Kanta Pandey. This even as CNBC-TV18 learns that NSE has applied to shift its expiry date to Tuesday from Thursday. Hello and welcome to a fresh new edition of Markets Forward, your go-to program where we aim to get you everything you need to know as you gear up for the next trading session. Today was a tinge of red across the board. I'm Prashant. With me, my colleague Vinny. Vinny, hi.
Hi, Prashant. The tinge of red, but, yesterday we saw some bit of that hope coming in again, but global Q is not anything exciting for the market, right? And that's keeping the pressure on.
Yeah, I think we started with bad global Qs because US was down about 1.5%. And the problem did not come from equities, it came from bonds. Bond yields spiking significantly. I mean, especially on the long end, the 30-year in the US, for example, we woke up to at highest levels since October of 2023. So these were 10 to 12, 13 basis point kind of moves across the yield curve. It was and of course, equities in the US had sold off. So yeah, it was a bit of red. And there was also, of course, it was also expiry today. So I think some element of that, but the market has looked a little skittish. Remember, as we came into this particular week on Monday, we were saying that after a 4% kind of a Nifty week, the prior week, a 7% for the mid-cap index, a 9% for the small cap, we should consolidate a little bit. And I think that's exactly what we've done. We're not down or anything at all. There's, of course, one more day to go. But it's just been a consolidatory kind of day more than anything else. So even today, the market, of course, at one point, the Nifty did break the 20-day moving average, which is, a simple indicator of the near-term trend for the market. We closed above it. We closed about 100 points above the 20-day. The Nifty bank also was trading below the recent swing low. That also recovered a little bit towards close. Market breadth was unimpressive, but nothing negative. About 1,500 down, about 1,250 up on the NSE. So all in all, I mean, it was just a negative day, but can you really read too much into it in terms of where the market is headed? If anything, I mean, what we've seen so far is that the dips are bought very, very quickly. We had one dip earlier this week as we began, but that was, of course, covered up quite quickly as well. So I think with this expiry out of the way, from tomorrow onwards, will we get a more clearer picture? I think that remains the hope.
Absolutely. That's really going to be the hope for the markets as well, especially this week. But all the sectors actually today, most of them ended in the red except for media, so nothing much of an excitement there. And broader market, that also was a bit of an underperformance there. You're seeing 0.5% of decline for mid-cap, small-cap as well. But that's how the market setup is looking like. We'll watch out for what happens in tomorrow's trading session. But, we have an exciting lineup for you all on the show as well. We'll start with the top movers and shakers of the day with Vivek. And, the stock of the day, which we are keeping an eye out on, are going to be IndusInd Bank, Colgate, and we will give you the key reasons why these stocks were buzzing in trade today. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session. But let's get started with the first segment for today. Vivek is joining in with us from the big wall to take us through the top movers in terms of today's trading session. Vivek, over to you.
Thank you so much for that, Vinny. Well, quite a whole host of movers, a very volatile trading session, but the last hour did see some buying action emerge. Now, looking at, the shipbuilder companies, amongst them, the top gainer being Garden Reach Shipbuilder. The company told the exchanges that they had emerged as the lowest bidder for 25,000 crore worth of projects, and that clearly cheered the street, over 10% higher for Garden Reach. Fortis Healthcare, one name from the broader end of the market. In fact, most of the hospital stocks were doing quite well today, but Fortis Healthcare, very strong FY26 guidance, higher than what the street was anticipating, 14 to 15% top-line growth. They're also expecting margins to expand. Street like that was 7.5% higher. Well, pipe players, you actually saw quite a few of these companies go ahead and declare what was essentially muted Q4 as well as muted FY25. But news reports indicating that the company has taken significant price hikes after 5 to 6 months of significant decline as far as prices were concerned, is something that kept the street quite cheerful as far as the piping stocks are concerned. Names like Astral, Supreme, Prince Pipes, all of these stocks actually ended higher in the session. VRL Logistics, after a while, you did see some margin expansion coming about. So Q4 was a good margin expansion story for this particular name, higher by almost 5%. And Interraj Building Products, a name we don't discuss too often, but one from the broader end of the markets that did very well. We had the management earlier today
and they guided for close to 18% growth as far as the top line for FY25 was concerned. But on the other hand, quite a long list of losers as well. Top amongst them being Colgate Palmolive. They're calling out weakening urban demand. They're also calling out rising competition, and on the back of that, almost 6.5% lower as far as Colgate was concerned. And the kind of commentary that Colgate gave actually spooked the rest of the FMCG pack as well. So most of the FMCG names like Varun Beverages, ITC, all of these stocks ended with a tinge of red in the session today. One stock from the broad end of the market, one of the top laggards in the NSE 500 was GMM Pfaudler, muted show, and stock low by over 7.5%. BSE, our colleague Yash did come up with a story saying that, there could be a change as far as expiry days were concerned from NSE being on Thursday to Tuesday. The street worried about market share loss. Stock ended low by over 4% today. And the entire pharma pack, while healthcare and hospitals did well, the pharma pack didn't do too well today. Mankind, muted show, Torrent Pharma, all of these stocks today ended lower in the session.
Yeah, absolutely. Thanks very much, Vivek, for that. So that's essentially what went up and what went down. Mayuresh Joshi is with us, of course, at William O'Neill, and Ruchit Jain and Motilal Oswal is also with us. Mayuresh, thank you for waiting. Ruchit, welcome to the program. Just a quick view on the price action, Ruchit. Technically, how are we placed?
Hi, very good afternoon. Well, last 2-3 trading sessions, we have seen some correction, but this does not seem to be the corrective phase which we usually see in a downtrend. We can see that the market breadth is not that bad, and consistent sector rotations have been witnessed, either some from metals, defense. There have been some sectors which are witnessing good buying interest and a relative outperformance. So the high top, high bottom structure is intact. Today's low exactly coincides with the 20-day exponential moving average in the Nifty. And even if you see on the Bank Nifty front, last entire 1 month, we have seen some consolidation, but this entire consolidation just seems to be a time-wise correction where even 20 DMA has not been breached yet in the Bank Nifty index as well. So we believe that this is just a correction within an uptrend. I think this provides good opportunity to create fresh long positions whenever we get some such dips. So I think this is a good time to get into long positions. 24,450 to 24,550 is a very good support zone for the market. And we expect the broader markets to resume the up move, and Nifty should head higher again towards 25,200 marks from here on. So the risk-reward ratio is quite favorable after this last 2-3 days of correction to create fresh longs in the markets over here.
Okay, that's a view coming in on the markets on the technical front. Mayuresh, I'm looking at it right now. Nifty FMCG is what I want to talk about, because week to date also it's down. Overall, we're not seeing anything great in terms of a month to date performance also from the FMCG side. Does it become attractive now? Would you look at any of the names on the FMCG pack?
No, Navini. No, I think the perspective here is that Q4 was always expected to be a little bit muted because we are still not out of that consumption conundrum, and urban consumption is still looking a little soft. Rural consumption is just picking up. So combination of both the tax cuts that have been announced in the budget, which will start playing out from Q1 for the rest of this year, along with expectations of better monsoons this time round, leading us to believe that rural consumption should start coming back quite strongly as well. Will create a combination where I think as we head into the second half, and specifically in Q1, Q2, as volumes start bottoming out in terms of degrowth, they should show significant signs of improvement. The second aspect related to pricing, because a lot of FMCG companies actually resorted to alternate SKUs. They lowered grammage in certain cases. They could not pass on prices completely. Input costs has also remained elevated. I think all those issues would largely be stabilizing and behind us. And therefore, operating leverage should start playing out by creating a base effect for these stocks with these conditions in play in Q1 could give a significant improvement in the second half. And therefore, I think stocks like Marico, where I think the numbers have been relatively better, is something that we keep on continuing holding in our global portfolios. Stock like a Britannia, where our belief is that there might be a significant amount of tailwinds coming through for various products that Britannia probably does, is something to be watched out for as well. And something like a Jyoti Labs, where our own sense is that the urban consumption trend should start picking up very, very strongly in the second half as well. And Jyoti Labs is a pure play premium consumption or urban consumption coming back. So I think these 2-3 plays is something that we are keeping.
Okay, all right. Josie Laboratories is what he's got in his mind. We'll, of course, chat more stocks with Mayuresh in a bit. One of the names, of course, which had everyone's attention this morning, at least, was IndusInd Bank, because disastrous numbers for the quarter. And, analysts remain wary overall. We actually spoke with Hetal Dalal of IIAS and Digant Hari of GreenEdge. Governance perspective and an investor perspective as well on IndusInd Bank. So why not play out those sound bites, and then we'll ask Ruchit and Mayuresh for their views.
And RBI in India is extremely strict. They are very, very careful about the depositors' money. So they will clean up. They will clean up the bank, but it's a long run process, as you said. More than a year or two will go. The news floating around was that along with a very, very disastrous set of results, maybe IndusInd would announce a very good private banker or, a team of private bankers as the new management. And I think that is what was building in this optimism that, like Hetal said, everybody knew that there is a fraud and there could be more frauds. But even then, stock price was not reflecting a lot of that because there was this optimism of private bankers coming and leading the bank out of this trouble and back to glory. I think that hope, they have not announced the candidate yet, which means that, probably RBI may want to put a candidate who will first be very tight and on the cleaning up side and then think about growth. So I think this whole expectation gets delayed by at least 6 to 12 months.
Look, I think the management in the past has talked about the fact that there have been lapses and there are concerns around accounting, but this is the first time they really talked about it as a fraud, and fraud has very severe sort of implications in the banking system. And therefore, the kind of oversight and the kind of intervention that you'll now see given a fraud of this nature and this size is likely to be different from simply saying that there are accounting lapses. I think having a nominee of RBI on the board is par for course for a lot of banks, but this will therefore, if you actually have an RBI nominee on the board, it's going to show a lot more sort of signal a lot more severity of the problem, and RBI stronger oversight in ensuring that the cleanup actually happens.
Okay, let's move on and talk about, what's happening today. And the biggest news flow that we had was that market regulator SEBI may soon release a circular regarding index expiry days for stock exchanges. Sources tell us that a key committee under SEBI met recently. This is to discuss the expiry day rules. Yash is joining you with us to give us details on this one. Yash, what are you picking up here?
Well, that's correct. The big news is that market regulator SEBI is circular in terms of final regulations on choosing the expiry dates out of Tuesday, and Thursday. That set of regulations is expected as early as tomorrow or maybe next week latest. Also, what we've been given to understand from our sources is that India's largest stock exchange, the National Stock Exchange or NSE, has already filed an application, a request application with market regulator SEBI in terms of, opting or wanting rather Tuesday as its expiry day. What does that do? If in a situation where Tuesday is given to the National Stock Exchange, then BSE would be left with Thursday as its expiry day. Also, what we've been given to understand from our sources in SEBI is that market regulator SEBI is actively considering the National Stock Exchange's request to be given Tuesday as its expiry day. And this could be negative for BSE, as various sources suggest that this could lead to a migration of as much as 20% of volumes of the options contract, and majority of them could go to NSE. Also, it could help NSE, increase its market share in options, weekly options contracts by as much as 5%. So this is, of course, positive for NSE if in a situation where Tuesday is given and Thursday remains with BSE. But of course, the final call will be with market regulator SEBI, and this request has gone from NSE to get Tuesday as its expiry day.
Okay, thank you so much for that, Yash. Mayuresh, coming to you in terms of IndusInd Bank, your thoughts coming in here. Street still is a bit fearful in terms of what's going to be happening in the appointment scenario, right? So what are you watching out for here? Or would you look at IndusInd Bank given that the fall that we've seen coming in? How are you looking at the fundamentals?
I think all things as they stand, Vinny, I think who comes in is going to be extremely critical. And I think the street probably remains enthused, as Digant was also mentioning, the clip that you played, that there is expectation on the street that some private banker will probably come through and some reputed name and brand. Having said that, I think the entire cleansing of process that IndusInd has done I think the expectation now is that they should start on a clean slate. But I think the street will take time for confidence to come back in terms of both reported numbers as well as the new management to come in. And therefore, I think the street will wait its time for both these factors to play out. In my own sense, I think the price damage is largely now done. The management has given its comments in terms of how the balance sheet has probably got cleaned and how compliances will be adhered to the T. And therefore, I think it might just take stuck in a range as we speak. We still continue preferring the large leadership banks like an ICICI Bank out of the private banks.
Ruchi, IndusInd, of course, it's more fundamentals, and maybe as Mayuresh said, and I think Digant earlier, we played that soundbite, stays in a range. BSE, I wanted your thoughts, chartically.
So the overall trend still remains positive. We have seen a series of high top, high bottom structure in this. But frankly, if you look at the momentum setups and the momentum readings are quite overbought post the recent run-up. So I think this is a good time irrespective of what news outcome comes. I think at least one should look for partial profit booking if anyone is holding existing long positions and bought at low levels.
Okay, that's a view there. Thanks so much for the view on BSE. But let's move on to the next stock that's in focus, and that was in focus today. That's Colgate. And now, looking at the numbers, they missed the estimates in Q4 FY25. Urban demand was soft, intensifying competition. That's something that impacted the numbers. What were the other factors? Mangalam is here to tell us those details. Mangalam.
It was a lackluster performance that came in from Colgate in the fourth quarter. The street wasn't going in with a lot of expectations, but despite that, the company managed to meet, those muted expectations on the EBITDA and net profit front. The revenue was a miss. The street was working with a number upwards of 1,500 crores on the top line. The company reported a decline in the revenue. It was a little over 1,450 crores what they reported, and as a result of which we did see that trickle down into the bottom line as well. The important part, even if you strip off the expectations, the revenues declined by about 1.8%. Year on year, the EBITDA declined by about 6.5%, as did the net profit. Margins came off by 170 basis points as well. The company alluded this weakness to slow urban, consumption environment, at the same time intensifying competition, and they didn't see any hurry in recovery. If you look at it, they're saying that there is gradual recovery likely in the latter part of the year. Even in the management conference call, they said that their focus is to revive sales as well as volumes, but they did peg it down to the second half of this financial year, which is why the street now expects recovery to be slow and in the latter part of this year, as a result of which they perhaps decided to take some money off the table until growth returns on Colgate. So there was a mild smidge of a recovery from the lows. The stock is already corrected about 35% from the highs, but that quickly was sold into, and it ended at the low point of trade.
Mangalam, thank you very much for that. By the way, I don't know if you have a view, if you want, weigh in, Mayuresh, but I wanted your thoughts on Gokaldas, which fell sharply, 7-8%. We had the management with us today. Doesn't look like the numbers are bad or anything of that sort.
I think decent set. But again, I think, Prashant, I think we'll be a little bit selective in this space again. Our own sense is the stock like Endocount, as an example, I think is worthwhile looking at this juncture for two reasons. One, I think Trump's tariff policies, you're really not sure of what can come through. What ICL has done, what Endocount has actually done is they've done a few acquisitions in the US. They're also looking at a greenfield acquisition in the US. And therefore, I think the kind of revenues that they're looking at over the next 3 years, as a combination of these acquisitions and the greenfield that they're probably putting in the US, offsets a lot of issues if it does come through in terms of US tariff policies. At the same time, I think the FTAs that we are probably signing up, the one that we've signed up with UK, there is a discussion going on with the Eurozone as well, and Australia as well. I think the China Plus One, specifically when it comes to cotton sheets, when it comes to pillowcases, and the additions thereof that Endocount has probably done, I think that probably remains a far better pick, in my opinion, within the textile space. Obviously, I think players like a Gokaldas, a KPR, or Vardhaman are integrated companies and will do well over a longer period of time. But at this juncture, looking at the global macro backdrop, I think ICIL is a little bit better placed compared to us.
Okay, thanks for that, Mayuresh. And Mayuresh as well as Richard, thank you so much for joining in with us on the show. On that note, we're going to step into a very short break. After the break, we'll get you top corporate voices along with the key events to watch out for in tomorrow's trading session. So stay tuned in.
Welcome back. Let's just quickly run you through some of the top corporate voices that we had on the program through the course of the day. DLF, of course, is the first one. The management is optimistic about selling all units in its Gurgaon project, the Dahilias, within the next 4 to 5 years. Sales from the project have come as a positive surprise so far for the company that is in FY25. The company is also guided for a rental run rate of nearly 7,500 crore rupees by March of 2026.
And next on our list, we had Protean eGov. The management says it has separated the distribution business from PAN 2.0 and expects the SaaS segment to begin scaling with the ONDC framework. In FY25, the core revenue from ONDC stood at 8 crore rupees, while the contribution from SaaS were just marginal. The company is now looking to expand into sectors such as agriculture, healthcare, ONDC, and identity services.
We also had RVNL with us, who told us that FY25 was a challenging year, the year gone by, citing elections, execution delays and a prolonged monsoon as key hurdles. However, execution has picked up pace in the third and the fourth quarters of the financial year. It's continued into this year as well. Looking ahead, the company expects revenues to reach around 22,000 crores this year, that is FY26. Overall performance is likely to improve. Margins are seen at about 6.5% in the medium term. The company expects margins to grow to between 7 to 8% going forward.
And before we wrap up the show for today, we will bring you the key events to watch out for in tomorrow's trading session. Abhishek is here to give us those details. Abhishek.
Well, to begin with, RBI will have a board meet tomorrow to consider the dividend payout to government. Also, RBI will give out data with respect to banking sector's momentum on deposits and advances front. So, deposit growth was around 10.2% YOY last time, and loan growth was around 10.3% YOY last time around. So, watch out for that. Along with that, they will give a forex reserve data. That will be another factor to watch out for. Stocks that will be going ex-dividend tomorrow is CMS Infosystem. A total dividend of rupees 6.25 will be adjusted to the stock price. Havas India final dividend of rupees 6 will get adjusted to the stock price, and LTI Mindtree, the final dividend of rupees 45 will get adjusted to the stock price. Now also watch out for rights issue. Mahindra Lifespace developers, that right issue is tomorrow, and we are in the midst of earnings season. So key earnings which will be closely watched tomorrow is Ashok Leyland, SEL Info, JSW Steel, as well as Reliance Infra. Over the weekend also we'll get some results, so watch out for All Cargo Logistics, JK Cement, Kolte Patil Developers, NTPC, Ramki Infra, as well as Sarda Energy, which are some of the key results to be watched out for. Back to you.
All right, Abhishek, thanks very much for that. Well, I think it's a wrap on this edition of Markets Forward. We'll, of course, be back with more news and updates in just a bit from now. Thanks very much for staying with us.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Weak global cues weigh on the Lal Street. The Sensex and the Nifty lose nearly 1%. IT and FMCG stocks decline the most. Market regulator SEBI may consider granting Tuesday as the weekly index expiry day for NSE. Sources say regulations could be announced soon. Analysts believe the move could be a negative for rival BSE, which could see at least a 20% decline in options volume. Shares of IndusInd Bank gain on hopes that the worst could be over after it reports a 2,300 crore rupee loss in Q4. Analysts remain wary as the bank suspects internal fraud and continues to hunt for a new CEO. Bajaj Auto moves to take a controlling stake in Austrian superbike maker KTM, plans to infuse 800 million euros to support KTM's ongoing restructuring efforts and continue operations amidst financial distress. The Enforcement Directorate is crossing all limits and violating the federal structure, says the Chief Justice of India, over the ED's case against Tamil Nadu government-run liquor retailer Tasmac. The Supreme Court stays the ED's probe and questions why the agency filed the case when the state police is already investigating the matter. US President Donald Trump takes credit for brokering the India-Pakistan ceasefire yet again, tells South African president that he thinks he settled it through trade. Foreign Minister Jaishankar tells a Dutch news portal that ceasefire was negotiated directly between India and Pakistan. Adds New Delhi told everyone, including the US, that India needs to hear it from Pakistan if they want to stop the firing. 2 Israeli embassy staff shot dead near a Jewish museum in Washington, D.C. by a man who shouted "Free Palestine." The suspect is in custody. FBI calls it an act of targeted violence. Google-backed consumer tech company Glance launches a new shopping app powered by artificial intelligence. Glance AI aims to replace search-based shopping by providing personalized options to its users. The man who designed the iPhone, John Ivey, and his company will take over creative and design control at OpenAI. Sam Altman's company acquires Ive's company for $6.5 billion to work on a new generation of hardware devices and other AI products. Well, let's go straight to the day's market action. Weak global cues weighing on our markets. The Sensex and the Nifty down 1% each. Broader markets relatively outperformed today. 41 of the 50 Nifty stocks closing in the red. FMCG and IT were the worst hit. 200-point cut there on the Nifty. The Sensex dropped about 640 points, 133 points lower on the Nifty Bank, and the mid-caps lost by about 294 points. That's the market action for you. But staying with the markets, here's the big CNBC-TV18 exclusive story this evening. The National Stock Exchange is likely to have requested SEBI, the market regulator, to make Tuesdays the weekly expiry day for derivative contracts. Sources tell CNBC-TV18 the regulator may approve this request. Currently, NSE contracts expire on Thursday, while contracts on the Bombay Stock Exchange, that's the BSE, expire on Tuesday. Yash is here now to explain more about this development. Yash, what can we expect and what will this mean both for the NSE as well as the BSE?
Well, Shireen, as you rightly pointed out, first of all, what we've been given to understand from our sources is that SEBI's final regulations when it comes to, making those 2 days, that is Tuesday and Thursday of every week as weekly expiry for 2 exchanges, those regulations could come very, very soon. Very soon could be tomorrow, that is Friday, or the outer limit would be next week as far as these regulations are concerned. Apart from that, we've been also given to understand from our sources that India's largest stock exchange, the National Stock Exchange, has written to SEBI with a request, with an application seeking Tuesday as its day of expiry for its weekly contract. In a situation where SEBI grants NSE its request, that is giving them Tuesday as their expiry date, naturally the Bombay Stock Exchange will have Thursday as its expiry day. In that case, what we pick up from analysts is that it could be a negative for BSE because if the expiry day falls at the start of the week itself, of course, a lot of volume could be driven on that day. And in terms of numbers, according to sources, it could lead to a migration of as much as 20% of weekly options volume from BSE, and majority of them could go to NSE. Not just that, it could help NSE gain market share in options contracts by as much as 5%. Also, what we've been given to understand is that market regulator SEBI is actively considering the National Stock Exchange's request to grant them Tuesday as their weekly expiry day. But of course, the final call rests with market regulator SEBI, but the overall structure of the regulations, that is expected as early as outer limit being the next week itself.
We will just be, right now, whatever is a framework, it's there, and we will be issuing post The consultation paper, the comments we have analyzed, that committees have met, and soon we will be issuing further clarification on that.
So that will like a month, 2 months?
No, I think within this month.
So will it be a
They'll shift to Tuesday.
No, those days are fixed now, those 2 days.
Question from you is that there is a lot of talk today about the expiry day circular from SEBI. What is NSE's take on it? Is there a day that you have decided?
No, we have not been aware. We are getting it from you, but whatever the decisions of SEBI, we will have to go by.
Well, that's NSE's Ashish Chauhan there. And SEBI Chief Tuin Kantapande also promised to move forward with the NSE IPO application, but he stopped short of giving a timeline. NSE CEO Ashish Chauhan also spoke about the proposed IPO, calling it a work in progress.
NSE IPO, I think all I can say is that if all the outstanding issues will be resolved and we will move forward.
So by when? Is there any timeline on it?
Can't give you the timeline, but I think we should soon be doing it.
So have you received any assurances from the NSE side on some of the outstanding
NSE and SEBI, they are talking, and I think they are resolving the issues, and I'm very hopeful that it will be cleared and we'll move forward.
So what about the IPO? Where has that point reached?
Again, we are awaiting our no objection certificate. We have applied to the regulator, and as and when that comes, we can do the further process of preparing the DRHP and later on filing it with the regulator again and things like that. So it's a still work in progress.
Well, some progress there on the much anticipated NSE IPO. Bitcoin prices, meanwhile, hitting a record high, crossing $110,000 in intraday trade. Prices have rallied 5% just this week and 27% in the last 1 month. Bitcoin was languishing on account of tariff-related uncertainty, but the rallies resumed after US and China struck a 90-day trade deal. Bitcoin prices have rallied 63% in the last 1 year. When asked about the possibility of regulations, SEBI Chief Tuin Kantapande said the government is yet to take a policy decision on cryptocurrencies. Remember, the RBI has made it very clear they do not want cryptocurrencies as an asset class. The government has allowed it and, of course, imposed a tax on any cryptocurrency-related transactions.
The policy call is to be taken by the government. Crypto as such is not a security at the moment under the SEBI's remit.
Now, Walmart-owned fintech firm PhonePe will stay away from cryptocurrencies, at least for now. Speaking to CNBC-TV18, the Chief Technology Officer of PhonePe said it would be socially wrong for the company to offer cryptocurrencies on its platform. Here's explaining why.
We believe that the way crypto has been positioned and interpreted by a large set of the population as being an investment vehicle, many times marketed as safe enough to actually put in and grow your money, putting something like that out on PhonePe at the scale that we've operated at would be just socially wrong, right? And that's why we've never actually taken a view that we would never put crypto out on PhonePe, irrespective of whether the regulator
is a straight up Ponzi schemes. I mean, you just don't want to touch that.
Even if the regulator said it was okay, the way it's been positioned. Like, I've been on a cab driver. I was talking to the driver, and he was saying that he's moved his money from the chit fund into crypto, where chit fund is actually,
this only happens in Bangalore, right? Chit funds to crypto in a cab drive.
But he thinks it's safe enough to actually move into crypto because he's seen that suddenly there's been a run up on that, and we'd not do that irrespective of whether we'd be able to make a lot of money distributing crypto or even creating our own cryptocurrency.
Well, the debate on cryptocurrencies continues. Meanwhile, Bitcoin at a new record high. Oil prices eased as unexpected pile-up in U.S. inventories raised demand concerns. Reports that OPEC Plus is in talks to increase production in July also weighed on sentiment. Meanwhile, gold prices close to 2-week highs amidst concerns over the U.S. government's growing debt and soft demand for U.S. 20-year Treasury bonds, which drove safe haven demand. India's private sector gained strong momentum in May, largely boosted by a sharp rise in services activity. As per the HSBC Flash PMI data, India's composite PMI hit a 13-month high, coming in at 61.2 compared to 59.7 in April. The uptick was also driven by strong demand from both domestic and international markets. Shares of IndusInd Bank ended in the green today on the hopes that the worst could be behind the company. It reported a 2,300 crore rupee loss in Q4. Analysts, however, continue to be wary as the bank suspects internal fraud and also continues to hunt for a new CEO. Now, the RBI has asked the bank to submit probable CEO candidates by the end of next month. The Hinduja Group, which is the largest shareholder in IndusInd Bank, has once again promised to infuse more capital if the need arises. Bajaj Auto will acquire a majority control of Austrian motorcycle manufacturer KTM through its subsidiary Bajaj International Holdings. The subsidiary has arranged a debt funding package of 800 million euros. This will be used to support KTM's business revival and debt restructuring. Bajaj Auto has said that 200 million euros has already been infused into the company so far. Remember, Bajaj Auto was initially a dormant minority investor in KTM, now picks up a controlling stake. Turkish firm Chelbi Aviation's Mumbai subsidiary has approached the Bombay High Court. The firm is challenging the revocation of its security clearance and is seeking annulment of that decision. Chelbi has also filed an arbitration application against the Mumbai International Airport. The company's contested what it calls unilateral termination of its contract for ground handling operations. So remember, the matter being heard in the Delhi High Court and now Chelbi moving the Mumbai High Court as well. The Supreme Court has pulled up the Enforcement Directorate for its probe into Tamil Nadu government's liquor retailer. Chief Justice B.R. Gavai said that the probe agency, and I quote, is crossing all limits and violating the federal structure, end of quote. The Apex Court has stayed the ED's probe as of now. Ashmit joins us now with the details. Ashmit, strong words there from the Supreme Court about the manner and conduct of the Enforcement Directorate's actions. Take us through what transpired and what this now means as far as the ED is concerned.
Well, the Supreme Court fuming at the Enforcement Directorate, saying that it's crossed all limits. All of this with respect to the ED investigation into the TASMAC liquor stores, the liquor corporation in the state of Tamil Nadu. Now, what's important is that the ED claims it's probing a 1,000 crore rupee scam in the state of Tamil Nadu with respect to liquor retailing. The Tamil Nadu government, however, approached the Apex Court where they clarified that 41 FIRs have already been filed in this case between the years of 2014 and 2021, that the ED conducted raids despite those FIRs, that the ED confiscated phones of TASMAC officials and then subsequently went ahead to breach privacy norms by cloning those devices. Now, all of this inspired strong words from a bench headed by no less than the Chief Justice of India, Justice Gavai, observing that the ED has crossed all limits, that the action of going ahead with these raids that took place in the month of March, despite the fact that there are FIRs already in place, is a blatant breach of the federal structure of our constitution, the center-state relationship that we have. And on the back of that, the Supreme Court not mincing words, saying that it will not allow for this investigation to move forward. For now, a stay being granted on the ED investigation into the TASMAC case. Furthermore, a notice has been issued to ED where the ED has been asked to explain its conduct of going ahead with these seizures, with these raids, despite the state police already having filed FIRs. So some tough questions for the ED to answer. This case will be heard once again in the month of July.
Ashwin, many thanks. Now, US President Donald Trump, yet again, taking credit for brokering the ceasefire between India and Pakistan. Trump's remarks came during a press conference, this time with the South African president in the Oval Office. Trump said that he settled the issue through trade. The United States president has over the last 2 weeks on multiple occasions claimed that his administration engaged in high-level trade discussions with both India and Pakistan and indirectly facilitated a reduction in hostilities at the border. However, Foreign Minister S. Jaishankar told a Dutch news portal that the ceasefire was negotiated directly between India and Pakistan, further adding that it was the Pakistan army that sent a message that they were ready to stop firing, and India responded accordingly.
If you take a look at what we just did with Pakistan and India, we settled that whole thing, and I think I settled it through trade. We're doing a big deal with India, we're doing a big deal with Pakistan, and I said, what are you guys doing? You know, somebody had to be the last one to shoot. But the shooting was getting worse and worse, bigger and bigger, deeper and deeper into the countries. Pakistan has got some excellent people and some really good, a great leader. And India is my friend, Modi. And he's a mutual friend. Yeah, he's a great guy. And I called them both, and we just did something good.
Yes, you know, we have a mechanism to talk to each other as a hotline. Yeah. So on the 10th of May, it was the Pakistani army which sent a message that they were ready to stop firing, and we responded accordingly.
And where was the U.S. in this process?
Well, the U.S. was in the United States. I mean, obviously there were U.S. Secretary of State Rubio and Vice President Vance had called up. Rubio had spoken to me. Vance had spoken to our Prime Minister. They had their view, and they were talking to us, and they were talking to the Pakistanis, as indeed were some other countries.
Yep.
I mean, the United States was not alone in this. I think there were some countries in the Gulf. There were some others as well. That happens naturally. When two countries are engaged in a conflict, it is natural that countries in the world call up and ask and try to sort of indicate their concern and what they can do in such a situation. But the ceasefire, the cessation of firing and military action was something which was negotiated directly between India and Pakistan. We made one thing very clear to everybody who spoke to us, not just United States, but to everybody, saying, look, if the Pakistanis want to stop firing, they need to tell us. We need to hear it from them. Their general has to call up our general and say this. And that is what happened.
Well, that's the Foreign Affairs Minister S. Jaishankar. And speaking of the India-Pakistan conflict, John Bolton, who served as the U.S. National Security Advisor for 18 months in the first Trump administration, has said that India needs to set some ground rules with the U.S. for any future back-channel talks. Speaking exclusively to CNBC-TV18, Bolton added that Trump likes to be the center of attention, and that's why India should not take his claims personally.
Well, I wouldn't take it personally in the sense this is Donald Trump at work. This is what he does with friend and adversary alike. He likes to be the center of attention, and one way he can be the center of attention is that he announces that he was the center of the solution. It's not something I think most Americans experienced in national security affairs think is helpful, and indeed I think it can sow misunderstanding. But it wasn't particularly directed against India. He's done it, as I say, to friend and foe alike. So I think in future discussions, it's worth getting the ground rules straight with President Trump at the beginning.
Well, that's John Bolton there. Now, Prime Minister Modi visited Rajasthan today to lay the foundation stone of development projects worth 26,000 crores. Also inaugurated over 100 railway stations. In his public address near Bikaner, the Prime Minister once again hailed Operation Sindoor. He said it was India's response to Pakistan's provocation, and that is the new form of justice, and that there will be no talks with Pakistan unless it is about Pakistan-occupied Kashmir.
जो सिंदूर मिटाने निकले थे उन्हें मिट्टी में मिलाया है और तीनों सेनाओं ने मिलकर ऐसा चक्रव्यूह रचा कि पाकिस्तान को घुटने टेकने के लिए मजबूर कर दिया.
Well, we will head to a break, but up next, ONDC's retail order numbers declined by 33% in 6 months from October 2024 to April this year. We'll tell you why, but right after this short break. Well, the big global story, 2 staff members of the Israeli embassy were shot dead near a Jewish museum in Washington, D.C. The 2 victims, a man and a woman, were leaving an event from the museum where the suspect approached a group and opened fire. The suspect, identified as Elias Rodriguez, was detained by the event security team and was heard chanting "Free Palestine" in custody. The FBI has called it an act of violence. And speaking of Israel, forces have killed over 93 Palestinians in the last 24 hours in Gaza. This also includes 38 who've been killed since dawn. Forces have also reportedly fired warning shots towards foreign diplomats visiting the Jenin refugee camp in West Bank. Meanwhile, the United Nations has sent 98 trucks to the enclave, making this the first delivery since early March. This came after Israeli Prime Minister Netanyahu said he was open to a temporary ceasefire. However, he also said the military would continue its efforts to take full control of the region. Meanwhile, Ukrainian military has claimed that 10 of its drones hit a semiconductor plant in Russia. Officials have said that Russian forces struck a military training site in northeastern Ukraine, killing 6 soldiers and injuring at least 10. The commander of the military unit has been suspended. Meanwhile, Russia has also claimed that more than 370 Ukrainian drones attacked across the border. Around 27 were aimed at Moscow, where airports had to be temporarily shut down. President Trump and South African President Cyril Ramaphosa sparred over the U.S. leader's claims of the genocide of white farmers in South Africa. During a contentious meeting at the Oval Office, Trump cited news articles and showed videos of what he claimed were mass graves for white farmers. Ramaphosa rebuffed Trump's claim, saying that farmers of all races were being killed because of rising criminal activity. Ramaphosa began the conversation by joking that he did not have a plane to offer Trump. This comes a day after the Pentagon confirmed that it accepted a jet from Qatar to be used as Air Force One. Here's that tense exchange at the Oval Office.
Why did a country give an airplane to the United States Air Force? Okay, the United States, not to me, to the United States Air Force.
I'm sorry, I don't have a plane to give you.
I wish you did. I take it. I would take it. If your country offered the United States Air Force a plane, I would take it. But we have many people that feel they're being persecuted, and they're coming to the United States. So we take from many locations if we feel there's persecution or genocide going on. Generally, they're white farmers, and they're fleeing South Africa.
People who do get killed, unfortunately through criminal activity, are not only white people. Majority of them are black people. And we have now been utilizing...
The farmers are not black.
Well, that's Cyril Ramaphosa versus Donald Trump in the White House. The man who designed the iPhone, John Ive, and his company will take over creative and design control at OpenAI. Sam Altman's company acquires Ive's company for $6.5 billion to work on a new generation of hardware devices and other AI products. So this is going to be a space to watch out for. The government's Open Network for Digital Commerce, or ONDC, has seen a slowdown in the number of retail orders, falling from 65 lakh in October 2024 to 43 lakh in April. However, other segments, including its logistics and mobility verticals, continue to grow. Shilpa joins us now with more. Shilpa, take us through what's leading to this slowdown in retail orders on ONDC.
Well, you know, Shireen, what was once touted as a challenger to e-commerce and food delivery giants, the Open Network for Digital Commerce, or the ONDC, is now seeing signs of a slowdown, especially in the retail segment, which is in fact its largest segment. And this includes food delivery, groceries, and your online shopping. Now, retail orders, as you mentioned, peaked at 65 lakhs orders in October 2024, but it dropped to about 43 lakhs in April. And this is according to ONDC's own data. Now, at the same time, other segments on ONDC, like logistics and mobilities, are actually picking up. Now, these are essentially players using the network for third-party logistics services and also cab and auto services. And this is largely led by Ola in logistics and Namayatri in mobility. So what's behind the retail decline? Now, industry players cite that there is poor user experience when you try to order things on via the network, and also weak customer support. Now, buyer and seller apps say that subsidies that once allowed them to offer deep discounts were also slashed from around January, and that made ONDC less attractive for, you know, the kind of price-sensitive users that we see. Now, some of the buyer apps have also started charging a platform fee of 1.5 rupees. We also spoke to a few businesses who offer buyer and seller app services for ONDC, who say that while there is a dip in orders now, this is part of a larger calibration that ONDC is doing as it also begins to focus on financial stability about 2.5 years after it has launched, and that several smaller sellers continue to bet bet on the promise of ONDC. We also reached out to ONDC, which refutes any slowdown and said that as the network scales, it is evolving its approach towards sustainability, and this includes a phased realignment of incentives and the introduction of a normal infrastructure fee that is on the anvil. So all in all, the sense that we are getting is that yes, there is a slowdown, and a large part of it is because the discounts were scaled back, but many players say that it is still too early to write off the promise of ONDC. Back to you.
All right, Shilpa, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with more.
Hello and welcome to News Centre with me, Parikshit Luthra. India's all-party parliamentary delegation comprising of 7 teams and 45 MPs, along with former diplomats, have left for foreign nations in an attempt to expose Pakistan's role in sponsoring terror attacks against India. Delegations will visit 32 nations to engage with foreign leaders and think tanks. The MPs are expected to highlight the impact of the Pahalgam attack, which left 26 people dead, and India's Operation Sindoor, targeting terror infrastructure in Pakistan with precision strikes. The United States urged both India and Pakistan to exercise restraint. US President Donald Trump claimed credit for the ceasefire announcement, but Foreign Secretary Vikram Misri told lawmakers that US had no role to play in the cessation of hostilities between both nations. The ceasefire is holding for now, but what next? And should the US play any role in the conflict when India has dismissed any third-party intervention. Joining me now to discuss all of this and much more is former U.S. National Security Advisor John Bolton. He served in the first Trump administration for a period of 18 months as NSA. Mr. Bolton, thank you very much for joining us here on CNBC-TV18. What has the India-Pakistan conflict, which began on the 7th of May, shown in terms of India's response to Pakistan-sponsored terror?
Well, I think there's no doubt that India has an inherent right to individual and collective self-defense under Article 51 of the UN Charter, which it exercised. It did a few days ago. It did in 2019 when I was National Security Advisor. And I think it's important that India always show that this was a terrorist attack emanating from bases on foreign soil, Pakistani in both cases, to justify what it's doing. But that right, I think, is pretty clear. The question then obviously is what happens if Pakistan decides to up the ante, which happened again both in 2019 and this year, and to underline that this is a solution. There has to be a solution to this problem of Pakistan not controlling these terrorist forces on its own territory. I think that's sort of the most important place to start. But there are a number of other issues, particularly raised by this year's attack, notably the role apparently played by Chinese-supplied fighter planes to the Pakistani Air Force. Fifth-generation fighters, it appears, and what that means to the bigger picture of strategic stability on the subcontinent and really globally.
Right. India's military response by Operation Sindoor included targeting terror camps in Pakistan, which were the hub and command and control centers of terror outfits like the Lashkar-e-Toiba and the Jaish-e-Mohammed. Do you think India has sent out a strong message and was able to eliminate the ability of these terror camps to carry out attacks on India?
Well, certainly the response was much more vigorous than in 2019, and perhaps that is the result. I think the fact that, at least as we understand from publicly available information, it was the Pakistani military that ultimately contacted its Indian counterparts to say, let's bring this clash to a halt, let's have a ceasefire. So it took a little bit longer than it did in 2019. I think people were concerned it might escalate even further, but it did come to a stop, and I think that's important. But I think from India's point of view, certainly the Pakistani response in the intervening 6 years has not been sufficient, that these terrorist groups are still able to attack and recover from whatever damage was inflicted on them. I've certainly argued, as have other people, that this support for terrorist groups, if you want to look at it that way, or at least acquiescence in terrorist groups operating from Pakistani territory, is not good for Pakistan itself. It's not the world's most stable government, even though in Pakistan they call the military the steel skeleton. It's still at risk of falling to terrorist groups inside Pakistan, which would be bad for that country and bad for the neighboring countries too. So these issues have been there for a long time. That obviously means they're difficult to resolve, but this latest incident proves anything. It's that this cycle needs to be stopped at an earlier point, and that every country has a responsibility to control its own sovereign territory and prevent these kinds of terrorist assaults on its neighbors.
India has said that the progression towards Operation Sindoor began on the 22nd of April when Pakistan-sponsored terror attacks took place, and there were civilians who were killed in Pahalgam. The attack involved religion-based segregation, which has been recounted by the victims themselves. What does this show about the intention of the resistance force and Pakistan's role in this?
Yeah, I mean, this obviously has been a continuing source of difficulty, and India has felt the blow of terrorist attacks, not just in Kashmir, but at its own parliament building. So like the United States, which has also suffered attacks from radical terrorists in Southwest Asia, this is a problem that we simply cannot live with. And it's why India's responses clearly constitute legitimate self-defense. I just say I think it's important to get the kinds of information that you've just described, get it out into the world press, make sure that the case that India can make, should make, is important to provide legitimacy for the steps it takes militarily. And I think it's something that the United States government should spend more of its time talking to Pakistan about. We've obviously had a long and complex relationship given the war in Afghanistan. But even the fact that under the Trump plan and the Biden administration withdrew American forces from Afghanistan, this continued threat of terrorist attack out of Pakistan, stemming, many people believe correctly, from elements within the Pakistani military, is not something that can go on for a long period of time. This is the sort of thing that indicates that the influence of China in Pakistan, which is growing, unfortunately, is hardly beneficial to peace and security in the region.
Right. Ambassador Bolton, what we were really shocked by was how US President Donald Trump took credit for a ceasefire even hours before the Indian government could announce that it has had any conversation with US on it. In fact, there is a lot of discomfort within the Indian government that President Trump said that he mediated for the ceasefire to happen. What do you make of all of this?
Well, I wouldn't take it personally in the sense this is Donald Trump at work. This is what he does with friend and adversary alike. He likes to be the center of attention, and one way he can be the center of attention is that he announces that he was the center of the solution. It's not something I think most Americans experienced in national security affairs think is helpful, and indeed I think it can sow misunderstanding. But it wasn't particularly directed against India. He's done it, as I say, to friend and foe alike. So I think in future discussions, it's worth getting the ground rules straight with President Trump at the beginning. I think the fact he made a call, that Vice President Vance and Secretary of State Rubio made calls trying to be helpful was a good thing. I don't want to discourage it, but I think he needs to understand how sensitive this is on both sides, and that in some cases, what goes on quietly out of the spotlight is a lot more important than what happens in the glare of the spotlights.
Do you also think that President Trump has gone ahead to hyphenate India and Pakistan together, as he said that he's spoken to India and Pakistan and told both of them that if they want to continue trade with the US, then they need to stop fighting? President Trump also remarked that he is going to do a lot more trade deals with Pakistan. Do you think that statement by President Trump was insensitive to the Indian government, which is a close ally of the United States?
Well, I think it shows he doesn't know much about the history here. And to him, the part of the problem with Trump is that trade is about all he thinks about, unless forced to think about other things. There's no doubt in any country's foreign affairs agenda, trade is important, but it's important for the economic well-being of the countries themselves. There's no way you can underestimate it. But in the big picture, it's one of several things competing for attention, and we found in efforts to advance the Asian Security Quad in Trump's first term, the idea of Shinzo Abe to have India, Japan, Australia, and the United States cooperate more closely, that we were lucky to get any strategic discussion in at all. And the meetings tended to degenerate. There weren't, I think, but two, but they tended to become trade meetings almost immediately. And I think, look, I think Prime Minister has a very good personal relationship with Trump, and that in Trump's mind is critical. He sees most of international affairs through the prism of whether he has a good personal relationship with his counterpart in another state. So the Prime Minister's built up a significant asset there, and it would be worth using that to try and explain to Trump a little bit more of the complexity of what's involved here and the legitimate sensitivities.
Can we still trust President Trump, is the question.
Sure, but what you can trust is he will look for the most publicity he can get out of almost anything. And I was saying you should try and establish ground rules. Don't necessarily have complete faith he'll follow them once you set them. But in this kind of affair, we know that the what really triggered the ceasefire was a communication from the Pakistani military to their counterparts on the Indian side. That's the kind of thing done without public attention, and sometimes that can be extremely important. And if the effort at a ceasefire is diverted by public statements by one country concerned about the outcome, it can wreck an awful lot of work that's been done behind closed doors.
Just to speak about China, you've referred to China earlier. What role do you think China played in this conflict between India and Pakistan, and what is the big worry?
Well, I think the biggest news about China out of what just happened is the presence of sophisticated Chinese fighter planes on the Pakistani side. And there's some disagreement about exactly what they did, but a lot of stories about how effective this, what we believe is probably a fifth generation prototype of Chinese fighter planes. And the accompanying information in the public domain that Pakistan may be buying as much as 80% of its sophisticated weapon systems from China, a real reversal from decades ago when much of it was bought from the United States. So I view these indications of increased Chinese influence over Pakistan, particularly on the aerospace and defense side, is very, very troubling. And I think that is something that obviously should be troubling to India as well, given the geography that you face with the shared border with Pakistan on the west of the country, and given what we know about China's hegemonic aspirations all around its periphery. So I think that is something that we need to give some very careful thought to.
All right, just shifting for the moment away from the India-Pakistan conflict, Trump has said that he now favors direct talks with Iran and how they are very close to a nuclear deal with the nation as well. Where does this leave US's traditional ally, Israel?
Well, I don't think they're close to a deal. I think this is salesmanship at work. If they are close to a deal, it would be a duplicate of the 2015 Obama nuclear deal, which was unsatisfactory and Trump was right to withdraw from back in 2018. So my guess is in Steve Witkoff, the president's personal envoy, you have somebody who knows nothing about nuclear weapons, nothing about Iran. I think the Iranians are just out maneuvering him. And my guess is that they're really not that close to a deal at all.
Moving on, Donald Trump has announced cessation of sanctions against Syria during his Gulf tour. He also recognized Syria's new ruler, Ahmad al-Shara. What kind of message does this really send out to U.S. allies?
Well, I think he did it at the instance of Saudi Arabia, which has a grave concern about the potential expansion of Turkey's influence in northern Syria and in the Middle East as a whole, given the Erdogan regime's neo-Ottomanist imperial ambitions. So I can see why the Saudis wanted it, and I think that's an interest the U.S. shares. But Trump made a mistake in lifting the sanctions before he got more indications of performance from Ahmad al-Shara, as you say, the new Syrian leader. He can trim his beard and he can take off his combat fatigues and put on a coat and tie, and he can abandon his nom de guerre and pick up what he says is his real name. That's all well and good public relations, but I would like to see action to show that he's no longer really the al-Nusra Front, the al-Qaeda affiliate in Syria, that he wants to turn the page on terrorism. And there are a number of practical things he could do. Release all the archives and information from the Assad regime about American hostages, all foreign hostages really, that the Assad regime took. Completely open their archives and facilities to international inspection on Assad's chemical and biological weapons programs, and make full disclosure of everything the Assad regime did with Iran during the Assad period in power, including the building of the nuclear reactor Deir el-Zor, a reactor being built by North Koreans, financed by Iran, obviously part of the Iranian nuclear weapons program. That, to me, real concrete action, as opposed to just talk, is what you need to lift the sanctions.
My final question now, what is the biggest threat for India going forward, considering China and Turkey's support for Pakistan?
Well, look, Pakistan is the immediate, imminent threat given the actions of the past few weeks. I think it's really, though, China that's the bigger threat. And I think one course of study in the near term here is the difference between Pakistan's reaction in 2019 and 2025, the growth of Chinese influence. In other words, this is not simply the material contribution China has made to Pakistan's military, but is this an indication of much greater political influence as well? Because I think that would indicate a very serious problem. It would take the Pakistan issue to a much higher, more dangerous level if the Chinese influence is really responsible.
All right. Thank you very much, Ambassador Bolton, for joining us for that very important all-comprehensive interview on the India-Pakistan conflict and a preview into Donald Trump's foreign policy as well.
The top brass at Walmart-backed PhonePe has spoken about the National Payments Council's move to cap UPI market share at 30%. Now, remember, the deadline has been changed over and over again. It currently stands in 2026 December. Speaking to me, the CEO and CTO of PhonePe said that while they understand the intent behind the regulation that the NPCI is hoping to bring in, the approach needs more thought. PhonePe argues that PhonePe has not muscled any competitor out of business using its capital, and so no company should be penalized for being a market leader. Remember, NPCI has yet again deferred the implementation of the 30% market share limit till the end of 2026. PhonePe is the clear leader with over 46% share at this point in time. Take a look.
Speaking of regulation, the other overhang, of course, now pushed out to 2026. But you know, you've lived with this for the last many years. It's a 2-3 year cycle that keeps playing out. I mean, how do you deal with this? Are you now working with the fact that, look, we'll wait till 2026 and see what happens then, or are you working with the fact that, look, we've got to be prepared for 2026 to actually happen?
I wish this were an app update that I could sort of work on, right? I mean, some of this is just because the deadlines are cyclical, some of the build-up is. I'll say this. I think because this was the third cycle that just finished in 24 December, and because I think there's also, I think the media really starts dialing this up as you get closer, right? It's almost like this.
Are you not checking your WhatsApp every few days to see whether NPCI has
I think honestly,
sent out
the
a memo?
ecosystem has become it. I genuinely think that media, because NPCI was reporting monthly numbers for all the players, unlike a lot of other segments, the attention to the leaderboard on UPI. I mean, right now I see people reporting this person jumped to number 7 and that one jumped to number 9. It's like,
yeah, because 1 and 2 is done and dusted.
No, can you tell me, e-commerce is a decade older. Could you tell me who the number 7 and 8 player in e-commerce are? Could you tell me in food tech? Could you tell me in cap tech?
Or
Could
do
you
we
tell me
even
in any
report
sector?
it?
You can't. Now the point is, because the data is there, it's a talking point.
Yeah.
And because they put this cap circular out, it's a larger talking point. I think this time, I think the comfort that we got, the comfort we were seeking was when we spoke to the policymakers, the regulators, ecosystem. I think one assurance that was provided was that whatever they do, I think there is a desire by the regulators to actually create a more diversified market. I agree with that.
Sure.
The fact that burden is somehow falling on us did not sit right by us, and we express why. I mean, it can't be the entrepreneur's burden to actually reduce market share, and I think they agree with that at some level. But I think the approach to then get past this impasse has to go from circular to something else, and I think that broad understanding after 4 years of dialogue has happened, and it sort of comes, it's translated into two things. One, everyone's agreed, no matter what happens, you don't hurt the customer. Not PhonePays, not GPays, not ATMs, not the 10th persons. You just don't hurt the customer because payments is sacred. Second, newer players have to stop calling themselves smaller players. You're small because you're new. And if you want market share, you can't just say, I want that. You got to earn it by differentiation.
Yeah.
And I think even Dilip at NPCI said this now. I think people need to give users new reasons to buy their toys.
Yeah.
I'm hopeful before 26 arrives this time. There's been so much discourse around this publicly, privately, at the ecosystem level that I think they will unleash, hopefully, the next wave of innovation on basic interoperable UPI paradigms. You need one QR in any app to work. You need one app to work. Beyond that, everyone should be able to innovate. I think because of the cap, what's happened is innovation significantly slowed down. Because now what's happening is, the large players can't launch first, okay? The small players don't want to launch first. They want to get growth. So no one's launching. And I think that's actually the only way in which you change the market.
While I get what you're saying, that you see this as a perverse regulation, anti-entrepreneurship, anti what you're doing, but do you believe that it's something that perhaps environmentally is gaining momentum?
So couple of things there. I actually don't think it's perverse regulation. I understand the intent.
Yeah.
I think the approach needs more thought. Majority of the lawsuits are in the Google ecosystem or the Facebook one. And they're of two kinds. Facebook is staring at regulation or not regulation, I think activism around the fact that they bought out pretty much all their principal theoretical competitors.
Yeah.
Right? So they have every major social network in their stable. We've not acquired anything in payments, life till date. We built everything we have, and slowly and painfully, as we just discussed. So that argument here doesn't hold. We've not muscled anyone out using capital. Yeah. And the Google argument, which is now playing out in 50 states, and they're paying penalties left, right, and center, again had to do with abuse of monopoly, not monopoly. India had a anti-monopoly law. We removed that in law and took a position that abuse of monopoly needs to be demonstrated, and that lies with CCI.
Yeah.
Because if you don't remove that, you remove any incentive for anyone to innovate. If being the leader of something or being large in a sector in of itself is inherently bad, somebody then publish these leaderboards on day zero so that I know I don't need to actually go past some number, right? I'd like to believe that we trust our markets and our innovation cycles more than that.
Secondly, I think specifically to UPI, there's no barrier to entry. You still have new TPAPs, apps coming in practically every month, right? NPCI is trying to create a more vibrant environment. It is a completely interoperable platform, which means effectively the consumer is not tied to any specific app, but it's a choice that they can easily migrate from one app to the other. In fact, many consumers have multiple apps.
Fair enough.
So it isn't a monopoly by design or force. It is, first of all, it's not a monopoly. We talk about
a closed loop system.
It's not a closed loop system. It's consumer choice that is ultimately playing out.
Hello and welcome to News Center with me, Parikshit Luthra. Our focus today is on Tata Motors, which has launched the new Altroz hatchback at a price point of rupees 6.89 lakhs ex-showroom. This is the first major upgrade that the car has got since it was launched in 2020. Altroz is a premium hatchback and is positioned competitively against the Baleno, the Swift, the Glanza and the Hyundai i20. Tata Motors, which was the second largest car maker by market share in FY24 after Maruti Suzuki, slipped to the third place in FY25 behind Maruti and Hyundai. The company's electric vehicle market share is also under pressure due to stiff competition and more launches by other OEMs, including JSW, MG Motor and the Mahindra Group. If the company's EV market share was 73% in FY24, the same came down to 54% in FY25. But the company is now getting ready to launch at least 5 new products in FY26, and the new Altroz is a critical part of the strategy to win back lost market share. I caught up with Tata Motors Managing Director Shailesh Chandra about the company's FY26 strategy and began by asking him about the upgrades that the company has given to the new Altroz to make it more competitive. Listen in.
We have redesigned this product in terms of its styling, which is more modern, which is strikingly agile. You'll see different kind of elements like flush door handles or the new lighting elements, which is very modern. Or you talk about the wider proportion of this car. So it has really lifted this car in the hatchback, premium hatchback segment. Also, the interiors have made more plush with color, material, and fabric. So overall, a lot of first-in-class tech features, high focus on comfort. So it's a car which the target customers are going to really like and be very proud to own.
Okay, now could you give us a sense how much does the Altroz contribute to Tata Motors sales percentage-wise, and how do you expect to increase this with the latest upgrade?
So, at the start of the interaction, you said that it is getting a refresh after 5 years. So the 5th year, had been really challenging, which is the last financial year because of aging of Altroz. The peak volume that it had done was in FY24, just a year back, doing nearly more than 70,000, if I'm not wrong. But it literally halved in the last financial year, and that has been the reason for why the market share for us came under stress, because we lost nearly 35,000 units in Altroz. And therefore, this year, it should show the revival of this product, and therefore, it should really help us big time in terms of volume growth as well as market share growth.
Right. Could you give us a sense of the offtake you're looking on a monthly basis, production-wise at least, sir?
I've kind of given a hint, but I'm saying that typically any segment we are present in, we aspire to be, holding a market share of about 20 to 25%, which means that you are among the top 2 or top 3 selling cars in that segment. That's the aspiration. The segment size is about 3 to 3.5 lakh a year. So you can do the arithmetics around this.
Great. So clearly, sir, it's going to be very important for you to claw back your market share. And the reason why I'm talking about market share, because as we see the data, the retail data shared by the Federation of Automobile Dealers for the month of April and also for the full year fiscal 25, there is a marginal decline in your market share by at least 1%. So you're saying that it was the low sales volume for the Altroz, which was the biggest reason for this, and you feel that with this new launch, you will be able to claw back that share?
First, it is important to understand, Parikshit, that the industry last year was a tale of two cities. The hatches declined by about 13%, and the SUVs had grown by about 10.5% or 11%. And therefore, the players who had exposure to both SUVs as well as hatches pretty much mimicked the slowdown in the industry. But SUV-heavy players did see the benefit given the growth rate that we were seeing in the SUV segment. As far as we are concerned, in the SUV segment, we had an industry-beating growth of nearly 11.5–12%. Hatches, which declined by 13% in the industry, our decline was more than 30%. Because of the aging of 2 products that we have in the hatch segment, which was Tiago, which was also in the 5th year requiring a major intervention, and the Altroz. And we lost nearly 50 to 60,000 numbers as compared to FY24 because of the issue of aging and also the decline of hatches, which we were seeing. But we launched the model year, intervention, and a new Tiago was launched in January 2025. And in Q4, we saw a significant jump in Tiago, coming back to the volume levels where it used to be. And now we have Altroz, where we had seen the significant decline, that also coming with a very strong refresh. And therefore, we have a very low base effect of FY25 now. So hatches should be the area where our growth rate should be extremely high. But also on the SUV side, you are seeing the success of Punch and Nexon continuing to thrive. We have the full year now available for both Nexon CNG as well as Core. We are going to add an additional product, which will be Sierra in the second half of this financial year. So on the SUV side also, there's a lot of action. So both on hatches and SUVs, we clearly see a strong revival, and therefore we should have an industry-leading growth this year.
Right. So do you believe that it would be Q1 when we would see Tata Motors clawing back the market share, or it would be more towards Q2?
You will see through this year our market share increasing.
Also about the product onslaught from Tata Motors this year. If we saw a muted demand across the industry last year, and now you're coming up with new products almost on every month or in 2 months or 3 month basis, what is the kind of product onslaught or offensive that we can expect from Tata Motors?
You know, our refreshes are going to come in time. So there will be one refresh. You have already seen the new Ultras. There will be 1 or 2 more which you can expect in this financial year. Then there is expansion of EV portfolio with Harrier and Sierra also coming in this financial year. Then you would have the ICE portfolio, which will come with a new nameplate, which is again Sierra ICE. So a lot of actions that you are going to see during the year.
Right. How would you describe the current market sentiment right now, especially in the entry-level segment, Mr. Chandra?
See, at an industry level, or, you know, if you really see all the consumer-facing industries, there has been a bit of slowdown for last 1.5 years. And we see that trend right now, you know, continuing. And therefore, at an industry level, we are seeing pretty much similar kind of moderate growth as we had seen in FY25. Specifically talking about entry segment, and if you really see the hatches segment, which has been declining as far as the share of TIV is concerned. But within the hatch segment, if you really sub-segment the hatches into 4 parts, entry, mid, high, and premium, there's a gravitation towards the premium hatchback segment. And it is coming at the cost of significant decline in the entry hatch segment. So I think entry hatch segment will remain under pressure. There's also the customers who would be considering an entry hatch. A section of them is also seeing used car market also as an alternative. So I believe that the entry hatch segment will be under greater stress as compared to the industry overall.
Right. What would be your full year estimate for FY26? So if I'm not just speaking about Tata Motors, but I'm speaking at an industry level for passenger vehicles.
You know, I said that, you know, it is going to be very moderate growth as we have seen in FY25. That's broadly the, you know, consensus that we are getting once we talk to the forecasting agencies or even our industry peers. So it seems to be so far, based on the trailing trend that we have seen on the demand side in the last 5-6 months, it continues to be the same, and therefore we are expecting a moderate growth.
Right. When it comes to electric passenger vehicles, Tata Motors is still in the pole position, but the pie has been increasing. You know, there are more players entering and their sales are going up on a monthly basis as well. There's a lot of competition for you. What would you be doing in terms of fighting out or navigating this competition? You've got a big Harrier EV, a Sierra EV also coming up, but larger plans to make sure that you're able to continuously make a mark.
See, Parikshit, you know, we are segmenting the electric vehicle industry into 4 parts now as the industry is growing in size. One is the entry segment, which is mostly used as city cars, less than 12 lakh. Then there's a 12 to 20 lakh segment, which is seeing intense competition because all the models are getting launched by all the players in this sub-segment. And there's a, you know, good potential that is also emerging in greater than 20 lakh segment. There's a 4th segment, of course, which is the fleet segment. Let me talk about our position in these 4 segments. One, that we are not present right now in the greater than 20 lakh segment. So we'll come with 2 very strong products, which is Sierra EV and Harrier EV. So that should help us expand our volumes by entering into a new segment, which is showing promise. Entry segment with Tiago and Punch, we are the dominant player with 75% market share. It is the mid, segment, which is 12 to 20 lakh, where we have lost the market share the most. The idea now is going to be further enhance the value proposition of Tiago and Punch in the entry segment to expand that segment more, and we are doing certain interventions there. Strengthen the Nexon and Curve further in terms of what value it offers to the customer at a certain price point, and regain some of our lost market share in that segment. And then you have a new segment that in any case I said we are entering, which is greater than 20 lakh. On the fleet segment, we want to expand the consideration of the fleet buyers. So far, it has been limited to employee transport and some of the electric vehicle-focused shared mobility companies, which has been under stress. And therefore, for doing that, we are trying to see how our electric offerings in the fleet segment can deliver similar kind of value as what a CNG vehicle delivers, and that's also work in progress. So in short term, these are the actions in all these 4 segments which should strengthen our volume growth as well as the market share. And in the long term, mid to long term, we aspire to hold 50% plus market share. For that, apart from these actions, we'll also renew our portfolio with more promising product in time frame of 18 and 24 months and beyond. That is something which we will talk about at the right stage.
Mr. Chandra, always a pleasure talking to you. Thank you so much for speaking about Tata Motors' product offensive for FY26 and why the Altroz upgrade was so important and so critical for the company. Thank you once again for being with us. Time for a short break, but coming up, Marriott International has launched its new global brand called Series by Marriott. A special discussion with Rajiv Menon, President of Marriott International's Asia Pacific, excluding China region, when we return. Welcome back. You're watching News Center. Our focus now on the hotel and tourism sector. Marriott International has launched its new global brand called Series by Marriott. The world's largest hotel company has chosen to debut the brand in India. With this, the company has signed a foundational agreement with the hotel management firm Concept Hospitality. Marriott has said that it will also make an undisclosed equity investment in Concept Hospitality. The international hotel chain currently operates over 30,000 rooms in India and plans to reach 50,000 in the next 5 years. The launch of Series by Marriott aims to capitalize on the India's hotel sector momentum. The market is projected to surpass $11.7 billion in this fiscal and grow to $13 billion by next fiscal. According to Rubik's Data Sciences, domestic travel, events and foreign arrivals are all contributing to this upswing. Occupancy rates are also rising from 68% in 2024 to a forecast of 73% by 2027. Joining us now to take this discussion forward is Rajiv Menon, President of Marriott International's Asia Pacific, excluding China region. Thank you very much for joining us, Rajiv. Let me begin by asking you that you've launched a new brand, Series by Marriott, and you decided to have a global debut, not in the United States, but India. Why was that?
Parikshit, first and foremost, good evening and great to be with you again. Well, you know, this just shows the significance India has, particularly for Marriott International. From a long-term strategic point of view, we see India as an incredible growth story. And as you said, we're making two big announcements today. One about launching a soft brand in the mid-scale to upscale segment, namely Series by Marriott. And number two, our founding deal here in India with Concept Hospitality Private Limited for the Fern brand in particular to be affiliated with Series by Marriott. We see incredible opportunity for growth over the next few decades.
Rajiv, what I would like to ask you, in terms of growing your footprint, how many more hotels would this mean in terms of addition in 2025 and possibly in the next 5 years?
So currently, Parikshit, Marriott operates 158 open hotels and has a pipeline of 112 hotels across 42 cities with 17 brands. With Fern as Series by Marriott coming in over the course of next few months as we bring these hotels into the system, that would be 84 open hotels today and a pipeline of 31 with total room count of around 8,000 more rooms. However, for us, it's not just what's open and in the pipeline, it's the incredible opportunity this partnership represents from a growth point of view over a long period of time. So as these hotels come into our system, we will expand our presence to 90 cities across the country with the opportunity to grow in many more destinations across the country.
Right. So that is pretty significant. Could you also give us a sense of how does the Series by Marriott offering, how is it different from your hotel presence all across the country already? And what kind of customers are you reaching out to? And how will this be a major revenue driver going forward?
When you think about Marriott International broadly, we have the largest portfolio of luxury brands. We have, and that's global. Across India, when you think about it, in our 17 brands, we are representing across many segments, from luxury down to select service. But where we had a little bit of white space was in this mid-scale to upscale space. And that's where this partnership is significant because Fern has an established history of close to 30 years of strong reputation. They have a large distribution network, and we think there are synergies in bringing the two companies together. So from our point of view, when you think about access to more customers, Marriott today globally has 237 million Marriott Bonvoy members. We believe there's a real opportunity to continue to grow that membership base while giving Fern hotels access to our members, also bring in new members in these secondary and tertiary cities that aspire to be part of Marriott portfolio as they travel both domestically as well as internationally. So we see across the board win-win for both sides, and ultimately it helps us drive more revenue.
Right. So as there is a plan to expand presence in 90 cities with Series by Marriott, could you give us a sense of what is the probably average price point or tariff point that you would like to attract customers with in India with the Series by Marriott offering?
Parikshit, as you look at the landscape of Indian hospitality, it continues to evolve. Our business is very much driven by demand and supply. When you look at, luxury hotels, as I'm talking to you right now from the St. Regis in Mumbai, there has been incredible growth both in rate as well as occupancy, as you just talked about. So first quarter in India for us, Marriott International, our RevPAR, which is revenue per available room, grew some 16% over same time last year. And that growth is represented across our portfolio, be it on the luxury side or on the premium side or in the upper upscale side. When you think about the Fern portfolio, again, a lot of it is going to be driven by demand and supply. Rates will vary by market. However, we believe with the access that Fern hotels, through their affiliation with Series by Marriott, will have to our distribution channels, to our reservation platform, to our incredible base of Marriott Bonvoy members, there'll be a real opportunity to drive additional occupancy as well as rate across these hotels.
Right. So if I would ask you about the full year going forward, is there an outlook that you can give us in terms of the total revenue growth that you're expecting from the India market?
So India has continued to grow double-digit for us, both in terms of revenue per available room, as we would call it RevPAR, and also when you think about net unit growth in terms of the number of new hotels or new rooms that we are adding into our system. And I expect that this year will be no different. Full year, we expect double-digit RevPAR growth as well as net unit growth. And this particular partnership will only make that stronger as we move forward.
We've seen some softening in demand in the United States. Are you seeing this as an impact of the tariff uncertainty? Is this playing out other geographies? And which are the key countries which are the big growth drivers for you right now?
So you are right in terms of, some uncertainty at play. However, Asia Pacific still remains fairly robust. Our first quarter RevPAR growth, revenue per available room growth in Asia Pacific ex-China, which is my world, came in at about 11%. And just to put into context, we finished April with 14.5% revenue per available room growth. So the market remains pretty strong, and India remains at one of the forefront markets for us, along with markets like Japan, Vietnam, and other Southeast Asian countries.
Right. And finally, on your expansion plans over the next 5 years, Series by Marriott and your collaboration with Fern are very important parts of that strategy. But in the next 5 years, what is the kind of expansion and presence that you would have in India?
So India would end up becoming, in the next 2 to 3 years, the third largest market for Marriott International. Today, as it stands, with our 158 open hotels, we are the fifth largest, with Fern, Series by Marriott hotels coming into our system over a period of time, as well as our continuing growth through our other brands. We expect India to remain a decades-long growth story, and I remain pretty bullish overall.
Right. And finally, any markets within India which are really driving the growth for you in a big way?
So we see opportunity across the board, but when you think about what I just mentioned with Fern, as we bring Fern hotels into our system, we expand our distribution from 42 cities to almost 90 cities across the country. There are some 750 districts across the country that have opportunity to provide accommodation that is, of certain standard to the customer base as Indian middle class evolves. And we think we are best positioned today to be able to make those offerings through the number of brands that we have, and particularly our ability to grow the Fern brand with Series by Marriott remains immense.
All right. Thank you so much, Rajiv Menon, for joining us with that outlook on India and the strategy behind launching the Series by Marriott brand here in India. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, you've often heard us talk about investments. When to invest, where to invest, how to invest, and of course, what to invest in. But perhaps not enough time and thought is given to the question around exiting our investments. When and how should we exit the investments which have done their job for us in our portfolios? Well, that is exactly what we will focus on this week, setting up a framework for scientific and planned exit strategies. And this can also, of course, help us plan our retirement more effectively, among other things. Joining me to do that this week is Mrin Agrawal of FinSafe India. Mrin, thank you so much for joining in. Welcome to the show. And this is, I admit, this is a question that even I don't ask enough. So I thought it's an important conversation to have. Do you agree?
Absolutely, Surabhi.
So, I want to tell you about the genesis of this thought. I think when the market was, going through a correction, that is when a lot of people were wondering that, yes, of course, you keep buying in when the market is falling. But people also wonder that, okay, I've made a lot of profits since COVID. Should I be now booking some gains? So you tell us, what is the overarching principle when it comes to exiting investments and, taking that profit home?
All right. So, yes, we often talk only about investing, and very often I do see that people do not have an exit strategy in mind. So 3 things that you have to keep in mind when do you exit a fund, right? First is, of course, if it is near to a goal. So if you have done goal-based investing and you are nearing your goal, then, of course, you do need to look at exiting the fund. Second is if the fund is underperforming, right? Or if there is rebalancing required. So in a situation where, for example, one asset class has become, has had a higher allocation, let's say if equities has gone up a lot and you're having more equity than what you really need to have, that's when, these are the 3 reasons why you would need to basically exit your investments, right? So when we talk about each one of these 3 cases, right? When do you check for underperformance or when do you check for rebalancing? It has to be only once a year. And also, once when you check this performance, it's not like you see that the fund is underperforming for 1 year. So then you just look at exiting it. You'll still need to track the performance of the fund for a period of time. And you have to do the right tracking, right? It's not like just saying this X fund gave this much, my fund gave this much, so I'm exiting. No, you need to look at what is the performance of your fund versus the category average versus the benchmark, and then track it for a period of time. And the same thing goes for the rebalancing as well, right? I mean, it's not something that you would do on a 3-month basis. You would need to look at it on a yearly basis. And the last thing is on the basic framework, especially when you are near a financial goal. And we saw this in COVID. We saw this earlier this year, a couple of months back when the markets were down, that when people wanted to withdraw their money for their goal, if the markets are down, obviously your investment value is also going to be down. So to protect yourself against some of these situations, especially if you're exiting before a goal, one of the things that you do need to do is that at least a year before the goal, look at what is the value of the investment. If it is somewhere near to the goal value, look at protecting whatever part of that investment by moving it out into a safer instrument, right? So this is basic framework.
Okay, that's a great starting point. Helpful thoughts there. But Bryn, I want to go back to the basics, really, financial planning 101. And I sometimes wonder, because obviously planners tell us to, plan for specific goals. Take a holiday in 3 years, buy a car in the next, 4 years, or look at retirement in the next, say, 20 years. But at the same time, when we look at our portfolios, usually people have a bouquet of mutual funds, mid cap, large cap, small cap, thematic, etc. In your experience, how do we marry the two? Have a certain set of funds which are for specific goals, but then you have an overall bouquet, which could be mid, large, small, thematic, defense, etc., passive, active. So how do you set for goals within an MF portfolio?
So there are various ways of doing it. Some people would just like to do it on an overall basis to say, I have this portfolio, and then I'll decide at the time of exit. I think the better way to always do it is to say, this is my goal. To this, I will tag these 3 or 4 investments or these 3 or 4 funds for this particular goal, because then it becomes easier for you to basically do the exit, right? Because then okay, if this is my goal and I need this money, these are the 3 funds I've tagged, and you just exit those particular funds. So I think it's basically what works for each individual, but I would seriously suggest tagging in specific funds for specific goals.
Yeah, absolutely, because that's what I was wondering. I mean, you might have a huge chunk of your money, let's say in large cap funds. Now, your goal might be a holiday, but you really want to exit, your entire position in that large cap fund for a holiday that could cost you, say, 2 lakh rupees. So, okay, so you're saying that, bucket it in individual goals and then list the specific funds to arrive at that goal. Got that point. Mrin, on the point of when you're nearing your goal, and you said you then need to start, exiting before you hit the date of the goal. So give us some examples of how this may work. Maybe medium-term goals, short-term goals, even long-term goals. So say the plan is to buy a car over the next 2 to 3 years. How would you plan for it, and when will you start the exit process?
See, as far as short-term goals are concerned, like 2 to 3 year goals, in any case, you would only look at debt funds in such cases. So there it becomes fairly simple. You can pretty much withdraw at the time of the goal itself, where the short-term goals are concerned. But when you actually have longer-term goals that you've planned for, let's say child's education and you need to pay college fees, right? So what I did this for myself as well, wherein a year before the college fees had to be paid, and whatever that amount was for the 4 years, right? So that was in any case what the goal value was. So what I did is that, whatever, it was pretty close to the goal value. So I actually removed that entire money and I went and put it in a debt fund. Now that may not be the situation for everybody. You may be still far away from your goal value, right? So in which case, I think one of the things to do is that maybe start withdrawing money over tranches. But certainly, if you have invested in equities for a goal, I would not look at withdrawing at the time of the goal, because you don't know what the market is going to be like, right?
Yeah.
So I would just play cautious in this case, rather than saying, no, I want to maximize my returns, or I want to wait and increase my corpus, right?
Okay. Yeah, fair enough, because you don't know. I mean, when you're about to hit the goal, suddenly there might be a 10-15% drawdown as well. May not be in your favor. Got that point. So, this whole conversation on rebalancing, let's take COVID as an example, Mrin, because a lot of people who entered the market at that time managed to buy the dips. They've seen sizable appreciation in their wealth, right? And now they're looking at a market which is range bound, and sometimes you've had volatility on the downside. So now let's apply the exit framework here. Should they exit? Should they not exit? What would be the route? What should someone be doing if they're sitting on 5 years of gains since COVID in their mutual funds?
See, I would always say that, it's like where mutual funds are concerned, it's not handled like stocks, right? And the point is that, let's say you've had some great gains, but you'll still have a reinvestment risk, which is like, where do you go and invest the money, and at what rate is it going to grow, right? And this is what I always tell investors, like when people say that I invested in this fund, but it's not doing well, and there's some other fund doing well, or this whole conversation that was happening around gold as well, right? To say that gold is better than equities, so should I move my money to gold? And my question is, how do you know that this performance is going to sustain, and how do you know that gold is going to do better than equity, right? So when you look at data, and I found this really nice data actually available, wherein they have looked at various tenure periods, and they looked at buy versus hold versus doing profit booking at 20%, 30%. Yeah, and reinvesting. And actually, if you pick up any data, it's going to show you that buy and hold always works in the long term. So I am a great believer of goal-based investing. And I would say if your fund has done very good, well, that's great. Continue to hold it. I mean, why are you penalizing the fund by exiting it, right? So I would just say stick on to your investment. If it's done really well, continue to stick on with it till the period of your goal.
That's really reassuring to know that, this propensity to book profit and then to reinvest, find that dip again in the market, that is not necessarily the path to long-term wealth and prosperity. Buy and hold. And that's the easier thing to do as well, right, Prince? So I think that would work well for retail investors. Brings me now to the next question of rebalancing. So if you could just elaborate over here, what all entails in rebalancing? When you sit with your planners or your advisors, what are the questions that I should ask? And when do I need to rebalance my portfolio?
So once a year is enough. You don't need to do it more than that. And you can decide if you want to do it on a calendar year basis or if you want to do it on a financial year basis, whatever works for you. Now, the first thing that you need to consider is what is the asset allocation, and what is the deviation from the asset allocation, right? So you need to set an internal benchmark as to at what number or at what deviation percentage are you going to do that rebalancing on an annual basis. Now, I think that number of 15%, 20% is a good number. So what it means is that, let's say that you have 60% in equities and you have 40% in debt, and that 60% becomes 75%. So there's a 15% deviation basically. So you might decide that at a 15% deviation on an annual basis is when I'll start doing the rebalancing, which means I will get my equity back down to 60%. So that number of that deviation has to be decided by the investor. As I said, it could be 15, 20%, right? Now, what funds do you exit? Then what funds do you rebalance? So let's say you have a set of equity funds and you have to bring down your equity allocation. So the easiest one would be to look at the funds that are underperforming or where you have very, very small holdings. And this is very common, because people just tend to buy these NFOs, or I would say, unfavorable funds, like, for example, if you have thematic funds or sector funds that you might have just got into, or if there are small holdings, or if you're having a lot of duplicate funds. So, now in this era of ETF investing, very often you see people having 4 Nifty 50 ETFs, right? Which is really duplication. So, these are the factors that you look at first, either underperforming funds, small holdings, duplicate funds, or funds which shouldn't be in your portfolio, let's say like thematic or sector funds. Now, if you don't see any underperforming funds, for example, you've had a good year and you've bought all the right funds and nothing is underperforming, then you basically have to go and see that which category do I want to reduce? Do I want to reduce large, mid, or small cap? So basically, essentially based on your risk profile, what risk profile you want to maintain or what risk profile you want to be in, you keep those funds, and the ones that you reduce those. So this is about reducing. But when we come to increasing, because there's also increasing exposure in a fund, right? It could be the other way around, where equities have had a bad year and you want to increase exposure. So of course, over there, you want to ensure that you're well diversified and that you're not over allocated in one fund.
Absolutely, absolutely. Well said. But Marind, the tough part is to reduce allocation to a fund or to an asset class that's working very well. It could be mid caps one year. It could be gold this year. And we're getting questions on this as well. If you could just take up the gold issue, a lot of portfolios, because we historically have gold holdings, there people might have gold coins and bars, and there's obviously the jewelry exposure. Then a lot of people have invested in sovereign gold bonds or gold funds and ETFs. But it's hard to reduce exposure when that asset class is still doing well. So specifically, when it comes to rebalancing, what would you advise on gold now, looking at the market?
See, if you're very, very overexposed and you're finding it difficult to reduce, let's face it, as a financial advisor, it's easy for me to come and say that reduce your exposure, right? But if you're finding it difficult to do it, I would just say, okay, stick on to it, but don't add more, certainly, because the bigger issue that people have is that when mid caps are doing well or when gold is doing well, they will go and add on more. So at least if you're not reducing, don't add on more, certainly. And end of the day, somewhere you'll have to keep in mind the allocation, because see, when the markets are going up or when everything is looking very good, it's all good, right? But then when you have that fall is when you're going to have a big fall. So somewhere I would say that we'll have to think about these factors for sure.
Absolutely, absolutely. Got that point. We need to take a very quick break. But when we come back, we apply this whole exit framework to a long-term goal like retirement planning. How do you ensure that you start coming out of funds? Which are the funds to start exiting as you're approaching a landmark moment like retirement? Back with that in just a bit.
Let's talk money. Money.
Welcome back. You're with us on Let's Talk Money, and this week we're discussing exit strategies, how to exit your funds smartly so that you maximize the output. Now, Mrin, specifically, I want to talk to you about systematic withdrawal plans. How important are they when we are talking about exiting funds where we may not need the entire lump sum money upfront?
Yeah, so very interesting. I've seen that SWP or systematic withdrawal plan is something that's gained a lot of traction in the last 1 year. And I'm often asked about it as a route to creating wealth, right? So I would like to clarify a couple of things. SWP is a product where you basically want to take out money on a regular basis. So it is the opposite of the SIP where you're investing. Here, what you're doing is that you're trying to set up a regular cash flow. So it's a product for regular cash flows. Now, couple of things that you have to keep in mind in the SWP, right, is that, see, whenever you want regular cash flows, it has to be from a product which is growing at a stable rate and which has surety of returns, right? Now, I'm seeing a lot of people talking about setting up SWP from equity funds, which is a little concerning for the reason that equity funds can be extremely volatile. So, for example, let us say that you have some amount, let's say 1 crore, and you think of setting up an SWP, but then the markets fall by 10-15%, as we saw earlier this year. So everything is going to go out of whack, right? I mean, all your calculations and everything are not going to hold good, whatever you've done, right? Like if you started with 1 crore and you're removing some amount every month and the markets fall, your 1 crore is going to come down, let's say, to 85-90 lakhs. Obviously, all the calculations that you've done are going to change, right? So very, very important that, you need to get the reason for doing your SWP correct. That first, the SWP is meant to generate regular cash flows. It has to be done from an instrument which gives stable returns like debt funds and certainly not equity funds. And point number 3, the SWP also needs to be planned well. And I'll explain this through 2 examples, right? So
yeah, so Mrin, I get your point. What you're saying is that don't do SWPs directly from equity funds because equity funds can be volatile. Let's take an example. Let's say that, someone is looking at regular income after retirement. Let's say they've got a corpus. They've got either a 1 crore or 2 crore corpus. How should they plan the exit via the SWP route then?
Yeah, so 2-3 things. See, now if you make an investment, let's say, into a debt fund and you start the SWP right away, it's like you just getting your money back over a period of time, right? So I think first thing is that you should actually invest in a debt fund for, let's say, at least a 3-year period and then start the SWP, because then you've built some amount of gains over the last 3 years, basically. So that's the first thing to be kept in mind. Second is you have, I think, some SWP calculators that are available online, but actually I would actually suggest that please plan this with a financial advisor because it's not that easy. I'll give you an example. Let's say that you start with a 2 crores corpus and you want to withdraw 1.5 lakhs per month. And I'm assuming return on investment at 5%. I'm looking at a post-tax return on like a short duration debt fund. Okay. So you've got a 2 crores corpus. You've put that money in a short duration debt fund and you want to withdraw 1.5 lakh rupees every month. If you do the cash flow calculation, this money is going to get over in 16 years, right? Let us say you wanted to plan for the next 20 to 25 years. You're actually going to fall short because the money is only going to last 16 years. So there is another plan that you can do with the SWP, which is that you invest part of the money. So in the same example, you invest 1 crore and in the short duration debt fund and you start the SWP. Same way, 1.5 lakhs every month. It's going to last you for 7.5 years, right? Now, the balance 1 crore, you can invest into a balance fund for about 5 years, move that money into a short duration debt fund, and then start the SWP. So what happens with that is that then you are able to have the SWP running for about 19 to 20 years. And that way you're able to meet your requirement of getting that amount on a monthly basis, because what you've done is that the first part of it you've invested, you've ensured that you're getting your cash flow for 7 years. The balance amount you invested into another instrument to grow the corpus and then start the SWP on that, right?
So this is interesting. Basically, you're breaking this up. You're letting one part of that corpus continue to compound in an equity instrument, and you're remaining the other half of that corpus is being put in a debt instrument, which is more stable, and then you do a systematic withdrawal plan from the debt portion of it. Got that? That makes a lot of sense. Mrin, we are trying to just squeeze in some viewer queries here as well. If you can quickly answer these. Because viewers have been writing in saying they have some doubts on mutual funds. So I want to take this query that's coming up on coming from Sam on Instagram. He's saying, what is the difference between value, growth and momentum funds? And how should I look at their composition in my portfolio? Do I need to rebalance? Do I need to add them? What should I do? Mrin, new fund categories, many of them on the passive side.
Yeah. So the value funds are funds which invest in stocks which are basically trading, below their true value, basically, and they're expected to essentially grow in the long term, but they're undervalued at this point in time. Growth stocks are, of course, from sectors that are expected to grow well over a period of time and give you sustainable growth. And momentum investing is all about investing in what is basically trending, right? So in a very, very simple way. Now, what should be the allocation of each of these categories in your portfolio is totally dependent upon the risk that you want to take. Certainly momentum, followed by growth, followed by value. That is your high risk to lower risk. So if you want to take a very high risk, if you're able to take high risk, then you could have a higher amount in momentum. If you don't want to take high risk, if you want to be more conservative, you could do value funds. It's all dependent upon what is the sort of risk that you want to have in the portfolio, basically.
Okay, absolutely. So that, I guess, is the golden rule for rebalancing. First, assess your own risk profile, your own requirements and your goals, and then look at your portfolio. So final thoughts, Mrin. I mean, this is a very helpful conversation. So just recap this for us in a nutshell. Exit strategies and the question of exit via an SWP versus lump sum exits. Just what should be a holistic framework to follow?
Okay, so first and foremost, look at exiting only if you're close to a goal or if you're looking at doing rebalancing. That's point number one. Secondly, lump sum versus SWP. So lump sum, of course, you can withdraw and then you can design like whatever sort of strategy you want for your withdrawals. But there does exist a systematic withdrawal plan, which is actually a very good feature that's there in mutual funds to get regular cash flows. But point number one, always, I would say, of course, do it in a debt fund because equities are really, really volatile. And secondly, plan it well. Use the SWP calculators online to figure out as to how long the money would last based upon what is the sort of withdrawals that you're doing. And as I said, if it's really not tying in with your time frame, then see how you can work with a financial planner or get someone to basically design it out for you.
Okay, all right, Mrin. Thank you very much for joining in. Sometimes, something that sounds so logical and commonsensical escapes our mind. So it's important to discuss it and put it out there for everyone's reference. Thanks very much for joining in and sharing your thoughts with us. Well, folks, that's a wrap on this edition of Let's Talk Money. Hope you found this conversation useful, simple and systematic, not just when it comes to your investments, but when it comes to your exits as well. Keep sending us your feedback, comments and queries. We'll see you with another conversation next week.
Let's Talk Money.
you didn't want to do anything with the jewelry business, but yet in 2005, both of you decided that it sparked the fire within. What happened there?
Aditi's always loved jewelry. I grew up watching my dad in wholesale gemstones, and I always thought it was a sleepy, antiquated business, so never really wanted to get in. Kind of crazy story. Ratan Tata came to speak to campus for us, and I introduced myself and I said, I'm such a big fan, and we had a 3-hour conversation, and he's like, why don't you visit Tanishq?
What made you focus on the gemstone side of the story?
I think it really making our customer the true north. So when we introduced the good, better, best heirloom, no one else had done that before.
You believe that this is the Kodak moment for the diamond industry. Why do you say that?
Federal Trade Commission in the US said a lab-grown diamond is a diamond. They're chemically, physically, optically identical.
Okay.
You can get a lab-grown diamond for 90 to 95% cheaper.
What's the India plan?
We've started 6 months ago with an alpha launch. We've way surpassed our expectations so far. India is roughly 22% of the world's jewelry market. I think by 2030, I think we get past 1,000 crores.
Hello and welcome to the Young Turks Reloaded podcast. I'm Shireen Bhan. Entrepreneurship is about creative destruction. It's about creating new categories, but it's also about reinventing existing categories. My guests today are attempting to do that in the gems and jewelry business. They started Angara, which quite literally means the fire within, a company started in 2005 to cater to the online jewelry market in the US. Today, they've got revenue of over $100 million and the aspiration of touching $1 billion by 2030. They've just launched in India and they're hoping to make India a big part of their global growth plan. To talk to us about bringing color back into the jewelry business, as well as the disruption that we are seeing in the gems and jewelry business because of the growth and the rapid rise of lab-grown diamonds, Ankur and Aditi Daga join me on the podcast today. Ankur and Aditi, many thanks for joining us here on the Young Turks podcast. It's great to have you join us on the program. But, I want to start with the two of you. Both of your families have been in the gems and jewelry business for centuries. In your case, centuries. In your case, how long?
Decades.
Decades, okay. And you didn't want to do anything with the jewelry business, but yet in 2005, both of you decided that it sparked the fire within. What happened there?
Yeah, so I think both of our stories are slightly different there. Aditi's always loved jewelry. I grew up watching my dad in wholesale gemstones, and I always thought it was a sleepy, antiquated business, so never really wanted to get in. But life, of course, comes full circle. So my first brush with jewelry was in college. Kind of crazy story. Ratan Tata came to speak to campus for us.
Right.
And
this is Wharton.
This is at Wharton, correct. And then he just mentioned that he's going on a train to New York. So I went to the train station, tried to catch him there. And I introduced myself and I said, I'm such a big fan, but I just want to let you know that when I go from Delhi to Jaipur, I'm behind a Tata truck. And the exhaust is coming straight into our car and I fall sick. And so if you can fix that, that would be great. And we had a couple of minutes of conversation. He said, give me your details. And so when he got back to India, he then wrote me a letter saying, next time you come to Bombay, I would love to meet you there, which is insane. So go to Bombay and we had a 3-hour conversation and he's like, why don't you visit Tanishq? Tell me what you think. And that was my first brush with jewelry retail. And I said, wow, this is amazing. This is organized retail. I'm seeing what they're trying to do. Thereafter, I happened to join McKinsey after undergrad. And fortuitously, my first project my longest project was with McKinsey, with Tanishq in India. And so I said, I clearly see this way to organize jewelry retail, and that's the future for me. So life ends up coming full circle.
So Tanishq inspired the Angara story.
That's right.
And what did you think when he decided that this was what he wanted to do?
The next time he says, I'm never doing something, I'm going to bet against it, because he said I'm never coming into the jewelry industry before. So yeah, I learned my lesson.
And you never considered getting into the jewelry business either.
I didn't initially, but I don't know. I always had a love for jewelry, and I don't know when I fell in love with it first. Whether it's, going as a child to the temples and you see the deities adorned, and it's glowing, everything's glowing, and it looks so beautiful, and kind of I fell in love without knowing, or like seeing my mom kind of decked up in the holidays, and I'm one of 4 sisters, so they're always waiting for us, that if there's an occasion, we're going to take something from her jewelry box and wear it, and seeing my father design so passionately, or my grandfather hearing his stories for their legacy, seeing him sit with the karigars and really kind of making sure that the jewelry is perfect for that custom piece, nahi usko wapas todo, make it again because the customer wants it this way, it doesn't sit properly, and that attention to detail,
old school.
it was in my head, I guess at some point. And then his charming brothers, at the front and sales, but they weren't selling, they were building lifelong relationships, it felt like. And then it felt like this treasure trove, and like, how do we scale this? Somewhere at the back of my mind, it was there. And then kind of when we met fortuitously and wanted to start something together, we kind of put all those pieces together.
And the two of you actually met and got married when you were 22, and that was an arranged thing.
That's right.
Yes.
Yeah.
And so you didn't know each other at all.
No, not at
previously.
all. Nope.
So what was that? What was that like when you first met Aditi?
Yeah, so we were introduced, as you mentioned, and it took me 2 months to figure out, can someone be so perfect? So I was like, kuch to gadbad hai. And what you see is what you get. But I think what I ended up doing is I used all my karma points from my previous lives, went all in, and luckily she said yes, and I'm super thankful for that.
And so you have grown together. I mean, 22 and then setting up a company together and watching it grow into $100 million enterprise today with the aspiration of $1 billion in sales by 2030. You've kind of built this together. What's that been like?
I mean, it's been an amazing journey. Like you said, we grew up together. So we went to grad school together. Then we started this together. All those points of disappointment and, shared experiences. We love doing things together, but we also find time to pursue our passions independently. And I think that's the key, that we grow independently and together.
I'll get to the passions in just a second, but let's talk about starting up. So in a way, the gems and jewelry business has been in your blood, but actually starting up, that experience, and I want to go back to 2005, the decision to bootstrap, not get any venture money on board, that's because you saw a friend of yours go through a bad experience, I believe.
That's right. Yeah. One of my best friends raised a lot of industry capital or venture capital at that time. And everything for him went right for the first 4 years. But the markets in 08, 09 turned and everything changed. All of a sudden, he was able to sell the company. The board took him out of that position. And I never wanted to go through that. Ours is a 50-year journey. It's not like a 5 years, let's build it, let's sell it type of play. And so venture capital, 5 to 10 years fund cycles versus what we were trying to do was completely different. And honestly, I would have been fired in the first 2 years if there was a VC funding us. I did everything wrong. So graduated in 05. We raised some amount of industry capital at the onset. We hired a lot of very good people without product market fit. So we had huge burn, but very little in terms of sales. We were trying to do everything. We were trying to do diamonds, color stones, all sorts of product categories, which was trying to attack too much with limited amounts of capital. And the people that we hired, even though they were amazing, a lot of ex-De Beers, LVMH, very senior talent, but we were a startup with no revenue. So it was not the right person at the right time. And so I went through 90% of our capital very quickly. We were 4 months away from running out of cash. And we would have gone under in that case. Luckily, a few things happened. One is we shifted all of our operations from New York to India. And our operating cost structure went down by 90%. We focused all in on colored gemstones. And all of a sudden, things started taking off. And our team there and in India, we were all in. We were 24/7. We lived it. This was our life. And the only thing that we're thinking about is how do we make the company survive? And that focus that resulted from that, even till today, we're trying to be as focused as possible, but we have PTSD from that time, right? So that's why no further capital raises. We will grow it on our own. We will reinvest capital, and we'll get to $1 billion without any external funding.
I'll talk about the PTSD in just a second, but many of the decisions that you were forced to take, shifting operations to India or doubling down on the colored gemstone side of the business, were perhaps not conscious decisions as much as you were forced to take them because of your circumstances. As you look back today, I mean, that was probably the biggest bet that you made, which has taken the company from where it was, which was on the brink of not being able to make it to where it is today. So as you look back, what made you focus on the gemstone side of the story?
So I think it really making our customer the true north. I think that was the key. Customers would call us and say, we love the design, but can you give us a bigger carat weight, or can you give us a higher quality? And we said, there's something to this when enough customers started calling in. So when we introduced the good, better, best heirloom, no one else had done that before. So we pioneered in introducing different qualities, different sizes, different metals all together. And so no matter who the customer was, you could get exactly what you wanted, provided you liked that design sensibility. And that's really helped us take off.
I'll talk about personalization as well, but going back to that difficult period, the first 5 years of the business where, you were still figuring things out. Selling jewelry online to start with is a difficult proposition because trust has been so crucial as part of this transaction. And it's taken a while, even in India. I mean, in India, it's taken a long time for people to get used to the idea of e-commerce to start with. But what was that like? I mean, when you put the business plan together, how concerned were you about the acceptability of this?
Yes, so the numbers on the business plan or on the Excel sheet were actually super exciting. But in reality, so what was happening is 2% of jewelry in the US was sold online back in 2005, but it was growing at 50% per year. So we're like, oh, this is amazing. We always wanted to be a Colorstone-oriented company. And kind of the backstory there is that these families been in the business for 300 years. And 300 years ago, it was all about color.
Right.
So for hundreds of years, color was the majority of studded jewelry. And we said, can we bring that back? And my parents were in wholesale gemstones also. So I kind of saw it happening. And I was like, there's an opportunity here.
Why do you think we lost on the color side of the story?
So De Beers and A Diamond is Forever was the single most brilliant marketing campaign of all time. So in 1947, they launched 75 years ago, roughly, with the idea of A Diamond is Forever, with a 2-month salary for an engagement ring. That's how you show your love. This idea, the singular idea of perfection. So a D flawless, which is colorless and flawless, is what we should all aspire to. And that's the ultimate idea of success. And all of a sudden, Colorstones went from a majority of the industry to 10%. And in that process, can we revive that? Can we bring the industry back to that? It was much easier said than done.
Right.
And so if e-commerce is 2%, if Colorstones are 10%, so that's 0.2% of the market.
Yeah.
That's what we were dealing with. And we had to create the entire category, which was a gargantuan task. And it took us a lot of time and effort and luck to get out.
Well, luck is crucial, but what were the key ingredients, the key levers that you decided to play on to take on the De Beers of the world and, in a sense, reclaim share?
I think there was a lot of education involved, as Ankur said, and no one knew about the different qualities of gemstones that were available. So, for example, in India, when you say opal, people could be selling Ethiopian opal, which has a beautiful color play to begin with, but as you begin to wash your hands, it loses it over time, versus a higher quality Australian opal, which is the one that should be sold because that's what lasts for a lifetime, or as long as as it can. And I feel like those things are critical, educating the customer about the different qualities. And, I have a background in education. So it's really about scaffolding. On every page, it's like, okay, what information does the customer need? What's a rollover telling them that this quality exists in this space? What does good mean? What does better mean?
Yeah.
And I think that was key. Education was really key. And in the e-commerce space, reviews are pivotal.
Yes.
So really building that trust over time, it took a lot of time and effort, to do that for the customer.
So when do you believe you felt that you had been able to survive this storm and then you could put together a plan to thrive and scale the business?
Yeah, so 2010 was a turning point. We were cash flow positive in 2010, and that's when we also jumped back into Colorstones. And because the business started taking off, we said, you know what? we have something here. And what was fascinating for us is the awareness initially was so low. So even if you go to Tiffany and Fifth Avenue, right, the largest retail store in the US, you would only see 3 to 5 sapphire rings. So, and citrine, peridot, amethyst, those were not even there. So we had to first show customers that, hey, this is the entire world
This
of
exists.
gemstone
Yeah.
jewelry. And back then, Google and search engines in general were the primary way to get traffic. So somebody had to actually type in sapphire engagement ring for us to show up. So building awareness, I think, was step one. But what was interesting is we were the only ones in that market. So because there was no competition, the cost per clicks were very low. And the economics started working, and we started growing very quickly as a result of that, thankfully.
Let's talk about 2025. I mean, what we're seeing in the jewelry market worldwide today is this big takeoff as far as lab-grown diamonds are concerned.
Yeah.
And now, people are asking the question on what actually happens to a company like De Beers. In fact, you believe that this is the Kodak moment for the diamond industry. Why do you say that?
So I'll give you some data that we're seeing live. So De Beers is interesting because it was 6.6 billion in revenue in 2022. It halved. 2024 was 3.3 billion. In a high fixed cost business, it's just very difficult to survive in that. But the reason that happened is in 2018, the FTC, so Federal Trade Commission in the US, said a lab-grown diamond is a diamond. They're chemically, physically, optically identical.
Okay.
So all of a sudden, it legitimized the entire industry for everyone. And now, you fast forward 7 years, you can get a lab-grown diamond for 90 to 95% cheaper.
Yeah.
And it's chemically, physically, optically identical. So the whole use case that for natural
So
diamonds...
if it's identical, then what's the difference then? If
Yeah.
it's certified as being identical.
Yeah, so one comes out of the earth,
Yeah.
one is grown in a
Yeah.
lab. So the interesting thing is, so historically, diamonds, the way De Beers created that whole industry, there were two primary reasons you would buy diamonds. So one is financial flex. If you're wearing a 1 carat, 2 carat, 3 carat solitaire, it says something about your socioeconomic status. right? The other is it's an inflation hedge. It outperforms inflation by 2 to 3% per annum. So it's a great investment while you get to wear it. Now with lab grown, the financial flex goes away because it's 90 to 95% cheaper, and no one can tell if you're wearing natural or lab.
Right.
And the investment case goes away because diamonds have gone down in price anywhere from 40 to 45% in the last 3 years.
So it's not a safe haven bet.
No longer.
No
It
longer.
used to be historically.
Yeah.
Last 10 years, that's not the case. Almost every other asset class has outperformed. Sensex obviously has. Gold has performed better than that. Gemstones have performed better than that. So because both of the primary use cases are gone, it's going to be very difficult for natural diamonds. You'll have like a Tiffany, Graf, Harry Winston, and 20% of the market will survive, but everything else, in our opinion, is going to be left.
So you believe this is irreversible, the change that we're seeing today?
It's a better product.
But you can afford to be agnostic because it's still 20% of your business is between lab grown as well as natural diamonds at this point in time, and the bread and butter continues to be gemstones for you. But do you see this changing? Do you see yourself shifting more towards lab grown if you believe that that's going to be the market that's seeing this kind of explosive growth?
Yeah. So the lab grown. So the color stone market in India is very interesting. So 2% of India's market is color gemstone based. That's it. But
and given the history of India, why do you think that's the case? Again, a lack of choice, especially on the organized side?
So it's choice and it's education both. And this idea of Indians look at jewelry as an investment. That's the primary use case, right? And in that, there was never this idea that gemstones would hold value, whereas diamonds were perceived to hold value. So I think that's fundamental to it. 90% of the market is gold jewelry, 10% is diamond studded, and then 2% is... But what's really interesting is if you look at Sotheby's, Christie's, Phillips auctions world over, color stones are way outperforming. They're 2 to 3 times the high estimates for all of the auctions, right? So as an asset class, they're starting to take off. And I think as soon as people start realizing that, and diamonds, so if you look at kind of appreciation, diamonds have lost value over the last 10 years. Sensex has gone up by 11%, gold by 14%, gemstones anywhere from 15 to 21% per annum. As soon as people start understanding that, I think the market starts to turn. There's already an affinity. So we were surprised at how savvy the Indian customer already is. We're selling aquamarine, citrine, sapphire, emerald, ruby, with a lot less need for education than we had in the US.
Okay.
So like you were saying, the market already knows. The Maharaja Patiala wore color, the Nizam wore color.
Yeah.
It's been a part of our culture for centuries. But there is a slight need for re-education now, which is part of our objective.
And just to add to that, I think it's really interesting how in colored gemstones, it's the opposite of diamonds, where 80% in India want natural color. And I think this is natural affinity, the astrologer told him to wear this. And, things like that, and color is such a big part of our DNA,
Yes.
where, the energy that comes from natural gemstones is very attached to the Indian DNA as well.
So you've got lab-grown diamonds taking off, but you've also got a preference as far as natural gemstones, colored
Absolutely.
gemstones are concerned. So both running on parallel tracks. But let's talk about India, because it's taken you a while to get here, to launch operations here. You finally decided to launch in India. What's the India plan?
So we've started 6 months ago with an alpha launch. We've way surpassed our expectations so far. So we've done 10 crores in revenue thus far with minimal marketing. We're already profitable in India. India is roughly 22% of the world's jewelry market. I think by 2030, I think we get past 1,000 crores. And I think it grows from there. So we're super excited about the market. It's ripe for color right now. Just some rough numbers to kind of show India versus the world. 400 billion is the overall market size for jewelry.
Right.
India's 85 billion, as is the US. What's insane about that is the US GDP is $30 trillion.
Yes.
India's GDP is 4.3 trillion.
Yeah.
Right? It's 7 times more valuable here. 2% of India's GDP is jewelry, and is growing at 10 to 15% a year. This is, in my opinion, the most exciting gemstone or jewelry market in the world, and it will be for the decades to come. So we're super bullish. We're excited.
So clearly the headroom for growth is what you're betting on as far as India is concerned. But what have been some of the initial learnings? You said you launched in India 6 months ago. What have been some of the initial learnings of having launched in India?
That the e-commerce customer is very savvy in India,
Yeah.
and they're very mature. So our average order value is over 50,000 rupees, which is really high for jewelry online. Like Ankur mentioned, that the Indian customer is very sophisticated in terms of knowing about color. There's been less education. They've leaned towards bluestones a lot, which is surprising to me. That has been a key learning. And then the lab versus natural in diamonds, that 80% want lab. And on the color side, like I mentioned, 80% want natural color. I think those have been the key learnings.
We've had a couple of startups here in India do online jewelry. And of course, you talked about Tanishq, we had Carrot Lane. And I believe you have a personal link to Mithun Sucheti at Carrot Lane, and he managed to sell that business
brilliant job.
to Titan. How do you see the evolution of the e-commerce market, and specifically the jewelry market? What surprised you about the way that it's going in India?
I think so. What's idiosyncratic about India versus the US? I think India will go very much the way of the US. This is still today a offline market. So even the e-commerce players that you're talking about, most of their sales happen offline. I think that will start to change. I think people are much more comfortable. We're talking about Zepto, for example. They're just much more comfortable ordering online, buying online.
Yeah, difference between a coffee and a 50,000 piece of jewelry.
That's right. And in that 50,000 rupee piece, I think, so it's interesting. Three fundamental differences are happening for us in India versus the rest of the world. One is 80% of the customers that have called in are saying, "Aapka store kahan par hai?" Right? And that doesn't happen anywhere else in the world.
Kahan pe hoga?
Yes. Or kahan par hai? Right? So they're already thinking we have offline retail.
But are you going to do offline retail?
So our first store worldwide will be in Jaipur.
In Jaipur?
Yeah.
That's home.
That's
quite literally for you.
That's great for both of us.
So we're super excited about that. But we're going we're completely customer-led in terms of what's needed. Our store experience, I think, will be fundamentally different than what you see here at a Tanishq or Carrot Lane or Bluestone or so. There'll be much more experience centers. Everything we do is bespoke. So if you order right now, the piece will be built after you order.
Okay. Every single piece is done that way.
Every piece is bespoke. And let's say you're a ring size 5. It will be made in that. So kind of the manufacturing process for us, we're completely vertically integrated end to end.
Right.
Except for mining, we kind of do everything else.
Yeah.
So we cut and polish gemstones, we cast jewelry, we manufacture jewelry, we retail over the web. So that piece, kind of the life cycle of that piece is really interesting. So if you order now, let's say it's a ring size 5, it's a 3-stone sapphire ring. It will be cast, it will take 8 hours to cast it.
Okay.
Then we'll hand pick the diamonds and color stones. We'll set that. We will then polish, rhodium, QC thoroughly, and then ship out. So by the time you wake up tomorrow morning, it's already on a flight somewhere to you. But that whole 6-month process from 300 years ago, we've compressed down to 24 hours.
How do you do that? How do you compress what took 6 months to 24 hours?
We had to vertically integrate. So we started with manufacturing jewelry. Then we went into product development and design. Then we started cutting and polishing gemstones. And so we'll buy rough all over the world. We'll go to Western Australia for opal. We'll go to Thailand for ruby and sapphire. A lot of gemstones are cut and polished in Jaipur. So we have that as well. And so we'll source...
manufacturing is all here?
So manufacturing, we have a center in Thailand, a center in Los Angeles, and a center in Jaipur. And so we have now offices all over the world. We have supply coming from all over the world. Everything is centralized. Depending on where the customer is, we will make everything in-house. But then it gives us the ability to really cater to whatever the customer wants, which is back to our original mission. It took us a lot of time and effort to do it. But now we feel like the experience is what it should have been from the get-go, which is you could have whatever you want. And I'll give you kind of an example of ring size. So most jewelers across the world will stock in a ring size 6.5. And let's say if you're a ring size 5, they will modify and resize. Now the problem is structural integrity is harmed and the shape of the ring is harmed. But it's convenient because they have inventory. Right? And they want to sell that inventory. For us, we're making it from scratch, so we'll do it right the first time. We have 40 different gemstones, multiple qualities, shapes, sizes, budgets. To do all of that in one physical store is very hard. But what our customer is looking for is, are you guys legit? Do you actually exist? If a problem happens with the product, can I come in and return it? And that's where I think the experience center concept for us will be key. This is our quality. You compare our quality to the best in the world, a Tiffany or Harry Winston or so forth, and we'll be up there. These are the natural gemstones. We'll have an example of a ruby, sapphire, tanzanite, so forth, and all of the various qualities we offer. And we'll have an example of lab also. And then you tell us what you're envisioning, what the design is, and we'll craft it and ship it to you, which is a fundamentally different model than anything else.
So it's already personalized, but are we now heading into an era of even more personalization or hyper-personalization, if I can use that term, especially with the AI tools that are now available? I mean, how much of that is already being incorporated into plans for you?
Yeah, so it's a fundamental part of what we're trying to do. So the original mission is to bring the industry back to its roots. AI will make that possible. So we're developing something as a chatbot right now where it's like you're sitting in front of your jeweler.
Yeah.
And you would say, hey, I'm dreaming of a pendant that's a 5-carat sapphire pendant, or I met my fiance in Venice, and so I want that to be a part of the ring. And in real time, the piece will be created and priced out, and you could choose the gemstones as part of that process. So we're super excited about that.
And you can change anything along the process as well. So it is hyper-personal.
And so, you know, are we starting to see results already of this? I mean, is this already in execution?
It's still in testing phase right now, but we're excited to launch it pretty soon.
But
by the end of the
to be able to do this at scale, I mean, what are your concerns? Because it's great as an idea. I mean, everybody would want as customized a solution as possible, especially when we're talking about jewelry, because it's not just about the piece, but it's also the emotion linked to it. But to be able to scale that, what are some of the challenges?
I think making sure that, and that's why we're in testing phase right now, that all the details are there. You know, we don't want to miss anything, and I think that's critical.
So I think for us, a couple of things. So there's a front end, which is easy to do. The back end is the structural integrity of the piece needs to be maintained. It needs to look and feel right. But then the back end is the key. We have 40 different gemstones, all shapes, sizes. And if we don't have it, we can cut and polish it for you in that permutation. So tying all of that together is going to be key to providing that type of experience.
I have a little backstory on that. I'd once sketched something of a design on a paper, and Ankur very sweetly for my birthday took that paper and got it made into a jewelry piece. Now, it was just a sketch, right? It was something in my head. And it didn't have the structural integrity, so it didn't sit well at all. And that example is really stuck in our head too, that, you know, you can dream of something if you scribble something on paper or you're thinking, but to really make sure that it sits well on the customer, you know, we want to make sure that experience is truly complete.
So will you say no, this doesn't work? I mean, if somebody were to send you a design that, will you turn it down?
We will actually suggest
a variation,
modification
of that. Okay, but you know, as you look at the opportunities today, and everyone's talking about the need to be phygital, I mean, you know, there is, of course, all of this online retail that's going on. But how do you look at this omni-channel or phygital, you know, proposition that most people are looking at this point in time?
So I think that the question is, why are they looking for offline here where that doesn't matter in the rest of the world? And I think a part of it is trust. They want to make sure you're there. At least in our initial feedback, that's what we've heard. They don't necessarily need to buy the product right there because it is a big purchase. It's not one of those things like we're talking about Zepto. It's not a Coke can. This is a 50,000 rupee piece of jewelry. So they're willing to wait, is our hypothesis so far. But they just need to make sure we're legit. And whatever they're buying, they need to be able to see what it will look like, most likely. And you know, as we progress, we'll see if that hypothesis is correct and we'll modify accordingly. But our strong hunch is that's how it's going to play out. So we're building flexibility. And so we have Jaipur as a factory, Thailand as a factory, LA as a factory. We're sourcing from all over the world. We're also selling all over the world. We are over-indexing on investing 4 more centers than we need to make sure we never disappoint the customer. Once we lose that trust, that relationship ends.
complexity of dealing with tariffs, supply chain disruptions. What have the last few weeks meant for you?
It's a challenge, but we don't expect this to slow down anytime soon. The level of complexity will only increase. Uncertainty will only increase. We just have to be ready for it. We're selling all over the world. Our supply chains all over the world. So in this year alone, we're launching in India. We're also launching in all 6 GCC countries. We're launching in Japan.
Okay.
So we're taking on a lot at once, but the core is the same. And as long as we can maintain that core, I think you talked about these 3 pillars. So color, customization, and exceptional quality and exceptional value. As long as we can maintain that, we'll make it work. We'll figure it out.
And it's interesting because you talked about gold prices and things like gold prices are not in your control, or what happens to diamond prices not in your control because, it's a global supply demand and of course market shifts impacting prices. How do you then ensure that without losing money that you can actually, deliver to the customer at a price point that continues to be attractive, that continues to be affordable? I mean, how much room is there for you to be able to absorb the kind of price shocks that we are currently seeing?
So I can give a couple of examples of what we did to work around the tariffs to some extent. So one is, April 5th, there was a 10% tariff kicking in.
Yeah.
We shipped all of our inventory worldwide to LA before that.
Okay.
Luckily, it can travel by air, so it's easy to do, to beat the time for tariffs. We can also cast.
Really a race against time, wasn't it?
It was. And we didn't have a lot of heads up, as nobody else did either.
Yes.
So, and we can cast in LA as well.
Okay.
So if you make the entire piece in LA, we don't need to worry about tariffs. So that's where the flexibility comes in. We're able to adjust to whatever it takes. And importing gemstones into the country before the tariffs kicked in, that was a 0% import duty or tariff.
But does it not increase costs for you to be able to do all of that in LA versus being able to do it in Thailand or India or,
It does. Yeah, but we have to,
So is
it's
that
a
going
cost
to
benefit.
eat into your margins?
It will.
Yeah.
It will. And
significantly.
Crazily enough, we have not passed that increase to customers yet. Because we're anticipating that there's going to be an agreement. We don't know when, but there will be an agreement. So if we revise prices, we may need to revise it back. And that will cause turbulence for the customer. And so we're absorbing it for now, because everything we're importing now, we are paying a duty on. And there was really a double whammy. So gold prices went up 15% in the last month.
Yeah.
Same time the tariffs kicked in.
Yeah.
So everything for us is 25% more expensive than it was in the past. We can absorb it now, and we're going to need to figure it out fairly quickly, as is everybody else in the US.
Yeah. And we just don't know as far as the tariffs are concerned. That's the big, dealing with uncertainty and as business owners, how do you cope with that? I mean, there isn't a playbook that teaches you, and you can only control what you can control. So is there a focus right now on efficiency and squeezing out costs on, what is the focus to be able to cope with this uncertain, volatile environment where you're also dealing with input costs going up so significantly?
So to be honest, it's an advantage for us.
Really?
So we're vertically integrated.
Yeah.
So we capture margin all across the supply chain.
Okay.
Right? So tariffs will affect everyone, but we can absorb it a little bit better. Our profit margins are also the highest in the industry because we're vertically integrated. So we have a little bit of buffer there, and we can actually be aggressive on pricing when no one else can. So we're trying to think of it more as an opportunity than a threat. At the same time, the stuff we can't control, we don't worry about.
And neither can anyone else.
Yeah,
too,
yeah,
right? So
absolutely.
We're on a level playing field.
So let's talk about growth and let's talk about expansion from here and what the priorities are going to be. You talked about the India launch, your GCC, Japan coming up as well.
Yeah.
So, your hands are full. It's going to be a busy next few years, I would imagine. What's the investment pipeline looking like for you at this point?
So as CEO, my job now is as a capital allocator. And the capital for us is not inventory, it's people. Our ability to scale and to grow is directly correlated with our ability to find the best in the world at whatever it is. And that's hard. Any key role, it takes me probably 6 months to hire that person after 15 interviews. And if we can find the right people, we can grow very quickly. And because we're not public, because we don't have a board, we don't worry about quarterly projections. We know what our 5-year plan is, our 15-year plan is. We don't worry about the short term. It will happen when it's supposed to happen. We're very aggressive, but we want to get it right, because the cost of getting it wrong, we've been through before. We don't want to go through that again.
So what is the 5-year, 15-year plan? Let's start with the 5 years. What is the 5-year plan?
I think we get to $1 billion in revenue
By 2030?
By 2030, I think we get to $10 billion by 2040.
By 2040?
Yeah, and at that point, we're only 2% of the jewelry industry. And if you look at category killers for everything else, Google has 70% of search, for example.
Yeah.
Or Microsoft has 70% of enterprise software.
Yeah.
Loosely speaking, right? So 2% doesn't feel all that hard from that perspective, but easier said than done. And I think at that time, and even when we get to $1 billion, our profit margins, given our profit margins, we'll probably be one of the most profitable jewelry retailers in the world. But we'll also be better than anyone else at delivering value to the customer. That's how we're thinking about it. And that being said, putting stuff on Excel is pretty easy to do.
Yes,
Actually
that's the
delivering
easy part. That's the easy
We
part.
joke about it. He thinks in Excel, I think in PowerPoint.
And then the two converge in real life. In real life. But is it getting, as part of this 5, 10, 15-year plan, is a listing, a possibility? Is that something that you would want to consider or are considering at all?
There are all possibilities.
We have no immediate impetus to do it.
Yeah.
I know you have a rule as far as experimentation within the company is concerned.
Yeah.
So $10,000, if it works, it works, and if it doesn't, then you pull the plug on it.
Yeah. That's to be agnostic to who comes up with the idea, whether it's mine, Ankur's, or anyone in the company. And it's basically to keep it fair, and then so you don't get emotionally attached to the idea.
Right.
And that way, if it works with the 10,000, we'll scale it. We'll put more money into it. But if it doesn't,
but is there a time limit as well? There is clearly a $10,000 limit, but is there a time limit as well?
Absolutely, but depending on the project, it varies a little bit, but it's a short time frame. It's a very tight time frame, though.
And what have you had success stories coming out of this challenge, so to speak?
For customer service, we did. I had this one experience where I went to a Fifth Avenue jeweler, for a milestone event, and I was like, okay, I'm so excited about this purchase. And this is about like 2007 or 8 or so. And they didn't have my size, so they shipped me the piece.
Right.
And it was, I was so disappointed with that experience because I thought there was less care put into it. It was just shipped. So, one of the ideas that we used the $10,000 on was, what do we want the customer unboxing experience to look like? And does it truly wow the customer? Does it bring them joy?
Yeah.
And over 30% of our reviews ended up coming on the unboxing experience. So clearly we knew that was a winner. So we invested more and more into that category. So that sense of joy that they had when they ordered it, we try to amplify that even more when they unbox it. It has to be equally joyful for them that way. So that was a clear winner, and I certainly have had many that were not winners, but it was a great way to use that rule out.
So speaking of rules, you have a rule as far as innovation is concerned, where you set aside $10,000 for whoever wants to experiment with an idea. But the two of you have a rule, and it's a 30-minute rule. Take me through that.
So Ankur's far better at compartmentalizing than I am.
Really?
Because I guess, as women, particularly I feel for myself that I wear so many hats that I could talk about work now, then I could talk about it 2 hours later, and I could just come and discuss something with him. So we said, you know what, to keep sanity and truly be present for each other, we have 30 minutes a day contiguously that we can only talk about work. And that's kind of helped, maintain our relationship, and I think even improve upon it.
Funnily enough, our favorite professor in grad school knew both of us, and he said, you guys should never work together.
This is Harvard, where the two of you went together, yeah.
And he said we should never work together.
Really? Why did he say that?
So statistically, when couples start something, it doesn't work out for the marriage. And the reason I think is, and I think what he meant was, there's so much stress, and there's so much uncertainty, and you're managing a family, and you have two people that don't have a steady income stream. And so generally what happens is, even if the company succeeds, the marriage may not.
Yeah.
And we had to set a lot of boundaries to make sure that doesn't happen to us.
Speaking of getting there, going back to what's happening as far as the industry is concerned, and the shifts that we're seeing, the US market and India, and of course you gave us some of the numbers to explain how they're similar in many ways at this point in time. But on the entrepreneurial side, do you believe India is far more entrepreneurial in the gems and in the organized gems and jewelry space today than the US?
Oh, by an order of magnitude at least. 35 lab-grown startups that are funded here. There's like 2 in the US in the last 5 years.
Why do you believe that's the case?
I think the Carrot Lane exit created the entire ecosystem. It validated it. Mithun did the hard work. He built the primary demand for e-commerce. Now, there's people that say, you know what, that's been done before, we could do the same. And we think it's awesome. This is how it should be. This is super exciting. I think it's great what's happening here. The energy is unreal. This is Silicon Valley on steroids, I feel.
But would you consider looking at partnering with people here, or anything interesting that you might want to consider picking up?
Maybe we want to get it right. That's and we don't want to rush that decision per se, but never say never. So Aditi's taught me never to say never. So we'll see.
What else have you taught him, Aditi?
He said, I'm never going into jewelry. I'm never going to live in
Englewood Cliffs, where we live.
in the suburbs and little things like that. But I got my data points along the way.
Yeah, that's a separate Excel sheet altogether.
Yeah, absolutely.
With a PowerPoint presentation. But what have been some of the key lessons for you as entrepreneurs of building this business out, of building it profitably, ensuring that it retains its global flavor as well, dealing with the kind of volatility? What have been some of the big lessons that you would like to share with people who are now looking at getting into, whether it's the gems and jewelry business or business in general? What would you tell them?
So as an entrepreneur, one of the big mistakes we made is we didn't worry about product market fit. The idea is get to product market fit with as little capital expended as possible. That is, I think, number one. Second is, for us, our true north has always been the customer. That's been right. When it was not the case, before that pivot, we used to get so many more things wrong. But if you just listen to the customer, they'll tell you what is needed. I think third is follow first principles. So there's a playbook in India now, which is you raise capital and you build as quickly as you can. You projected 100 stores, 1,000 stores, whatever. I'm worried that people are not thinking about the right customer experience to the extent they can. Certain people certainly are, but as an industry overall, that's what's going to determine success. And that long-term thinking, I think, is key. Whereas if you're already planning for an exit and you're pre-seed, hey, maybe the priorities...
Yeah, then you build differently. You build differently. Yeah.
Correct.
Yeah.
And we've made so many mistakes on the way. I would imagine most other startups will as well. Just be ready for that. This is a grueling, grit-based, very hard journey you're going to embark on. Make sure you're clear on what the mission is and just look at that. It's kind of like Swami Vivekananda. Take one thing, make it your life, dream it, think it, sleep it. If you don't do that, you're going to fail. At least that's what we've been through.
I think also don't wait for the product to be perfect. Perfect it along the way, because there's always room for improvement. And I think pivot fast. I think those two things we were slower at initially and really put us on the brink of failure till we learned the hard way.
So today, as you learn to, or you have learned to pivot fast, what's the most important muscle, institutional muscle, that you've had to develop to be able to do that?
I think agility, but in the mind, that accept new ideas, don't put it down before you've really thought it through.
Don't say no.
Don't say no. Don't say no. Absolutely.
So has that been the big learning for you?
Yeah, I think we try to behave like water. We will go wherever the stream is taking us. Try not to push back. We're not fixed to any ideas. We've been wrong enough that we know that we're not right all the time. And in my case, I'm probably wrong more than I am right. So it's fine.
What's the mission now that you've set for Angara? What's the mission that you've set for yourselves? Besides the numbers, of course, the numbers will play out as and when they do play out. But what's the larger mission? What do you hope to accomplish from here on?
If we can get the industry back to its roots, how jewelry was supposed to be bought, rather than when retail stores came, the salesperson is pitching you what they have in the store. It's not what you want. We're trying to get back to that, and we're trying to get back to color. Those are, I think, the two principal things that we're thinking about.
And I think as we grow, I think maintain that soul. The soul of jewelry, of course, but even as entrepreneurs, continue to learn and evolve. The business is doing great, thank God. But I think growing in this industry, beyond the industry, and passing that on to future entrepreneurs.
Well, it's been an absolute pleasure speaking with the two of you. We wish you the very best of luck with Angara for your plans in India, but also the next 5, 10, 15 years. And we look forward to hearing much more from you about how the industry transforms itself, as well as your plans on reclaiming what you believe the industry should be, going back to its roots. But thanks very much, and look forward to seeing a lot more of you back here.
Thank you so much for having us.
Thank you. It's been a pleasure.
Well, with that, it is time for us to wrap up this edition of the Young Turks podcast. From all of us here on the team for now, goodbye and many thanks for watching.
Sholay. I've seen it many times on the big screen, but I want to see it again, and probably Mughal-e-Azam as well. Pass. I'd say probably Andaz Apna. यार ये मैं आंसर करूंगा तो प्रॉब्लम हो जाएगा.
What have you got up your sleeve?
Well, we've got The Anarchy, which is a TV series adaptation of William Dalrymple's epic saga on the history of the East India Company. It really is a story that has to be told with that epic scope and scale, the way that the Game of Thrones or The Crown have been told.
So have talks begun with the Netflixes and the HBOs of the world?
Talks have just begun.
What are we talking about in terms of resources that you require to be able to put something down? Ballpark.
The per episode costs for shows like Game of Thrones and The Crown range anywhere from 8 million to 20 million an episode.
Now you believe that India has been poised to have its crossover or breakout moment, just as we've seen with the Parasite and so on and so forth. Why has it been so elusive?
Because we've been victims of our own success in a way that traditionally India has never really had to reach out to the world.
What's exciting you about the stuff that you're seeing being made today?
A show like Kohra, for example, right? It's very local, very rooted. But I think the beats of the way that the story unfolds is told in a very international way.
Are you also seeing a diversity from where these scripts are coming in?
I think the number of people from the smaller towns, I'd say even sometimes from villages, who reach out to us with, even if it's a concept note, it might not be a full screenplay, is quite significant.
What was the one that surprised you? What was the one that you were absolutely sure of?
Barfi was one which was the most difficult to pin down, but you knew it at a visceral level, you reacted to the material. Chennai Express actually was another film where, you know, there was a full narration that happened with a group of 20 people, and we were laughing off and like falling off our chairs.
What was the casting call that you made that kind of worked out the way that you had imagined it to?
I think probably Dangal. And at that time, of course, Irfan, he was someone we had in mind. He would have done a wonderful job. But then I got a call from Amir at that time. Many other stars of his stature might not have been okay with playing an overweight wrestler who's like a bit of a has-been, who's living out his dreams through his daughters.
Hello and welcome to another edition of Young Turks Reloaded. I'm Shireen Bhan. The Indian media, entertainment and film business is poised for the next big wave of disruption. After a wave of corporatization and consolidation, industry is now grappling with a booming OTT market, a rising live entertainment economy and a film business that's yet to fully recover from COVID and the onslaught of video streaming. Today, we roll out the red carpet for a man who spent a good part of the last 2 decades mastering the art of storytelling, from delivering box office hits like Dangal and Chennai Express to producing game-changing series like Rocket Boys. He's now ready with his next big project. Siddharth Roy Kapoor, welcome to the Young Turks podcast. Thanks very much for joining us on the program.
Thanks so much for having me.
So let's start with the big reveal. What have you got up your sleeves?
Well, we've got The Anarchy, which is a TV series adaptation of William Dalrymple's epic saga on the history of the East India Company. It's one of those books that you just can't put down.
Yeah.
And when I first heard that William was working on this book, I actually found out about it a few months before it was going to be published. So I reached out to him immediately. He was kind enough to give me a manuscript. And I read through it, just chugged through it in one sitting, and realized that this was.
Buff?
I am a huge history buff. I am, and it's just
William Dalrymple cannot be done in a day.
Well, it was one of those things which just sucks you in because I've always been very interested by the history of colonialism and of course the Mughal rule, sort of before that, and the way William writes, he writes with such drama, and the way he treats his characters, he just makes them live and breathe.
And so I reached out to him instantly after that and told him I'd love to take on the rights. And, after a bit of back and forth, because he wanted to know what the vision was.
Yeah.
And we realized that we had exactly the same vision.
So
which
what
is
was
about,
the vision that you painted for him?
Well, the vision really is about how contemporary the subject really is. I mean, we talk about these global corporations which are larger than most nation states, being in multiple countries and having the ability to actually influence the world. Here's where it actually happened 500 years ago, where you had a global corporation with its own private army coming and taking over a subcontinent that was 25% of the GDP of the world at that time. And, you've got delicious characters in there, from Robert Clive to the Mughals, to the Dutch, to the French, to the Portuguese, to the Jagat Seths, the moneylenders. So it really is a story that has to be told with that epic scope and scale, the way that the Game of Thrones or the Crown have been told. And I think I've always had the ambition of being able to take our content and reach out to the world with it. And this is a story that we should be telling ourselves.
So this is going to be mounted for a global audience.
This is going to be mounted for a global audience.
And you've managed to bag a big name to do that for you.
So we've got Stephen Frears coming on board. I used to watch films like High Fidelity and Dangerous Liaison when I was, in college. And to imagine that the director of those epics is now going to be actually helming the anarchy is just...
And how did that come about?
Well, our partners Whip, actually, which is a US production company, they've made shows like Mayor of Easttown and Dickinson. Paul Lee, who runs Whip, was running ABC when I was at Disney and running India. And we stayed in touch for a long time. And then he started Whip and I started Roy Kapoor Films. And we were chatting about what we could do together. And when I told him about these rights, he said, wow, that's something I'd love to collaborate on.
Right.
So we got together, and through Paul and through Whip, we were able to reach out to Stephen. And he knows William, incidentally.
Okay.
And that helped. And he'd heard of the book, he read it and loved it, and that's how he came on board.
So when do we finally see this being converted into reality on screen?
Well, we're ready with our materials now. We're ready with the writing, and I think the next stage really is to figure out the right home for it, so the right platform. That's a process that's ongoing right now.
So how do you pick the right home for something that you're producing? I mean, give us an example in the context of this with the anarchy. How do you find the right home?
I think the platform that can actually give you the resources to tell the story in the way it should be told, and that gives you the global reach to be able to reach out to everyone who you believe the story will resonate with, would be the right platform. And I think, you can literally count them on one hand, maybe two. There are 5 or 6 platforms around the world that have the resources and have the ability to be able to give you that reach.
So have talks begun with the Netflixes and the HBOs of the world?
Talks have just begun. A little too early to sort of get into details around that, but it is exciting.
I would imagine that exciting. But, again, just break this down for our audience. Like, from the time that you actually decide that, okay, this is a script that you want to actually convert into something that goes to screen, to reaching out to a platform that could potentially house this, what are we talking about in terms of timelines? And then finally, the eventual execution.
It takes time. These massive projects take a long time, because what happens is that you need to find the right creative team to start with, the right writers, the right director. You then go through various iterations around drafts of scripts and pilots and Bibles. Then you find something that, okay, fine, this is something that we now all have bought into. We love what we've put down on paper, and that's when you take it to a platform. From that point onwards, it's really about getting the right platform on board, and then you start your pre-production. So the process can usually take anything from 3 to 5 years.
3 to 5 years, which also means that you have to have deep pockets to be able to sustain yourself for 3 to 5 years.
Well, if that's all you're doing, then yes. Thankfully, you do continue with life as usual while you've got these big projects that you're hatching.
Yeah.
So the good part is that you're making films and series and doing all that, good stuff, while keeping your eye on the prize, which is, large projects like this.
But, for a large project like this, with a global ambition and a global aspiration mounted to that scale, what are we talking about in terms of resources that you require to be able to put something like ballpark?
Well, the per episode costs for shows like Game of Thrones and The Crown range anywhere from 8 million to 20 million an episode. I heard the budgets of the latest Yellowstone, series were actually $20 million an episode. So you're talking significant funds. As I said, there are a limited number of global platforms that can actually have the ability to fund you in that manner, and those are the ones that you talk to.
And link this back to what's happening in India when you're delivering for an OTT platform here in India. What do the costs? I mean, they're clearly nowhere in the vicinity of what we just talked about. But what are we talking about?
Well, in India, it's the budgets are pretty different. So I think you're talking anywhere from, if it's a show that's really quick and easy and like more intimate and a more controlled setting, it could be anywhere from 50 lakhs to 1 crore per episode. But if it's something larger and at scale, then it could go up to 4 or 5 crores an episode.
This global aspiration that you spoke of, and this has been something that you've been rooting for a long time now. You believe that India's been poised to have its crossover or breakout moment, just as we've seen with the Parasite and so on and so forth. Why has it been so elusive? What makes you believe that we're finally there?
So it's been so elusive probably because we've been victims of our own success in a way, because we have such a large captive market of our own that traditionally India has never really had to reach out to the world.
Right.
You've had the Indian audience and you have the diaspora audience that accounts for millions and millions of people wanting to watch the stuff that you're producing.
Yeah.
And so unlike Italian cinema or French cinema or German cinema, which has had to find new markets, we haven't had to do that. But I think the time has come now where you have a whole generation of filmmakers who've been schooled in an international style of storytelling, but who are still rooted and want to tell stories from their own country. And I think that actually gives you the ability now to really believe that you can reach out to the rest of the world. But I feel the more rooted your stories and the more local your stories, but with a global style of storytelling, those are the ones most likely to succeed.
So what's exciting you about the stuff that you're seeing being made today that gives you the hope and the belief and the confidence that we are ready to make that inflection?
With a lot of the stuff that we're making, especially on streaming platforms today, I think, you've seen stuff that is being told with a pretty global sensibility. I'll just give you a few examples, like a show like Kohra, for example, right? It's very local, very rooted, but I think the beats of the way that the story unfolds is told in a very international way, right? So I think it's about finding local stories and finding internationally appealing ways and global ways to be able to tell it.
When you look at a story, you look at a script, what draws you? What's the first thing that draws you to a story or to a script that kind of tells you in your gut that this is something that you want to take forward, this is something that you want to make? Which have been some of the examples where something's jumped up at you and it's been a success, but also where it hasn't and it's gone on to surprise you?
So the first thing is I react as an audience, right? I react as just someone who enjoys movies or enjoys shows or, just like a viewer. And so when I read something and I feel like, oh, wow, this is something that I would really want to watch, that's the first thing that really has to stand out for me.
And how many scripts do you get in a week?
Oh, we get a whole lot. I mean, we have a team that really, their only job is to sift through the material that comes in. I'd say anywhere from 10 to 15 scripts a week, probably, if not more.
Are you also seeing a diversity from where these scripts are coming in? I'll ask you this in the context of a conversation that I had with the founders of an audio streaming service. And they said that they're getting stories coming in from the interiors of UP, from Chhattisgarh, and those are the ones that are actually turning out to be their big blockbuster hits. What are you experiencing?
The same thing.
Really?
The same thing, which is very heartening. I think the number of people from the smaller, more the smaller towns, I'd say even sometimes from villages, who reach out to us with, even if it's a concept note, it might not be a full screenplay, is quite significant. And we have a website and we have an email link that helps people to be able to just send us their material. And that, I think, has shown us the diversity in terms of the places from which we've been getting that content.
So what was the one that surprised you? What was the one that you were absolutely sure of and it delivered on that expectation?
I think probably Barfi was one which was the most difficult to pin down, but you knew it at a visceral level, you reacted to the material. Because, Anurag Basu has this amazing ability to be able to conjure up a world without really putting that much down on paper.
Yeah.
So he actually talked us through what he had in mind as far as the film was concerned. And he didn't have a complete screenplay, but just the characters and the world he was able to sort of envision and
what more important than envision, actually communicate, just blew us away. So that was one of those leaps of faith that I'm so glad we took. Because it could have been very easy to say, yeah, just come back to us with a final screenplay and then we look at it. But it was one of those films where we said, no. We've made Metro together. We'd made Life in a Metro before that. And we had the confidence in him to be able to take that forward. Chennai Express actually was another film where, there was a full narration that happened with a group of 20 people, and we were laughing off and like falling off our chairs. And it was just, one of those films which you know that if this is executed in the right way, it's going to be a rip-roaring success.
It's interesting that you talked about the fact that it was a narration, it wasn't even a full screenplay or perhaps not even a finalized script. And I remember watching, I can't remember who it was, but these film stars saying that, when they actually saw, and this is like maybe 20 years ago, or even 15 years ago, saying that scripts were actually being written on set, dialogues were being handed over to you before you actually got onto set. How much of that process at the back end has changed, especially with corporatization and so on and so forth?
That's changed very significantly. Yeah. Today you have, fully completed screenplays with dialogues ready well in advance before you go into prep. Actors expect it, the HODs expect it, everyone expects it, and more importantly, those funding the film expect it, and rightly so. But you do need to leave a certain amount of flexibility for creativity to strike, right? So I think it's important while a scene is being played out, if, the writers on set or the writers called in, and there might be certain things that the actors and the director feel they want to play out differently. You always need to leave that
for some spontaneity.
But that can only happen when you're really well planned.
Yeah.
Because that room for spontaneity needs to be still within a controlled budget, within, a certain number of days of shoot. And that, I think, is important to leave space for.
So as a producer, what's the stuff that you sweat today? What's the small stuff that you let go? What's the stuff that you sweat today?
I think budgets, obviously, is something that everyone looks at very closely, and you should look at very closely as a producer. The script is something that you should really, really look at very, very closely, because you need to be completely convinced about every line that's in there. Either you get convinced or you're able to convince, but one way or the other, the entire team associated with the project needs to be on the same page. The casting is something the producer needs to be very, very closely involved with.
How involved are you personally with the casting?
I'm pretty involved with the casting. Having been around as long as I have, having the relationships one does, it's important to be able to pick on, pick up the phone on the people that you want to be able to cast and give them a feeling of how passionate you are about the material, so that they understand that it's something that they should give consideration to as well. So for the key cast, that's something I'm quite involved in.
What was a casting call that you made that kind of worked out the way that you had imagined it to?
I think probably Dangal was that one time that was a very important casting call, because I remember that we had a young girl in our creative team who came up with the idea, having read an article in the Times of India. And she came up and said that, that we want to make a film on these. I mean, wouldn't that make a great story?
Yeah.
The Fogart sisters. And I said, absolutely, you must go and, check it out and go and meet the family. She did. And she said, you know what? It's about the father and the daughters, not just about the daughters. And she came back and we spoke to Nitesh Tiwari. We just made a film with him just before that Chillat party. He loved the story. He went away and wrote a great screenplay. And then we started brainstorming on who to cast. And at that time, of course, Irfan was someone that we'd worked with already on Pan Singh Tomar and Metro and so many. He was someone we had in mind. He would have done a wonderful job. But then I got a call from Amir at that time saying that, he had time to sort of listen to scripts. And I immediately thought, what about this for him? And that's one call that actually really helped, because I think he was able to see the potential in it. Many other stars of his stature might not have been okay with playing an overweight wrestler who's a bit of a has-been, who's living out his dreams through his daughters.
Yeah.
But he immediately saw the potential in it. Of course, in typical Amir style, he asked us if we'd wait for 5 years.
What was your response?
Our response was absolutely, because I think when you know him well enough, you know that he might say that, but it might be difficult for him to resist something that he loves that much. And so pretty much after a year after him saying yes, 5 years later, he came back and said he'd do it.
I think my research tells me been involved with 6 Indian movies that have made it to the Oscars.
Yeah.
So why do you think, or what do you believe has been that, the ingredient or the secret sauce that you've kind of meshed into the work that you did for these films to make it where they did?
Well, it's hard for me to be able to define that. I think it comes from the sensibility probably of the choices that one makes along the way. And thankfully, those are the ones that get selected by the Film Federation of India to be the ones that get sent for the Academy Awards. But it probably is because one has a bit of a global outlook on things. And I'm always looking for ways in which to be associated with content that has the ability to resonate beyond our borders. That probably might be the reason.
Speaking of the Oscars, the rules have changed now. You're going to have to watch every movie.
Every movie, I know.
Movie. But what do you believe that? Do you believe that that's a good thing to do? And how do you see this changing things?
I do actually think that's a good thing to do, because I think it's only fair for a film to get judged as compared to everything else. And it's probably not okay for members to be able to vote, having watched only 10 or 15 of the films that are up for grabs. So it's definitely going to be a much more demanding process of the Academy members. But I was watching a lot of those movies anyway, so I think for me it shouldn't be too bad.
How much time do you actually spend consuming?
A lot. And firstly, I just enjoy consuming content. I think whether or not I was in this business, I'd still be doing it.
You do it irrespective.
Exactly.
Yeah.
I mean, I grew up watching copious amounts of films, so that in that sense, nothing's changed.
Nothing's changed, but a lot has changed as far as this business is concerned, and that's what I want to talk to you about. Where do you believe we're at? As I said, we've gone through that phase of corporatization. We've gone through a phase of consolidation now, especially as far as the television side of the business is concerned. Where do you believe the industry finds itself today?
It's at an interesting crossroads today. I think we've gone through a period of consolidation in the last couple of years, where you've seen a lot of consolidation amongst the top sort of corporates in the space, which has led to a certain less aggression in the calls being taken, the number of things being made, etc. Probably because organizations tend to go a little quiet when they are consolidating, merging, acquiring, etc., etc. And I dare say now that water's found its own level on that score, I think the next few months are going to see a lot more activity. The second part, of course, is that consumer habits have changed, and we have to acknowledge that. So I think what COVID did is really made people realize how convenient it is to be able to watch content at the tip of your fingertips.
Yeah.
And now to get out of that cycle takes much more. So to get someone to pay money to watch a film in a cinema hall, to go through the effort of booking the ticket, getting out of their house, braving the traffic, braving the ads that come before the film, braving an interval, all those things, it needs to be something really compelling. And which is why you've been seeing in the last few months a bit of a feast or famine situation. So the films that are doing well are doing incredibly well. I dare say they're doing better than they might have done even before COVID.
Okay.
But the films that are not working now have no flaw to how badly they can do. Which therefore means that the game has been upped as far as we're concerned, and which is a good challenge for us, because it means we need to give people something compelling, and then they will come.
Speaking about giving people something compelling, there seems to be almost a disconnect between what audiences want and what filmmakers are delivering. And why do you believe that's the case?
Probably in Hindi cinema, what has happened in the last few years is that we've been trying to be all things to all people, and therefore becoming nothing for no one, in a sense, right? Because we have such a large audience we believe we need to cater to, it becomes a little difficult for us to be able to figure out who our core audience is. And I know that's a little bit of a broad thing to say, but writers need to just write based on what the story they want to tell, and don't let that get diluted by feeling like I need to reach this audience and that audience, and the cities and the villages and the rural and the urban and the global. Just tell the story that you want to tell, and tell it with complete conviction. And I think then you will realize that audiences will come.
So do you expect 2025 to be a better year, both in terms of the quality of content as well as the pipeline of content? Because we've had a problem with both post-COVID.
I think so. I think 2023 was an incredible year. I mean, you had 5 movies crossing the 500 crore mark in the box office, which has never happened in Indian cinema before. 24 was a little bit of a lower year, and now 25, I'm hoping, will once again prove that, the audiences have come back to the cinema halls. Because for the movies that work, like I said, the sky's the limit today. And that gives me a lot of hope that if, the big movies this year fire and do incredibly well, and you always have a few surprises. So some of the smaller movies come in and just, like 12th Fail or like Munjia, for example, come and just surprise you. That really is the hope.
Speaking about making strategic bets at this point in time, and I want to talk about the economics of putting something together, either for the cinemas or for OTT at this point in time. What are the challenges as a producer for you? And do you believe that the costs will have to be reimagined as well and be repurposed for this new reality that we're talking about?
I do think so. And to some extent, we're already seeing a little bit of recalibration there when it comes to costs of actors, of heads of department.
Actors are taking salary cuts.
Well, I wouldn't say salary cuts, but they're definitely looking at now coming in more on the back end and taking less on the front end.
So, what does that mean exactly?
So which means actually enjoying the success of the film if it works. So taking less upfront and then becoming partners in the success.
So it's going to become more revenue share going forward?
Yes. So there's a component of obviously, something that's built into the cost already, which is a fee. And then there's sharing in the profit. And therefore, the upfront fee can be lower to reduce the cost of the project.
Yeah.
And then in success, everyone gains. So that I think is becoming much more prevalent as we go forward.
How much is the cost of talent of the key stars as part of the overall mix as far as costs are concerned for perhaps a big project?
If it's a big project, it could be as much as 30 to 40%.
30 to 40% is just the actor's cost?
Yeah. The lead actors. But, when you look at it, a lot of the viability of that project is based on those actors being in it. So I think when you look at it that way, you take out the drama from it and you take out the fact that, oh wow, it is 30 and 40% paid out to individuals. It's the same thing in Hollywood as well, right? If Tom Cruise is doing Top Gun, Maverick, a lot of that budget of Top Gun Maverick is going to be his fee, right? But that's because that film is going to get a massive opening because of Tom Cruise. And it's the same thing with our films. I mean, if Salman Khan or Amir Khan or Shah Rukh Khan or Hrithik Roshan are in a film, a lot of the economics are based on their presence in the film.
What about women?
Yeah.
Are the women getting paid any better?
They are getting paid better, but there's always room for more,
nowhere close to
parity.
Yeah. What is the difference that we're talking about today?
It's quite significant. I mean, if you looked at it completely, without any